Okay, let's talk about these markets. London's about to reopen. We were off yesterday. We weren't, but you were. And as a result of which, we're going to see the market gapping down a little bit at the get-go. So the FTSE 100's got a bit to price in. Ignore the FTSE, basically. It doesn't tell you very much about today. It tells you more about yesterday. Elsewhere around Europe, though, we are anticipating that we are going to see a fairly flat session. There are a significant number of stocks that need to be priced in as well that have reported numbers this morning, fairly big names. Some of the banking names in particular are going to be in focus. It'd be interesting to see how HSBC, though, does maybe impact the FTSE 100 this morning. It's obviously a significant weight in that index. Stock 600 is barely budging this morning, so we're down by 0.1%. The IBEX opens flat, the CAC opens fairly flat as well, down by 0.2%. The FTSE is the outlier, but we can ignore that. The DAX may take a while to get going this morning. Number of names reporting numbers there. And the SMI, the inflation story, is beginning to pick up even in Switzerland, I note this morning. Right, Tom, what have you got on the sector front?
On the sectors, top of the list right now is energy, up 0.7%. So oil prices, of course, in focus. The volatility's come through. Brent is actually trading down 0.7, but at 113, so higher, of course, over the last 12 hours. So energy at the top of the list, up 0.6%. Construction materials up 0.5%. On the downside, pressure once again on the travel and leisure sector, and you can tie that, of course, to higher energy prices. So that sector is feeling a bit of pressure today, a bit of pain, down 1.1% so far. Banks, of course, with the mixed results coming through. Strength for UniCredit, but weakness for the likes of HSBC. Currently, that sector is down 1%. You can see HSBC is one of the biggest losers, if not the largest loser within that sector, currently down 5.3%, Anna.
Yeah, absolutely. And so the story of two banks really very obvious this morning. So HSBC down by 5.4%, UniCredit up by 2.7%, and very, very contrasting stories to be told this morning. HSBC taking that charge for, well, fraud-related charge in the UK, secondary securitization exposure, idiosyncratic, according to the CFO. That's part of the story, but they're also taking a charge because of the sort of bigger picture macro risk attached to the war in Ukraine. And UniCredit, on the other hand, beating estimates, and that stock up by 2.7% as it still tries to consolidate across borders in Europe.
Rheinmetall's up, not down. So to speak to that sort of lumpiness we talked about earlier, you are seeing maybe the outlook being the more dominant theme in terms of what the market is looking at this morning. You are going to get, with these big defence orders, some degree of quarter-to-quarter volatility, and I think that probably is what we're seeing this morning. So the market may be looking at the forward-looking indicators, and the stock is up by 2.2% as we speak.
Let's talk about what's happening in these global markets then. Madison Fowler joins us, Global Investment Strategist at JP Morgan Private Bank. Madison, good to have you with us. And I want to start with, to start with what's happening with the earnings story, because I wonder to what extent you think that that really can compensate for a lack of clarity, a lack of transparency, the inflation threat, the higher energy prices, all of which stem from us watching day after day what is happening in the Strait of Hormuz. But the earnings story has been strong, and the earnings story in the US has been incredibly strong for S&P names versus their history.
Sure. And so I think that when we are looking at the S&P 500's rally from the lows, we've seen a 13% rally, which is really remarkable. That rally happened within 11 trading days. And part of that comes from, the movement towards a de-escalatory scenario, but a lot of it, I think, comes to the fact that earnings are the fuel. So even accounting for revaluation effects, Q1 looks like S&P 500 companies will produce around, call it 15-16% EPS growth. And on top of that, we are seeing a decent amount of breadth in the sense that most sectors are producing earnings growth, and we're also looking at over 80% of the companies that have reported are also noting earnings upward surprises, which is well above the 5-year and 10-year averages. So this is a notably strong earnings season, but of course there are some, I think, conversations to be had around concentration even within that.
Yes, conversations about concentration, so concentration around tech. I wonder how you're thinking about big listings still to come as well, and what that might do to appetite for various names within certain sectors in the States and maybe elsewhere. I mean, the SpaceX IPO is going to be huge. It's supposedly coming the middle of this year sometime. Is the market going to have some kind of indigestion? Is this going to lead to rotation out of other names into this kind of stock? How are you thinking about these big listings?
So I think that this speaks to the overarching theme that we've been monitoring for a number of years, in which companies are staying private for longer, which means they are accruing more value before they eventually do go public. And so I think that that's one reason why we do think it's really prudent for investors to balance both private and public market exposure in their portfolios. But when it comes to equity markets at large, I do think again that brings to the conversation the concentration within public markets, specifically around tech. And we are, I think, believers in that tech story and believe that tech is producing strong earnings growth, and not only that, strong margins on top of that. But I do think that at the same time, it's really important to balance that sector exposure, not just tech, but also industrials, also focused on financials and healthcare. So a play between both scarcity and I think also some value plays as well.
I just want to kind of push on or build on Anna's point about the IPOs of these mega names, the SpaceXs, but also potentially Anthropic is valued at north of $800 billion, so it could be $1 trillion IPO. The liquidity draw and what that does to markets in the back half of this year, if those two events occur, and how investors should think about that in terms of liquidity moving out and heading toward. How does that reshape the market narrative towards the back end of this year?
I think when we, look at any sort of large IPO listing like that, it's going to be really important to gauge what the market sentiment is around that. I think, in the lead up to 2026, we were looking at investors react to IPOs from a more positive standpoint, and so that I think will be ultimately a really good sentiment check for markets as we see these private companies do go public. And of course, we could always see pockets of indigestion as that does occur, but I do think by and large for those investors, the best way to manage that is to ensure that they're balancing both public and private market exposure to navigate through that period of time.
Your first answer reflected on the fact that markets have been assuming a de-escalation when it comes to what's happening in Iran. We're not seeing evidence of that, and if anything, we're seeing evidence of an escalation. What does that, I guess there's a question about what that does to the IPO pipeline potentially later this year, but how comfortable are you with the disconnect in terms of the equity outperformance versus an escalating situation in the US, in Iran, and whether those two factors meet?
So I think we tend to think about the outlook in terms of scenarios. So in a de-escalatory scenario, I think you are looking at an environment in which you are looking at only a modest impact to growth and inflation, so relatively a resilient macro backdrop, which is, I think, offering that fuel and support for earnings, which we think can carry markets higher. I think when you start to talk about other scenarios, perhaps if you see oil north of 100 for the next few months, or if you were to see it gravitate even towards 140, that's a sliding scale of greater risk for both the economy and for markets. We think that kind of middle scenario around 100 is still manageable for equity market investors and for risk assets at large. But of course, I think that also starts to underpin where you focus on. So the U.S. looks more resilient compared to Europe, for instance, which is a more energy intensive economy, and as a result of that, its market would likely struggle a bit more. The scenario in which you'd see oil at 140, that's more of that recessionary type risk. So I think it's about balancing across the range of scenarios, and we want to be prepared for all of those. So that means positioning for upside, but also I think allocating towards shock absorbers. So you can think of fixed income if you were to see that downside growth scenario, but also inflation real assets if you were to see more inflationary type risks persist.
What do you think of a US 30-year at 5%? You talk about kind of balancing a portfolio. Can I do it in bonds? Do bonds work if we're going to see higher yields?
So I think that it comes down to, where you focus on within fixed income. So as we've seen, longer dated bond yields rise over the course of the past few years, not just around this scenario, but around rising fiscal risks, volatile inflation, questions around central bank independence, that has all been really reflected in a rise in term premia, which is why I think we've been more focused on that short to intermediate part of the yield curve. And I think as we've looked at a really hawkish repricing in central banks, especially from the ECB and the BOE, that leads us, I think, to focus on that 5-year and in space, because we think there's a little bit of a mispricing there without, I think, actually acknowledging that there are also downside risks to growth as a result of this conflict. So I think the market right now is focusing overly so on the inflationary risk.
But if I worry about equity markets and what is happening in terms of a scenario where we go from kind of 100 to 140, are front-end bonds the best protection against that move?
So I think if you were to see a move from 100 to 140, that's where you, I think, see some real demand destruction actually start to hit the economy, and that recessionary outcome, which would actually drive growth lower and, in our view, force central banks to cut. That actually more difficult scenario is actually that middle one where you're just in the stasis of persistent inflationary pressure.
Madison, does that mean then you see some of the European government bond markets as mispriced right now in the Euro? So do you think we're assuming too many hikes, that it won't be possible for European government bond market or European central banks rather to execute all the hikes that are priced in?
Yeah, I think that's right. And I think even within that, you are looking at different degrees of patience that central banks can employ. So when you're looking at, the ECB, they came into this conflict in a bit of a different place where they had gotten inflation back already pretty much in line with its target. Growth was actually improving. And so I think as a result of that, that means that, they might preemptively move a bit more. But 3 hikes, I think, still seems too much for us, given the fact that we haven't necessarily seen that pass through into core. What's really interesting, I think, is when you start to talk about the gilt market and what the BOE might do, given the fact that, yes, inflation is sticky, and yes, I think that you are looking at pronounced, risk around inflation expectations, but at the same time, that stagflationary type risk and the growth impact and that softness that might be felt, and we're already seeing it happening in the labor market within the UK, that to us signals that the, BOE should really, I think, consider some of those downside risks to growth in the months ahead. So I think that does look like an opportune moment for investors to consider the gilt market.
Well, we're looking at the gilt market today, and there's the catch-up from Monday, obviously. So you're seeing gilts selling off, and yields are up between 7 and 9 basis points. So 9 at the front end and 7 at the back end. And the 10-year is now above 5%, so 5.04, so levels we haven't seen since 2008 in terms of yields. And that is obviously a constraint on the Chancellor with all those fiscal ramifications of that. So how close are we to kind of calling stagnation in the UK with yields at these levels, with the energy shock, and with a lack of fiscal impulse coming through?
I think we're still navigating a very uncertain environment, but I do think at the same time, when we look at the market pricing and what we know today, it does appear that, if we were to consider the fact that, yes, inflation expectations have risen, but there are downside risks to growth, for us it seems that the, BOE is more likely to perhaps hike once this year, but even might need to consider cutting next year, if that were...
Do you see gilts higher from here, or...?
Of course, we could see...
Sorry, yields higher.
Yeah, so I think that, of course, we could always see, short-term spikes higher, but our view over the course of the next 12 months is for gilt yields to fall. And so we would be of the mindset that you should be focusing on, the 5-year space and when it comes to investing.
Nice to see you. Thanks for stopping by.
Thank you.
Global investment strategist at JP Morgan Private Bank. Core 6 looks like this morning. You've got a number of big names out there that are worth focusing on. HSBC is one of them. Rheinmetall is another one. As you can see, Rheinmetall is up this morning, despite maybe disappointing initial sales numbers and quarterly reporting numbers coming through. The outlook much more positive. The market seems to be looking there. ASML is also higher. Let's get some details on what is happening in the banking sector and elsewhere. Chloe, here with the details.
Good morning, guys. HSBC is down quite significantly, more than 5% this morning after profit missed estimates. And that was tied to a fraud-related charge in the UK, but also to other charges related to the deteriorating economic outlook because of the situation in the Middle East. And so this profit missing estimates is really dragging down those shares this morning. Moving on to another banking story, which is a little bit more positive. And we've got UniCredit hitting a record of profit thanks to fee income in particular. And that position UniCredit quite well ahead of its takeover bid for Commerzbank, and we are up quite strongly this morning, about 3% for that bank. We are also up for AB InBev, the beer company, and that is because there has been actually quite good volume growth, quite good beer demand in Mexico, Colombia, and Peru, and it's also a company that's really benefiting from its decision to diversify its portfolio beyond beer as well. And so we're seeing quite good results, and therefore shares up quite strongly, about 6% this morning. Fresenius Medical Care is not having that good of a day. This is a dialysis company. It reported lower than expected profit, and that was due in particular to some weakness in the U.S. market, which is a really key market. It was down. Now it's unchanged, but it was down at the open this morning. And finally, Vodafone is up after CK Hutchinson decided to agree to sell its stake in Vodafone 3, which is the UK's largest mobile operator, for $5.8 billion. And so we are seeing this big M&A story driving those shares this morning, and we are up about 1% for Vodafone.
Thank you very much indeed, Chloe Melick, with some of the stocks on the move today. Coming up, UniCredit shares on the rise, as Chloe was saying, after reporting a record quarterly profit, while Sabadell and HSBC slump on first quarter misses. We're going to discuss the outlook then for European banks. We'll bring some more insight and more detail after the break. This is Bloomberg.
Tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
Bringing you up-to-the-minute automotive news whenever and wherever it happens. I'm Matt Miller in Detroit, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Earnings season is here.
Certainly valuations have shifted quite significantly.
Maybe a bit of optimism.
Bloomberg is first to break the numbers.
We're talking about a move away from U.S. assets. So much corporate issuance.
Let's get the reaction and context.
With the smartest insights.
We're observing what's happening in the Middle East.
The situation is volatile.
We're closely monitoring the impacts on supply chain and logistics.
Cross-border M&A, still such a difficult thing to get done in Europe.
Continuing coverage on Bloomberg.
Tuesday morning, good morning, welcome back. We are 18 minutes into the equity market session here in Europe. At a headline level, actually not a great deal to report. London playing a little bit of catch-up on the sector front. Telecoms and technology, the two leading sectors. On the downside, banks and basic resources. So at least we've got some alliteration to talk about.
Yes, indeed. Let us focus on those banks then, shall we? We've got HSBC, UniCredit, Sabadell, all in focus because we have numbers out from all of these businesses. UniCredit certainly ploughing its own path. It's a miss for HSBC after Europe's largest lender set aside funds for fraud-related exposure and flagged the impact of the Middle East conflict. Let's bring in Tom Metcalf, our EMEA Finance Managing Editor, who can talk us through some of the dynamics at play here. Let's start with HSBC. Credit losses there and a big focus on what they've had to say about the UK.
Yeah, exactly, and a big surprise. No one really had in their expectations a 400 million provision against what they're describing, as a loss against a UK fraud. So a lot of question marks about who that firm is. HSBC not saying. What they have said is it's basically kind of an indirect exposure. So they have lent to a private equity firm, which is then exposed to whatever this UK fraud is. But that is really what's dragging down the shares, along with, pretty negative sort of signalling around the exposure to Middle East and, the fact that, they are expecting that situation to just kind of continue to drag on the business.
Good morning for UniCredit, though.
Yeah, very good. And, what a week, because they're just starting their sort of lowball offer for Commerzbank. So it's kind of the results that Lowball probably wanted. Yes, exactly. Definitely lowball. It's 10% below the Commerzbank's market cap.
Yeah. So does this help? Presumably this helps that process?
I think it just underlines, what a tight ship all Shell is running. And, over the weekend, they had all the shareholders basically coming out and, supporting, the move of Commerzbank. You can understand why, because, so far, everything all Shell's done, he's basically been able to achieve. So really simplified that bank, really, focused on returns. So I think it just goes to show, UniCredit's all going in one direction at the moment, the one that all Shell wants.
What about Sabadell and Spain? What's happening in the Spanish banking space with Sabadell and their numbers?
So that's the most fascinating story maybe of all, because they just sold the TSB unit. So these results are a little bit difficult to unpick because you're pulling out all the TSB results. But again, shares slightly down. It just looks like, their whole story now is we're, kind of stronger as an independent bank. So, it's a good job we weren't bought by BBVA. And it's always interesting to see the results because, with shares down, it just kind of sort of undermine that sort of narrative a bit that they're trying to push, that, we're bigger, stronger, separately.
We are a decent way through now, the European corporates reporting season, and the banks, we've got most of the banks.
Yeah.
What are they telling us about the European economy? What are they telling us about the impact of what is happening in Iran and the credit story and the recession risk that is growing and the story around the ECB? Is there a kind of macro picture that I can take away from what these banks are telling us?
So I think that there's no one through line from all the banks. Not all the banks, for example, like HSBC today, the French banks are sort of maybe overly flagging sort of, there is risks here from the Middle East, the macro picture. But that would probably be my takeaway. We don't expect kind of a unilateral approach. But the fact you got some of these big banks and the banks that most expose, HSBC, for instance, starting to raise those warning flags. I'm coming out of this set of earnings for banks, at least, a little bit more pessimistic and, not unduly, not sort of, oh gosh, it's sort of crisis time, but it's more probably sort of disappointing times ahead, I suspect, for some of these banks.
Yeah, and it takes us back to the question as to how long this conflict continues and exposure, and to what extent the next quarter these kind of numbers have to be factored in as well. Tom Metcalf, thank you very much indeed, with some analysis and detail around some pretty interesting bank earnings coming through today from Sabadell, HSBC, of course, and UniCredit. To the defence space now, Rheinmetall reporting prelim first quarter sales that missed expectations. As you can see, though, the stock is up 1.4%. Despite that, Germany's largest defence company expects first half revenues to favour the second quarter, supported by truck deliveries to Germany and the resumption of production at a Spanish ammunition plant following an earlier accident. Joining us now is Bloomberg's chief Europe correspondent Oliver Crook, who follows the defence space very closely. Ollie, how surprised should we be then by this earnings miss from Rheinmetall, given the kind of the overarching theme of increased defence spend?
Yeah, I think the overarching theme stays pretty stable. I think now it's a job for investors to try to sort of manage that versus expectations because, of course, the broad macro story isn't going to change dramatically. So I'll go through some of the numbers here we got from Rheinmetall in the first quarter. As you say, revenue estimate that missed estimates, $1.9 billion. It was estimated to come in at 2.3, so a miss of about 500 million on the revenue side. But again, looking at full year sales, the expectation is still to be up 40 to 45% this year. You look at the margins, they came in at in line with expectations at 11.6%. 6%. But again, operating margins for the full year still projected to go up to 19%. And again, when you look at that all-important backlog, this is how much is sitting on their order books, 73 billion euros in the first quarter of this year. But again, we're looking at the longer term for Rheinmetall. As you can see there on the screen, 1 year it's down basically 13%, down about 10% this year. But again, going back to the beginning of the war in Ukraine, the beginning of 2022, this is a stock that's rallied 1,570%. So again, the broad story is still intact, but there's going to be some more adjustments in pricing.
Yes, and Ollie, there's a lot of expectation then in that broad story that increased government defence spending is going to have an impact on this business and on this sector. How far through that story are we?
Yeah, we're still in the sort of foothills of that. We're still at the very beginning of that. That German funding, you know, we're talking about defense spending over the next decade or so. But again, the question is how much of this has the market already priced in? Are we sort of past the peak for a lot of these names within the European defense space? What I thought was very interesting was that after this war in Iran began, you didn't really see a rally at all in European defense stocks. You see it as relatively flat. And in fact, that's the case for many of the stocks that we saw over in the United States. So I think there is a much broader question, despite the fact that these sort of tailwinds remain intact for the industry, that maybe the market kind of got to where it needed to get in terms of the pricing. Again, we could obviously see that reprice pretty radically given just the moves and the shifts that we've seen so far. But again, the story for the last year has been more trading sideways.
Okay, we're not done yet. Leonardo's coming up, Hensoldt's coming up. Ollie, any expectations? What should we be looking for?
Yeah, for Leonardo, what's very interesting is you had that reshuffle at the very top. You had Giorgia Meloni effectively replacing the CEO of Leonardo because of some of the differences that they had. You know, the former CEO barely seen as a sort of independent thinker, not really taking his cues from the government, something that Meloni really pushed back against. So now you have a new CEO replaced about a month ago, so you're going to get some new direction potentially in terms of the guidance where the business is going to go and what his sort of vision for that business is. And of course, Hensoldt, something that we watch very, very closely. They do all the radars, the kinds of things that you're really going to need if you're under missile attack, which of course has been part of the story in the Middle East and out of Iran and many of the other Gulf countries that now need to have improved sort of surveillance, sensors, but of course air defense. So that's a conversation we'll have with the CEO of Hensoldt tomorrow to see kind of how the war in Iran has changed their sort of picture for their business and what they're pushing into.
Mr. Crook, thank you very much indeed. Our Chief Europe Correspondent, Oliver Crook, joining us from Brussels. Stay tuned. We are going to have that conversation with the CEO of Hensoldt, 6:15 a.m. London time tomorrow morning.
Yeah, it's really interesting, isn't it? The timing with which this defence spending is secured and comes through, and whether that matches up with what investors are expecting or not. We've seen incredible gains for these defence companies, but volatility could also be part of that understanding.
Yeah, and Guy's been talking about the fact that these are quite chunky and they come through lumpy, I think is the way to describe it. They have this massive backlog, and they still see earnings going up to 19% from around, what, 11% now? So the margin story improves. They have that backlog, but it's getting it out.
They're trading on massive multiples, these stocks now. I've come a long way very, very quickly.
Yeah,
so you've got to deliver now.
Absolutely. So we'll look to the earnings story to continue to do that. Coming up on the programme, could technology actually be a boon for private credit as asset managers seek to calm anxiety around exposure to software firms? We'll get into that conversation with Mark Pinto from Moody's Ratings next. This is Bloomberg.
About 80% of projects will find it difficult to secure financing. And this is really all because of the level of readiness or preparation. As you know, for investment to occur, you need well-prepared, technically prepared projects, but they must also demonstrate economic and financial impact. So one of the major challenges is the stock or availability of bankable projects in countries. Almost all countries have got good plans and ideas, But when you look at the readiness of those projects, that's a major obstacle. And that is why the African Development Bank, through the African Water Facility, invests heavily in upstream preparation of projects to enable countries to have a large pool of investable projects. The second element that is an obstacle is the institutional and regulatory environment in most countries, which make it difficult for investment to happen.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
This is the opening trade. We're 30 minutes into today's session. If you were to strip out the FTSE 100, this would be a pretty optimistic look across the equity markets, particularly compared to yesterday, with losses of around 1%. Today, across the benchmark, you're seeing gains of 0.2%. Over in France, you're seeing upside of around 0.4%, and the DAX in Germany adding 111 points so far. But the FTSE 100 is challenged, down 0.9%. There's the catch-up play, of course, closed yesterday for the bank holiday Monday, but also the banking sector under pressure today, led by the likes of HSBC. Guy, what are you seeing?
Okay, let's talk about what we're seeing internally within these markets. 422 up, 163 down. So basically 2 to 1 in terms of the gainers versus the losers this morning in Europe. But you've got to think about how bad yesterday was and then factor in what we're seeing today. Volume is a little higher, actually. Yesterday, obviously, with London out, very, very low, so we're kind of bouncing back a little bit there. Let's talk about some gainers. AB InBev. Apparently, we're drinking a lot of beer in Mexico right now. There is a World Cup coming. I'm going to factor that in as well to my thinking. Hugo Boss is also trading higher. UniCredit is the one I want to focus on. It is up by 3.23%, really delivering. Really solid numbers coming through in terms of what we are getting out of that company right now. Does it encourage, therefore, the idea that it would be a successful owner of a German bank, which is kind of quite interested in Frankfurt. Fresenius is tracking a little lower this morning. HSBC also low. Just want to kind of just think about HSBC. UK banks are down today. Let's call it circa 2%. So just back that 2% out of the HSBC number just to get more of a real look, because London was closed yesterday. So the London market is down. HSB is down more, but I think you've got to kind of factor in the initial down bit when you look at what we're seeing in terms of the numbers on the screen today. And Rio is also softer today, down by 2.2%. London is playing a little bit of catch-up, Anna.
Guy, let's get an update on some of the other stories we're covering this morning. A fragile 4-week ceasefire in the Strait of Hormuz hangs in the balance after the US and Iran resumed armed hostilities in a flare-up of violence that has also drawn in the UAE. The events have prompted calls for the US and ally Israel to renew attacks on Iran, with the US Senator Lindsey Graham saying Tehran's choice to attack the UAE and cargo ships, quote, more than justifies a big, strong and short response to inflict further damage on Iran's war machine. Australia's central bank has raised its key interest rate for a third consecutive meeting. The policy committee opted to increase the cash rate to 4.35% by a vote of 8 to 1, unwinding all of last year's cycle of monetary easing. The move underscores its determination to tame stubbornly strong inflation and cements its outlier status among global counterparts. And Bloomberg has learned that Apple is considering using Intel and Samsung to manufacture the main processors for its devices in the United States. Such a move would reduce reliance on longtime partner TSMC. Sources say talks, however, have not resulted in any orders so far. Guy.
Going to watch that space very carefully. Let's turn to what is happening in private credit right now. Apollo's John Zito has told Bloomberg that the asset class is the safer place to be as the rise of AI dramatically shifts the environment for, quote, the whole ecosystem of investing. It comes as more investors in business development companies have tried to redeem their shares in recent weeks.
For whatever reason, everyone's acknowledging that we're going to be in a higher vol regime, but they're not acknowledging that credit is actually typically been the safer place to be.
Yes, okay. We're going to kind of take that thought and run with it a little bit. Mark Pinto, Global Head of Private Credit at Moody's Racing, sitting next to us this morning. Good morning.
Good morning.
How are you feeling about private credit? Is this a safer place to be right now?
Well, I can tell you it's certainly an area that's going to grow and continue to grow.
Yep.
The elevated redemptions, as you just mentioned, within the context of the perpetual non-traded BDCs, a very small part of the overall private credit ecosystem, are likely going to continue, but what we learned from this episode is that the structure worked. And that's what I think is really important.
Do we know yet if the structure works? We haven't been through a credit cycle in quite some time.
Right.
The feeling is that maybe we're about to get one, or there's one in the not too distant future. Can I give private credit a tick in the box until we've been through that?
I don't think so. In fact, what we've just gone through now with the elevated redemptions is a test. It is not the test. So this is all about underwriting at the end of the day.
Yes.
And the question is whether or not the private credit lenders have been disciplined. I think one of the things that we've been focusing on recently is this software exposure within the BDCs. So roughly 25% of the average BDC that we rate at Moody's is in software. And as we know, the only free lunch in investing is diversification. And it doesn't feel like when you have 25% of your portfolio in one sector, that doesn't feel very diversified.
And so what do we know about that underwriting and the underwriting discipline? Then, Mark, what do we think we will see as we start to learn more about the underwriting standards that have been applied here?
Well, we are going to see some deterioration, but from a pretty strong point. So if I look at the perpetual non-traded BDCs, it's not a very seasoned portfolio. And if I look at the number of troubled borrowers in that particular cohort, it's just 0.5% are troubled borrowers today. That's likely to normalize, mean revert. And the question is whether or not this goes beyond that. And really only time will tell.
Only time. So that sounds like a small number. Is that the number I need to know if I'm thinking about whether anything that happens in private credit becomes systemic or not?
Yeah, well, let me contrast that with the publicly traded BDCs, which also have a significant exposure to software. There, the troubled borrower number is about 2%, so significantly higher, but it's down from 2.5%. If you look at the software companies today, they have performed quite well. Their revenues are quite strong, but that's somewhat rear view mirror looking, right? So I think what we're going to focus on going forward are billings and client retention. I think these are two early indicators to figure out whether or not these software companies that have been underwritten have staying power.
You've talked about, Mark, you've talked about the fact that you've talked recently about the fact the sector's faced a liquidity crisis, but not yet a credit crisis.
Correct.
What takes us from a liquidity crisis to a credit crisis?
Well, I think the liquidity crisis, if you will, this was a test, and I think the test was passed. Now what we're doing is we're focusing on these troubled borrower numbers, right? So we call them non-accruals. We just have to continue to watch very closely. What's interesting, in the public bond markets, we're seeing defaults come down, and there may be somewhat of a lag in the private credit market. So we typically had thought that maybe when the credit cycle turns, it would turn for everyone at the same time. But it doesn't seem like the two markets are working in sync. So we'll continue to compare and contrast the default numbers we see in the public market as well as default numbers we see in the private markets.
Okay, so there could be kind of match up at some point. There will be a signal. Do you expect us? You see the sector growing?
Yes.
And growing from here.
Yes.
But do we also see more redemptions? until this is cleared out?
Yeah, I think within the BDC market, we will see elevated redemptions between now and the end of the year. But whereas we saw somewhat of a inconsistent response by the private credit lenders. Some were meeting requests at 5%, some at 7%, some at 10%, some at double that number. I think going forward, you'll see a more consistent approach where they'll meet at 5% regardless of the number of requests that are made. They'll meet at 5% and they'll continue to move on from there.
You said a bunch of quite interesting things. I just want to follow up on a few of them. The industry is going to grow.
Yes.
Who is going to grow the industry? Where does the money come from that is going to grow the industry? Because there'd been this kind of assumption that institutional money was kind of reaching its limits and that retail was going to be the next kind of growth leg of this industry.
Yeah.
Does that transition now not happen? And if so, kind of have we reached the limits on institutional?
I would say we haven't reached the limits, and it depends where in the world you are. So in the U.S., we've seen a lot of money from retail investors come in the last 5 years. The numbers are somewhere between $200 and $400 billion. I think there is slightly in retrenchment mode, but I think going forward, we could see them come back in and come back in even a bigger way. The Trump administration recently had an executive order, which the Department of Labor responded to, that would allow private assets into the self-directed retirement programs in the U.S. We call them the 401ks.
Is that a good idea?
I think if it's managed in the context of a target date fund where it is professionally managed, where you or I or my children are not directly going into a private credit fund, but are being helped by an institutional portfolio manager, I think over long term, that could be something that could enhance portfolios.
Right. And so how does that retail investor experience of gating that we've seen recently, what have we learned from that particular dynamic, Mark? Have we learned that retail investors didn't understand the risks and now they do? Or what's the story?
Yeah, I would say that this was a lesson for both the industry and retail investors. What the industry learned is when you take in retail money, that comes with certain risks. So you need to take in that money and there has to be care applied to that. I think what investors learned is that investing in a private credit fund is not like investing in a mutual fund. You can't put your money in on a Friday and take it out on a Monday. So I think it was lessons learned all around, but the disclosures were there. Whether or not they were read or not is another story. It doesn't appear that everyone read them.
Yeah, it's been an education, hasn't it? We're also being educated, it seems, in the hyperscalers and their tapping of private equity in some cases to build out the capacity to kind of move AI forward.
Yeah.
What stands out to you from that dynamic? Are there any risks that are being overlooked? How comfortable are you with the fundraising in that area?
Yeah, so a couple of things. One, John Zito was just talking about this. When he's talking about software and AI, he's talking about the data centers. We at Moody's think that there'll be north of $3 trillion spent on data centers over the next 5 years. The original deals that came out were non-investment grade rated deals from investment grade rated companies. So the Mag 7 are very highly rated for the most part, but what they're trying to do is remain asset light, not asset intensive. So they were building these things and the original deals were non-investment grade. What we saw is that they would dwarf the non-investment grade market if they were to push all of the debt there. So they had to change the structure of the deals, whereby some of the risk was absorbed by the Mag 7 company themselves, whether it's force majeure or insurance. And so I think you're seeing better deals today, investment grade deals, and they have to be investment grade deals in order for them to attract as much money as they would like to. This is a huge build out we've not seen since the railroad build out at the late of the 1800s, early 1900s in the United States.
And it was the debt that caused the problem in that build out of the railroads.
We're going to have to see. There's a lot of scale. There's a lot of investment going on here. The other big difference between the railroads and the data centers is railroads we still have today, right? Data centers, will the technology change and will you end up with stranded assets? We don't think right now you will. We think they're building to what is needed. In fact, there's more of a concern about underinvestment than overinvestment today, but that could change very quickly.
So we've talked about data centers, we've talked a lot about tech this morning. We were also just having a conversation about defense and about the mismatch of expectations perhaps from investors on how quickly these opportunities are going to materialize for defense names. Private credit is an area that is interested in defense opportunities, and defense companies are turning to private credit. How does that story evolve?
So there are really 4 major tailwinds that we see for private credit going forward, particularly in Europe, right? So post-Liberation Day, I like to call it Liquidation Day because that's what it seemed to happen then, you've got a tailwind of defense spending, sustainability, transition, and innovation. And all 4 of these things require a lot of money. Necessity is the mother of invention. Here in Europe, banks dominate. It's nearly the only major source of financing. Regulators actually would like to see more options. Private credit can come in, provide long-dated financing that is bespoke, and that can be done very quickly, and I think you're going to see them really play in these areas.
What's the catalyst to get that done then? Is there something that happens at the regulatory front, or is there something in the markets that changes that dynamic that brings more private credit into Europe to fund that kind of build-out?
Yeah, it's a combination. We recently had a private credit conference here in London, and we had a regulatory panel because regulation is so important to this market, whether it's how to bring in retail investors or how to make sure that when insurance companies invest in private credit, they're doing so in a responsible manner, or how banks lend to private credit funds. Regulators are going to play a very big role. We had someone from the ECB as well as the Bank of England, and I can tell you the session was both scintillating and all about regulation. 2 words.
Those 2 things don't go together.
You would never find those 2 words in the same sentence.
Is this a stigma that it needs to get over in Europe, private credit?
I don't know that it's a stigma. The market is less developed here than it is in the U.S. U.S. banks are used to being disintermediated. We're used to innovating. In fact, in the U.S., banks only provide 25% of the financing of the economy. The opposite is here in Europe. 75% plus is provided by banks. I think in order, again, to meet the capital needs that Europe is facing, they will need more innovation. I see regulators more as backers than blockers, but they want to see this segment of the market grow in a responsible fashion.
Mark, very interesting. Thank you very much indeed for joining us around the set. Mark Pinto, Global Head of Private Credit at Moody's Ratings. Coming up, the US and Iran exchange fire in a flare-up of violence, casting doubt on the fate of a 4-week ceasefire. The latest next. This is Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Is the opening trade. Now, the US and Iran exchanged fire in a flare-up of violence that also drew in the UAE. All of this in the past 24 hours, prompting calls for renewed strikes on Iranian targets and casting doubt on the fate of a 4-week ceasefire. The US military says it fought off attacks from Iranian drones, missiles and armed small boats as it facilitated the passage of 2 US-flagged vessels through the strait. Oil is edging slightly lower after sharp gains on the fresh round of hostilities. The US president striking a positive tone, saying prices could be worse.
Can't let Iran have a nuclear weapon. We hit all new highs, and I said we have to take care of business because we can't let that happen. So we did a little detour, and it's working out very nicely. They thought that energy would be at $300, right? $300 a barrel, and it's like at 100. And I think going down, and I see it going down very substantially when this is over, Chris, and I think very rapidly too.
Let's bring in Bloomberg Horizons anchor Germana Basecci, who can take us through, Germana, the latest flare-ups and the stress that the ceasefire is very obviously under right now.
Yeah, that's right. I will tell you, though, this morning it has been quiet in the region. Again, it could be the calm before the storm as we wait for President Trump to wake up. But yesterday was a very different situation. And hours after President Trump announced this new plan, Project Freedom, to help guide vessels through the Strait of Hormuz, what you started seeing was repeated attempted attacks on vessels that were looking to pass through the strait. In the afternoon, we reported on an ADNOC vessel. This is the energy company of the UAE that was targeted by one of those drones from Iran, causing a fire there. Later in the evening, UAE residents, and of course I'm one of them, we live here, we received multiple missile alert texts, and this is the first time we received these texts since the ceasefire went into place about 4 weeks ago. Later in the evening, the Ministry of Defense said that they had intercepted 14 missiles and 4 drones in the course of 12 hours. And again, one of those drones managed to intercept the air defense system and cause damage at an oil export terminal in Fujairah. So that really takes us back to sort of the status quo that existed around the time of the war. Now, as I mentioned at the beginning of this, it has been quiet this morning, and there are questions about where we go from here. Obviously, you know, the battle had moved to the strait, so to speak, with vessels attempting to pass, with the U.S. saying this morning that 2 of their destroyers had managed to navigate through successfully. But I think what's happening there really underscores the serious amount of danger that ships and ship owners would be subjecting themselves to should they want to make that move, even with this new project that was put in place by Trump. And at the same time, the Iranian side have come back this morning, once again insisting that there is a new protocol. The Ghalibaf, the Speaker of the Parliament, was saying that there's a new equation for the Strait of Hormuz. And the Iranian Foreign Minister also saying this morning that there is no military solution to a political crisis. Project Freedom is Project Deadlock. So once again, we are in this impasse, but we have to wait and see what the U.S. decide to do from here. Should they go down the military route, or once again try to pursue the path of diplomacy, maintain the blockade in place in hopes that it will push Iran to make further concessions?
Okay, tensions are clearly very high. Still, Bloomberg Horizons anchor Jemana Pasechi, thank you for that update out of the region. Let's look ahead to what else we are watching throughout the day. ECOFIN ministers will be meeting in Brussels. The Milken Institute Global Conference continues. We're going to hear from BlackRock's Larry Fink and Brookfield's Bruce Flatt. And at 3 p.m. UK time, data out of the US, ISM services and jolts on the labour market front, and earnings out of the US. Pfizer before the market, and AMG, of course, with a gauge on the demand for AI accelerators. And later on the macro front, Fed speak from Michelle Bowman and Michael Barr.
Yeah, lots coming up. Still plenty to think about as we work our way through this week. Let's get a kind of sense of where we are, though, this Tuesday morning. Oil has climbed and has stayed reasonably elevated. Yields are elevated. Equity markets having a little think about what comes next. Bloomberg M Live, Adam Linton joins us now. If I can get that out. Good morning.
Good morning.
So the UK comes back. We've had fighting in the Gulf yesterday. We've got yields in the US that are kind of on a 30-year tenor now at 5%. Oil is up. Can equity markets continue to look to tech? Or do we now have to spend a little bit more time thinking about what is happening here?
I think if you look at different regions, you get a bit of a hint as to what's actually going on. So, in previous shows, we've talked quite at length about how Europe has a relatively meagre tech sector. So if you look at that kind of essentially strips out the tech effect for you. And, if you look at, on a 1-month chart, since the ceasefire was like, initial pop higher, but since then we've kind of drifted a little bit lower. So that's kind of a tell that clearly something is acting as a drag on Europe. Europe's, economic exposure to high energy prices is a concern. We've seen, the back end prices of the oil curve continue to move higher. ECB expected to tighten in, and then you've also seen this kind of trade salvo between Europe and US, Trump threatening the auto sector. So I think if anything ex-tech, I think is clearly vulnerable at this stage. But if you look at, Asia, which also has economic exposure, that's been on the 1-month basis far outstripping Europe, and the bounce back is even, rivaled that of the US. So for now, it does appear that, tech sector is enough to keep things going.
Let me talk to you about FX then, Adam, because this has been interesting. There are some periods where interest rate differentials really matter for currencies, and there are other periods where they don't seem to be in the driving seat. And we spoke to an FX guest earlier on who was saying even if we get hikes from the Eurozone, that's not going to support the euro particularly, because the market is going to focus on something else, not just that higher interest rate. How are you thinking about the development there?
Yeah, I'd agree to that fact that, higher interest rates aren't necessarily going to provide support for the euro here on in. Obviously, one thing we're looking at is, the potential growth impact of higher energy prices, moving higher along the curve. That's obviously clearly a headwind for the euro. And as I mentioned to Guy just then, at a time where European industry is already struggling, we've now got the US saying they're going to potentially impose tariffs on certain aspects of the euro area economy. And, we've seen, warnings of stagflation. That will temper some expectations of how much more hawkish repricing we can have for the ECB. It looks relatively toppy at the moment. And, as I was saying to Guy and Tom on Friday, that, if you get a rerun in 2011, we see these interest hikes, unwound relatively quickly, then that would be euro negative. I think if there is an interest differential story, it's actually probably from the US. We're seeing traders ratchet up expectations of, the Fed to potentially hike rates, rightly or wrongly. We don't necessarily know at this stage. US is a lot more economically resilient to higher energy prices. And, it definitely looks as if risks are potentially tilting to downside for euro dollar. Obviously, dollar yen is a huge risk to that call. If you do get more pronounced move lower in dollar yen, that would be definitely a headwind. But, we've seen from the intervention effects so far, they've been relatively futile. So it doesn't appear to be too much of risk on that front.
So, Adam, we saw the 30-year in the US the yield crossing 5% yesterday. Is there another level that you're looking at, either for the 10 or the 30? I mean, there's implications for the US mortgage market. Maybe that's a constraint on Trump's actions. What is it? Is there another level that you're looking at in terms of how far this could run the bond sell-off?
I think it's not necessarily an impact of specific levels at the moment. I think it's momentum. I think if things really feel like they're getting away from us, then that's definitely going to be a cause for concern. Like you said, the 5% thresholds in the 30-year, that's clearly a news headline grabber. But I think, if you see things getting out of hand and Fed tighten expectations fractured higher, then that's clearly a cause for concern.
Adam, thank you very much indeed. Adam Linton of Bloomberg M Live. We have the Milken Institute coverage. That continues, of course. That's it for the opening trade. The Pulse is up next. This is Bloomberg.
the world's second-largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story. This is where your trading day begins.
And this is open interest.
Only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend. This is Bloomberg Television.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Hundreds of ships move away from the Strait of Hormuz and are seen clustering near Dubai as the ceasefire between the U.S. and Iran looks increasingly fragile. HSBC profit misses estimates on a fraud-related charge in the UK and rising uncertainty from the conflict in the Middle East. Plus, Bloomberg learns that Apple is exploring using Intel and Samsung to produce its main processors. So there is a lot going on in the markets. Of course, we'll look at this possible truce. U.S. stocks futures actually rebounding. Again, oil prices at the moment seem to be easing somewhat as traders monitor whether a fragile ceasefire in the Middle East can actually hold. If you look at bonds, they're rising modestly. Brent retreating towards $113 a barrel, easing fears of an inflationary shock that would prompt central banks to raise interest rates. But a lot of the focus is, of course, on the UK and some of the inflation concerns here. That's repricing some of the expectations for what we're seeing BOE do. And you see the FTSE actually down, where the DAX, the CAC, and the FTSE move gaining between 0.6 and 0.7%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, HSBC and Apple topped the corporate headlines this morning. Vivek Paul from Bloomberg and BlackRock Investment Institute, I've given you a new title, BlackRock Investment Institute, also tells us how mega forces are transforming the global economy. But first, a fragile ceasefire between the U.S. and Iran is on tenterhooks after the two sides resumed armed hostilities and a flare-up of violence that has also drawn in the UAE. Let's bring in Bloomberg Horizons anchor Jumana Barsechi with the latest. Jumana, where does this leave the ceasefire and the passage of ships through the Strait of Hormuz?
Well, once again, it is very, very tenuous, this ceasefire, especially if you look at everything that has happened the last 24 hours. I will tell you, Francine, this morning has been pretty quiet. That was not the case for yesterday. And what happened is early in the morning, President Trump announced this new plan, Project Freedom, to help guide vessels through the Strait of Hormuz. Hours later, what you started to see were a significant increase in the number of attacks at vessels attempting to pass through the strait. And even though Later this morning, U.S. CENTCOM announced that 2 U.S. naval destroyers were able to make it through successfully. That was not the case for a South Korean vessel that got damaged, and indeed this ADNOC vessel that we were reporting on yesterday as well that got targeted and hit too. And in the later hours of the evening yesterday, residents in the UAE, myself included, we received these missile alert threats. This is the first time we've received them in over a month since the ceasefire came into being. The Ministry of Defense saying overnight that they had intercepted 15 ballistic missiles and cruise missiles in total, 4 drones. And so an intensification of attacks once again. Now, where we go from here, a big question. There hasn't been a response to speak of in the early hours of this morning. Of course, we're waiting for President Trump to wake up. Yesterday, in an interview with ABC, he was asked whether Iran had violated the ceasefire. He didn't go that far. Of course, he expressed that his unhappiness that Iran continued to defy, especially their blockade around the Strait. But he has 2 choices, ultimately, whether to go down the military escalation route from here, and we've been talking about the accumulation of military assets, and indeed Israel would probably be standing by if there were another resumption or another round of the war. And at the same time, there's also the potential to restart these negotiations. The Iranian foreign minister overnight suggesting that there had been some progress on the negotiations, so offering perhaps a bit of a glimmer of hope that maybe they can go back to the negotiating table. But where things are right now, the Strait is still at an impasse. No vessels have gone through this morning. There's still a lot of danger for any vessels looking to pass. Iran is still maintaining that they have a right to blockade, and U.S. don't seem to want to back down on their blockade either.
Joanna, thank you so much. Bloomberg Horizons anchor Joanna Bercecci there with the very latest. It does really seem like both sides are engaged in a standoff, casting doubt on the ceasefire, with the conflict becoming a test of how well each other's sides endure economic and political stress. Now with us now is Mark Champion, Bloomberg opinion columnist. Mark, you wrote a wonderful column that basically says the risk of Iran war restarting is irrationally high, and you really lay out the fact that this is a conflict testing both sides. So tell us a little bit about why you think the risk of a return to war is irrationally high.
Yes, well, I mean, neither side really has, the reason we have a ceasefire now, we've had it for a month, and even as was noted just now, when President Trump was asked if the ceasefire was broken, when the Iranians had clearly shot at both the UAE for the first time in a month and at U.S. naval vessels. He didn't want to go there. Why doesn't he want to go there? Because there's no very clear, good option for getting the results he wants by going back to war. He can do it. The U.S. is a military superpower. He absolutely has the ability to do it. But there's no, clear exit there, as there hasn't been since the start of the war. The Iranians, for their part, they estimate that they can outlast the U.S., but they too don't really have a good option if it returns to war. They may believe that they can outlast the U.S. in a military conflict as well, but it's I think both sides, and this is the real problem here, significantly underestimate the capabilities of the other side to continue and the readiness of them to continue. What that does is to really reduce the willingness to make the kinds of compromise that you would need to get to a deal. So we're kind of stuck, and the most likely way to unstick it is to go back to war.
Mark, why do you think that Iran's new supreme leader believes his hand is so strong? Because it's unclear to me exactly how strong the regime and how much money they have.
Well, absolutely. I mean, they are. I do think he overestimates his strength. There are people within the regime who are concerned, especially about the economic weakness of Iran. Remember that, earlier this year, before the U.S. and Israel attacked, there were massive protests over the collapse of the rial, the Iranian currency, that had to be put down by extreme force. That is not the sign of a strong regime. It's a sign of a weak one. It's now weaker still And, you know, but he believes, the new Supreme Leader believes, that he can outlast, he doesn't really care about the pain he inflicts on his own people. He believes that he can impose his will on them, you know, with the barrel of a gun. And that and President Trump, will be under pressure at the polls with the elections coming up and from other foreign leaders, other economies, that he will be less able to really stick with it.
Mark, thank you so much. Terrific briefing, as always. Mark Champion there, Bloomberg opinion columnist. Now, Bloomberg has also learned that Apple is considering using Intel and Samsung to manufacture the main processors for its devices to reduce its reliance on its current partner, TSMC. Now, for more, Neil Campling, Bloomberg senior strategist, is here. Neil, thank you as always. So why is Apple actually having these discussions with Intel and Samsung?
So Tim Cook announced last week on the earnings call that they had supply constraints. Right. That's the crux of the matter. There is clearly a shift in terms of looking at the global locations of where manufacturing is taking place. And so Intel and Samsung are now potentially better positioned than they have been in the past to offer a solution to Apple. Now, Samsung has a leading-edge fabrication plant in Texas. Intel is developing one, and TSMC's next-generation plant in Arizona is not ready until 2029. So there are reasons why Apple would like to diversify the supply chain. It's easier said than done. Apple and TSM have been inextricably linked since the iPhone launched. Yeah. Over those 19 years, the stocks have also done very well as well. Apple's up over 6,000%. TSM's up over 3,500%. So the stocks have enjoyed this ride together. They've enjoyed the technology collaboration. And so, you know, we are looking now at options around whether the balance sheets are better at the likes of Intel that could offer a potential solution in the future. Whether they can remains to be seen.
So, Neil, exactly what's behind the supply constraints that the industry is facing today?
So supply constraints are in memory. It's been much talked about. It takes a very long time to get next generation memory up to production. And also the AI data centers are obviously sucking in a lot of the supply that's available. So whether it's on the processors or on the memory or supply constraints maybe on the optical solutions, there are many other technology companies now looking for these solutions, whereas really for the last decade or more, Apple has been the biggest purchaser of all of these semiconductor materials. So Apple needs now to diversify more as it can its supply chain.
Neil, thank you so much. Our Bloomberg senior strategist, Neil Campling. Now, BlackRock says geopolitical fragmentation and the rise of AI are mega forces reshaping an era of economic transformation. Well, Vivek Pol, global head of portfolio research and UK chief investment strategist at BlackRock Investment Institute, joins me now. Vivek, thank you so much for joining us. I mean, there's all of these confluence that actually impacts the UK, maybe more so than other countries. It's inflation, it's energy, it's what we're seeing in the Middle East, and of course, it's AI. Where does it, first of all, do UK assets sit within the wider remit?
Well, I mean, just listening to the conversation thus far this morning, it's amazing how all of the headlines are to do with these mega forces we're talking about, right? It's to do with geopolitics, it's to do with AI. And I guess for the United Kingdom, the geopolitical element has perhaps a disproportionate impact on the path of inflation and therefore the path of interest rates. If you look at where the markets are pricing the outcomes for the United Kingdom now versus the last time the Bank of England's did a monetary policy report just 2 months ago, we went from having effectively markets pricing 2 cuts to markets pricing best part of 3 hikes in the space of a very short period of time, right? The UK is particularly exposed to those dynamics because of its energy reliance, etc. And then when you look at the broader markets, like, you know, the United Kingdom, a large chunk of its large cap is effectively tuned into the global story rather than the domestic story. So when we're talking about the United Kingdom in terms of the big indices, we're talking about a global story. In terms of bond markets in the United Kingdom, look, we've seen massive movements in yields, in the United Kingdom yields over the last few months. But importantly, that's all been at the short end. That's all been to do with cash repricing. And I think the term premier dynamic, the longer dated stuff, hasn't really shifted as much. And I think that's one thing to look out for.
But Vivek, overall, I mean, I guess the concern is that if you look at bonds, they tell you one thing, equity markets tell you one thing, because there's these two tensions where AI presumably will be deflationary, energy costs will presumably go up. So I don't know who you believe in the markets.
Well, I think on that point, I think it's important to think that when would AI be deflationary? Because I think there's a time horizon element to this. I would be of the view, we were of the view that actually for the near period, actually it's inflationary before it's deflationary. If you look at sort of past historical examples of when we've seen big capex spending, you need to see that capex spend to then get the productivity benefits. And we're still in the stage where we're seeing that capex spend. So I think all signs point to higher inflation than the market had been historically expecting. And actually, this is not just the impact of the Iran conflict. If you now look at the data in terms of where we were at in January and February, the slowing of inflation globally actually was perhaps not as great as people were pricing it to be. Yeah. So I think this is a story where we're going to see greater inflationary pressure in the near term before potentially those productivity benefits come.
But is there a belief in the market that actually companies are okay and that the economy is okay? Because given all the headwinds, I'd be a little bit maybe more worried than some of the stock markets are.
Yeah, no, that's a great point. And I think this is where you're seeing that conflict, the confluence, I guess, of those mega forces kind of almost going at opposite ends, right? The first thing to say is the AI story is real, right? So the earnings momentum that we're seeing is real. It's enormous. We're seeing companies deliver. It's solid.
It's based on something.
They're delivering on those revenues, etc., right? So that is a real thing. And in general, I think the U.S. economy is in a comparatively resilient state. Having said all of that, right, the reason why I think markets have been comparatively sanguine thus far is much like I think Neil was saying earlier, the idea that, you know, this is I think the base case for many is that we see some element of a resolution. We see some element of the fact that the Straits of Hormuz open up because the economic incentives of all parties are so strong to make that happen. And conditional on that, you're going to see a positive, comparatively benign outcome in terms of the market pricing. If that was to flip, if markets were to price the fact that that is not going to be the situation we're in, then I think you see a different story.
So what do you buy right now? When you look, for example, at UK, do you believe that we're going to see 3 hikes from the Bank of England? I mean, they're worried, actually, about the state of the economy. And when we were at the Bank of England last week, they were a little bit more shy.
Yeah, so I think we are. I think the marginal move is up, but I think whether or not we see all 3, I think is a separate point, right? I think I think what we've seen from the period of like 2022 onwards is, central bankers don't want to be seen as being behind the curve on this one, right?
Sure.
So that's definitely true. At the same point, at the same time, this is that trade-off in action. This is, I think the previous guest was talking about supply constraints, right? In an environment where you have a world shaped by supply, the sort of narrative that we've been telling, you have that much more difficult decision to make as a policymaker as to prioritizing growth or inflation. My view would be that, yeah, we do see some hikes. Maybe we don't see all of the hikes that are priced into markets today.
Where do you see the most interesting space? I don't know whether there's something in terms of dislocation. I mean, if you believe the AA story is okay, is it on the rate side that you could see some market movements?
Yeah, I think the idea of dislocation kind of gets bandied about a lot. I'm not sure I believe that story, and I'll tell you why, right? So I think if you look at the energy markets and, we see what the longer dated futures are pricing in, it is still effectively one of some element of resolution, right? So the idea of oil settling at below $100 a barrel is still one of resolution. So I don't think there's actually that much of a disconnect in that regard. We've seen bonds reprice because the expectation around rates kind of staying higher for longer or not having as many cuts has changed. I think that's rational. I think in terms of where we'd see the opportunities today, look, again, conditional on this idea that we do see a normalization, that AA story is really strong, and that leads us to be overweight in the near term, both in the US and in emerging markets.
Yeah, Vivek, I mean, my concern is that actually when I speak to the military folks, they don't really see what the way down for escalation is, right? So everybody says, well, President Trump cannot afford gasoline to be at $5 or $6 in all of the states. And on the same side, you say, well, Iran is in really bad shape. They need a deal. But actually getting there seems a lot harder than the markets thought a couple of weeks ago.
I think that's fair. And I think the other point to make is that the longer this goes on for, the longer we're in this sort of suspended animation almost of kind of hoping it normalizes but not yet seeing it, the more discontinuous that shock could be. I think that's an important point to make. I also think that it's really hard for anybody to do a much better job of kind of anticipating the outcomes more than what the market energy futures are saying. So, I mean, it's right to be worried about this. It's right to kind of continually kick the tires on it. But I think at this moment in time, for the reasons mentioned, still the central outcome is likely to be that we see some element of resolution.
What does dollar do in this dynamic?
Well, the dollar's been fascinating, right? If you go back a couple of years now, I mean, you've seen very different performance for it. I mean, I think if this is a global shock, if this is kind of perceived as a global shock, you're probably going to see some element of dollar strength and dollar resilience. I think that's the general norm that we've seen. But I think as we've seen over the last couple of years, it's very much conditional on the nature of the shock and the way markets perceive it. There is no one all-weather diversifier in the way that there was historically. So I think we need to still kind of look at whatever shock occurs through that lens.
Vivek, thanks so much for joining us. Vivek Paul there, Global Head of Portfolio Research and UK Chief Investment Strategist at BlackRock Investment Institute. Coming up, we'll talk to Yu Ji from Chatham House as China-US tensions mount ahead of a meeting between President Trump and President Xi. That's coming up next, and this is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Astonishing day for U.S. technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, President Trump says he's looking forward to meeting the Chinese counterpart Xi Jinping, signaling his plans for the high-stakes summit are still on. That's despite fresh tensions between the world's largest economies on Iran, on Taiwan, and on trade. Now, Yu Ji, Senior Research Fellow on China at the Asia-Pacific Program at Chatham House, joins us now. Thank you for being with us today. What is President Trump, what does he need actually from President Xi?
Thank you, Francine, for having me. I think three things that Trump really wanted from Xi Jinping in this case. Firstly, to quiet down the trade tension. Secondly, hoping that Xi Jinping will be able to help the United States regarding what happened in the Strait of Hormuz. And I think thirdly, what Donald Trump really wanted is really a showman to show that he's able to talk to one of the most powerful person in the world.
So what does that look like? I don't know whether this means that there's going to be more tensions or whether he actually wants to strike a deal almost at all costs. And what does that mean for Iran?
Well, I think for now, what I've seen so far is that China has been playing a rather timid role when it comes to war in Iran and also Strait of Hormuz. Essentially, Beijing does not want to participate too much in order to show that interfere what United States want to do. And I think what really standing from the point of Beijing, what they're really looking for in here, it is really to setting a floor of this bilateral relationship, and which in the past decade or so seems to be going to roller coaster mode. And now they really see the opportunity that President Trump is the only dove, perhaps, within the Trump's cabinet, in order to preserve some sense of minimal stability on this bilateral relationship.
What do we know about how much China is or isn't supporting Iran? And this could be either on energy, but do they actually want the regime to survive? And could the U.S. strike a deal with China on Iran quickly if they needed to?
Well, I think a deal with United States regarding war in Iran is unlikely because overall what China is really concerned is how sustainable this energy supply from Iran and also from other countries would be. But I think secondly, for all these years, and China's relationship with Iran, particularly at the strategic level, is less of a substance, but more of a style, more of the diplomatic rhetoric in terms of strategic partnership. So what we have seen so far is that China really did not really do too much regarding this potential ceasefire. Or the potential wind down of the war for now. So I think it's unlikely that Beijing is able to do a lot regarding to help to quiet down and calm the situation. But I think instead, what Beijing is looking for some sense of minimum stability with Donald Trump for now.
What do you think the best possible outcome of the meeting between President Xi and Trump look like?
Okay, I think the most likely would have seen so far is that even though this is after 9 years of absence of U.S. president to China, so that is already, if they agree to meet with each other, if the summit actually happening, that is already success by itself, firstly. Now, secondly, if the two sides are able to have some kind of reasonable trade framework to agree with each other towards agricultural products, towards fentanyls and so on and so forth, I think that minimal success would be able to reach. I think so far, really judging from the strategic community within Beijing and also from US side, that seems to be the expectation of the summit remain extremely low for now. So really to have a FaceTime between the two men, I would consider that is already a success in itself.
What can you tell us about AI? How far behind are China compared to some of the U.S. companies?
Well, I think China has been catching up quite quickly regarding AI and also regarding other leading technologies. But what I have seen so far is that it seems to be the Chinese companies and also the Chinese authority now begin to using this regulatory tool in order to protect its own AI technology. So what I've seen so far is recently the NDRC stopped the Meta's acquisition towards Manus. And we have also seen over the weekend that MOFCOM has announced blocking certain US companies' access to China's AI technology. So I think what we have seen so far is, yes, on the one hand, China's playing catching up. But I think on the other hand, China is now also began to waging its regulatory tool and more inclined to use it.
Xi, I mean, one of the things that people say, just because of fragmentation, because of geopolitics, is President Xi the real winner? For me, it feels a lot more nuanced than that.
Well, I think Beijing does not really see this as a black and white way. Essentially, I think the key question is what kind of United States does China want and fit for China's interest? I think for China, it would prefer a United States that is gradually declining, but also militarily less adventurous, unlike what President Trump has been doing for now. So I think Beijing is also found themselves and try to figure out exactly, is this the United States that China wanted? Or perhaps China would prefer a United States like in the previous Biden era that is largely play by the rules and respect international rules. So I think Beijing is very much in a two mind in here.
Yuji, thank you so much for joining us, Senior Research Fellow in the Asia-Pacific program there at Chatham House. Now, there is, again, quite a lot going on in the markets. If you look at U.S. futures, they were a little bit wobbly earlier on today. For the moment, they're actually bouncing as traders trying to understand whether this fragile ceasefire in the Middle East can hold. And then global bonds rising pretty modestly. Again, Brent retreating a touch towards $113 a barrel. Coming up, Novonesis beats. We speak with Esther Baguette, the president and chief executive of Novonesis, after the company reported better than expected first quarter results. That interview coming up next, and this is Bloomberg.
is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Hundreds of ships move away from the Strait of Hormuz and are seen clustering near Dubai as a ceasefire between the U.S. and Iran looks increasingly fragile. HSBC profit misses estimates on a fraud-related charge in the UK and rising uncertainty from the conflict in the Middle East. Plus, Bloomberg learns that Apple is exploring using Intel and Samsung to produce its main processors. Now, Novonesis has reported better than expected first quarter results. The Danish maker of industrial enzymes saw a 7% growth in organic revenue and maintained its 2026 organic sales growth. Well, I'm very pleased to say that Esther Baguette, the president and chief executive of Novonesis, joins me now. Esther Baguette, thank you, as always, for giving us a little bit of time in your very, very busy schedule. Given all of the rising competitions in enzymes, but also biologicals, how defensible is your pricing power right now?
Excellent. First, delighted always to be here with you, always making time for the important things, and you are important, so very, very delighted to be here. We live, as you mentioned, in a very volatile environment, but a moment that also shows the relevance and the strength of our offering and the value we create to customers, consumers, and societies around the world. And we see that reflected both on the top line growth, where it grows 7%, mainly from volume, but to your question, also from price. And we see it also reflected with our close conversations with our customers, with also further dialogue on pricing to reflect the increasing costs and dynamics that we see in the current market with the crisis in Middle East, and then feeling very comfortable that the actions in place, they will have lead to no impact to the overall profitability. So, long answer to say the strength and the value that our solutions create has never been stronger. That's true for food, for healthier nutrients, for high protein, for cleaner label. That's true for household care. That's true for bioenergy, where countries are seeking for decoupling for fossil fuels, and the value of higher yields, high efficiency, competitiveness, now it's coupled with energy security and national security.
So you believe that actually pricing hasn't, that you're not feeling extra pressure on pricing?
Oh, we see the pull from our solutions, which is broad-based, and it's innovation and value what we're creating to our customers. Of course, there is alternatives in the market, but the combination that we provide, the unique combination of a broad range of solutions, tailor-made solutions, more than 20% of our revenue comes from innovation, from products that they are launched in less than 5 years. And it's this unique value to give to our customers what gives us strong comfort, the strength of our revenue, the strength of the volume growth, and that's going to continue to stay.
I mean, you have some pretty strong cash generation, so are you prioritizing M&A, or is it going to look through organic investments or giving back to shareholders?
Excellent question. So we always prioritize growth. We continue to invest in innovation and what makes us unique. We continue to invest on CapEx to be able to be the partner of growth for our customers across the globe. Our CapEx investments, they are punctually higher than have been historically on the 12-14% of our revenue to cattle that growth, not only for today, but for tomorrow, deliver on the long-term guidance of 6 to 9%, also aiming to the 9% of the strategic growth period. And for that, we're investing in CapEx. And then the remaining cash, of course, is the optionality of M&A. Would there be an opportunity? But for sure, returning it back to the shareholders and leading to the maximum value shareholder creation.
I mean, where would you see, again, speculation for the moment, but is there a space in M&A that would look attractive right now?
We are focusing on delivering on our promises, and with what we have in our portfolio, we are in a really good place. We are in a good place to deliver the solutions to our customers, continue to outgrow the markets that we present, and we are collecting the fruits of the investment of the past as we continue to investing on the future.
Give me a sense of, when you look at volumes and in general, some of the weaker end markets, for example, some of the categories like bakeries, where do you see the most, I guess, the most weakness? If you break it down segment by segment, is there going to be some softness in the next 12 months or so?
First, and I'm sorry I'm repeating myself, but we see the underlying demand from our solutions strong across all areas. At the same time, we live in the same planet that you do, particularly in North America with softer consumer sentiment. We're starting to see that reflected in human health, where the consumers make preferential choices, and then we see lower leads, lower searches in internet for probiotics and solutions linked to preventive health. But then the underlying drivers for GLP-1, higher protein, healthier nutrients, continued penetration of innovation in household care. And again, I'm repeating, but on bioenergy for countries decoupling from fossil, doubling up on biofuels for national security, those remain strong and will continue to be there.
So talk to me a little bit more specifically about ethanol, Esther. I mean, this is one of the things that have supported also your business. Now it's dependent on regulatory support. It's also, it could, I guess, have a tougher time in some of the mature markets. So how do you see ethanol performing over the next quarters?
We started the year strong, again, with bioenergy, with a strong growth. In North America, continue to outgrow the market that we have done historically in the past, and we continue to outgrow the market, also supported by the increasing exports of North America in other geographies of ethanol. We continue to see the penetration of ethanol in Brazil. We continue to see countries doubling up on ethanol, particularly now even stronger, with the need for countries to decouple from fossil. Biosolutions, biofuels, they enable competitive solutions to fossil-based, they are competitive to gasoline, they are competitive to diesel, and they enable local jobs, and they enable diversification. Right. So this is a magic formula that countries are doubling up. The ones that they invested on that in the past, Brazil, India, Indonesia, even US, they see the benefits today. Yeah. They're doubling up on that direction. And then we see many other countries also rallying towards this direction and moving in the momentum. So good growth, it's going to be a driver of growth for the quarter, but also strong underlying dynamics for the sustainable long-term growth.
Esther, do you think the market is overestimating the risks from higher oil prices and the impact it has specifically on Novo Nordisk?
I would not dare to read how the market estimates us. I can tell you that we feel very good. Yes, we feel very good on how we are today. 7% growth is a really good number against a strong comparable. And then, yes, we're living in a world with uncertainty, but this very good growth and start of the year decreases the downsides of that risks. It puts us in a very good place. And maybe we're choosing to be prudent here and keeping the full range of the guidance in a place of a strong momentum and strong need for biosolutions.
What do you worry about the most for the next couple of years? I know you also, your full year outlook, your 2030 targets, which include a 6 to 9% organic sales growth, could be the envy of other companies. What would hurt that guidance going forward?
I like translating worries into focusing on what makes us unique. What makes us unique is our broad market presence, our broad and strong innovation muscle, the capability to connect market needs into innovative, disruptive answers and bringing them up to scale. So what we do is we're doubling up on each. We continue to invest in sales force to be closer to the customer. We continue to invest in application centers. We continue to invest in R&D. We continue to invest on CapEx to be the partner of growth with our customers. And then, with that, connecting the dots and the needs on the market with biosolutions and continue to bring the penetration of what is a stronger answer of the future, we feel very confident on the future ahead.
Esther Baguette, thank you so much, as always, for speaking to us. That was the President and Chief Executive of Novonesis. Now, UniCredit has posted its highest ever quarterly profit, but it's a miss for HSBC after Europe's largest lender set aside funds for fraud-related exposure and flagged the impact of the Middle East conflict. Now, for more analysis, let's bring in Tom Metcalf, our EMEA Finance Managing Editor. Tom, as always, thank you for being with us. So let's start with HSBC. What are your key takeaways from what we found out this morning?
Well, certainly that big surprise 400 million charge. So, seems that is tied to MFS, the specialised UK lender that collapsed earlier. And for me, the most interesting thing there is the way HSBC are describing it is, this is derived almost indirectly. So it's, through their exposure to a private equity firm that itself had lent out effectively to MFS. So, partly because that's a surprise, no surprise for the market are kind of focusing on that. It's a bit of a down market for UK banks anyway, but HSBC shares down really sharply. So for me, this is the first set of quarterly earnings under El Hedri that are really disappointed.
Yeah, but is it definitely a one-off, this fraud-related charge? And actually, this is what the CFO is saying, but for the chief executive trying to turn it around, trim costs, changing some of the benefits, it's not a great look. Yeah, exactly. Yeah, CFO saying very clearly, look, we're comfortable this is a one-off. They've done a review of all their books, not sort of seeing any other similar risks out there. But of course, no one necessarily expected this one, right? So it's one of those really disconcerting moments and, not help that, as I say, kind of just came out of the blue really for most shareholders. Tom, talk to me about UniCredit. So it reported a record quarterly profit. What's behind this performance? Yeah, it's kind of, as we've seen under Orchel, they are laser focused on, making sure that shareholders' returns are, best in class and, continues to operationally, UniCredit itself just deliver, basically. And that's perfect timing because today they are releasing that, what I describe as a lowball offer for Commerzbank. But, it's a really powerful message to be sending, both to UniCredit shareholders, but also Commerzbank shareholders of, look, we are delivering and, we'd be stronger together. And is this a sustainable growth strategy? Because in the past, people are saying, look, he's come in, he's cut costs, or Charles doing a good job on the metric, but it's all low-hanging fruit. Let's see what he has in terms of growing and becoming bigger and better. Has he not proven that? Well, it's hard to say, right? Because, the returns are kind of maxed out, right? Or, close to maxing out. How much further can they go? They're already basically at almost all profit. So, no, that is going to be the ongoing question, but it's probably too soon to know now. And, of course, Orchel's answer will be, we're absolutely fine, that we can definitely continue, but obviously this Commerzbank deal could unlock a whole world of opportunity, at least in Orchel's telling. But as long as the politicians are against it, can he get this done? The momentum is always shifting, and I'd agree, look, if Berlin is really dead set and willing to completely
push back against it, then, that is one thing. I think the reality is probably a bit more mixed in that, no government, in the EU right now wants to be seen as blocking kind of mergers that will help create kind of block-wide champions. So I think Berlin is in a difficult position as well, but obviously, Orchel is not in a sort of position where he's absolutely guaranteed to get this deal done.
So interesting. Tom, thank you so much. Tom Metcalf there, our EMEA Finance Managing Editor. Now, a divided Europe is losing ground in the global crypto race. The bloc is still debating whether to adopt digital euro, but progress has been slow. With the first issuance not expected until 2029, there are also growing concerns that Europe may already be falling behind. Well, the story is the focus of today's Big Take, how the crypto revolution is exposing yet another European weakness. Well, Ana Herrera, Senior Editor on Bloomberg's Crypto and Digital Payments team, joins us now. Ana, as always, it's a great story. I urge everyone to go and see it, because we used to talk about crypto day in, day out, and then now it's kind of like, if you're not a crypto investor, it's not in mainstream news. But what have you and your team uncovered?
So it's really not about the speculative frenzy now, right? You have people talking about digital payments and stable coins that are really not your average person, for example, a central banker. Mm-hmm. And the reason is because cash is declining. And so if you're a central bank, you're seeing all these forms of other payment that are emerging, and you want to make sure that your region is sovereign, right? And think about Europe. When we all take the tube in the mornings, we're all tapping our phone or our cards, and that infrastructure and those companies aren't European. And in a landscape in which Europe is trying to become more sovereign, they're thinking about payments too. And so there's this push to get a digital euro done, which would essentially be a digital form of cash. But being Europe, it's likely going to take a lot of time still. They're aiming for 2029, which in crypto years is like a century, and even just in tech is a decade, basically.
And this would be basically master. But what I don't understand is that they've tried right on the private route, because when I tap, it's PayPal's or it's MasterCard. So they've tried going around the private kind of credit card route in Europe, and that hasn't worked, which is why they're talking about Euro crypto.
So the idea there is that it's all U.S. companies, right? So obviously it's not like they're saying we're going to cut Europe off, but in a situation in which we don't know. Yeah. We all remember with SWIFT and Russia, countries are starting to think about their payment infrastructure as quite strategic and important. So there is a need to have a sovereign one.
So why is Christine Lagarde, the president of the ECB, so behind this?
Because she understands the importance, and much of the urgency has been driven by the fact that with Donald Trump in the U.S., there's been a massive push on stablecoins, which are another side of this, right? You can have your digital dollars that are either central bank backed, or you can have ones that are private sector backed. And so in the U.S., they've gone the private sector route, and you could have a scenario in which people might be holding dollars in Europe rather than euro. And so there's very much this urgency to get something done. The ECB wants to have a central bank backed one, but the private sector now, the European banks are saying, let us do, and they can, we're going to do stable coins and euro-backed stable coins, and it's going to be a good alternative as well. So we'll see what happens.
So Europe is slow. Who benefits?
I mean, everyone. I guess the U.S. primarily with stable coins, right? They account for 99% of all the stable coin issues are dollar-backed ones. And then I guess other countries as well. China has a digital one. Iran is using stable coins also as well. Russia is going to pilot soon or launch soon a central bank digital currency. It's all seen as, as more commerce moves online and cash declines, you need to own your rails and have your rails, right? And so Europe needs to get there and have its rails ready.
Yeah, it's time to get your act together, Europe. I think that's the main message. Anna, thank you so much. Ana Herrera, Senior Editor on Bloomberg's Crypto and Digital Payments team. And I urge everyone to go and read, but also send to friends this wonderful big take on crypto and the place of Europe in it. Now, coming up, from AI data centers to the energy transition, we'll talk to Massimo Battagliani, the chief executive of the cable manufacturing giant Prysmian. That's coming up next, and this is Bloomberg.
Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Welcome back, everyone. Now, the cable manufacturing giant Prysmian is involved in everything from the data center build-out to the energy transition. Its share price has soared over the past few years with high demand, but it also faces the geopolitical uncertainty hanging over global trade. Well, Massimo Battaiani, the chief executive of Prysmian, joins me now here in the studio. Massimo, thank you so much for joining us. I mean, you're kind of in the center of it. And nobody really would have thought 15, 20 years ago that cables were really essential to building all this stuff out that we're trying to. Now, you know, President Trump's administration tweaked tariffs on aluminum imports in April. Does this affect you?
No, not at all. Not yet. No.
How do you see tariffs and trade? I mean, what impacts you?
The tariff was supposed to protect local producers in U.S., and we are a strong local producer in U.S. Yeah. We built significant footprint in U.S. through investment, acquisition, and 99% of what we sell in U.S. is made locally. So we probably benefit in the other way from tariff because importers will have additional charges to their costs they bring it to the U.S. So we should be seeing this in the coming quarters.
So you've also said that you're about to sign agreements with hyperscalers on data centers. How, where, how much?
We increase our presence in the data center space when in 2024 we acquired a large electrification player, cable player in U.S. His name was Anchor Wire. So we became very strong in electrifying data centers in terms of bringing power, electricity for servers and cooling and all the rest. We missed the inside building optical space opportunity. Now with our stronger cable and fiber footprint in U.S., we are kind of unique because most of the other players have production outside the U.S. And, you know, U.S. like local for local production. So hyperscalers have reached out to us for long-term agreement. We have to expand capacity with significant investment, but we're happy to become stronger in the data center case in the moving quarters.
But this would be, what, millions? I mean, can you give us an idea?
We're talking about investment higher than 1.2 billion euros in the next 3 years for revenue stream around $5 billion plus in the next 5 years.
So this would be a huge, actually, also in terms of your capacity increase. It would be significant. Can you give us some of the names of, are they, you know, the big famous hyperscalers?
Yeah, they are the big four, the big names.
We would know them.
Yeah, you know them. Yeah, they are the Microsoft, the Meta, the Googles, and the Amazon. So they all need additional security of cables to continue the data center expansion. And we are unique in the sense that with the power cable that we offer to them and the optical cables, we are the only one providing the full spectrum of value chain components.
So how much would your capacity increase?
We'll increase the capacity in optical cable by 40–50% in the next 2 years to serve this unique opportunity.
So I know you guided towards 2026, and a lot of people thought, hey, hold on, that's very conservative. I mean, do you want to under-promise and over-deliver?
That has been the style of the company thus far. And it's like to be always in the position to beat our guidance. But this year we feel very good at beating our guidance, which has a set midpoint at 2.7 billion. So we see us in the upper part of the range, and of course we have to wait until July, first of all, to wait to land this hyperscaler agreement, and second, because we have a better perspective of the second half of the year by the middle of this year.
But so if you sign the deals with hyperscalers, does your guidance automatically go up?
Of course, most of the impact of this deal will be 27, 28, but yes, I would say that there will be some significant impact already in 26.
Talk to me a little bit about M&A, because you pursued the acquisition of Encore Wire and Channel over the past couple of years. You have a very strong M&A track record. You said you're looking at a few targets. Should we expect something big from you?
Now we have the financial strength to continue to reopen our journey in M&A after the two large acquisitions we made in the past. We want to become even stronger in the electrification business, and U.S. is the strongest market across all regions. We also have some opportunity in optical business for some additional M&A. Yes, I think that in the next 12 months we will be again disclose some good opportunity in the M&A journey.
In the U.S., you're very focused on the U.S.
Is the country that I favor the most. I've been living there for a few years. I appreciate a different type of market. It's very consolidated, is very, very disciplined. Competitors always behave in the proper way, and the profitability is higher than what we had in other regions. So M&A in U.S. is the natural place to be. But of course, we are not neglecting opportunity in other countries, in other regions like Europe or Latam, for example.
But when you talk, when you give us a scale. When you say it's going to be a big acquisition, so there's numbers flying around, right? Bank of America says it could be 10 billion. 10 billion is a lot. Is it 10 billion?
We can, think of something closer to the size of Encore Wire, which was a 4 billion euros sort of enterprise value.
It's a lot.
It's a big one, yes.
So this is going to be a big year for you on so many levels.
We have many opportunities for organic growth. We are just about to disclose our strategic plan where investment are going to be deployed in the next 5 years to expand capacity and capability across all regions, and M&A will be the natural top-up. As you said, we have a good track record. I think we build a good capability of integrating with inclusive approach the company that we acquire, and delivering the synergies, which is what matters our investors in terms of value creation. So we will continue the good combination of organic growth and M&A in the future.
Massimo, from my understanding, you haven't completely ruled out some kind of dual listing project in the U.S. Are you working on that?
We are not working on that. We paused it for a second because we were busy with the Channel acquisition. We will reopen this discussion at the board level. We see a lot of upside by becoming more U.S. in terms of a U.S. listing. Already today, 50% of our EBITDA is generated in U.S. with the organic plant, hyperscalers, and the M&As will become even more reliant on U.S. And this will entitle us to be considered one of them with a U.S. listing.
So you could have, I'm speaking, potentially like a big M&A deal in the U.S., these hyperscalers, and at the same time,
you're probably reading my mind. That would be the best combination.
My dream. Yeah. But so you'd like to do it as a package almost.
Yeah, it would not be a package because there would be some sequence among the two elements, but it would be a nice combination to deal with.
So interesting. Well, I hope this is one of only, the first of many, many interviews to come that we'll have together. Massimo Battaini, thank you so much for joining us, the Prysmian Chief Executive. Now, it is a big day. It's also a big week. So let's look, as always, at the markets to maybe give us a bit indication of what they're expecting with Iran. They're frankly on tenterhooks. If you look at markets overall, look, U.S. stocks, futures are rebounding a touch. Oil prices seem to be easing again a touch, but traders really trying to monitor whether this fragile ceasefire in the Middle East can hold. I'm also looking at global bonds rising modestly. Brent around $113 a barrel. Up next, it's Bloomberg Brief, and this is Bloomberg.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time
sat down with me and said, succession starts now.
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm election.
Hear it first on Bloomberg.
In New York City, 10 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. A ceasefire looking more fragile after the U.S. and Iran exchange attacks overnight in the worst flare-up since the truce began. Apple seeking options beyond TSMC with initial talks with Intel and Samsung for producing processors for its devices. And U.S. stocks set to test new highs as earnings continue, and more data on deck with PMIs and JOLTS this morning. Let's get a check on markets around the world now. First over to Asia and David Savage. David.
Good morning, Bonnie. Generally a quiet session in Asia with markets in Japan, China, and Korea all closed. Asia Pacific Index was slightly lower on the day, led by Hong Kong stocks. Turning to FX on dollar yen, again in focus. But as you can see, it was fairly range-bound for the session, trading around that 157.25. If we turn the board to the main story of the day, RBA raised rates for a third consecutive time, initially leading to an increase for the Aussie dollar, but gave back those gains as Governor Bullock seemed to signal a pause for rate hikes going forward.
All right, that is the picture from Asia. Looks like that first intervention from the Bank of Japan is keeping things on the straight and narrow for now. Goldman Sachs saying that Japan has the capacity to intervene 30 times if necessary. All right, to London, back from the holiday. Let's get over to Justina Lee for a look at markets across Europe. Justina.
Good morning, Vonnie. Now, we're seeing a bit of calm return to European markets today, with the Stoxx Europe 600 up a little bit, German two-year bond yields down a little bit. And of course, all of this is reflecting the fact that oil prices are easing a little bit today. Now, we need a little bit of a special UK market check with kind of London reopening after that holiday yesterday, which means a lot of the price action is still catching up with the bearish kind of circumstances that we saw yesterday. You know, the FTSE 100 is down with kind of that profit miss from HSBC. Now, when it comes to kind of two-year gilt yields, we're seeing a bit of a gain today and also kind of reflecting higher oil prices yesterday. And the fact that, you know, traders are still pricing in more rate hikes from central bank kind of in response to that higher inflation picture.
And we're only going to continue to see that. Let's take a look at U.S. index futures. They are pointed higher, much higher today. Just one word of caution, the equal-weighted S&P 500 is now lower than the S&P 500 for the year, so it's been down 9 out of 10 recent sessions. Let's take a look at bond yields, which continue to creep higher. We have the 30-year Firmly above 5% yesterday. It continues to stick at that mark. At what point is this going to be very eventful for equities? We are going to ask our guest in a few moments. We have the 10-year yield grinding ever higher as well towards that 450 mark. And oil today, while it did come off its highs a little bit, we're still well above 110 on Brent and elevated on WTI as well. Nevertheless, the VIX still with a 17 handle. Let's get to some individual movers now. Here's Chloe Melly. Chloe.
Good morning, Bonnie. ON Semiconductor is falling in pre-market trading this morning after providing an outlook that seems to indicate a slower than hoped recovery in industrial and auto end markets. And the expectations were really, really high going into the earnings. And so we are seeing that slight disappointment on the numbers translate into quite significant share price weakness for that company this morning. Moving on to Pinterest, which is definitely having a better day in pre-market today. It is up quite significantly, up more than 16% after better than expected results and guidance, and that seems to point to better ad monetization on the platform and some AI investments really starting to pay off as well for that company. And finally, Duolingo is down this morning quite a lot as well after saying that after not providing the outlook boost that a lot of analysts and investors had been expecting. And so we are seeing that disappointment really reflected in the shares this morning, and we're down almost 13% for Duolingo in pre-market.
All right, a massive move there, Chloe. Thank you so much. Chloe Melly there in London. Coming up this hour, we're going to speak with Henrietta Packman of Allspring Global Investments. But first, the US and Iran exchange fire in the Persian Gulf, making the current ceasefire even more fragile. Iran's parliamentary speaker posting on X, quote, "The security of shipping and energy transit has been jeopardized by the United States and its allies. The new equation of the Strait of Hormuz is in the process of being consolidated." Joining us now from Dubai is Jumana Bersachi. Jumana, bring us up to speed with exactly what's happened in the last 24 hours and whether anything has actually changed in terms of stances in the Strait of Hormuz.
Yeah, both very valid questions. Well, a lot has gone down in the last 24 hours, and it wasn't that long ago that we were talking about this so-called Project Freedom. President Trump announced it on Truth Social yesterday morning, which was the U.S.'s plan, or is the U.S.'s plan, to help guide vessels that are stranded in the Persian Gulf safely through the Strait of Hormuz. It was dubbed a humanitarian mission. Now, what happened is after President Trump announced this Project Freedom, we saw multiple attacks and attempted attacks on vessels around the Strait of Hormuz. And most notably, a South Korean vessel got hit. This is something that President Trump mentioned in one of his Truth Social posts yesterday. But then also a tanker associated with ADNOC, that is the UAE energy company, the national energy company over here in the UAE. And towards the evening, what happened is something that we have not seen throughout the course of the last 4 weeks, and residents received missile alert tone warnings, i.e. They were notifications that the UAE air defense system were actively intercepting missiles, and overnight the Ministry of Defense actually did say that they did intercept 15 missiles in total, 4 drones. One of the drones actually managed to break through the air defense system and sustain a considerable amount of damage, we think, at the Fujairah oil terminal facility. There was a fire there, and then 3 nationals were also injured as well. So this is a big flaring up, once again, of the type of hostilities that we saw during the war. Now, I will say throughout the course of this morning, things have been quiet. There hasn't been a retaliation, neither from the UAE in terms of action, but of course in terms of words, they have condemned the Iranian attacks. Nothing also from the U.S. president, but we're waiting to see what he does when he wakes up. But ultimately, you know, in the introduction out to me, you were talking about still the effective closure of the straits. And despite the U.S.'s best efforts here, we've been reporting this morning that contrary to what the U.S. is trying to achieve, many vessels have been actively staying away from the strait because of the still lingering risks and the danger crossing it would constitute. About 50 of them have moved closer towards the Dubai coast and away from the Strait of Hormuz.
All right, so a fraying ceasefire, but perhaps no huge escalation, at least yet. Jumana, thank you so much. Jumana Bersachi in Dubai. Now to a Bloomberg scoop. Apple has held preliminary talks about enlisting Intel and Samsung to produce the main processors for its devices in the US. Bloomberg learning that Apple has concerns about using technology not made by their primary supplier, TSMC, but is trying to adapt to supply chains disruptions constraining company growth. Bloomberg's Neil Campling joins us now. So Neil, Can Intel and Samsung potentially do as good of a job as TSMC for Apple?
What a great question. I'd argue that since the launch of the iPhone 19 years ago, TSM's partnership with Apple has been one of the best the technology industry has ever seen. For Samsung or indeed Intel to try and replicate that is a tough ask. Clearly, the leading edge fabs that you need for the processors for Apple are very, very sophisticated. But at the same time, you have Intel and Samsung that are probably better positioned than they had been for quite some time. Samsung have a facility in Texas, and Intel are developing a new leading edge fab with capital that's coming in from the US government, of course. So, and you also have TSM's new fab that's not ready until 2029. So it could well be a possibility that they offer that opportunity, because we heard from Tim Cook last week that Apple's growth was actually being constrained by the supply of chips and other components. So Apple does need to diversify in many respects. Whether Samsung and Intel offer a viable solution will remain to be seen.
I mean, would it be the case that you could buy an Apple product and you mightn't necessarily know where the chip provenance is?
That's very true. I mean, I think if we look at the inside the guts of the iPhone today, you probably don't even realize who's actually powering that technology. You know, TSM and ARM-based chips have been in there in the past before Apple customized the silicon. So in many respects, it doesn't matter who is producing the chips, as long as they meet the exacting standards that Apple has in that incredible integrated ecosystem that combines software, hardware, chips, memory, and an over-the-air updates in a very seamless production that really has set itself apart in technology over the last 2 decades.
Now, elsewhere, Neil, Meta looking at building a data center in El Paso, going to be up to $13 billion in total costs, and it has to raise debt for that. Will it be able to do that easily?
The previous examples of this, they raised $30 billion last year in a similar kind of deal. There's a lot of appetite for AI, not just in equities, but across other assets as well. Last year's $30 billion was well received. You could probably expect a sort of an anchor investor will transpire in this deal, like PIMCO did for the last one last year. But so they probably won't have a problem in raising these kind of structures to fund these data centers, which have very good, healthy paybacks over the long term, given the incredible need that the data centers require to operate this AI technology.
You know, the New York Times originally reported the Trump administration is considering an executive order to form a working group on AI. In other words, it would sort of vet AI products, I guess, before allowing them, quote unquote, to go to market. How would it work, Neil? Is it doable in, capitalist society?
Yeah, it's difficult to know, isn't it? I mean, we have the advances for the likes of Anthropic with regards to these AI models is at such a breakneck speed. It's very difficult for any government, whether it's the US or the EU, to try and work out exactly where the pinch points are, the problems or the issues that could come around from these kind of models. But they have to create some working parties to try and capture or where the risks are in some of these models, for sure. But technology evolves at such a pace that there's a risk that we could even create a working party to look at a technology that could actually be outdated from a new model that gets updated in the next couple of months. So we'll wait and see whether policy can catch up with technology advances, I think.
All right, Neil, thank you so much. That is Bloomberg's Neil Campling. Now to other top stories trending on the terminal this morning. Alphabet returns to the euro debt market with a $3.5 billion mega bond deal. According to sources, proceeds will be used for general corporate purposes, which may include repayment of outstanding debt. Last February, Alphabet raised nearly $32 billion in sterling and Swiss franc-denominated bonds to fund its AI build-out. Palantir raised its revenue outlook for the year and reported first quarter results that beat analyst estimates. Palantir posted a beat on U.S. government revenue but fell short in U.S. commercial sales. Palantir has long supplied U.S. government agencies such as the Department of Defense and U.S. Immigration and Customs Enforcement, or ICE. Audi's CFO told reporters that President Trump's push for higher tariffs may impact the company's financial performance this year. The company is assessing the potential impact should the president increase levies on European car exports from 25% to 25% from 15%. Coming up, shares of HSBC falling after missing the street's profit estimates. More on that next. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
It's the world's second-largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
I'm Bonnie Quinn in New York. Shares of HSBC are lower this after the lender's profit missed estimates, and that was due to an unexpected fraud-related charge. The CFO saying in the earnings call that she thought the issue was idiosyncratic and that the bank has found no other problems. Joining us now is Bloomberg's Tom Metcalf. I mean, that's going a little bit easy on themselves, right, Tom? It wasn't all thanks to MFS, and also not all of the banks were taken in by MFS.
Yeah, I mean, it's a really interesting set of results today precisely because this charge, about $400 million, is indeed a bit of a surprise. And, you know, yeah, our understanding is it is tied to that collapse of the UK lender MFS. And basically, yeah, HSBC indirectly exposed through sort of a relationship with what it described as a financial sponsor. So I think the biggest thing here is, you know, it's those surprises that shareholders really don't like. So it's no surprise that, you know, the shares in HSBC are down today. Of course, it's other elements you can pick out from the results that are also pushing down the shares. There's the Middle East kind of charge and generally kind of cautious wordings about the outlook there. So not a great first quarter for HSBC, I'd say.
And yet, UniCredit knocked it out of the park. I mean, coming at the best time possible as well for Andrea Rochelle, right?
No, exactly right. Like chalk and cheese, these two set of results. So UniCredit, you know, operationally continuing to look pretty strong. And of course, yes, absolutely perfect time for this set of results, which comes at the same day that UniCredit is releasing its sort of what I would describe as a lowball offer for Commerzbank. But of course, it's very useful messaging to have to sort of back up the narrative that UniCredit and Commerzbank would be better together.
Should we see that anytime soon then, Tom? When do we expect the next stage to happen?
So for the next month or so, this offer will go out. I mean, no one's expecting it to really substantially increase UniCredit's control. They have about 30%. What is likely to happen is they'll creep over 30%. But I guess, you know, it just sets out the stall for the direction of travel over the, you know, coming months on this deal where, you know, Rochelle clearly very keen to eventually find a way of making it happen. But of course, on the other side, Commerzbank making it very, very clear They are not interested, and perhaps even more pertinently, Berlin still showing like no interest in active opposition really to this thing.
All right, Tom, thank you so much. That is Bloomberg's Tom Metcalf. Let's take a look at these markets now as we approach the open for the United States. As you can see, you have your dollar index just ever so slightly stronger, a weaker euro to that point, and then you've got really nothing going on in the British pound. Brent crude up above $113 a barrel. We're off our highs from yesterday, but that's still quite elevated after those tensions again in the last 24 hours surrounding that ceasefire. New York crude above 104, creeping ever higher now, and gold putting on a few dollars. It's above 4,500 an ounce. Bitcoin continues its rise as well. Coming up, the Milken Conference in full swing in Beverly Hills. We'll bring you part of our conversation with PIMCO President Christian Strick next. This is Bloomberg.
In case you missed it, on Bloomberg Crypto.
There's a debate going on right now in DC that I think folks need to start paying more attention to, and that is the yield. And the question really is, who is going to keep the yield? Who makes money off stablecoins? Well, right now, in the case of some of the large stablecoin issuers, there's a yield that on those deposits. So when there's a dollar, for example, deposited in a bank account, there's interest paid on that dollar. And so who's capturing that yield? And I think one of the really interesting things about the Genius Act is that it bans so-called yield-bearing stablecoins from giving that yield directly back to consumers. Now, that's not true everywhere. And I think if consumers have a choice, why would a consumer want an institution to keep that yield? Or would there be sharing of that yield? So right now, one of the debates going on is, will rewards be allowed? And I think these are really important questions.
Don't miss Bloomberg Crypto live Tuesdays.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
Bloomberg Brief. I'm Bonnie Quinn in New York. PIMCO President Christian Strick says investors are continuing to look beyond the U.S. He spoke to Bloomberg's Romain Bostic and Katie Greifeld at the Milken Institute Global Conference. Take a listen.
The high-quality fixed income notion of PIMCO really resonates around the world, as it does in the U.S. It resonates around the world. Same kind of questions. There's a demand for income. There's a demand for something that different in the portfolio. As equities do so well, how do you diversify away from equities? So in some ways, it's very similar. Now, also what we see is
an ask for something other than just the U.S. What else is there? Global fixed income, emerging markets, also alternatives in outside of the United States jurisdictions is another area, real estate, infrastructure, et cetera. So there really is this ask of what more can we do than the U.S., especially because as U.S. equities do better and better and better, it just means that your portfolio is more and more exposed to the U.S., which last year was a bit of an issue. If you're not denominated in dollars, if your home currency is not dollars, it's euros, it's yen, it's something else. Yeah. You saw the dollar depreciate as much as it was. It was a rude awakening, and so now there's a lot more of an ask for how do we diversify away from the U.S.
When we talk about that geographic diversification, though, is that a long-term structural shift, or do you think that maybe the pendulum swings back, assuming the political situation here evens out?
Well, I mean, we're not calling for the end of the dollar or anything like that. No, it's not that. But no, there is a structural. I mean, people are looking at the fracturing of geopolitics, and that speaks to the need for diversification. And so, yes, this probably is a structural long-term trend that we'll see. Now, that said, we see in instances like in March with the outbreak of the conflict in the Middle East, then the dollar does do well. So it isn't a one-way train, but yes, we do think that over time you're going to see continued requests for diversification of portfolios.
I want to talk a little bit about private credit because, I mean, you think about the conversations that are being had stateside, and especially at this conference, there's a lot of concern out there. But do those same concerns exist when you take a look at Europe and just the globe in general?
They do. They do. And in some ways, even more, because if you're an investor in Hong Kong and you're so far removed from what's going on in the U.S. and you start to see these headlines, you start to see underperformance, you start to see defaults, you hear about fraud, then you overreact even more than many in the United States do. So everything that you see in the United States in terms of investor reactions is actually magnified outside of the U.S. for those investors who invested in the U.S. And then, of course, we've seen instances this year of asset-based finance opportunities in London get into trouble with fraud and real questions there. So all of these questions are very much relevant and very much alive with international investors.
PIMCO President Christian Strake speaking to Bloomberg at the Milken Conference in California. Time now for your front page news. First up on the Washington Post, the White House briefly under lockdown Monday afternoon after a Secret Service officer exchanged gunfire with an armed individual near the Washington Monument. The person was shot and taken to a hospital. The gunfire exchange also struck a nearby juvenile who didn't sustain life-threatening injuries. Next up, on the Financial Times, Elon Musk's trust agreeing to pay $1.5 million to settle the Twitter lawsuit. That's a fraction of the $150 million the SEC claimed Musk gained by breaching regulations. Musk also doesn't need to acknowledge any wrongdoing as part of the settlement. The FT says the settlement comes after the SEC showed leniency towards several figures and businesses with ties to the Trump administration. And the Wall Street Journal reporting OpenAI discussed spinning out the company's robotics and consumer hardware divisions late last year to give them more room to grow without weighing down the core business. The Journal reports the proposal was rejected in part because OpenAI concluded the new entities might have to remain consolidated on its balance sheet. Let's have a look at where we're headed into the open. The 10-year yield right down about a basis point, still at 4.42. We're going to speak about yields next with Henrietta Packman of Allspring.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. A ceasefire looking more fragile after the US and Iran exchanged attacks overnight in the worst flare-up since the truce began. Apple seeking options beyond TSMC with initial talks with Intel and Samsung for producing processors for its devices. And US stocks set to test new highs as earnings continue and more data on deck with PMI and JOLTS. Let's take a look at these markets then. We'll see what comes up on the board. Brent crude, and it is now a little bit lower, so we are just retracing some of those gains that we saw in the last 24 hours. Same for WTI, a little bit of relief for this market. Nevertheless, Brent crude at 112.66 is not far off the wartime high. We had yields creeping higher. We're just off a basis point again. So just at that tiny little bit of relief in this market with the 10-year at 442. We were above 5% on the 30-year for most of the day yesterday, though, and we're still at 5% on that tenor right now. Let's take a look at futures because we've obviously seen earnings knocking it out of the park, and you can see that continue today with futures pointed higher both for the S&P and particularly the NASDAQ 100, telling because the S&P equal weighted index is actually down. It's had 9 down days out of the last 10. You wouldn't know that, though, to look at the overall index. Bitcoin as well continues its march higher. It briefly topped $81,000 a coin. Let's get to some individual movers now. Over to London and Chloe Melly. Chloe.
Good morning, Bonnie. Intel is up this morning after a report that Apple is considering using Intel and Samsung to build processors for its devices in the US, essentially creating a second option beyond its longtime partner of TSMC. And so we are seeing that reflected in those shares this morning for Intel, up almost 4%. Moving on to another tech company that is not having as good of a time, and that is On Semiconductor. It provided an outlook that seems to indicate that there is going to be slower than expected recovery in the industrial and auto end markets, and the expectations were really high going into the earnings, and so we're seeing a slight disappointment there reflected in those shares that are down more than 4% in pre-market trading. And finally, over here in Europe, in the UK, we've got HSBC being also down after profit missed estimates, and so the performance was really weighed down by a fraud-related charge in the UK, as well as charges that were tied to the deteriorating economic outlook because of the situation in the Middle East. And so we are seeing those disappointing numbers dragging down those shares, almost 6% for HSBC this morning.
All right, Chloe, thank you so much. Chloe Melly there in London. Joining us now is Henrietta Pacmont, Fixed Income Investment COO of Allspring Global Investment. Henrietta, thank you so much for joining. How concerning is this move? So we're above 5% on the 30-year yield, and we're very, very close to that 450 mark now, just a few basis points away. If we had the same move that we had last week, we'd be above 450 on the 10-year.
So, yes, I mean, we know why it's happening. The news over the weekend obviously wasn't great in terms of what's happening in the Middle East, and we've seen that reflected in yields. That being said, I do think we are at levels now that are, again, pretty interesting for investors. We particularly talking about the long end, that's an area where we've been actually quite cautious. Why? Because that's where we're expecting volatility because of the duration. So our interest has been more on the sort of intermediate side there.
Yeah, we have seen the MOVE index start to perk up a bit again. It was so quiet there for a while, even amid all the turmoil, and we're still well off peaks that we've seen in the last, let's say 12 months. What is this particular bout of volatility telling you, Henrietta?
We're a few months into the conflict now, and as we talked about a few months ago, the longer it lasts, the less helpful it's going to be. You've obviously got central banks on tenterhooks, many of them on hold at this point, but they are keeping a key eye on inflation and how that might turn out. So I think that's why we're seeing it, is because this conflict is dragging out at this point.
Yeah, I mean, speaking of inflation, and we have a new head at the Fed coming in, Kevin Warsh. What do you make of his positions? Because on the one hand, he's a very conservative economist. You would expect him to be hawkish. On the other hand, we know there's a tendency at the moment in the administration to prefer lower rates. And you also have this dynamic playing out in the economy where there's a terrible fear of inflation being persistent, and yet a real concern that maybe the labor market is a little weaker than we would like it to be.
So you've got a few things going on in the US. Absolutely, you've got the dynamics that are very particular to the US at this point in time. But yes, they're going to have an eye on inflation. What are the energy prices going to go? Are you going to have a broadening of the inflation story as well? So they're going to keep a keen eye on that. Growth is actually in the US, if you look at it, pretty strong. So that again is something that they're going to have in the balance. But you mentioned the labor market, and in the US they do have that dual market, and if anything, we are seeing a sort of gradual softening there, though it's still pretty strong. So a lot of factors for them to look at, which explains their current behavior.
Yeah, bonds, break-evens, they've been in a sort of a range. What will cause them to break out of this range, Henrietta? Is it just a continuation of this war, oil prices at current levels, or does it need something else?
I think, yes, obviously that is a factor. We're coming into the driving season as well in the US. We need to see how strategic reserves are impacted, how oil aspects are rerouted. So that is going to be a key element that they have in mind. If there's any escalation, if there's any sort of infrastructure damage that occurs in the region. These are things that could escalate things on the upside. And then what's going to be interesting to look at is, obviously, we've got this sort of growth story in the US that is pretty strong, driven by AI, and we need to see if that holds up, because that could cause a break from a central bank perspective as well.
Yeah, Goldman Sachs yesterday saying that we will get productivity gains out of AI. That's definitely going to happen. We know Kevin Warsh believes that's going to happen, but that before we get to that, we're going to see AI produce inflation. Where do you come down on the AI productivity argument?
I'd agree. We are going to see those productivity gains, but there's a lot that needs to be put in place actually before those can occur. It's not just the brain side. It's not just the LLMs that you put in place, but it's also the data structures that companies put in place, and that takes a bit more time. So it'll be really interesting to see how these productivity gains occur, and how companies capitalize on the AI story. So I think this is something something that, is maybe a phenomenon that is going to be faster than others that we've seen historically, given its nature, but is going to be a story that is with us for years to come.
Stephen Major of Tradition pointing out this morning that there's a huge diversification, let's say, in EM right now, or a huge bifurcation. So we're seeing massive losers and real winners out of the energy price spike. And then in aggregate, EM, that's causing EM to have the narrow spreads that we've seen in some time and so on. But you're looking for opportunities. Where would you go, Henrietta?
So obviously it depends, what kind of energy dependency they have, and energy dependency on the Middle East in particular. I think that is a big factor in what we're seeing on the EM story. Another aspect is again the tech aspect and the exposures of these countries to the tech story as well. So it's a question of making sure that we understand those dynamics and we look at the relative value that is available in the market for our positioning.
All right, Henrietta, thank you so much for joining us this morning. That's Henrietta Pacamon of Allspring Global Investment. Now to other top stories trending on the terminal this morning. Alphabet returns to the euro debt market with a €3 billion mega bond deal. That's about $3.5 billion. According to sources, proceeds will be used for general corporate purposes, which may include repayments of outstanding debt. Last February, it raised nearly $32 billion in sterling and Swiss franc denominated bonds to fund its AI build-out. Starwood Chair and CEO Barry Sternlicht says his company has been investing in data centers for the past 5 years, expanding from the US to Europe and Asia. He spoke to Bloomberg's Romain Bostic from the Milken Institute Global Conference.
The last 5 years we've been doing data centers. Yeah. And then we started really in the Dulles market, the largest data center market in the world, 8.5 gigawatts in place. And Dulles was the home of the internet. And then, so there's great connectivity. And then we broadened out to other markets. We did a deal with a Bitcoin miner. Yeah, and
Whitmire Holdings, right?
Whitmire Holdings, and we're looking at others, and then we're expanding other states. And we've, with 2 platforms, we've launched into Europe and into Asia. Also have moved into Australia, and we're looking in Japan and Korea also.
HSBC reported profit that missed estimates. Results were weighed by an unexpected charge related to the collapse of the UK mortgage lender, MFS. Coming up, the ceasefire holds for now. More on the US-Iran attacks overnight. This is Bloomberg.
How the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romain Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
We should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data. Yes. We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things. and make sensible underwriting decisions.
Welcome to Bloomberg This Weekend. I'm David Burrow.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Now, Bloomberg exclusive Intel pre-market shares higher. After reporting that Apple has held preliminary talks about enlisting Intel and Samsung to produce the main processors for its devices in the US. Bloomberg learning that Apple has concerns about using technology not made by their primary supplier, TSMC, but is trying to adapt to supply chain disruptions constraining company growth. Bloomberg's Neil Campling joins us now. So investors obviously liking this from Apple, Neil, but is it a good idea? I mean, obviously we're in the preliminary stages and nothing has actually been signed yet.
As you mentioned, it's very early in discussions, and actually to move an extra process to another supplier can take a number of years. These are very sophisticated chips that are being made. At the same time, Apple has relied on TSM as its sole manufacturer of the leading edge chips for close to 20 years now. So it makes sense to try and diversify the supply chain when possible. Given some of the disruptions we've seen previously with COVID, we've seen with the tariff concerns, we have seen now with the geopolitical tensions in the Middle East. So if you can develop these chips closer to home in the US for the biggest market, for the iPhones and for the MacBooks, then it makes sense to try and diversify. But it's easier said than done. It's a very sophisticated process that has been developed and improved over the last two decades.
Would customers want to know what's inside their devices? How, it used to be Intel Inside. That was, Apple would literally promote that on the cover of every, MacBook that you bought or whatever. Would customers still want to know what was inside?
I think the most important thing is that is for customers of Apple products now is just to have Apple Inside in terms of combining the hardware, the software, the chips, the memory, that everything just works in sync. And that's really about the Apple IP. Who's manufacturing those chips or the technology inside that, I think nowadays is less important for the consumers and the users. It's just about having the fastest products, having the most efficient products. So in many respects, I think consumers don't mind whether it's an Intel chip, a Samsung chip, or a TSMC chip that's driving the Apple ecosystem.
Now, Meta is looking at building a massive data center in El Paso. It's going to be more than $10 billion, potentially as much as $13 billion, and it's going to need a lot of debt. Neil, is it going to have any trouble raising that?
I think it's unlikely. I think they managed to raise $30 billion in a similar debt offering last year for another data center, and there's a huge amount of appetite for any investments regarding to AI, not just in equities, but cross-asset and debts included in that, especially because of the returns profile are very attractive over many years into decades that you're expecting from these massive AI infrastructure build-outs. Last year, we saw a sort of cornerstone investor, which was PIMCO for the debt offering, and I suspect this year we're likely to see a cornerstone that will help out with this particular deal. So it'll be one to watch, but I think given the huge amounts of cash flow generated by the big tech companies, that these assets are well sought after in the debt markets.
Neil, the European Union's in talks with Anthropic about testing its companies for vulnerabilities uncovered by Mythos. Tell us more about this, the context, and what it could find.
Sure. Well, I think Mythos, we've seen updates recently where we've heard incredible progress regarding to finding out flaws in existing operating systems and web browsers that have been tested millions of times, that Mythos found within minutes or hours. So if we can then utilize these technologies to help find where the vulnerabilities are, we can potentially, whether it's governments, whether it's corporates, find out these vulnerabilities and help sort of plug these issues before they could be used by bad actors. So it makes sense to try and use these technologies in the right kinds of ways to make advances with these technologies.
Amazing, Neil. So much to cover every day these days. Neil Campling, thank you so much for joining. A ceasefire is holding after a day of clashes, though, between the US and Iran involving shipping in the Strait of Hormuz and missile attacks against the UAE. Bloomberg's Kasia Klimashinska joins us from Washington. There was a moment yesterday, Kasia, when, people across the UAE were getting alerts where I think everybody's stomach dropped and thought, oh no, this is starting again. And yet, in the end, neither side has accused the other of breaking the ceasefire, as far as I know. Is that true?
That's exactly right. So yesterday was tricky for the markets and for the Middle East with clashes between the US and Iran. But as you said, none of the sides claimed that the ceasefire has been broken. So it looks like it's back in place today. Those clashes yesterday, those flare-ups, they came after President Trump announced that the US will help guide some ships out of the Strait of Hormuz, saying that there are basically some innocent vessels there with their crews running out of food that need assistance and need to get out. So the U.S. did help 2 U.S. ships get out of the strait yesterday and responded to some fire and drones from Iran. But as you said, even as the U.S. Central Command briefed reporters yesterday, they didn't say the ceasefire was broken, and they will talk to reporters again today.
It would seem to suggest that the U.S. knows that there is a way through the Strait of Hormuz that won't touch off any mines that might be buried under there. Is that right, Kasia?
So that's very interesting. Yes, that's one of the questions that the U.S. Central Command got asked yesterday, whether there are mines in the strait and how, dangerous they are, and they seem to be playing down that risk, which also has been proven by those 2 U.S. Vessels going through yesterday, and a handful, a small amount, but still, of other vessels, for example, aimed for India, that managed to go through the passage. So this does not seem to be an issue. So perhaps there is a chance that the talks will resume, because obviously yesterday, with this fire being exchanged, I don't think there was any talks between the U.S. and Iran, but we have to see whether they will continue to talk and reach some sort of agreement, at least over this critical waterway, how to lift the blockade and keep especially the oil and oil products flowing through the strait.
Just 9 days now before the president is supposed to meet Xi Jinping. Tensions have been mounting, though. Any developments that we should know about, Kasia?
For China especially, Iranian oil is very much on their mind, because China is a significant buyer of those energy resources from Iran. So President Trump reiterated again yesterday that he's looking forward to this meeting that, as you said, will happen 10 days from now. But China so far has been quiet, hasn't confirmed the dates officially yet. This is pretty custom. The schedule of President Xi rarely gets released so early ahead of time. We know that there are also conversations going on between U.S. and China on lower level, not only about Iran, but for example, technology is another important area, and obviously trade and tariffs.
Kasia, can I ask you about the story that the SEC is investigating fraud in private credit? If anything is going to send jitters through the market, it's a headline like that. So what do we know?
Yes, so that's, of course, a very important growing market of private credit, and the Trump administration is appearing to be changing its tone a little bit. At first, Trump endorsed this market in a big way, for example, encouraging more of the U.S. retirement money to flow into private markets. And then the SEC, the Treasury, the Fed started acknowledging that obviously there are some risks related to those investments, just as there are related to most of other risks. So yesterday, SEC acknowledged that they are investigating some reports of probe, still also praising the private markets as an important source of money, of funding for private companies and small companies especially, but they did acknowledge that there are some reports that they are looking into without naming any specific companies.
Yeah, and it's not just the SEC, it is the Treasury and also the Federal Reserve, which is interesting. The White House looking at potentially putting a working group together to vet AI models. Is this a workable option? Will companies, readily hand over their models for White House vetting?
Yes, that's another area, another sector where the Trump administration is clearly changing its approach. At first, Trump was very supportive of the AI, particularly supporting building new power stations to expand those data centers. But now, especially after Anthropic released its latest, both the Trump administration seems to be a little bit more cautious. Yes, saying that maybe they will have a working group, maybe some sort of a review before new products hit the market. And apparently, that's according to the New York Times, the White House met with the tech companies last week and discussed such an option. We know that also there are a lot of other issues and tensions between the administration and the AI companies, particularly at the Pentagon.
All right, Kasia. Fantastic roundup for us there of all of the political events in the last 24 hours. Kasia Klimashinska in Washington. Coming up, another busy day for earnings. Also, jobs data on deck will get you set up for your trading day. This is Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in 1.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI. That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazla Amin in Davos, Switzerland, and this is Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now, a look at what's ahead today. First up, Pfizer reports earnings before the bell, and then after the market close, we get AMD and Live Nation among companies reporting. Plus, we get some services PMI data, 9:45 and 10 a.m. Eastern, some April figures there. Fed speak from Vice Chair of Supervision Michelle Bowman at 10 a.m. and Fed Governor Michael Barr at 12:30 p.m. Let's take a look at some pre-market movers. Intel is up more than 4% on that report that Apple is weighing using Intel and Samsung to build device chips. Palantir, of course, out with earnings yesterday. It is lower now. It did raise its revenue outlook, but the commercial sales component missed, and that has the market just a little bit put off. Duolingo, though, down 13%. It narrowed its revenue forecast and is suffering greatly. This is your macro picture going into your Tuesday session. We're keeping an eye on Brent crude, still above 113, though easing off its highs. The 10-year yield creeping ever higher. Futures also pointed higher. That's it for Bloomberg Brief.
As an exchange, what can you do to make it more attractive to be a publicly traded company?
Talk to our customers. We spend a lot of time with our listed companies, listening to their concerns, particularly the offices of the CFO, head of IR, listening to their pain points, general counsels as well, and then act as an advocacy group for those companies to really focus on structured reform to allow a company to tell their story in the most efficient way possible and reward them for the good disclosures that they are making in the market.
Is there any sort of financial innovation that you could drive to get more companies to list? Tokenization has come up.
Well, we did announce our tokenization initiative earlier this year. We already built the technology, we've already done a variety of proof of concepts. It allows for instantaneous settlement, 24/7 trading. It importantly allows for the rights associated with a share to move into that electronic form, but is going to be a platform that runs in parallel to our more traditional exchanges.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
You're still seeing a market that's a little jittery.
There are no signs of cracking right now.
We need to factor in a lot of uncertainty.
We are in a new era of diversification.
We're seeing a lot of positive tailwinds, but we are prepared for that to face some challenges.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, holding on to a fragile ceasefire. We're following a tense day of trading strikes across the Middle East, keeping investors on edge and oil comfortably above 100. The tension helping send 30-year bond yields through 5% for the first time since July.
And this presents a real problem to the bull case for equity markets. The whole case has been predicated on the idea that central banks would not hike rates into an oil shock. Now you've got a 99% chance of the ECB hiking rates by June. And you have, of course, an increasing chance also in the United States of a Fed rate hike. It's not a base case, still getting bled into some of the market pricing for next year. At what point does this really crimp some of the momentum that we've seen in equities?
Should we just sit on the bond market move just for a little bit more? Highest close of the year on 10s and 30s. Some big numbers coming out of Treasury. The quarterly refunding statement comes on Wednesday. This is the quarterly borrowing estimate, 189 billion US dollars. That is a heck of a lot more than the number penciled in back in February.
How does this get received by a market that is expecting it to be issued really on the front end of the yield curve? At what point can they just concentrate on the two-year yields and not necessarily call the hand of the Federal Reserve? How much do they move this away from the 10 and 30 year to try to give some sort of headwind? And can they do that given the amount of debt that the United States has to issue?
It is $122 billion more than anticipated in February. That's a ton of debt right now to this market. And why? Spending just feels like it's going to be going up, especially when this administration is asking for a much higher defense budget, given what has been going on with the conflict in the Middle East.
Bill issuance has been doing all the heavy lifting ever since we had Janet Yellen over at the Treasury. And this line keeps coming up in the statement. Does it change on Wednesday? The increases in note and bond issuance not expected, quote, for at least the next several quarters. Does that language get adapted in a few days' time, in the next 24 hours?
We'll have to see. And ultimately, how much does that affect the market? But are they trying to hold off until after the election to then increase some of the issuance? I mean, how much can they really hold off on increasing some of the issuance, given the fact that that bill is massive? And also, by the way, we have the issuances from all the corporate players, too. I mean, at what point do they really start cannibalizing from one another?
Crowding each other out. Alphabet issuing debt over in Europe. We can talk about that later in the program. Let's talk about crude. This move here, surprising. Brent pulling back, WTI as well. Brent crude down to 113, down by 1.25%. Yesterday, a move of almost 6 percentage points following tension in the Middle East. Just go through the headlines, piece by piece. The US military fighting off attacks from Iran, facilitating the passage of 2 US-flagged vessels. At the same time, the US is shooting down 7 small boats. There's a drone attack over in the UAE. Things were pretty tense in the last 24 hours.
Massive escalation, but the president did not say that this was an interruption of the ceasefire, but potentially we're going to get an update on how the U.S. administration views the past 24 hours today. At 8 a.m., we will hear from General Kane, as well as Secretary Pete Hegseth. The DOD will be giving this press conference. And then later in the day, we're also going to be hearing from Secretary Rubio. He'll be briefing at the White House. Do they view this as an escalation of hostilities? We heard from the Iranian foreign minister. He said Project Freedom is Project Deadlock. They still have control right now of the Strait of Hormuz, even though the United States was able to make incremental changes. And what you see is vessels clustering around Dubai now because it is becoming very tense to try to cross that strait.
If Iran is firing at the UAE and firing at the US at the same time, and the US is firing back, do we have a ceasefire anymore?
Widely, no. I think that everyone pretty much would agree. The fact that it isn't being declared the end of the ceasefire by either side, and the fact that you're actually having some conciliatory language come from both sides, the Iranians even saying, we look forward to discussing more talks, and the fact that President Trump hasn't escalated more significantly is being taken by this market as a sign of relief that no one wants to enter the hot war that we were in a couple of weeks ago.
This equity market's bouncing back up by 0.3% on the S&P. Coming up this hour, we'll catch up with Jeff Yu of BNY with the equity rally looking to get back on track. Jorge Leone of Rystad Energy on a fragile ceasefire, and Jane Foley of Rabobank on upending rate cut expectations. We begin this hour with crude elevated following a tense 24 hours across the Middle East. Jeff Yu of BNY writing, despite the lack of progress in the Iran talks, the US equity performance stands out. However, the stress points in the US economy are starting to show. Jeff joins us now for more. Jeff, welcome to the program. The data I've seen so far looks pretty resilient. Where are you seeing the stress and the shock starting to show?
So it's more on a forward-looking basis, really, and given the path for the Fed, we're still looking at labour markets. You know, you can argue, yes, it's still a no hire economy, but two things. You know, one, at what point does that shift towards a few more fires compared to hires, especially with tightening financial conditions? You know, you mentioned the 30-year rate yourself in the US. So, but secondly, how about wage growth? Right now, for the US, I'll admit it's a bit asymmetric. You know, the bar's always higher. It's expected to lead. We've been talking about US exceptionalism again. So cracks insofar as if it's not performing up to very high standards, that by markets will be considered a crack as well, especially given the concentration risk.
Jeff, is that an argument to buy bonds with 30s at 5 and 10s at the highs of the year?
So right now, our data is showing our clients are loving this in terms of bonds, but the key caveat, if you don't have to worry about FX exposure. So what we're seeing is US investors buying US treasuries, European investors buying Eurozone treasuries, UK investors buying gilts, some of the largest flows we've seen over the last 2 months or so, because real rates are high. The break-evens haven't moved as much comparatively, so nominal yields higher, that's great for pension managers and the like, but if you have FX exposure, you probably want to stay away from that, so the divergence is very, very large.
I want to get to that in 1 second, but Jeff, just sitting on who's buying this, then why is the yield rising to such a degree? How much is there a risk of central banks hiking into potential weakness with the oil prices higher?
So really glad you brought that up. I don't think, especially in Europe, I don't think any central bank should be hiking right now. So yes, the market's pricing in almost 100% an ECB move in June. I don't think that's the right move. And I think that's why, if you look at our flows, yes, euro's at a relatively elevated level, but you're not seeing the conviction flows in there relative to sterling because there's policy error risk. If you hike right now into a demand shock, then you risk actually easing further down the line. Even the RBA today, yes, they hiked, but Governor Bullock mentioned worried about mortgages, worried about wages and the like. And I think that's why the ECB, as the Bank of England, is so hesitant as well, because the demand shock in the UK is even stronger.
Okay, should and will are two different things, Jeff, and people have been saying this for a long time, and you've got a 99% chance right now, priced into the market, the ECB is going to hike rates in June. You have an increasing chance that even the Federal Reserve will be in the same boat. Is the market just not believing this? Is the market just essentially saying they're not going to do it because essentially it has always been a bad turnout?
So I think it's quite idiosyncratic right now because for the ECB, they don't have a dual mandate. They don't have an employment mandate, right? So they just follow inflation expectations and wages. For the Bank of England, it's a bit more balanced. Australia actually does have a dual mandate, similar to the Fed right now, but they were sort of hawkish beforehand. I think for the Fed, it really is about balancing the labour market. So if the labour market also eases enough, wage growth is soft enough such that you don't worry about the second round effects and you still see inflation expectations being anchored, which in fairness is what the break-evens are signalling right now, then I don't think there's that much compunction of a move to be as aggressive. So yes, I think markets are still a bit too aggressive in their pricing around the world.
Jeff, what if this is more than just a demand shock and this is a structural change? Wouldn't then banks like the ECB have to hike?
So from the ECB's point of view, they would argue that you risk having a more permanent disruption and changes in how the economy is structured, and without the resilience that has been building since 2022, but they're not there yet, then maybe from their point of view, they actually need to act. Now in the US, again, it's actually a bit more interesting because even if you don't have the wage argument, then there's the other argument, because the US is so far ahead on the AI side in terms of productivity gains, that can actually help offset some of the inflation as well. That is the structural change, which is also anchoring the break-evens. And I must say, there is a stronger argument actually for that in the US compared to Europe. But this, again, is a favorable argument for the US because it means real rates are probably priced a bit too high in Europe. They need to come down, whereas they're adequately priced in the US. So again, that is sort of a US exceptionalism story, which again, over the last few weeks has been talked about, of course, until the recent tensions picking up again in the Strait.
There's a real risk here that we're confusing should, shouldn't with will and won't. I understand why they shouldn't. Yep. We've seen this under Trichet, particularly over the ECB, the mistake into GFC, the mistake into the Eurozone debt crisis. Under Lagarde, let's talk about the will won't. Feels like she set up June. It looks like she set up June. Why wouldn't they hike in June?
So the moment she said at the press conference that she's aware of the direction, she mentioned the ECB, the Governing Council, has a direction, that basically said they are moving, right? So every meeting is live and they would need to move. And we can argue whether it's being dogmatic or they genuinely fear inflation expectations rising in Europe, because the last round of inflation expectation surveys, they actually did pick up quite noticeably, not as strongly as 2022, 2023, but they wanted to shift anyway. But I think, from a growth perspective, if you look at where the savings rates are, if you look at the labour market, again, going back to wages in Europe, if they start to really soften, then maybe the Governing Council will hold back a bit. Either way, I think it's going to be closer than expected in terms of the vote when it comes to the meeting in June.
Just out of interest, do you think it's a good argument to buy longer dated debt in Europe if we are on the brink of what you would consider a policy mistake?
I would say yes, that is favourable, as long as, and here's the key caveat, because if we are going to compare versus the Trichet era, as long as the policy mistake does not trigger fiscal issues, right? that was sort of the case a dozen years ago. You know, right now we see less issues surrounding that. You look at where BTPs are trading, you look at where Greek debt is trading. You know, Greece is certified one of the strongest names, you know, fiscally speaking, right? So I think that is a much stronger argument, especially if the fiscal spend in Germany and heading into the EU budget next year, you're going to see more joint issuance. You're going to see Germany anchoring the entire European budget. So yes, a much stronger argument there.
Hey, Jeff, it's good to see you. Thanks for dropping by. Jeff Yu there of BNY. I think we've got a decent feel for what he thinks these central banks shouldn't do. But what they will do might be somewhat different.
This is the contradiction in markets right now, because the market is pricing in as a base case what he thinks they shouldn't do. So is it just that two markets are not speaking to one another? Given that backdrop, why isn't the dollar stronger? Why do people not want to buy in another currency? Why is there still an aversion to really going overseas? It's a sort of conundrum wrapped in a riddle. This is something I've been thinking about a lot.
Well, we can spend some time with Jane Foley a little bit later this hour to talk about that. And please, that's how you spend your last 24 hours.
It's been great.
At home.
You know, getting massage.
Long weekend.
What about the dollar?
What about that
Why?
dollar? I hope that's not what you do. Equity futures right now in the S&P 500 positive by 0.3%. With an update on stories worldwide with your Bloomberg Brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, good morning, John. Nearly a month into a fragile ceasefire in the Middle East, the US and Iran are trading fire again. US Central Command says the military fought off Iranian drones, missiles and small armed boats as it guided 2 US-flagged vessels through the Strait of Hormuz. The Trump administration is reportedly considering an executive order to create a working group on AI. The New York Times is reporting the proposal could introduce the government reviews of new AI models and resemble a framework followed in the United Kingdom. Palantir shares lower in early trading. Sales in the first quarter hit a record, but commercial sales in the US fell short of expectations. Palantir's long-running deals with the US and foreign governments are facing growing competition as well from rival tech companies. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie later this hour. Up next on the programme, the ceasefire in jeopardy.
Can't let Iran have a nuclear weapon. They said we have to take care of business because we can't let that happen. So we did a little detour, and it's working out very nicely.
Up next, we'll catch up with John Lieber of Eurasia Group, live from New York City this morning. Good morning.
Day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
And this is how the day is stacking up. Full of economic data, 9:45 Eastern Time. We've got a PMI. Then later on, ISM data, 10 a.m. Eastern Time, and JOLTS data too. The jobs data starts to come through, job openings ahead of ADP tomorrow. claims on Thursday, payrolls on Friday.
Yeah, a real key question here. If you do have a hotter than expected print, sorry, Stuart Kaiser, but does that become negative for markets in the sense that it opens the door a little bit wider for a rate hike? If the labor market allows that sort of wage price spiral, that will suddenly change the game.
Redefining dovishness at the moment, aren't we?
Indeed.
From cutting rates to not hiking. That seems to be the dovish view right now, not hiking.
I mean, essentially, even Neil Dutta coming out and saying the path is slim, but it's there for them to have to hike rates, because ultimately, if you have an economy that can handle higher prices and it keeps on coming through the price increases, well, all of a sudden, you've got a problem on your hands. The Fed has to act.
Here's the stock market picture this morning. Positive by a third of 1% on the S&P. On the Nasdaq, bouncing back by 0.6. AMD earnings after the close. Look out for that. In the commodity market, crude still elevated. A move of almost 6% in yesterday's session, eating into the losses of Thursday and Friday. We're back to about 113 on Brent. And with that move, the highest close of the year on a 10-year yield, on a 30-year yield. And it's not just about a move in crude. It's about debt issuance as well. The quarterly refunding estimate from the Treasury and the numbers that we get from the Treasury tomorrow. Just where on this curve is that issuance going to fall?
It's widely expected to come on the front of the yield curve. It still is $80 billion more than a lot of people had expected in the previous read. They are going to have to lay out how they are going to issue more debt without affecting this market, because it is very clear that Treasury Secretary Scott Bessent has his eye on the 10-year, and he's got his thumb on the scale. So let's see how he accomplishes that.
Needs to push harder, that's for sure. Down just a basis point this morning, 443 on 10s. Under surveillance this morning, the ceasefire in jeopardy.
Can't let Iran have a nuclear weapon. We hit all new highs, and I said we have to take care of business because we can't let that happen. So we did a little detour, and it's working out very nicely. They thought that energy would be at $300, right? $300 a barrel, and it's like at 100. And I think going down, and I see it going down very substantially when this is over.
So here's the latest this morning. The US and Iran trading fresh strikes in the Persian Gulf, putting the fragile ceasefire very much in doubt. Bloomberg's Tyler Kendall joins us now from Washington for more. Good morning, Tyler.
Hey, John, good morning. Well, yesterday we saw the worst flare-up in fighting since the ceasefire began nearly a month ago, as CENTCOM confirmed that the U.S. military repelled both missile and drone attacks as it helped to guide at least 2 U.S.-flagged merchant vessels through the Strait of Hormuz. President Trump later added in a post that the U.S. military had destroyed at least 7 Iranian fast boats that had been targeting commercial shipping, amid big questions about just what the situation in the Strait currently looks like. Iran is warning against any further movement, as reports confirm that the U.S. has moved in at least 2 naval warships to help with future operations. And just underscoring how fragile the situation is for shippers, data analyzed by Bloomberg News shows that an unusually large amount of vessels are now clustered in an area just off of Dubai, which is right outside this newly created zone of control, according to maps released by Iranian state media yesterday. It's, of course, adding to the regional risks, as the UAE confirms that it intercepted more than 20 projectiles in the last 24 hours and is now blaming Iran for attacks on a key port as well as a state-owned tanker. And John, within just the last few moments, actually, people familiar telling Bloomberg News that officials in Abu Dhabi are in preliminary talks to establish a new defense-focused investment vehicle that would be aimed at bolstering the country's domestic manufacturing and diversifying its supplies as this conflict continues. Still, we did get this post yesterday from Iran's foreign minister saying that talks are making progress. And when you ask the White House, they maintain that diplomacy is still an option. The question is just how quickly we can get there.
Tyler Kendall with the latest. Tyler, thank you. Down in the nation's capital in Washington, D.C. More from Tyler in the next hour. Let's extend the conversation with John Lieber of Eurasia Group, writing the following. Risk of ceasefire collapsing remains elevated as a deal is unlikely until June. Negotiations appear deadlocked, with both sides believing they hold the advantage. John joins us now for more. John, welcome to the program. Just out of interest, why is it unlikely until June?
You know, both sides, I think, aren't at their pain threshold yet. Certainly, the U.S. is starting to feel some of the economic pain from this war, but mostly it's being felt abroad. And for the Iranians, they're dug in. They're not willing yet to give the concessions that Donald Trump wants to see on the nuclear program and they think they have the superior leverage in the deal. That's what these attacks over the last 24 hours were about. We're about reasserting Iranian dominance over the Strait. So while we think there will be a deal, the deal will probably come sometime in June. It could come in May, but we think it probably comes sometime in June, which means a very delayed reopening of the Strait of Hormuz. But for right now, both sides are kind of still circling around each other. They're having these preliminary talks that aren't really going anywhere. And until they unlock this nuclear issue, I don't think there's space yet for a deal to come together until the pain is higher.
John, for anyone watching the events play out yesterday, it was a clear violation of the ceasefire. Is this administration prepared to say that?
No, because they don't want the ceasefire to end. So structurally, we think both sides really don't want to go back to fighting. The U.S. doesn't have the domestic political space to do so, and the Iranians just want to stop being bombed. So I don't think either side wants to see the ceasefire break down, and I think that's what yesterday demonstrated. The Iranians were able to send a message: we still control the Strait. United States, you cannot escort ships out of here easily without us retaliating. And the U.S. had the opportunity to declare the ceasefire over and strike back, and they didn't. And I think that really shows kind of the structural incentive set that both sides here have to keep the peace.
Clearly, the blockade is hitting the Iranian economy, though. At what point will the pain be enough on this regime, though, to bring them to their table? Or does that point not even exist when you're dealing with a regime like this?
Yeah, so you look at the blockade, and Iran's now shipping about 30% of its pre-war oil out of Iran, but prices are much higher. So the hit to their budget is only about 30 to 40% of their pre-war budget. It's not great for them, and they've got a lot of reconstruction to pay for now, but they can keep going, and the regime is solid in that scenario. So, they don't want to keep this fighting up. I don't think the economic pain is necessarily the thing that's going to drive them to the negotiating table. But at some point, they're now putting out plans to open the Strait with a phased discussion about the nuclear targets. And the U.S. is saying, no, we have to do the nuclear first. You can kind of see the contours of a deal. And I don't think the Iranians would be engaging in these talks and putting out these proposals if they didn't want to get there.
John, a lot of people thought that the deadline was May 14th when President Trump and Xi Jinping of China were supposedly going to meet. President Trump says that meeting is still on. Do you think that it's feasible that it could take place without some sort of better agreement in place between Iran and the United States?
Yeah, absolutely. I don't think the Chinese need to see a deal come together, and they're not really that involved. I mean, they might end up being involved in some aspects of how a peace deal comes together, but right now they're not important interlocutors in this debate. And Trump himself is basically domestically resilient to this to the fight so far. You had a clip on of him earlier talking about how much worse he thought this was going to be. So I don't think that the Iran conflict is in any way an impediment to what both sides in the U.S.-China deal relationship want, which is just calm right now. They don't want anything to disrupt their critical mineral supplies in the case of the U.S. and China's access to global markets in the case of China. So I think that is going to be the overall state of play for U.S.-China for the near term, and Iran is not going to disrupt that.
Are there any checks then on exactly how long this goes for? Some people used to think that it was oil prices. Oil prices now well above $100 a barrel. When you take a look at Brent, in December, we're over $90 a barrel. Some people were saying this meeting with Xi Jinping, that doesn't seem to be an issue. Other people were saying popularity, that doesn't seem to be an issue based on the polls that are currently coming out. So what are the checks on how long this could go on?
Yeah, great question. I mean, I think that this has gone longer than we anticipated for sure. But if you look at this accumulating economic damage, I mean, it's hard to see oil staying contained where it is right now if this conflict does go on another several weeks. You also have the enormous pain that's being felt globally from shortages of helium, from shortages of fertilizer, from shortages of aluminum, and all these disruptive effects across global supply chains are going to start to have an impact on the U.S. economy in particular. And I think that mounting pressure, I would be very surprised if you don't see oil going up from where it is today. And I think that mounting pressure is ultimately what makes the U.S. say, okay, fine, we'll do a deal here. And but we don't expect that for another several weeks, which is a pretty bad economic story.
That's not a good one, that's for sure. John, thank you, sir. John Lieber there of Eurasia Group with his own predictions on where this is going. For crude, I think we've spent the last 2 months, many people have asking the question, how much damage do these high prices do? When you speak to people in the commodity market, they still look at this as low. Why are crude prices still so low, given the risks and the reality abroad right now?
This is ultimately the question that a lot of them have to say. Other people say, you can say that the market's wrong, but the market tends to be right more often. And then you have the likes of Stephanie Roth over at Wolf Research talking about how the One Big Beautiful Bill and a whole host of other stimuli measures have allowed this economy to keep going. So this is the debate underpinning what seems to be a persistently low number based on what some of the commodity strategists are saying.
Also, this administration has been able to jawbone this market. And because of that, you have hedge funds and traders unwilling to take on bigger risks to bet to the upside or downside because you're seeing 10 to 15% moves in crude in a day, something you would maybe see in a year. So they've been able to jawbone this, but at some point does it start to catch up to them, especially if John Lieber says you're not going to get something until June.
At the start of March, the conversations we were having, imagine 2 months of this, you'd be talking about a number closer to 200 than 100 on crude, and that is not where we are this morning. Brent at about 113. Up next on the program, Jorge Leon of Rystad Energy with Brent sitting above 110. Plus, Yahira's got your morning movers. Palantir sliding on a sales miss. That stock is down by 3%.
About 80% of projects will find it difficult to secure financing. And this is really all because of the level of readiness or preparation. As you know, for investment to occur, you need well-prepared, technically prepared projects, but they must also demonstrate economic and financial impact. So one of the major challenges is the stock or availability of bankable projects in countries. Almost all countries have got good plans and ideas, but when you look at the readiness of those projects, that's a major obstacle. And that is why the African Development Bank, through the African Water Facility, invests heavily in upstream preparation of projects to enable countries to have a large pool of investable projects. The second element that is an obstacle is the institutional and regulatory environment in most countries, which make it difficult for investment to happen.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Equities bouncing back up by 0.3% on the S&P 500, on the Nasdaq up by 0.6%. More earnings later. The earnings so far Phenomenal. Cantor's Eric Johnson writing this: earnings estimates are moving up faster than stock prices can keep up. Mike Wilson of Morgan Stanley putting some numbers on those earnings. First quarter EPS surprise for the median S&P 500 stock, 6%, the strongest Bramo it's been in 4 years.
Yeah, saying that the median stock earnings growth is 16%, which is just massive. And you can see that the forward EPS growth is up 21%, up from 8% at the start of the year. So it gives you a sense of why there's so much bullishness and why when you say, but, look at those oil prices, people say, look at those earnings and tell me that I'm wrong.
Look at those oil prices. Check them out. Brent and WTI. This is why the equity market is somewhat insulated from this. Brent crude just short of 113, 112.85, down 1% today, an almost 6% move yesterday. The hostilities resumed in the last 24 hours, but it also demonstrated just how committed both sides were to trying to maintain some kind of ceasefire.
They're hanging on this ceasefire literally by a thread. But to John Lieber's point, you do see both sides at least having a discussion behind the scenes. The issue, of course, is going through the Strait of Hormuz. Does Iran offer any pathway for the United States to be able to guide or escort at some point ships out of the Strait of Hormuz? And what does that mean in terms of where do they decide to put nuclear in terms of the pecking order of what to be discussed at the table?
Every single morning for the last 2 months, the first thing we've all checked has been the commodity market. That's started to change for me in the last few days. Started to turn to fixed income just a little bit more. Not going to say the stress emerging here, but I think it's notable we've taken out the highs of the year. On 10s, on 30s, on a closing basis, 30s of 5 still this morning.
Yeah, Mike Wilson at Morgan Stanley says 4.5% on that 10-year is the line that really starts to matter for U.S. equities. We are almost there. We're 8 basis points away from that. And this really speaks to the longer-term oil expectations. When you take a look at the December contracts and see how high they've gotten, we're talking almost three-digit prices on oil at the end of this year. That is something that this bond market cannot ignore.
30s at 5%, Toten's close to 450. It's what Max Kentner calls the danger zone, right?
Yeah.
It's like right there, right now, looking at that danger zone this morning.
I'm guessing he's still bullish.
Max overweight. From the last time I read Max's notes. 3 hours away from the opening bell. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We start with Palantir. It blew it out of the water this quarter, posting a significant beat and a raise, but you wouldn't know it by looking at the stock, down 3% in the pre-market. And what analysts are pointing out is that it wasn't broad-based growth. You still see government doing a lot of the heavy lifting while its U.S. commercial business continues to struggle to keep up. Turning to another company posting a beat and a raise, but reacting way more positively, shares of Pinterest are up more than 16% in the pre-market as it sees momentum in its ad business due to AI. It's a notable shift for this company, which has posted earnings misses for the past 5 quarters. And we end on Intel. Those shares also rising in the pre-market. They are up 4%. Honor reporting that Apple is exploring working with Intel as well as Samsung to build its processors for devices in the U.S. It's still early days, and Apple is still locked in with TSMC, but it speaks to the tightness that we're seeing in the chips market with a company like Apple having to go out and find backup options. John?
Intel at 4%. Yahara, thank you. Appreciate it. On our radar this morning, the fragile U.S.-Iran ceasefire appears to be holding following a series of clashes in the Persian Gulf. Hundreds of vessels are now gathering near Dubai as Iran expands its control zone in the Strait of Hormuz. Elsewhere, HSBC shares are falling, down 5% in London trading. The bank's earnings missing estimates following an unexpected fraud-related credit loss in the UK. HSBC also struggling with rising economic risks stemming from the conflict in the Middle East. And finally, Alphabet returning to the European debt market, kicking off a 6-part bond sale. The Google parent company looking to sell at least $3.5 billion worth of bonds. The longest portion of the deal has a note maturing in 2063.
This strikes me, it reminds me of something that Amanda Lynham of Goldman Sachs said, that ultimately the biggest problem for a lot of investors is figuring out how to allow some of this debt being issued from the hyperscalers not to become too significant a part of any one index. So expect these companies to go overseas. Expect them to sell in Europe, in the UK, over in Japan, in order to raise money in a myriad ways to fund the $725 billion of capital expenditures that they need to finance. That's the reason why you're going to see all sorts of creative financing. It's sort of like a kid eating their peas. They don't really want to eat peas. If you're going to leave a lot of them, you want to spread it out over here, over there, over here, hide them under the mashed potatoes.
into ice cream.
And essentially, that's kind of what's happening.
Well, we're going to get more ice cream on Wednesday when we have the Treasury coming out, massive debt issuance, and as we talked about earlier, much higher than we were expecting from when they talked about it last quarter. And they say this is, quote, primarily due to lower projected net cash flows. So there's a ton of debt this week coming to the market.
It's the crowd and gout that gets a little bit more interesting, right? The Treasury wants to come to the market too, potentially issuing a lot more debt as well. And ultimately, if you want to entice that investor appetite, you've got to put up the yield just a little bit. Maybe we see more of that in the year ahead.
I'm guessing you're probably going to see more of that all around, which, as we were just hearing from Jeff Yu, people are thrilled about. If you're a bond investor, it doesn't mean you're going to demand less yield, but all of a sudden you can get income for the first time. What does that mean, though, for borrowing costs more generally? And that's the reason why it was difficult for him to answer. Would you buy long-term bonds if potentially there's a policy error on a central bank side? Because ultimately the fiscal response from both hyperscalers and from governments remains to be seen.
More debt. We'll come back to this a little bit later, of course. I want to talk about crude, Brent and WTI. Brent around 113. What a 24 hours we've seen. The US military fighting off attacks in the Middle East, facilitated the passage of 2 US-flagged vessels. The US had to shoot down 7 small boats. At the same time, there were drone attacks in the UAE, several missile alerts for the first time since the ceasefire. And in a separate incident as well, the UAE, an oil tanker there, struck by drones. That's just the last 24 hours, and still this morning, we're just about clinging, holding on to that ceasefire. Jorge Leon of Rystad Energy joins us now for more. Jorge, welcome to the program. It's surprising to some that we're still here at 112 on Brent, WTI at 1.4. And maybe the question is, why aren't we higher? Why are we still so low?
Thank you for having me. Well, that's the big question, I think. And I think the way I think about it is we are in a much better situation than 4 weeks ago. Let's not forget that we're now in the 4th week of the ceasefire. The ceasefire has sort of held steady, right? I mean, we haven't seen much action, and we knew that the ceasefire, by definition, was always going to be shaky. So I think that the market now is expecting that this ceasefire, even it is shaky, that it will continue. And let's also not forget that the diplomatic channel is still open. We're hearing some exchanges of proposals between Iran and the US, and there seems to be an open communication channel there. So I think the expectation from the market is that at some point, diplomacy will take over, and hopefully this will be resolved.
That is the more favorable, constructive perspective, without a doubt. And on a global basis, Goldman Sachs noting, of course, that oil stocks on a global basis aren't yet at critical levels. But they do say this: it significantly understates the risk of country product shortages. When you strip away the global story and just focus country to country, Jorge, where are the problems starting to arise?
I think that for me, the main problem is kerosene in Europe. I do think that we're likely to have a problem in the next few weeks. We're seeing now oil energy companies and flight operators mentioning this, highlighting this risk. We've seen a lot of flight cancellations in Europe, in continental Europe. We've seen some airlines charging an extra fee for the future flights, and we've seen a lot of cancellations. So I think that is one very important pressure point that we're likely to see even more in the coming days and in the coming weeks. That's, for me, the main worrying thing.
What kind of price levels could we see if we do start to see actual shortages start to manifest in the European continent?
Sure. So we have an extreme scenario where if there is no resolution to this conflict, and this becomes a protracted conflict, a prolonged conflict, and we don't see a significant de-escalation or even a narrow deal sometime soon, we think that oil prices could increase above $180 per barrel during summer. That is much higher than during the Russia-Ukraine war, and that is likely, of course, to prompt a recession in Europe for sure, and in parts of Asia, probably at the global level, we could see a reduction in GDP growth from 3.0% to probably closer to 1.5% growth. So there are these extreme scenarios, and I think that we should start also thinking about these tail risks, these tail scenarios, because as I said, I remain optimistic. The diplomatic channel seems to be opened. Our base case is that there is going to be a narrow deal at the end of May. But we should also think of those, other scenarios where $180 per barrel is something that we could easily see.
What we're seeing isn't necessarily demand destruction, which is simply an inability to transact in business in certain places where there are physical shortages. At what point do you get more traditional demand destruction just based on the level of pricing?
I think we are actually seeing now demand destruction at a certain point. Of course, not massive. We are seeing countries around the world implementing measures to reduce oil consumption, working from home, public transportation, et cetera, et cetera. So we are seeing now demand destruction. But I think that the moment that you have oil prices above $120, $130 per barrel, that is when really things start heating up, and you will see quite a bit of demand destruction. Let me give you one interesting data point. Before the war, we thought that oil demand was going to grow by 1 million barrels per day in 2026. Right now, we think that oil demand is going to contract for the first time since COVID by around 100,000 barrels per day. And I think that the risk is skewed to the downside there. So we are seeing demand destruction at the moment.
We do see, though, Diamondback saying they're going to raise output immediately because of how high oil prices are. Will we see more oil companies step in if prices continue to rise?
It very much depends on how long prices will stay at these elevated levels. But let's assume that they stay for the next 3 to 4 months. We will see some supply reaction. But let's not forget that in the short term, supply is quite inelastic. Yes, we could see a few hundred, a couple of thousand barrels at the global level of additional supply. Probably in the U.S., we could see more in Brazil. We can see a little bit more in Venezuela, probably. But it's quite inelastic supply in the short term. And also, let's not forget that the supply disruption is closer to 10 million barrels per day. So whatever additional supply they might come, whether it's 200, 300,000 barrels per day, is minimal in the big picture, right?
Jorge, does OPEC still have the same weight, given the fact that the UAE has left?
I think that's a great question. I think OPEC is slightly weaker now that the UAE has left. I think right now, regardless whether the UAE left or not, right now the ability of OPEC to manage the market is extremely limited because of the closure of the Strait of Hormuz. But if I think of a scenario where the Strait of Hormuz reopens and we're in 2027, 2028, let's think about that. And I see OPEC with a lower spare capacity because of the fact that the UAE has left, then that tells me that OPEC will have less tools to manage the market. So I'm a little bit worried about how efficient OPEC and particularly Saudi Arabia as this central banker of oil markets role they have can actually deliver and ensure stability in oil prices.
Jorge, it's good to see you. Thanks for dropping by and catching up with us. Jorge Leon there of Rystad Energy, every producer for themselves once this war is finished.
Absolutely. I mean, for the UAE, this has been a long time coming, but you can see for a lot of these countries, especially if you don't have the kind of finances the way Saudi Arabia does, they're going to want to flood the zone. We already see Iraq saying, if you can get our barrels out of the Strait of Hormuz, they are cutting it basically in half. $33. Unbelievable. There's going to be some traders that are going to say, yeah, I'm game for that.
It's a trade for the brave, right?
I was about to say, all you have to do is face off with those speedy boats that are coming towards you. Not a big deal. If you're willing to do that, we got a deal for you.
The president makes these severe things sound like cartoons, right? These speedy boats,
the whole thing,
these super quick boats.
I mean, look, some of this could be really characterized as a cartoon. It is anything but, and it has very real world impacts.
Brent crude this morning, 112.80. We're down by about 1%. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Apple is holding exploratory discussions about using Intel and Samsung to produce its processors for its U.S. devices. Sources telling us here at Bloomberg, the iPhone maker held early stage talks with Intel and Samsung, but no orders have been made yet. TikTok owner ByteDance says it will be charging some users for its new AI chatbot. Fees will range from $10 a month for the basic version to more than $70 for more sophisticated platforms. Indian Prime Minister Modi's BJP winning a historic landslide in West Bengal. It ends 15 years of rule by the previous chief minister. The win underscoring the BJP's broadening support base beyond traditional strongholds in the north and west. That is your Bloomberg Brief. John.
And Vonnie, thank you. More from Vonnie in about 30 minutes into the next hour. Up next on the programme, growing risks to policy.
The risk to both of our mandate goals has increased. Heightened uncertainty from the Middle East conflict present an unusual set of circumstances.
Up next, we'll catch up with Jane Foley of Rabobank, live from New York City. You're watching Bloomberg TV.
my old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. It doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start on the third floor or the lobby. You actually have to start in the basement.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute automotive news whenever and wherever it happens. I'm Matt Miller in Detroit, and this is Bloomberg.
So here's the state of play. Equities bouncing back by a third of 1% on the S&P 500. On the Nasdaq, up by 0.6. On the Russell, we're higher by 0.5. In the commodity market, setting the tone for the market in the last 24 hours or so. Brent crude bouncing back to 113, lower this morning by 1.3%. But this move in the bond market holds. 2s, 10s, 30s, very close to the highs of the year on 10s and 30s. On 30s, we're right there. North of 5% on 30s for the first time since July.
People were saying this is really led by the term premium. It isn't led by break-even rates. That has been true perhaps until now. When you take a look at 10-year break-even rates, they've reached the highest level going back to 2023. Not anything to write home about, 2.5%. Not necessarily terrible, but still well above that 2% target. Is this a Federal Reserve tacitly acknowledging that the new target is something closer to 2.5%? Or is this the market just slowly creeping, sending a signal that inflation is going to be higher for longer?
They've been ignoring 2% for how long now?
More than 5 years.
Okay, we heard from President Williams yesterday. We'll hear from him again in just a moment. President Williams has been saying the same thing over and over again for the last 5 years. We're on the path back to 2%. We're on the path back to 2%.
In 2067.
Right.
Ultimately, this is a Federal Reserve that has tacitly acknowledged that a 2 to 3% range is okay. Do they formalize that, or do they tighten the screws that much more? Ultimately, if inflation is a choice, are we just choosing a new target?
Under surveillance this morning, growing risks to policy.
The risk to both of our mandate goals has increased. The elevated levels of inflation, mixed signals from the labor market, and heightened uncertainty from the Middle East conflict present an unusual set of circumstances. But the current stance of monetary policy is well positioned to balance the risks to our maximum employment and price stability goals.
So here's the latest this morning. The Federal Reserve facing an uncertain path forward with a growing number of policymakers leaning towards a more cautious approach. Jane Foley of Rabobank writing, it is our view that the Fed will be led by Wash into cutting rates further later this year. Jane joins us now for more. Jane, welcome to the program. Where is the support for that going to come from? Who on the committee is going to join him? And what is the argument going to be?
Well, I think you can add a lot of different factors into there. You can add in the AI, the productivity stories. You've got to see some weakness in the labour market, I think, for that view to really get extra traction. And of course, the political element, assuming that Walsh does get approved as governor. But you know, I would agree that the Fed will not explicitly say that they're allowing the inflation target to be higher because they want to keep inflation expectations anchored, and to do that. that, they will carry on saying that they're still targeting 2%. But, it's Rabo's view right now that they will see sufficient weakness in the labour market to push forward. But clearly, there's a lot of risks to that view.
Jane, this came from Neil Dutta of Renmac. Lisa was talking about him earlier on in the programme. I'll share the quote with you. Delivering on the dovish policy the president wants will probably take on a much different meaning than at the time Kevin Walsh was nominated. Neil goes on to say, it means keeping the policy rate from climbing, balancing the tensions of higher spot inflation against cooling real activity. Keeping the policy rate from climbing might be viewed as sufficiently dovish later this year, given where inflation might be, Jane. What do you think about that?
Well, you've got to put that in context with all the other G10 central banks. So right now, if you look at the whole list of G10 central banks, the market pricing is suggesting that they're all going to hike in the next 6 months, with the exception perhaps of the Swiss, apart from the Fed. So in that context, it is already dovish. But you know what? That's been the case all year. So we go back to February before this conflict, and policy rates were only confident of the Bank of England and the Fed cutting interest rates further this year already. So in market policy rates in February, we're already implying that the market wasn't that uncomfortable with the view that all of those other central banks could be hiking as their next policy move, albeit probably next year, not this year, as the market is now expecting.
It seems like there's a divergence right now, Jane, between bond markets that seem to be pricing in a significant chance of even the discussion of a rate hike at the Federal Reserve. They are pricing in a rate hike at the ECB, but they have reduced their expectations for how much the ECB is going to hike rates. There's a sense that people are viewing the Fed as more hawkish and the ECB marginally a little bit more dovish than a couple of weeks ago. And yet currency markets are not reflecting that at all. If anything, the dollar has underperformed what a lot of people would have expected it to do, given the sort of risk-off feel that's been underpinning some of the oil markets in particular. How do you explain that?
I think there's two different stories here. And I think, first of all, there was the safe haven story for the dollar. And we saw that really playing out at the very start of this conflict. So the dollar performing really well in March. And of course, the market had gone into this conflict short dollars. So you saw this short covering, the dollar went up. And then, of course, last month in April, those gains were unwound. And meanwhile, there was also a very significant story going on with this sort of readjustment of policy rates. So, for instance, if you look at the performance of G10 currencies since the start of the conflict, sterling is right up there. You might think, well, that's unusual, isn't it? There's local elections coming up this week. That's not going to be good for the government. Why has sterling performed so well? Well, it's simply because the adjustment in policy rates, and I think we all know this now, was so significant. The market went from pricing in cuts to pricing in as many as 4 interest rate hikes, and perhaps it's still too aggressive. And I think this is one of the things that's going to carry on playing out. And, you've just pointed this out with respect to the ECB. The market has backtracked a little bit on those initial rate hike fears. I think perhaps there's more to go, particularly for sterling or for the Bank of England on that front, because these economies are oil importing economies, and these economies are likely to be hit harder than the US by the impact of inflation and the impact of this supply shock. And there's still this story playing out in money market rates, and that's still going to be reflected in foreign exchange.
Just based on growth differentials, are you surprised the dollar isn't doing better?
I think the dollar can hold up maybe better. I mean, if we look back to, say, last April, if we look back over the last 12 months, the dollar has been clouded by a whole load of negative sentiment, really built around this whole de-dollarization story, this whole, the dollar failed to act as a safe haven last April on the heels of the tariff announcements from President Trump. That Trump wants a weaker dollar. There's a whole host of negativity surrounded by the dollar. And I think, going into this year, or going into really even last month, that the market is still sort of overshadowed by that. But if we look into the medium term, if we look at the tech investment, if we think about productivity gains, if we think about the advantages that will give US trade over the next, 10, 20, 30 years, there are still some really strong positive US economic stories there, which can ultimately, I think, really help support the US dollar over the medium to longer term.
I think Japan would like a weaker dollar as well, based on the last week we've just seen. Hey.
I think that they would pay for it. In fact, they've been trying to pay for it, and let's see if it works.
Hey, Jane, it's good to see you. Thank you. Jane Foley there. of Rabobank. We hit 160, closed at that level last Wednesday. The Japanese stepped into the FX market. The past 3 days, yen weakness. Not big moves, but just yen weakness starting to come back into the market over the last 3 sessions.
If this is a Bank of Japan that's not going to hike rates, well, they're not going to be able to stave off the general weakening trend that we've seen in the face of higher inflation, given the concerns that markets have that ultimately this is an overly dovish administration. You're going to see that kind of bond vigilantism around the world. Again, one of the reasons why you're seeing yields creep higher.
You're getting battered by terms of trade shock. One-off intervention might stop the tide a little bit, a day here, a day there, but the trend's still pretty brutal if you're not hiking interest rates.
Burning money makes sense if you can decrease the inflationary input from imports for a longer period of time. Burning money does not work when it lasts for literally a day. So we'll have to see exactly how much tolerance there is for that.
Dollar yen around 158 this morning. Coming up next, we'll catch up with Tracy McMillan of Wells Fargo, Victoria Coates of the Heritage Foundation, Gil Luria of D.A. Davidson, and Torsten Slok of Apollo about AI and the labour market. That's going to be an interesting one about an hour from now. From New York City this morning, good morning. The second hour of Bloomberg Surveillance, just around the corner.
Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation. As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlett Fu, who's taking a closer look at drone companies. With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. And we're here, where the action starts in Sydney. And in Tokyo, get ahead as the global trading day begins. The Asia Trade, weekdays only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up. Sorry.
The U.S. economy is unbelievably resilient.
The job market seems to be undeterred so far.
The balance of risk is actually shifting more to the inflation side.
The Fed is
again, kind of caught between a rock and a hard place.
We're only forecasting one cut in 2027 now.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your price action of scores look like this. Bouncing back from pretty muted losses yesterday, up 1/3% on the S&P 500, up 0.6 on the NASDAQ crude, and almost 6% move on Brent in yesterday's session. Some real tension boiling over in the Middle East yesterday, taking Brent crude higher. This morning lower by 1% to 113. And these moves in the bond market, 10s and 30s, yields new highs for the year on a closing basis. 10s just short of 443, 30s still north of 5%, heading into a week full of economic data, including data later this morning. PMIs in America, 9:45 Eastern, 10 a.m. Job openings and the ISM.
Is good news potentially going to exacerbate the sell-off? I don't want to say it's bad news. We all welcome the idea of a labor market that is strong, of manufacturing and services that are strong. Nonetheless, the strength has really put a feature on how long the oil prices can remain high without inflation taking off. That's the reason why you see in the bond market the tension of both issuance coming in and robust potential inflationary pressures coming together with the highest yields that we've seen all year.
This week's a big week for the job market. The data on Friday, important in that regard. Payroll's just around the corner. Two headlines back-to-back just crossed into Bloomberg, getting our attention. This from Coinbase, planning to cut the workforce by about 14%. PayPal, planning job cuts as well. Those headlines just starting to build, just on the margin.
So here's the why. On one hand, you could say Bitcoin's been battered. Coinbase hasn't necessarily seen the promise as much, so maybe that's the reason why they're cutting back. But the number two, AI. They're blaming AI. They're saying AI is changing how we work. This is Brian Armstrong, the CEO of Coinbase, out on Twitter earlier. Over the past year, I've watched engineers use AI to ship in days what used to take a team weeks. He went back to say we need to return to the speed and focus of our startup founding with AI at our core. We heard this from Block. How many more CEOs are going to use this as an excuse? Is it an excuse, or is it a fundamental shift in the labor market that highlights how AI could cannibalize from existing jobs?
What's the phrase people are using? AI washing. Was Block AI washing? Is this AI washing?
At the same time, this is something that a lot of people are saying. And when you take a look at what you can actually do with the tools, I go home every night to a lecture on Claude. Claude could do this, can you? No, I can't. So at a certain point, you start wondering.
I'm just so happy I don't live in your household. I don't want any more lectures on AI. But PayPal is saying that they're cutting because they pursue a turnaround strategy. Remains to be seen if that is because of AI. But AI potentially could be this useful excuse if maybe you also were hoarding up some of your labor, and now's a good time that you want to potentially lay off some individuals, and now you can say, well, actually, we're making it more efficient.
Some AI washing, maybe in the labour market. We'll spend some time on this later this hour with Torsten Slog. Equity futures on the S&P, positive by 0.3%. Coming up this hour, we'll catch up with Tracy McMillan of Wells Fargo as equities bounce. The former Deputy National Security Advisor, Victoria Coates, as tensions build ahead of the Trump-Xi summit. And Torsten Slog of Apollo, expecting AI to create more jobs than it cuts. That's a timely conversation. We begin this hour with stocks grinding higher as tech faces another earnings test later on today. Tracy McMillan of Wells Fargo writing, earnings beats and guidance are strong as investors focus on AI spending levels, ROI, and adoption pace. Tracy joins us now for more. Tracy, welcome to the program. Just share some numbers with us. How powerful has this earnings season been already?
Good morning, John. It's been a spectacular earnings season so far, and what we're seeing is earnings approaching 25% on the quarter, and we came into the quarter with analysts expecting about half that number. So it really has been an exceptional earnings season, and enough so for investors to compartmentalize what's happening in the Middle East with the war for the most part and focus on those earnings and push prices higher.
So Tracy, a lot of people have pointed to a handful of names that have supported that earnings growth. What does the median stock look like? And with that in mind, why is the equal weight S&P underperforming as much as it has been more recently?
Yeah, we've definitely seen a reconcentration in the stocks that are outperforming, and that's because during the earnings season, what we're seeing is that those are the stocks that are really exceeding investor expectations in terms of growth. And we have also seen, because of the war, growth expectations coming in from economists, across various firms. And so when that happens, investors look for growth. When growth becomes scarce, investors look for growth. And that is what we think we're seeing here.
Tracy, have we already seen the best of this rally? I mean, is it over? I asked after Ajay Rajadaksha of Barclays came on at the end of last week and said he had been really bullish on this equity market, was moving more neutral, just because the pain is going to start biting now from higher oil prices.
Yeah, it's really not unusual after such a strong rally to see a pullback in stocks. And, right now, what we are forecasting is moderate growth and higher inflation with probably a 4 handle across the coming months. And that is if the war begins to wrap up. And if we see a continuation of the war, then we've got to look at those more negative scenarios where the best might be behind us for this year.
So what does it mean for the war to wrap up? Right now we're having a debate in real time about whether it's a ceasefire or not a ceasefire as people lob missiles at one another. Is the status quo enough to actually create a more benevolent backdrop for risk assets?
So we probably are going to need to see more ships passing through the strait in order for it really to be a more attractive environment for equity prices to move higher, because we are getting to the point where there's going to be some demand destruction and even some scarcity in parts of the globe. And if we don't get the oil flowing back through very soon, then we're going to be confronted with even higher prices and the possibility of that higher inflation for a longer period of time.
Well, the president said yesterday this is going to be a few more weeks, at least 2 more weeks. When would you need to see this in terms of more ships pass through the Strait of Hormuz in order to have still this bullish case?
Yeah, so we're already starting to see those buffers erode. The stockpiles that countries have been utilizing in the face of the scarcity that we're seeing in oil. So, maybe a couple more weeks, but we have already seen enough damage that it's going to take months, possibly years in some cases, to repair some of that damage. So we expect elevated oil prices. But to your point about the bullish case, right now we're anticipating about a mid-single-digit climb for the S&P 500 from here. So not terribly bullish from this point, but we do need to see oil starting to flow again, or we're going to have to look at a more negative scenario.
Tracy, I've got some bonds to sell, so bear with me. I'll give you some numbers. We'll head over to the UK and we'll start there. Yields higher across the curve, playing catch-up. The Brits were on vacation yesterday. 2s up by 12, 10s up by 12, 30s up by 11 to 576, and the highest yield we've seen going back to the late 1990s. You've got to go back to 1998. Tracy, are you a buyer?
So we are in the intermediate investment grade space for U.S. bonds. And that is the primary area where we are focused right now. We feel like long-term bonds continue to face some pressure from potentially higher inflation and higher rates. And so we've been pairing that and moving that into equities on equity weakness. So, intermediate space, 3 to 5, 7 years, U.S. investment grade is where we'd be buying.
U.S. specific, U.S. and U.S. investment grade. Where does the UK and the European story fit in, if at all?
So it fits in on the equity side. We're not buyers of developed market bonds at this point. But we are buyers of developed market equities, and we're looking there at defense names and financial names. Financials are a large component of the developed market index, and so there we're expecting a steepening yield curve. And again, negative for bonds, but potentially positive for financials.
Tracy, financials, just to finish on that. Over at Wells Fargo seems to be a high conviction equity sector call for you guys. Where does the confidence come from?
Yeah, it's coming from that steepening yield curve, and we're already starting to see that with the yields rising. It's also coming from deregulation in the background, helping margins. And we also think that there's going to be a reacceleration in M&A, and that should help investment banks.
Tracy, appreciate it. Thanks for the update. Tracy McMillan there of Wells Fargo. I was trying to sell some UK gilts. Tracy's not buying.
I don't think a lot of people are buying, which is the reason we've got the highest yields going back to 1998. The United Kingdom in a uniquely terrible place because on one hand you've got the inputs of higher energy costs, and then there's a question about political turmoil, whether Keir Starmer is going to remain prime minister, whether they're going to have to sell more debt, what the next leadership's going to look like, and will there be a fiscal response to an energy crisis, which is the ultimate fear for a lot of bond vigilantes.
And it's not exactly confidence in Starmer, it's fear of whatever comes next. That's what the leadership jitters are about.
Essentially, do you end up with a much more fiscally liberal type of person who is going to spend and potentially try to raise money that way, raise money through taxes, maybe just end up with...
And expect a different result at the same time, yeah.
We can go into that in a bit.
So, another time.
Yes, indeed.
Another time. 30s this morning over in the UK, the long end of the curve at 576, yields up 11 basis points, numbers we haven't really seen since the late 1990s. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Officials are investigating a shooting near the Washington Monument. The Secret Service says law enforcement shot an unidentified man after he opened fire on them. The alleged gunman was hospitalized. A teenager was also shot, but not seriously hurt. The SEC says it's investigating allegations of fraud in U.S. private credit companies. Chairman Paul Atkins told the Milken Conference in Beverly Hills they're taking the allegations seriously, but declined to say specifically which companies are under scrutiny. Nearly a month into a fragile ceasefire in the Middle East, the U.S. and Iran exchanged fire on Monday in the Persian Gulf. U.S. Central Command says the military fought off Iranian drones, missiles, and small armed boats as it guided 2 U.S.-flagged vessels through the Strait of Hormuz. That is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next on the program, China on the horizon.
We're leading China in AI, and I'm going to go see President Xi in 2 weeks. I look forward to that, but it'll be a very important trip.
In just a moment, we'll catch up with the former Deputy National Security Advisor, Victoria Coates, live from New York City this morning. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg. Bloomberg.
45 minutes away. We should get a briefing from the Defense Department. We'll bring you the headlines from that a little bit later in the next hour. After that, in the following hour, lots of economic data starts to come through. PMIs at 9:45 Eastern Time. The ISM and job openings data at 10 a.m. Job openings a little bit dated, but sets the stage for the data through the week. ADP tomorrow, claims Thursday, payrolls this coming Friday.
What does this market do if this is a hotter than expected labor market print, or labor market week, I should say, given all of the data points leading up to that? Is that embraced as a sign of resilience for the U.S. economy, or does that give a sense of heat underpinning some of the resilience that could potentially cause the increase in oil prices to be more inflationary than they are a suppression to growth? That's the tension underpinning markets.
Hello, Kevin Walsh, and welcome to the Federal Reserve. Right, what's your first job? What's the first mission? 6 months ago, it was cut interest rates. Let's see if the new guy can cut interest rates. 6 months later, I think Neil Dutter's nailed it. The new mission is to stop everyone else from pushing the hike.
Yeah, potentially coming up with some sort of new framework. My question, if I could be anything, I would be the fly on the wall in a conversation in the lunch between Kevin Walsh and Scott Bessent. What are they planning to do with a Treasury-Fed accord, with the issuance that we're expecting from the Treasury Department, with potentially how the Fed's going to rearrange their balance sheet, and then how they're going to look to AI to somehow give them justification to cut rates? It is a difficult brew, and they're probably going to sit on their hands for a while.
So we get the Treasury quarterly refunding statement and the announcement about where this is going to fall across various maturities. A lot of it is in T-bills. Thank you, Janet Yellen, for that one. Treasury Secretary Scott Bessent said he would change things. They've not changed. And the pressure based on where things are, where rates are today, pressure is going to be to maintain the status quo, which puts a lot of pressure on short rates and ultimately the Fed policy rate when it comes to where the Fed is and where government borrowing costs are.
This is another way to financialize the balance sheet. Essentially, if you shift it all to the front of the yield curve, and then you have the central bank putting their thumb on the scale of what exactly the rates are, then you can potentially lower the borrowing costs of the United States. Does it become at the expense of the dollar? Where is the sort of release valve in that type of scenario? These are the scenarios people are trying to game out as they figure out who is Kevin Walsh.
We'll find out in the next month or so, maybe. Equity futures on the S&P up by 0.3 on the S&P 500. On the Nasdaq, bouncing back by 0.5. Talked about these crude prices, still elevated. Brent at 113. Lower today by about 0.7%, but trimming those losses. WTI at around 105. Under surveillance this morning, China on the horizon.
We're leading China in AI, and I'm going to go see President Xi in 2 weeks. I look forward to that, but I'll say I'm leading. We have very friendly competition, but it'll be a very important trip.
Here's the latest this morning. President Donald Trump and Chinese leader Xi Jinping preparing to meet as the two countries navigate tensions over trade and technology. Bloomberg's Tyler Kendall has more. Good morning, Tyler.
Hey, John, good morning. Well, President Trump is signaling that the trip is still on after previously delaying the planned visit due to the conflict in Iran. That means we're a little over a week away, May 14th, from this highly anticipated visit, where a senior administration official tells me that trade is still expected to be front and center. In fact, both sides have signaled an openness to establish a new mechanism to make sure that economic dialogue stays open, potentially announcing a new U.S.-China Board of Trade during the visit. But of course, the tensions in the Middle East are threatening to derail or overshadow any potential progress. As we know, both sides have been jockeying for leverage. This White House has been trying to put on the pressure on Beijing to help reopen the Strait of Hormuz, as data shows us that nearly 38% of total oil flows through the waterway go to the country. And it's actually not just the White House. In fact, we saw Congress take some serious steps last month to advance a flurry of legislation that seeks to tighten export curbs when it comes to AI technology going to Beijing. Now, of course, China has taken its own series of steps in the past few weeks, including what was considered an unprecedented act of defiance just the other day, urging companies not to abide by U.S. sanctions on private refiners that are linked to Iranian oil. And John, new this morning, China confirming that it has invited Iran's foreign minister for a visit tomorrow for the first time since the war began.
Tyler Kendall, how connected are these these two stories. Tyler, thank you. Joining us now, the former Deputy National Security Advisor, Victoria Coates. Victoria, welcome back to the programme. Lisa's asked about this, Anne-Marie's asked about this, I've asked about this. How connected are the stories? The meeting in the middle of this month between the Chinese and US leader and the war in the Middle East?
Well, great to be with all of you, John. Good morning. Actually, the headline is the meeting next week because, you've been talking all morning about the oil prices, the war in Iran, the effect that has on the global economy. What happens between the United States and China is exponentially more important for the global economy. And so I think that that's why President Trump is keeping this trip on the books. We're seeing the preparations start in Beijing. So I think he's going to go there and try to, as Tyler was just reporting, come up with a new mechanism to make sure the trade stays under control, but also to see if we can get to some conflict resolution before it even begins with China, because nothing could be more devastating than a conflict between the United States and China. That's what I think the president wants to prevent.
But the Treasury Secretary said yesterday on Fox News, let's see them step up some diplomacy and get the Iranians to open the strait. Is this going to be an ask from the President of the United States on the Iranians? Are they getting ahead of it with already inviting Abbas Araghchi to Beijing to have a meeting with Yang Yi tomorrow?
Yes, I think the visit of Araghchi to Beijing tomorrow is extremely important because bear in mind, this is hurting China too. You're talking a little bit about those teapot refineries that they depend on for kind of cheap bootleg fuel going into the Chinese economy. So they need those tankers to come out. That reverse blockade that President Trump put on Iran is hurting China more than anybody else. So I don't know that this is an ask from President Trump as much as it is an ask from Chairman Xi that Iran get this situation resolved so that oil can start flowing to them again.
Tyler also mentioned this unprecedented stance, really defiance from China to basically tell some of these private refineries to ignore U.S. sanctions. Does OFAC need to come down hard on these to make a statement?
Oh, I think so, and I think they will, because in China you have this kind of dual universe where they pretend these things are private. Pretty much everything is public in China, is controlled by the government, and that's what they're demonstrating here, that they can force a private industry to take the risk of U.S. sanctions because they need that energy to get onto their markets. So I think that really shows you that they are hurting from this, and that U.S. sanctions are one of the most powerful economic tools on the planet.
In the meantime, Victoria, we've learned something over the past couple of days, and that is that the bar to restart real active warfare is incredibly high. Do you have any sense how high that bar is? What could actually trigger a restart of kinetic warfare?
Well, I think it would probably take some kind of more spectacular Iranian attack, because my understanding from the administration is they think the economic pressure on Iran is becoming just devastating, that it's not sustainable. And we've gone through these metrics before, but it gets worse every week. We're in month 3 with no internet, no stock market. The entire economy has ground to a halt. And as they run out of storage for their oil, that problem is going to become even more acute. And so you're looking at an economy that's on the verge of collapse. So I think the administration's view is they don't need to restart major kinetic activities right now. They can let that pressure continue to build. And we have seen some shifting on Iran's position on the nuclear file. They're starting to say some things that were completely impossible, off the table 3 weeks ago, are now suddenly something they'll consider. It's not the deal the president wants, so I don't think he's going to accept it, but it shows they're starting to move as that pressure builds.
Victoria, it seems like the pressure is building for President Trump as well. A recent poll from ABC, the Washington Post, and Ipsos showed his disapproval rating at record low. How much do you see this as forcing the end of some sort of conflict, especially heading into the midterm elections?
No, that's certainly obviously a consideration. The president is a politician. We are going into midterms, so the notion that that's not being taken into consideration is disingenuous, to put it lightly. But I think at the same time they do have time on their side compared to the Iranians. And if the Iranians wait this out, as it were, to the point that they face that kind of systemic economic collapse, then they're going to cease to exist as a regime. So I think they face a harder decision than the administration does. And certainly the fact that the president is keeping the trip to China on the books demonstrates that, he's coming at this from a position of strength. He doesn't feel tethered to the White House. He feels he can do other things on the global diplomatic stage.
Victoria, what is, though, the pain threshold for this administration? Because if you look at AAA national average today, it's basically $4.50. We're getting very close to $5 a gallon. And of course, if we hit that mark, then he would surpass the high that we saw under the Biden administration. I imagine that is what they are trying to avoid.
Oh, of course. And nobody wants these, these elevated prices over the long term. I mean, the American people shouldn't be feeling this pain given our role as one of the world's major energy producers. But at the same time, that this is something that's being caused by Iranian actions. The elevation of prices under President Biden had very different sources. In this case, we have an international situation that needs to be managed. It is, as the president has put it, an investment on the part of the American people to get out from this threat from Iran that we've been laboring under for 47 years now. They've been threatening to do this periodically for 50 years. So I think breaking that threat, preventing them from using this as leverage in the future is certainly worth this effort now.
Victoria, always good to see you. Thanks for making time for us. Victoria Coates there, the former Deputy National Security Advisor. The blockade makes a heck of a lot more sense than the absence of one. The idea that at the very beginning of this war, that Iran were the only ones being able to use the Strait of Hormuz made absolutely no sense at all.
Not only that, not only were they allowed to use the Strait of Hormuz, but OFAC at that moment, remember, for a few weeks' time, said it was legal to buy Iranian crude that was already on water, and we saw countries like India do that, which haven't done that in years.
Brent crude 113, WTI around 104, 105. Up next, we'll catch up with Gil Luria of D.A. Davidson, cutting his Palantir price target, plus your high-risk got your morning movers. Coinbase rising after announcing layoffs. Their stock is up by close to 4%.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Just spent the last 3 minutes, best of the last 3 minutes, 2 to 3 minutes, arguing about the absence of Knicks coverage. Do you want to do it now?
No, it was just an incredible game.
Game one. What do you want to do?
It was an incredible game.
Okay, what was the score?
Hold on, I gotta find it now.
Okay,
I don't have
great.
it up. I was waiting for it.
Prep next time. Come on. Future's positive. On the S&P by a third of 1%. On the Nasdaq, we look like this, up by 0.5. On the Russell, up by 0.5. That is never happening again. In the commodity market.
137 to 98. I thought it was 139. It's fast, bro. Commodities.
Just forget it. We're talking about crude. 113 on Brent. WTI 104. Yields closing high of the year in yesterday's session. 10s this morning, 443. 2s at 394. It's not just the US. The UK playing catch up. The market was closed yesterday. This morning, higher across the curve, up by 13 basis points at the front end of the UK curve. 30s at the long end. 576, the highest since 1998.
And you keep asking people who come on, and you'll keep asking people who come on. Are you in the mood for some UK yields at 30-year yields at 5.76%? The answer so far this morning, no, I'm good. I'm actually just fine. And this just raises the concept of how much there's kind of a buyer strike of long-term debt in certain places, and where that leads us in terms of yields. We're all watching in real time.
The outlook for growth is pretty dreadful in Europe right now. The Germans have come out, I think, forecasting something closer to 0% than 1%, maybe something in between. You'd think that's a decent argument to be buying the long end of these curves, and you're not seeing that buying step in a big way anyway.
Because of the fiscal response that potentially could come down the pike, you have Germany that at one point was saying no debt, and now is saying some debt for defense spending. At what point do they open the purse strings a little bit further? We see this across Europe. Maybe they should, or should have been maybe 5 years ago, and this is a bit of a catch-up as they try to build out their ecosystem.
Do you want to redeem yourself?
Well, look, the score was so big, I had to remember how big it was. 137 to 98. Jamie Berlin, we won our last 2 games by a combined 90 points. Last 3 games by 119 combined points, and first team to win 3 straight playoff games by more than 25-plus points. Jamie Berlin says that domination.
Jamie Berlin being one of our producers.
Yes.
Who you've reached out to just to get stats from.
Yeah, he was at the game.
On the basketball. He was at the game.
He was at the game. So if you watch,
he has a mug.
If you watch the playback like I do in the morning, you could see Jamie Berlin there. Incredible.
Okay, you're talking about Jamie like everyone knows who Jamie is.
Well, you do, so you can explain that, yeah.
They should.
He's our #1 Knicks reporter.
Okay, all right. Equity futures on the S&P, positive by a third of 1%. Shows off the rails. Let's get you some morning movers. Some individual stocks. Yahara has more. Hey, Yahara.
Hi, John. I actually learned something there. But we start with Coinbase. Those shares are moving higher, up 4% in the pre-market, as the company says AI is helping it run leaner. So it is cutting 14% of its workforce, with CEO Brian Armstrong pointing to more workflows being automated. We will hear more from this company when it reports earnings on Thursday. And like the last name, PayPal is also cutting jobs. Shares are slightly higher in the pre-market, trimming some gains, part of a turnaround under its new CEO, targeting around $1.5 billion in cost savings. And while AI was not cited here as a reason for the cuts, I will note that the company just last week announced a new leader focused on AI and simplification. And we end on something more physical. Anheuser-Busch, those shares are rising nearly 7% in the pre-market after volumes grew for the first time since 2023. This is notable as brewers are struggling with people pulling back on beer due to health concerns, but demand stayed strong, especially across Latin America, and it is expecting to see a boost due to the World Cup this summer. John?
Yahara, thank you. Thank you very much. More from Yahara in the next hour or so. On our radar this morning, the fragile US-Iran ceasefire is holding after the 2 nations exchanged fire in the Persian Gulf. Hundreds of vessels gathering near Dubai as Iran tightens its grip on the Strait of Hormuz, widening the control zone in the waterway. Elsewhere, Apple holding exploratory talks with Intel and Samsung about producing main processors for its devices in the US. Supply chain disruptions pushing the iPhone maker to consider alternatives to its current chip partnership with TSMC. And finally, the Trump administration is considering an executive order to create an AI working group to boost oversight. The New York Times reporting one proposal would include a government review process for new models.
So I view this as direct response to a number of polls that have come out, and even people who voted for President Trump in the previous election are feeling really wary around artificial intelligence. According to this one political poll, only 13% of people who voted for Trump in 2024 said the federal government should stay out of regulating AI, meaning the rest of them think that they should get more involved and are getting very concerned about how this looks. I wonder how tied this is to Mythos, given the fact that they're concerned about the potential cyber risk that's brewing, and how do they get ahead of it, at least from a PR stance, saying, look, we have our finger on the pulse. We're not just dropping the ball here.
Well, I think this is part of the problem. They felt like, I think they were behind when it comes to Mythos. So now they are trying to get their handle on it, and you can't wait for Congress to do this. They have basically become obsolete when it comes to this debate. It takes a very long time, so you have to start some sort of working group. The issue is, of course, we already have a number of agencies working across very advanced technology, especially the DoD. So it almost feels like they are losing the grip here, and they are trying to do something, maybe, like to your point, ahead of the midterm election.
Is this a midterms issue?
Definitely a 2028 issue. I think it could become a midterm issue depending on if you see more announcements like from Coinbase today that people are losing their jobs because of artificial intelligence, or also because you're building data centers and your electricity bills are going up, as it was in the midterms in New Jersey and Virginia.
On the margins, everything's a midterm election issue, although you have to imagine that oil prices trump this pretty significantly, and maybe this is just sort of lobbing something in there to say, look, we're on it, and let's quiet this one as we deal with these five.
This sector has a very bad branding issue that it needs to address very quickly with the electorate.
Is it a branding issue, or is it what it could actually do issue? I mean, this is part of the problem. On one hand, they're talking about how powerful it is, and that potentially is going to increase the entire United States ecosystem, the entire United States economy. On the flip side, it's at the expense of jobs. I mean, yes, Bitcoin skepticism aside, Coinbase cutting 14% of its staff because it wants to get back down to a startup culture with AI.
Says Coinbase.
Right, but we'll probably see more of that, right? More companies saying we're going to be more efficient, we're using AI, we can get rid of people, we can maybe hire less.
This is the fear. Whether it's AI washing, to use your phrase, which I'm going to have to really think about, or if it's something else, then we'll have to see.
Not my phrase, by the way.
But
We've seen so much of it.
Whitewashing makes sense, but AI washing, I mean, I guess you could do it with AI. You could do it with Grok.
Torsten Slok is going to join us later. He's got his own thoughts and some data on the labour market. Let's talk about tech. Palantir raising its revenue outlook but posting disappointing US commercial sales. Gil Luria of D.A. Davidson cutting his price target on the stock and keeping a neutral rating. Palantir is the best story in all of software. Gil joins us now for more. Gil, welcome to the program. It's interesting that you believe it's the best story in software, and yet you're still cutting the price target. What does that tell you about software, just in general?
Well, yeah, first of all, for Palantir, fundamentals are really divorced from valuation. When you have valuations at 80 times, 90 times cash flow, those things move independently of the fundamentals. The fundamentals, Palantir reported yesterday, were fantastic. 85% growth at 60% operating margins. Just to give you context, there's no other software company that's growing more than 30% with 30% margin. So Palantir, from a fundamental basis, is doing phenomenally well. But when you trade at multiples that are that high, you do have a divergence between fundamentals and valuation. And to your point, because of all of software valuations went down, we had to take our valuation down somewhat as well. And this is where Palantir is caught right now, is there's nothing they can do that's impressive enough for the market, since they still get categorized as a software company. But to be clear, the quarter yesterday was unbelievably good.
Gil, can we just talk about the growth? Palantir is one of those strange companies that so many people know the name, but don't really know what they do. Where's that growth coming from?
So there's two parts. There's the government and the commercial side that are really separate from each other. But first of all, it's not that complicated. Palantir helps government agencies and commercial entities gather disparate data from disparate sources to combine it for decision-making around the most important decisions. It's not that hard. For the government, Department of War has really been driving a lot of the growth. They are increasingly relying on Palantir for the most important things, for managing combat operations, for managing targeting. And they are, the more they rely on Palantir, the faster the growth, and the more it encourages other entities outside the federal government and in some international markets to embrace those products. That's why the growth on the government side. On the commercial side, they are able to cherry pick commercial customers, one in an industry, and help them transform their business and then capture some of that value. And their customers are so happy that the word of mouth is so good, they don't even need to sell anymore. Most of the activity on the commercial side from Palantir is incoming, and they get to be selective about those customers. So it's a really good place to be. And they're more than doubling, especially the US commercial growth, still more than doubling. And they just said that it'll continue to more than double this year and probably into next year. So they're having tremendous amount of success adding value with AI to their commercial customers. So those are the two drivers, government and commercial.
How big is the moat for Palantir versus being disrupted? And what percent of the software universe do you think has a sizable moat that could protect it from obsolescence over time as AI gets better and better?
So Palantir really has no peers right now. There are no other software companies that can do what Palantir does. The only risk somewhere down the horizon is if OpenAI and Anthropic decide to get into this business of making an impact at the enterprise level, which would require them hiring a lot of forward deployed engineers. So we're probably years away from that being meaningful. For the rest of software, the question's a lot more nuanced. There are software companies with some moats because they're entrenched at their customers. What they do is harder to do with AI. And there's a lot of software companies that what they do is exactly what AI does. And those are the companies that are already being disrupted. It's a very nuanced situation, software, which is why you've seen the whole category go down. And only a few of the companies are starting to emerge back up with success. But it's definitely a minefield of investment, has been for the last 6 months, and they'll continue to be for the balance of the year.
Gil, I wonder how much is just an excuse for a business model that seems to be flagging as developments come versus truly AI disrupting fundamentally so many businesses. And I want to go to the idea that we were just talking about Coinbase announcing that they were cutting 14% of their staff because they want to become more nimble and AI can do the work of an entire team. How much does this seem like AI washing to you without going into the analysis of what Coinbase does? And how much do you really see this as becoming more the norm as companies realize the power of some of these tools?
It is both. To be clear, it is both. These companies have been running, especially since COVID, with organizations that were too fat, and they had way too much employment. Part of it is that they're inherently very profitable businesses, so they could afford to run with staff that was too high. So now as growth slows down, they need to find a reason to cut costs, and AI is a very convenient reason. That is definitely the case in a lot of these situations. It was the case with Block, it's the case with Coinbase, and we're gonna see more of that. Part of it is companies that need to fund the investment in AI. You're seeing that with the hyperscalers, right? Everybody from Microsoft to Meta to Google to Amazon are cutting costs or cutting headcount so they can afford to build data centers. That's not AI making their business better. That's them having to pay for AI. And then there is some level of productivity that we're already starting to see, but I'd say that's the smaller part. Software engineers are more productive, and therefore we don't need as many of them. Some other roles, AI has been able to replace some tasks, so there you don't need to hire quite as many people, but that's just starting to emerge. It will be more and more of that, but as you'll hear from Torsten Slog soon, that also means companies, as they get more productive, as their employees get more productive, they're actually going to want to hire more people. Because if you get more return on labor, you want more labor. So there's a lot of moving pieces, but I would say that if I was to simplify the response, it's still mostly AI washing.
Gil, thank you, buddy. Gil Luria of D.A. Davison, and thank you for the promo. Torsten Slog, just a few moments away. Let's get you an update on stories worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. PayPal reporting first quarter earnings that beat Wall Street estimates. The company is looking for $1.5 billion in gross run rate savings over the next 2 to 3 years. PayPal plans to cut jobs and says AI is driving efficiency. Coinbase shares are getting a lift pre-market. The crypto platform also announcing plans to reduce its workforce by 14% and focus on AI native talent. Impacted U.S. employees will receive 16 weeks base pay. And here in New York, it was fashion's biggest night at the Met Gala. A slew of extravagantly dressed celebrities turned out to help raise money for the Metropolitan Museum of Art's Costume Institute. Beyoncé, Nicole Kidman, Venus Williams and Anna Wintour were the gala co-chairs, and Lauren Sanchez Bezos was an honorary co-chair. That is your Bloomberg Brief. John.
Tony, thank you. Credit to Chamalay, who chose the basketball. Went to the Knicks game instead, right?
Went to the Knicks game. Ben Stiller, though, did show up at the Met Gala, but he did wear an orange tie. He should have just walked the red carpet. This is what I would have done. Walked the carpet and then head downtown.
And then go to the game.
Yeah.
Okay. I think we know who's in charge of the Stiller household, right? Yeah.
And his wife was holding on to him, like, you're not running away.
You got the Knicks in with that. Impressive. Good job.
Okay.
That was good.
Up next on the program, the AI productivity boom.
There's no question that AI and everything around technology and AI is driving a massive, and I expect a long-lasting investment boom. I expect, stronger productivity growth, strong investment.
Up next, Torsten Slok of Apollo.
In case you missed it, on Bloomberg Crypto.
There's a debate going on right now in DC that I think folks need to start paying more attention to, and that is the yield. And the question really is, who is going to keep the yield? Who makes money off stablecoins? Well, right now, in the case of some of the large stablecoin issuers, there's a yield on those deposits. So when there's a dollar, for example, deposited in a bank account, there's interest paid on that dollar. And so who's capturing that yield? And I think one of the really interesting things about the Genius Act is that it bans so-called yield-bearing stablecoins from giving that yield directly back to consumers. Now, that's not true everywhere. And I think if consumers have a choice, why would a consumer want an institution to keep that yield? Or would there be sharing of that yield? So right now, one of the debates going on is, will rewards be allowed? And I think these are really important questions.
Don't miss Bloomberg Crypto live Tuesdays.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Equity futures net session highs higher by 0.4% on the S&P 500. On the Nasdaq, up by 0.6%. Under surveillance this morning, the AI productivity boom.
There's no question that AI and everything around technology and AI is driving a massive, and I expect a long-lasting investment boom in this country, and quite honestly in many countries around the world. The U.S. leads in this technology. It is, by far the leader in this, both in terms of developing it and I expect in using it. So I expect stronger productivity growth, strong investment.
So here's the latest this morning. The New York Fed President John Williams staying positive on tech's labor market impact. Torsten Slock of Apollo writing, AI will drive productivity gains and create opportunities that will more than replace jobs lost today. Torsten joins us now for more. Torsten, good morning.
Morning.
So the headline we got from Coinbase earlier on was job cuts, and job cuts attributed to becoming more of a startup, like culture, AI, all those things. Can we start with call centers in the Philippines and tell everyone why they're wrong about all of this?
Well, what's so interesting about this is that running a call center has become cheaper and cheaper and cheaper, and in particular cheaper when you have, of course, voice recognition, when you have AI helping you. So that's why employment in call centers in the Philippines for the last 10 years has actually been going up, telling you that running a call center is cheaper. That means more companies are using call centers, and they're expanding because it's becoming cheaper to produce the service of being a call center.
Now, is that just call centers, or do you see this applying to a bigger proportion of the labor market?
It is exactly something you can apply to the whole economy, because the issue is essentially that inputs are becoming cheaper, and when inputs become cheaper, maybe there's more demand for those inputs. So think of this for radiologists. Radiologists read a scan, and the scan, of course, can be read now by AI, but as that has become cheaper and cheaper, the salary for radiologists at the moment around $500,000 has continued to go up, and employment for radiologists has also continued to go up. And across the board, across industries, inputs of production have basically gone down, very similar to what we saw during the China shock, when China entered the WTO and goods coming from China became cheaper. The unemployment rate didn't go up. It was the case that cheaper goods from China made it cheaper to produce things in the US, and as a result of that, you also saw, therefore, higher economic activity. So broadly speaking, if you take your economic textbook out and you ask the question, what happens when it becomes cheaper to produce something? The answer is there's much more demand for that thing.
The answer will be different if you go to the Rust Belt. The answer will be different if you go to centers of production in the United States that experienced complete washouts during the globalization. How do you ensure that the Jevons paradox of AI doesn't leave a lot of people unmoored, without work, and not feeling the benefit of all of these advances?
And that is absolutely correct, that the China shock, or the entering of China into the trading system, it did create some very regional specific shocks in the manufacturing sectors in the US. They certainly could not compete with US and with Chinese production and US production at the same time. So instead, we're now also seeing similarly that those job categories that are most impacted, they may see some negative impact, in particular, of course, in programming and some parts of software. But more broadly speaking, this is input to the bigger part of the US business universe. And that means that when that input becomes cheaper, we should, of course, see growth in employment. The best example is, look at the weekly data for how many businesses are created in the US. It is literally at the highest level in US history. We've never seen so many businesses created in the US. So some of these businesses, of course, will also result in more employment. So in the last few years, the very significant inflection point of seeing more business creation is indeed also going to result in more employment, and at the same time also more productivity.
This is what a lot of people are saying, which is the reason why you have even Kevin Warsh saying that you could end up with stronger growth and even a disinflationary force because of all this productivity that's being introduced to the system. The transition period, though, is faster than anything we've ever seen before. This isn't like globalization. This is even a faster transmission, and a lot of people are being rendered, even me in my own home, useless by Claude. So at what point does this become a problem by virtue of its speed and how quickly it's displacing people?
And what's really interesting about that, because that connects with the discussion we have today in markets about inflation is going up because of oil prices. Inflation is going up because of tariffs. Inflation is going up because of restrictions on immigration. So far, inflation is not being negatively impacted, meaning disinflationary because of AI. So it's that transition period that becomes so important. But even though we all agree that we will get productivity gains and therefore downward pressure on inflation, clearly markets are not looking at it that way. The next expectation is, of course, as we know, that the Fed will be cutting only in December 2027. And there's now a higher probability that they will be hiking in the beginning of next year. So in that sense, yes, that transition is critical. But if this is going to take several years, which it likely will, then we still need to talk about, well, maybe there's a risk that rates will stay higher for longer before we get that disinflationary force.
Issue, Torsten, how much of a sequencing problem is there?
Well, there's also an identification problem because maybe the risk is that this is just going to take a lot longer than what people expect at the macro level. It's very clear we're seeing it at the micro level. There's a lot of corporate finance examples of where this is coming very, very quickly. But at the macro level, that's a much, much more slower moving animal because at the macro level, before we begin to see inflation come down, before we begin to see this have impacts on the broader economy, it can take several years, and it may even take longer than several years, up to 5 years. And if that's the case, then the Fed will not have the luxury of saying, oh, AI is disinflationary, because the Fed instead now has to look at inflation that's going up because of the conflict in the Middle East.
This massive capex in certain places driving up prices too. Part of the problem.
This has been a huge issue. So far, CapEx has been incredibly inflationary. At what point does that alone end up leading the Fed to have to hike rates, given the fact that the sequencing is so off? Do you think that we're underpricing that risk?
Yeah, so that's exactly why the big CapEx we're seeing is inflationary, of course, for semiconductor prices, very clearly. It's also very inflationary for wages for those who construct data centers. It's also inflationary, of course, for the price of energy, not only because of the Middle East, because of what's required to build the energy build-out. All that combined is exactly saying that the sequence is we should be expecting inflation to go up initially as a result of the data center build-out. And then once we begin to see the gains, and the question is maybe a few years away, we should expect to see inflation begin to come down. And that's particularly challenging for the Fed when we at the same time have energy prices continuously going up at the moment.
Torsten Slok of Apollo. Torsten, appreciate it. Lots to think about in the labour market right now. The AI problem, the sequencing issues, and the hope that it will drive down costs and ultimately boost growth.
Yeah, this is what Kevin Warsh is going to hang his hat on. I just wonder, it's not an easy call. Let's just be very clear about that. How do you ease this transition period in the labor market with allowing this economy to run hot, given an energy price shock that could potentially cause it to go too hot when it comes to some of the inflationary pressures? And it's the reason why the Fed is looking at a terrible backdrop, much worse than they would have been looking at if we just looked at oil prices earlier.
It's going to be very difficult to convince a committee right now to reduce interest rates because you believe this will happen in the future.
Beth Hammack is going to be pushing back.
This is something you're going to have to see in real time to get people to pay attention to tell them this will happen a year out and we can cut rates here with inflation getting closer to 4 and further away from 2. Good luck to you.
Well, the 10-year will be the ultimate arbiter, and it will say, see you later. And if you think that there's a buyer strike over in the United Kingdom, that's coming to the United States near you.
Do you want to buy some UK bonds, Torsten? No? Going to say, give that a miss? No? Okay, all right. Coming up, Jordan Jackson of JP Morgan Asset Management, the KKR CFO, Robert Lewin, Kathy Boshantik of Nationwide Mutual Insurance, and Heath Terry of Citi. The third hour of Bloomberg Surveillance just around the corner.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, succession starts now.
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. 'Bloomberg. 'Bloomberg. 'Context changes everything. Context changes everything. 'Context 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 changes everything.
We should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data.
Yes.
We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions.
Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
You're still seeing a market that's a little jittery.
There are no signs of cracking right now.
We need to factor in a lot of uncertainty.
We are in a new era of diversification.
We're seeing a lot of positive tailwinds, but we are prepared for that to face some challenges.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores. The price action looks like this. Equity futures on the S&P 500 bouncing back by 0.4%. On the NASDAQ, up by 0.6%. In the commodity market, Brent and WTI trimming this morning's losses, still lower by about 1.5% on Brent. Let's call this 112. On WTI, 103, 104. After a big gain yesterday of 5 to 6% on Brent crude, taking yields to new heights. 10s and 30s, new closing highs for the year. Your 10-year 4.44, 30s, north of 5%, closing there for the first time since last July.
And building on those losses, especially as you see it happening, not just in the United States, but globally with the UK, 30-year yield hitting the highest level going back to 1998. Again, at what point does this oil price shock become disinflationary or deflationary? We're not there yet, because right now people are taking a look at how there is strength in the underlying economy and saying the pass-through is going to lead to a fundamentally more inflationary backdrop. Even in the break-even rates, you're starting to see them creep higher. We're leaving that 2% target behind.
Attention turning to the economic data a little bit later in the next few hours. We'll get PMI data at 9:45 Eastern Time, the ISM at 10 a.m. alongside job openings as well. And then before all of that, happening right now, down in Washington, D.C., a briefing from the Defense Department as we just about hold on to a very fragile ceasefire.
I think this is an important briefing coming from General Kane and Secretary Hegseth, because the president yesterday didn't want to go as far to say that the ceasefire was disrupted, although we saw a number of hostilities, infrastructure that was hit. You had vessels that were hit. There were clearly an escalation in the conflict yesterday, but not enough for the president to say we are going to want to have strikes again. So let's see what these two individuals have to say. And then later on today, Secretary Rubio will also be briefing from the White House. So clearly there's a message that the White House wants to get
The
out.
most bullish thing you can say about risk assets right now, after the 24 hours we just had in the Middle East, is the commitment still to the ceasefire, despite the last 24 hours.
Yeah, is that enough, though? I mean, ultimately, the fact that there is commitment to ceasefire, is that enough to give people comfort when it's ultimately a game of time? Look, you can tell that nobody wants to start a huge war again, and there's clearly commitment to that. But where we are currently isn't good enough to bring down oil prices. We're still not seeing any traffic. It still is a flat zero in terms of the number of ships getting through.
There's interesting, though, diplomatic tea leaves happening, and I think it's important that the Iranian foreign minister is going to Beijing at the invitation of China. At the same time, the Treasury Secretary yesterday said China should be putting more pressure on Iran, and the president is going to China next week.
Looking forward to that summit, if it happens. Still an if. Changed last
The
time.
president said yesterday
We'll
he
see if
is
it
going,
happens.
but it is a good point. Of course, these things can change.
Coming up this hour, Jordan Jackson of JP Morgan with stocks stabilising. We'll catch up with the KKR CFO, Robert Lewin, following a double earnings beat for the first quarter, and Kathy Boszczanczyk of Nationwide looking ahead to Friday's jobs report. We begin this hour with stocks flat and crude prices easing as uncertainty weighs on Wall Street. Jordan Jackson of JP Morgan Asset Management writing, this conflict is going to be more drawn out than anticipated. The futures curve, the market still has all above $90 a barrel through September, and I expect that to reprice higher. Jordan joins us now for more. Jordan, good morning.
Good morning.
It's good to see you. It's surprising it hasn't repriced higher already. So what's going to change?
I think the inventory picture, right? We are drawing on inventories. Now, we came into this conflict global oil oversupplied, right? We had roughly 8.4 million observable barrels. That was a little bit higher at the beginning of the year. That's come down quite significantly. When we look at observable barrels that can actually be tapped into to offset the prices, it's roughly just shy of about 1 billion barrels globally. And so that's really when you start to get to a pressure point. We could start to get to that pressure point over the next 5 to 6 weeks. And I think that's really, again, we're kind of eroding that ceiling on oil prices because of the oversupply of inventory. As that story starts to change, I do think there's some risk that oil prices can move higher from
So the drawdown's unsustainable, pushes up crude. Let's take that to the equity market. Does that introduce an index-level threat on the S&P 500?
I do, because it continues to threat rates, right? The equity market can't seem to stomach a 10-year above 4.5% and a 30-year above 5%. And that's pretty much where we are. So I think if we continue to see the oil volatility feed into rate volatility, I think that's sort of what spells a little bit of concern for the market. And perhaps what ultimately happens is the 493 can't really do a whole lot, but the AI and that trade maybe continues to drive the market.
You just said something, that the market can't stomach that. It's stomaching it. We're seeing actually futures higher. We've seen near all-time highs on all the benchmark indices. At what point will people start waking up to rates?
I think at least in the month of April, right, what drove a lot of that performance was AI, right back into kind of what's worked over the last 3 years, and a big piece of that story has been the semi story. So I think the April to early May rally has been very concentrated. The rest of the market breadth has not improved as a result of this, and I think maybe perhaps equity markets, equity investors are optimists and bond investors are realists, and I think we're seeing a little bit more in the bond market before we see a spill over to equities.
So at this point, do you think that the bond market is offering an opportunity to pick up some yield, given the fact that people might be looking for safety at a time where valuations are pretty heady, if you do believe that some of these risks are coming down the pike?
Well, over the last few years, when we've seen rates pressure higher, 4.5% again on the 10-year, you've seen buyers step in. And so I do think that right at sort of these levels that we're seeing, there is a pretty interesting kind of barbelled approach that investors can take to fixed income. If I had $1 put into the bond market right now, I put $60 into 1 year and under paper and 40 cents into that intermediate core high quality fixed income. Why? You've got cash yields that's not coming down because the Fed isn't cutting rates, but I want a little bit of hedge in case we start to see more demand destruction in the event that oil prices continue to remain elevated.
The H for your Warsh name is H, honor Fed independence by prioritizing inflation discipline. How difficult is his job going to be?
Incredibly difficult. If we go back to our earlier mnemonic, A, it's part of our Warsh border mnemonic, anchoring to trimmed measures of inflation. He sort of leaned on this idea of removing the fat tails from inflation and looking at sort of the core median distribution. The problem with that is while it smooths out inflation, it tends to underestimate inflation when inflation's rising and overestimate it when it's coming down. Right now, the Cleveland Fed's PCE is at 2.3%. Conveniently, they measure most closely to 2%, right? Maybe that's trying to justify cutting rates now. But again, the Fed's got to be forward-looking, not backward-looking, and I think it's going to be really difficult for him to convince a committee of 12 voting members, 11 other voting members, and 18 other
So he stays on hold, because you think energy prices actually are going to go up as well.
Yes. And we haven't yet seen it feed through to the inflation. We've seen some of it feed through, of course, in the March CPI report. But the risk is that that's to the upside, right? And so I think our base case coming to the year, we were going to see a peak inflation rate of about 3.5% in the second quarter. We now think inflation could bubble up to 4%, maybe a little bit hotter than that by the time we get to May or June of this year. And again, that puts the Fed in a difficult position to justify cutting rates.
June meeting, 4 handle on inflation. That's a tough spot for the new Fed chair.
I think you cut rates, clearly. That's a clear answer. I mean, look,
good luck introducing that argument.
But this is the reason why Treasury Secretary Scott Bessent said, all right, given what we're looking at here, maybe you can wait a little bit. Question is, what other tools might he end up using, given the fact that ultimately there is this Treasury Fed accord that we're expecting?
People are speculating. We're going to see that, that's for sure. Jordan, thank you. Jordan Jackson there of JP Morgan Asset Management. There is a press briefing taking place in Washington, D.C. right now at the Defense Department. Tyler Kendall's been tracking that for us. Tyler, what's been happening?
Hey, John. Well, the briefing's still ongoing, but so far we've heard from Secretary Pete Hegseth, who started his remarks by highlighting what's been dubbed Project Freedom, this effort by the U.S. to help guide ships through the Strait of Hormuz. And he says that the U.S. is, quote, shouldering the initial risk. Hegseth went on to say that CENTCOM is in conversation currently with hundreds of vessels that it would like to see get through, and that the U.S. would prefer for this to be a peaceful operation, though he added that the U.S. is locked and loaded, in his words, if Iran were to interfere. Hegseth called this a temporary mission, but reiterated that the U.S. is looking to hand responsibility, in his words, over to international partners to help secure the strait. Of course, the biggest question that is top of mind is whether or not the U.S. views this recent uptick in fighting just yesterday as a violation in the ceasefire. We've yet to hear them take questions yet. The chair of the Joint Chiefs of Staff, Dan Kane, right now is talking about those U.S. efforts yesterday to repel both missile and drone attacks by Iran, as the U.S. helped to guide at least 2 U.S.-flagged vessels through the strait. We'll see if we get any further updates on how the U.S. is viewing this point in time in the conflict. Though, of course, later today we'll also hear from Secretary of State Marco Rubio, who's set to brief reporters at the White House at 3 p.m. Eastern.
Tyler Kendall with the latest. Tyler, thank you down in Washington, D.C. We'll keep tracking those headlines for you. The Defense Secretary, Pete Hegseth, saying the U.S. is stabilizing the situation but needs the world and expects the world to step up.
Yeah, I'm not sure who he's talking about there, because at this moment, all you have really are the Europeans that continues to hold conferences about whether or not or how they are going to potentially go aid the United States. But Secretary Hegseth says Iran is embarrassed they did not control the strait. Well, then who controls it? Because if the United States controls it, then why aren't vessels getting through? I mean, that is the key question. I hope someone asks him.
I'm just watching S&P futures, and they're taking a leg higher on this. And the idea that the United States wants this to be peaceful is notable. That is the rhetoric. You know, yes, locked and loaded, but we ultimately want this to be peaceful is pretty significant coming from Pete Hegseth.
A preference to maintain the blockade. Brent crude right now at 112, WTI around 103. Let's get you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Apollo Global Management has raised $6.5 billion for its hybrid equity strategy. The fund will provide financing that sits between credit and private equity, a key piece of the firm's broader hybrid business. Alphabet is selling its biggest ever euro-denominated bond, pulling in strong demand for a sale of at least 9 billion euros in debt. The company will use the money to support heavy capex spending for its ambitious AI plans. A source telling us here at Bloomberg that the longest portion of the deal is a note maturing in 2063. TikTok's owner ByteDance says it will be charging some users for its AI chatbot Daobao. Fees will range from $10 a month for the basic version to more than $70 a month for more sophisticated platforms. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. More from Vonnie later this hour. Up next, the morning calls, plus the KKR CFO, Robert Lewin, following the company's latest earnings. That conversation up next. From New York City this morning, good morning.
astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
I don't think any central bank should be hiking right now. If you hike right now into a demand shock, then you risk actually easing further down. I think markets are still a bit too aggressive in their pricing around the world.
That was Jeff Yu of BNY about the next steps regarding central banks, including the Federal Reserve, more specifically the ECB. The ECB is gearing up for a rate hike. They've got a history of policy mistakes under Trichet back in 2008, hiking interest rates into GFC, doing the same thing going into the Eurozone debt crisis back in 2011, I believe. And Christine Lagarde, the ECB president, set up the ECB to hike rates in June. You can back away from that. There's times to communicate we're not going to do that, but certainly that's the direction of travel.
And we've heard the same kind of rhetoric coming out of Joachim Nagel over at Germany. So a question about whether the market's wrong, pricing in a 99% chance that there's going to be an ECB rate hike, or whether some of the people who are saying they shouldn't do it, so they won't do it, are wrong, and that ultimately is the tension.
You're struggling to find a supply-side shock that a central banker in Germany doesn't want to hike into, right?
When you have a single mandate, that's what ends up happening.
Yes, and it might happen all over again. Equity futures on the S&P, positive by 0.5% on the S&P. On the Nasdaq, up by 0.8. There's a lift here to this market, with crude backing away from the highs of the session, 111 on Brent, WTI around 103. Yields worldwide pushing high. We talked lots about this move. The 10-year just slightly lower this morning by a single basis point at 442. Yesterday, a new closing high for the year on 10s and 30s. 30s holding on to 5.
There are 2 ways to look at this. On one hand, this is a warning shot in multiple levels about inflation, about a central bank response, and about what potentially could transpire with fiscal spending that is exceeding some of the revenues of these countries. Or you could say it's a great buying opportunity for fixed income, because ultimately you're getting yield. And it sort of depends on which side of the aisle you're on, whether you're going to be a buyer or whether you're going to be a seller, and that's what we're looking at.
At the end of March, people came on and looked at this bond market sell-off. By people, I mean people in fixed income, and they said, we're creating value. You should buy this. I haven't heard that phrase too many times a month later with yields at the same levels. Is it different this time?
There is a structural challenge when you have oil prices that are rising and you have potentially governments prepared to step in fiscally to support consumers that are hurting from these higher oil prices at the same time that CapEx is to the moon because of AI. That brew is becoming somewhat toxic for bond investors.
10s at 442. That's the price action. Let's get you some morning calls. First up, BNP Paribas raising its price target on Amazon, citing accelerating AI-driven demand. Your second call from JP Morgan raising its price target on Hire, saying it's improving US business is offsetting the Middle East travel slum. And finally, KeyBank raising its price target for onsemi to a street high 125, expecting a strong second half of the year. That name is down so far in the pre-market. Elsewhere, let's turn to private credit and private equity. KKR reporting first quarter earnings that beat Wall Street estimates. The KKR CFO, Robert Lewin, joins us now for more. Rob, welcome to the program. I want to start with the stock price and then talk about the underlying business. The stock into today, down 19% so far this year. Then I look at the underlying business and it just feels like there's a massive disconnect right now, Rob. What explains it?
Well, first, thank you so much for having me on this morning. I really appreciate it. You know, Q1 was a really great quarter for us in a lot of respects. A lot of momentum across our different business lines, geographies. You know, I spend a lot of time here talking about the health of our business, and I tell people that the #1 metric to look at is management fees, and our management fees in the quarter were up 30% year on year. That translated to our second highest fee-related earnings quarter in our history, our third largest adjusted net income quarter that the firm has ever had. And so when I take a step back, there's definitely a lot of market noise. We can't control our near-term share price, but what we can do is we can lean into share buybacks, which you saw us do in Q1. You also saw our co-CEOs and several of our directors buy stock personally in the quarter. You know, all we can do here is control how we're performing and operating, and if we do that over a long period of time, we feel really confident that our share price will follow.
Rob, how would you describe the macro backdrop underpinning some of the noise, as you call it, or some of the fears, particularly around private credit? We did see negative returns for the first time in a while in that asset class. How do you view things as changing in terms of investor appetite around this area?
Yeah, thanks for the question, Lisa. You know, it's interesting. If you look in Q1 of this year, this was one of our best credit fundraising quarters in our history. And a lot of that is because we're in the very earliest of innings of investors allocating more to asset-based finance. And while there's a lot of noise around the direct lending space, which for us is around a $40 billion business today relative to our close to $760 billion of AUM, so about 5% of our business. We have a number of institutional investors calling us up right now wondering, because of the pullback we're seeing across the private wealth space for private credit, for direct lending, is now a good time to be entering as an entry point into direct lending. And we think it is. What you've seen is because capital has come out of the direct lending space, spreads have gone out a little bit, and I think that is positioning some institutional investors for an interesting and compelling point to enter, and that's in part why you've seen such strong fundraising numbers and credit for KKR this quarter.
Do you think that the pain is behind us then? Some of the shakeout tied to software, tied to some of the lending standards that have gotten loosened up?
Yeah, no, listen, I think you had a lot of capital come into the private credit space very quickly. You were also through a period of time where the markets were really benign and default rates were really low. So we could see a scenario here as things play out where some of that capital that came in very quickly continues to come out, and redemption levels in private wealth around the private credit space remain a little bit elevated. I think that would be our base case. You could definitely see defaults increasing a little bit. You know, we've talked about that often. We were in a period of time that was been unusual the last few years. And so both things we think could be true. At the same time, we still view this as a compelling asset class to deploy capital against, and I think our investors agree.
Rob, could you tell us a little bit more about that, the money coming in very quickly? Is that another way of saying we sold to retail too much? And not just you, I'm talking about as an industry at wide.
Yeah, I think what you saw is for a period of time, the individual investor allocating very quickly to the private credit space. And some of the other asset classes like private equity and infrastructure were more measured in terms of how investors allocated income. That might be why you're seeing a little bit more strength in those asset classes with the individual investor. You take a big step back, you know, we see the individual investor today 1 to 2% allocated to alternatives. The most sophisticated institutional investors in the world can have 30 to 50% allocated to alternatives. Now, we obviously don't see the individual investor getting to that level, but what we do see is the individual investor over time going to 4 to 5% plus allocated to alternatives, really as a means to saving against their retirement.
Rob, what do you think the lessons will be with regards to marketing through retail channels? What are the lessons from the last year or so?
Yeah, so, listen, I could speak for what's happened at KKR on the private wealth side. And if you look at our business in Q1, we have 7 scaled products. All 7 of them had net inflows in the quarter. We raised roughly $4 billion of capital, and we had $250 million of redemption. And so we feel like we're pacing it pretty well, and we're focused on the long term and how we build products and vehicles that can really scale over time, and that we're really proud of the performance that we're delivering to clients, and we're really proud of the experience that they're having in one of our KKR private wealth products. So it's a long-term focus. We really aren't focused on the quarter-to-quarter capital raising, you know, as much as I think the market is.
On a broader level, there's a question about all of the money that's been going into private credit and private asset management, just in general, that's been going toward financing this push out for hyperscalers, given the needs to build out data centers and other infrastructure. How do you both participate in an industry that is going through an absolute revolution while not having over-concentration in particular areas?
Yeah, it's a really good question, and we spend a lot of time talking about that. Anytime you see a lot of capital going into a space very quickly, we think there's going to be some winners and there's going to be some losers coming out of that. And so as we think about, you know, where we've got capabilities inside of KKR, where we've got deep industry expertise, we've got geographic breadth across the firm that can help us. We've got outside capabilities that we're bringing to bear. You take that together with our really industry-leading infrastructure platform that's leading the charge across all things digital infrastructure, and we feel really good that we're going to emerge from this as a winner. Now, you mentioned concentration. It's a huge point. You know, we feel very strongly that as you look at our fund platforms, we need to be linear deploying over a long period of time. So I think that both negate some asset level concentration, but more importantly, you know, that fights against vintage concentration, which is, I think, the #1 thing that has driven poor performance, if you look back in history, in certain fund complexes, getting too concentrated in any one vintage. You know, if you look at the private equity space, you know, a lot of the underperformance over the last few years, I think, is rooted in some of our industry over-deploying in 2021 and early 2022.
I'd love to just finish up with the idea that you've had incredible fundraising success in the first quarter. How much do you expect that to be pressured going forward because of Middle East investors that are pulling back as a result of needs at home that they need to deploy cash to?
Yeah, Lisa, we really haven't seen that to date, and so it's been very much business as usual. Middle East investors represent roughly 6% of our limited partners globally, and we continue to do business with them today, like we did at the end of 2025 before the war broke out.
Rob, appreciate your time this morning. Thanks for joining the program. Thank you, sir. The KKR CFO, Robert Lewin. It's an interesting one, isn't it, Brownlow? If you looked at the stock move and you looked at the earnings, if you looked at the earnings this morning, I don't think you'd know the stock was down 19% before today.
It wouldn't really make sense given the record fundraising in PE, one of the best quarters ever for credit fundraising, given the management performance, et cetera, et cetera. And yet there is this existential fear that there are defaults lingering under the hood. You just wonder how high the bar is for investors in some of these names to dispel some of those concerns, because we've seen one after another lining up to make sure that they're saying, we're not the bad guys here.
It's going to take consistent execution over a long period of time, which I imagine is what they're trying to do. The stock is up this morning by a little more than 1% in the pre-market. Lisa asked the question, the connection between that business and what's happening in the Middle East. Here's the latest on the Middle East right now. The Defense Department holding a press briefing down in Washington, D.C. As we speak, the ceasefire still holds. That's the message they're communicating so far this morning.
Yeah, Secretary Haig says the ceasefire is not over. It begs the question, what would the United States need to see in terms of hostilities, given what happened in the past 24 hours, to say, actually, this does impede the ceasefire?
Up next on the program, we'll catch up with Kathy Bosjantik of Nationwide, looking ahead to Friday's payrolls report, a big few days coming up for economic data in America. Live from New York City, you're watching Bloomberg TV.
Welcome to Bloomberg This Weekend. I'm David Burke.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in 1.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
The open about 60 minutes away. The economic data seconds away. Equity futures, your scores look like this. Positive by 0.5% on the S&P, up by 0.75% on the Nasdaq. In the bond market, the stage set as follows. Yields near the highs of the year on a closing basis, pulling back from those levels this morning, down by 2 basis points on the 10-year to 4.41. The 30-year holding on to 5%, closing there for the first time since last July. We're down by a basis point this morning. With your economic data, let's cross over to Mike McKee for more. Good morning, Mike.
Good morning, John. We've got some trade data for the month of March, which should be in the first quarter. We got some estimates from the BEA and the government about that in the first quarter GDP numbers, but the trade balance comes in at 60.3 billion in terms of a deficit, of course. That's a little bit less than the 60.0 that they were anticipating. The big story here is that imports were a little smaller than maybe had been anticipated, up 2.3% after 4.3% in February. Remember, in GDP, we had a big increase in imports, particularly for electronic equipment that's going into all the AI stuff. So this may move the needle a little bit in terms of a revision to GDP. But the big numbers this morning coming up, still ahead of us, the ISM services number, which will be very interesting in terms of prices paid lately, and also JOLTS, which gives us something we can plug into the models about Friday's jobs report.
Mike, just on prices paid of the ISM manufacturing, I believe, was at a 4-year high, up for 4 consecutive months. Are you seeing that price pressure start to build, Mike, beyond just, say, the energy-sensitive parts of the market, the economy?
Well, you see some signs of it in some of the hard goods that are ingredients into other products, because a lot of that is still tied up in shipping as well. So you're starting to see that, but we haven't seen the real flow from this into second-round effects yet. But the longer this goes on, the supply chain analysts say it's really going to hit us. And that's what the Fed doesn't know. Yesterday, talked to John Williams for a bit. He thinks that the Fed is united on rates. The real difference is, are they sending strong guidance or not? He is of the belief that they didn't need to dissent, really, the dissenters, because the guidance isn't that strong, and they'll have to see what happens. Although he thinks inflation is going to fall fairly rapidly later this year. That's a big bet that the vice chair of the Open Market Committee is making.
That's a major bet. Mike, thank you, sir. Mike McKee with the latest here in New York City, breaking down the latest economic data. Prices paid is super elevated in that ISM. Everything else is pretty decent. Labour market seems to be stable based on recent indicators. Economy's expanding nicely. Prices paid just exploded over the last few months.
Which is why we're all watching ISM services prices paid, which comes out at 10 a.m. Do we get the same kind of read-through given the fact that oil prices are higher and consumers are able to pay? That's the interesting thing. You're not seeing necessarily a massive degree of demand destruction just yet.
Let's talk about the data. On Friday, we get the payrolls report. Kathy Bostjantic of Nationwide writing, we expect the unemployment rate to remain historically low and hold at 4.3% as the low-hire, low-fire environment likely persisted. Kathy joins us now for more. Kathy, welcome to the program. Does that mean these consumers in this economy will be able to tolerate higher prices?
Well, good morning, John. Well, I think what it means that it gives a little bit of support to consumer spending. I think the consumer's still going to feel the pain of higher prices, and they already are, right? With gasoline prices up around $4.50, per gallon across the country. I think the timing of when they feel the impact is important here too. It may be that consumers dip further into savings to maintain their consumption for the near term. That was not our original thought. We thought that really Q2, you would start to see consumer spending, discretionary spending pull back. That's still officially our forecast. We're looking for GDP growth to dip to 1%, from 2% in the first quarter, and then recover in the second half of the year. But when I looked at the March retail sales consumer spending data, you did see the savings rate dip. And if it's similar to what played out during the Ukraine war, the savings rate could go down to 2% or so. So maybe we see the slowness more in Q3. So bottom line, consumers not immune, but the strength of the labor market helps them feel a little more confident.
Kathy, where have you got inflation peaking? At what level and when?
Yeah, great question. So we just revised our numbers based on the string of the run up in oil and gasoline prices over the last week, and we now see it peaking, close to 4.5% on a year-on-year rate for CPI. We think that peaks in the second quarter, and then as gasoline prices trend lower in the second half of the year, you get year-on-year rate Q4 around 3.3%. That's headline. Core rates lower. We think that could dip below 3% to about 2.7%. So a lot of the headline pressure is really coming from higher energy prices. But again, this run-up, it does have an impact, and we think it gets consumers and businesses to pull back a little bit on their spending.
How much can this Fed not hike rates if the inflation rate gets to 4.5% and longer-term inflation expectations are well above 2%?
So it is a difficult time for the Fed, and we're seeing that, right? We see, even though they formally didn't adopt a neutral bias, as Chair Powell said, many of them are moving towards that. Wouldn't be surprised at the next meeting if you see that neutral bias. That said, this is a tax on the consumer, right? And we think it's largely temporary. We don't think it's going to get embedded into inflation expectations. But game over, if you're right, Lisa, and we see inflation expectations stay elevated for longer, that could prompt the Fed's hand. It's not what we're thinking at this point. We think that the Fed is probably just on a long period of hold, and actually raising rates could make things worse, right? It could slow the economy just when you're getting hit by these higher energy prices. But it is a delicate balance for them.
If the Fed were to cut rates here in the next couple of months, let's say, for whatever reason, because of beliefs in AI and what that does to some of the efficiency, the productivity in the labor market, what would happen with long-term rates?
Well, if the market did not believe that was the correct move, and they were worried that it could juice up economic activity and therefore make inflation even higher and more persistent, long-term rates would rise and the yield curve would steepen. And it would not really benefit the broad economy. You think about mortgage rates would only go higher. And that's one part of the economy we really like to get restarted. Imagine if housing was not so stalled. We'd have even stronger growth right now. So I think that would be the conundrum for the Fed, is if they make a policy change, markets don't agree, they're going to get penalized.
Surely incoming Fed Chair Kevin Warsh knows this, right, Kathy? And that potentially is one of the reasons why that might mean that he can't go in and try to get everyone to get on board with an interest rate cut?
I would think so. He has extensive experience, right, at the Federal Reserve, and is well aware of these dynamics. I think one thing we have to watch is the interplay between the Treasury and the Federal Reserve. And we know that the Treasury, they're looking to reopen and re-examine the Treasury-Fed Accord. What kind of cooperation would they try to do, some kind of yield curve control, and would that be successful? That would be one thing that we have to watch on the policy front.
Would that be something that you have to watch for this year?
It's possible. Yeah, it's possible. How quickly they move and make changes. I think it's something we have to be alert to. We already see the Treasury buying back more long-term securities. They're off the run, but doing buybacks. And there's already been talk of some increased cooperation. So maybe the Fed Reserve and the Treasury, they do engage in something where you're dealing with bills and long-term notes in a way that they kind of try to control it. I don't know that would be very successful. I think fundamentals still play out, but it's something that we have to be on alert for.
Kathy, appreciate it. As always, Kathy Botjanskic there of Nationwide Mutual Insurance. This time tomorrow, we'll be talking about quarterly refunding. Why does that matter? This Treasury needs to borrow far more than they thought they'd need to borrow only a few months ago. And it matters because at the moment, they're borrowing a lot of that at the very front end of the yield curve, so in T-bills. And there's been a speculation that at some point, they'll shift that out to longer dated maturities, coupon issuance, so to speak. Are they going to do that anytime soon?
Ultimately, a lot of people are expecting them to issue it in the front end and to have some sort of Fed Treasury accord. Scott Besson has talked about wanting to issue more on the long end, that it makes more sense. But that only makes sense when yields are low. It does not make sense when yields are at this level and they don't want to lock in borrowing costs at this speed. I just wonder what kind of Treasury Fed accord we could be looking at. That really should be the analysis going forward because that seems very feasible. Both have talked about it.
Not only has the Treasury Secretary, they said that's what he wants to do. Before he was a Treasury Secretary, he came on this program saying that it was really bad and terrible, and she was juicing the books when it comes to what Janet Yellen was doing, which is why everyone feels like, at least we've wrote it as, it's Groundhog Day for bond dealers.
I'm not sure how that works with a man who wants to reduce the balance sheet. I'm not sure how all of this adds up. I'm still trying to get my head around that.
I'm struggling as well. If you want to reduce the balance sheet, but you want to keep yields lower and you want to somehow cut rates so that you avoid the firing line of President Trump, it just becomes a very difficult equation.
You put more emphasis on cutting interest rates and you keep that super, super low, you're providing an incentive to anyone who's at the Treasury to carry on issuing a ton of T-bills and not term out the debt.
Which is essentially what they're expected to do. And we'll see that tomorrow when we get the exact breakdown of how they plan to fund $189 billion for quarterly funding.
Saw that under Yellen. We're seeing it under Besson. Not much has changed. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Recapping the data we just got, the U.S. trade balance coming in at a $60.3 billion deficit in March, slightly under expectations. U.S. imports falling to just a 2.3% rise after a more than 4% rise the previous month. More data coming later this morning with JOLTS and ISM services. Defense Secretary Pete Hegseth saying the U.S.-Iran ceasefire with Iran is holding despite recent strikes. Chairman of the Joint Chiefs Dan Kane describing yesterday's Iranian attacks as just below the threshold for war. Hegseth emphasizing that Project Freedom is a temporary project, but the U.S. is ready to resume combat if necessary. The Knicks dominating Game 1 of the second round of the NBA playoffs. Jalen Brunson leading all scorers with 35 points. The Sixers were coming off just one day's rest after storming back to eliminate the Boston Celtics. Game 2 tips off tomorrow night at Madison Square Garden. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next on the programme, we'll catch up with Heath Terry of Citi Research with AMD earnings, the next big test for AI. Plus, your Hira's got your morning movers. Shares of Shopify falling on slowing revenue concerns. That name is down by 6%.
about 80% of projects will find it difficult to secure financing. And this is really all because of the level of readiness or preparation. As you know, for investment to occur, you need well-prepared, technically prepared projects, but they must also demonstrate economic and financial impact. So one of the major challenges is the stock or availability of bankable projects in countries. Almost all countries have got good plans and ideas, but when you look at the readiness of those projects, that's a major obstacle. And that is why the African Development Bank, through the African Water Facility, invests heavily in upstream preparation of projects to enable countries to have a large pool of investable projects. The second element that is an obstacle is the institutional and regulatory environment in most countries, which make it difficult for investment to happen.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story. This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
This is input to the bigger part of the U.S. business universe. And that means that when that input becomes cheaper, we should, of course, see growth in employment. We've never seen so many businesses created in the U.S. The very significant inflection point of seeing more business creation is indeed also going to result in more employment and at the same time also more productivity.
We need more of that. That was Torsten Slok of Apollo with a constructive view on AI and the labour market a little bit earlier on in the programme, using the call centres in the Philippines as an example, and employment just going up and to the right every year that goes by, even with this boom in technology.
Yeah, the problem is just that it's lumpy, right? It's not going to benefit everyone at the same time. It might benefit a younger person who's in your own home who's working on Claude, but it might not benefit an older person who is, going with digital.
You went there, you talked about the displacement with globalization. It's a question we've returned to continuously. With this technology due to white collar, what globalization did to blue collar, and if so, how are we going to handle that?
And that's how people are receiving comments that might be AI washing. I'm going to get that right. When Coinbase or Block come out and say, we're cutting a significant swath of our employees because guess what? We don't need them. And we could do more with less, and we can have a smaller, innovative, startup-like feel using AI.
The stock market has certainly enjoyed the headlines and the earnings recently. Equity futures up by 0.5 on the S&P. On the Nasdaq 100 this morning, bouncing back on the Nasdaq higher by 0.75%. As we count you down to the opening bell, about 43 minutes away, let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. Shopify out with earnings this morning. Shares are falling 6% after the outlook disappointed. This is a company that powers online stores for merchants, so it gives you a good read on the consumer and the outlook suggesting that spending is slowing moving forward. Turning to Intel, those shares are rising nearly 4% in the pre-market. Honor reporting that Apple is exploring using Intel as well as Samsung to build its processors for devices here in the U.S. It's still early days, and Apple is still locked in with TSMC, but it speaks to the tightness that we're seeing in the chips market. And we end with Coinbase. As you all were just discussing, shares are up 4% in the pre-market as the company says AI can help it be leaner. So it is cutting about 14% of its workforce. But the question is, how much of that AI-driven productivity is just masking a tougher backdrop in crypto, something that the CEO did acknowledge. John?
Yahara, thank you. Thanks for breaking it down. Some single names for you. The morning movers going into the opening bell. As we count you down, some things to look for through today and through the rest of this week. More data at 9:45 Eastern Time. PMI data tomorrow. The ISM and job openings, 3 p.m. Eastern tomorrow. A press briefing from Secretary of State Marco Rubio. That's a little bit later this afternoon, rather. And then after the close, we get results from AMD. Looking ahead to later this week, we'll get another round of jobless claims Friday, the payrolls report. So the ISM and jobs data a little bit later this morning.
Yeah, key question, how hot is just right, given the fact that people are looking at the inflation read-through and saying, well, if the labor market's just fine, tepid, then it could be disinflationary down the line.
Let's talk about the data and the earnings we've seen. Looking ahead to AMD, set to be the next big test for AI, following the company's best month since the dot-com era. Heath Terry of Citi writing 2026 is the year enterprise AI scales and the gap between leaders and laggards grows larger. Heath joins us now for more. Heath, good morning.
Good morning. Thanks for having me.
It's good to see you. We've seen a massive rally in certain parts of tech. Yeah. We had a guest from Barclays yesterday who said we're too focused on the path to here and not on where we are. So can we forget about the rally and just talk about the price of the story today relative to the earnings you expect? How appealing is this sector at the moment?
Look, I think it's still very, very appealing. I think the broader sort of AI trade that we're seeing, I think your prior guest is absolutely right, though. We are still so very focused on everything that we have built to get here, everything that we need to build to get to where we're going. So the infrastructure's trade is still very, very important. But we're sort of leaving behind the beneficiaries of all of this in terms of the productivity you're going to see from AI, in terms of the companies that are delivering a lot of these services. And I think as we get through this year and see enterprising adoption of AI continue to accelerate, that's going to start to shift.
In very simple terms, this is enablers versus adopters.
Yeah,
People have been talking about shifting to adopters for quite a while. Why the lag? What's happening here?
But it's also, it's not even just that. It's a very specific subset of enablers, right? We're just focused on the infrastructure companies, and we're really just focused on the infrastructure companies where there are bottlenecks. You take it one step further into the enablers. You have all the hyperscalers and the neoclouds that haven't really participated at the same level. And then in terms of the companies that are really benefiting from this, it's the companies that are using it. It's the financial institutions, the healthcare companies, the energy development companies that are putting AI to work and seeing real material benefits from it.
How do you identify which adopters are doing it successfully and which are just wasting money?
Yeah, look, there's a huge spread. This technology is not evenly distributed out there. You look at what we look at to try and determine this is we look at revenue per employee. That's a reasonably good indicator. We look at the talent that's there. We look at the companies that have actually been hiring and investing in AI talent. There's not a lot of it out there, and so when companies have actually made a commitment to bringing it in, we think that that's really telling. And then we look at some of the partnerships that are out there. You know, who has partnerships with the leading AI labs? Who are front-footed in this? Some of it, you mentioned AI watching before. Some of it you have to keep an eye out for because companies will likely get ahead of themselves in terms of what they say they're doing versus what they're actually doing. And then we try and kind of filter from there.
Well, just in that vein, do you view it as a positive signal when someone cuts staff in order to raise money to spend on AI?
Yeah, look, I think you've got to start with the AI part of it. You've got to put the productivity there. I think there is a lot of motivation in industries to use cutting staff to sort of drive adoption of AI within the companies. If we take these resources away, it'll force them to use more AI, and so we watch for those kind of things. It's a risky move, particularly given the uneven pace of adoption of the technologies.
Morale hit.
Yep, the morale hit, although people don't seem to be too particularly worried about those for whatever reason. But the stock market's rewarding companies for doing that. And so I think we're going to see more of it, not less.
So you agree with Torsten Slok's view of the world when it comes to AI? In the end, it's going to create more jobs.
Look, I think if you make people better at their jobs, which these tools do, you want more of those people, not less. Now, the path to getting there may be uneven, right? We will see companies make missteps around layoffs related to AI. We will see potentially the layoffs moving ahead of the pace of new hires for that, and creating more jobs. And there will certainly be places within individual sectors where you see absolute job destruction, with the creation being in other sectors.
Where do you think we are now in the pace?
Well, in terms of the pace, we are seeing a real inflection. What we look at is hyperscaler backlog is just a proxy for this. We've gone from 28% year-over-year growth this time last year to 143% coming out of Q1. In Q4, that was 95%. So we accelerated from 95% to 143% in one quarter. That gives you a sense of sort of what's driving this and this bend in the S-curve that we're seeing.
You alluded to the positive feedback loop between job cuts and the stock price reaction. Cutting jobs, stocks positive. What about the positive feedback loop between spending, CapEx intentions, and the stock market reaction? Because that's not so positive anymore, at least for some names.
Is sort of the best proxy for this. That was 29% coming out of across the hyperscalers, coming out of both Q3, Q4, and Q1. So we've seen it very consistent despite this acceleration. So if you can borrow money at 6% and get a 29% return on it, you're supposed to do more of that. And so I think ultimately that's why we're going to see more CapEx around this. But the difference is, last year, the market underestimated CapEx by 40%. We underestimated revenue growth by 3%. Those numbers have to flip.
How sensitive is this C-suite to market reaction? It's kind of what I'm getting at here.
Yeah,
Do you think they just plow on, given everything you've just said?
I think most of the hyperscalers are very well aware of sort of where their customers are and where they're thinking. So I think they're willing to plow on. They're willing to take, the down 7% day when they announce more CapEx because they see the demand on the other side of it. They see the return that they're getting out of it. Companies like Amazon, they've been through this before. They know what an investment cycle is worth to them on the other side. It's the companies where you get a 20% bump because they announced that they were laying off 4,000 people because of AI, where I think you have to worry about management necessarily having a more of a concern or more of a reaction to the market's reaction than they are sort of longer term planning.
Interesting. Heath, thank you, sir. That's good framing. I'll read between the lines there. Heath Terry there at City Research. Heath, thank you. A notable line there, given the news we had earlier this morning.
Yeah, there might be more of an incentive in terms of the stock market reaction, in terms of the cutbacks, than the announcements to invest. Because if a company wants to invest because long-term they believe they truly are going to be a different company, they're going to keep investing, even if stock investors don't like what they're doing.
Stock investors this morning like what they're hearing. We're positive by 0.5% on the S&P 500. Coming up tomorrow, Max Kettner, who is max overweight this market. We catch up with the man from HSBC tomorrow morning, alongside General Karen Gibson of Academy Securities, Chris Harvey of CIBC, US Trade Representative Jameson Greer, and a whole lot more. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years, and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start in the third floor or the lobby. You actually have to start in the basement.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Haslada Amin in Davos, Switzerland, and this is Bloomberg.
All right, maybe it's time to buy the dip. 30 minutes till the start of the cash trade. I'm Matt Miller. Danny Berger is at the Milken Institute Global Conference in Beverly Hills. She joins us later this hour. Bloomberg Open Interest starts right now. Coming up, stocks eye fresh highs as earnings roll on and a fragile U.S.-Iran ceasefire holds steady. Apple branches out. The tech giant is weighing plans to produce more chips here in the USA, or at least saying that. And GameStop's bold bid for eBay draws serious skepticism as Michael Burry exits his entire stake, saying, with this kind of debt, it can't be an instant Berkshire. Stocks to watch include Palantir after raising its full-year forecast and beating its expectations on revenue, but the shares are sliding on disappointing commercial sales growth. You can see, I don't know if it's a slide, down 1% in the pre-market. Apple, a little change in the pre-market. It said to consider tapping Intel and Samsung to produce the main processors for its devices in the U.S. That's due to supply chain disruptions that even affect the biggest maker of consumer products in the U.S., at least in terms of market cap. And then Intel right now actually gaining on that report, right now up 4%, almost 4% in the pre-market. Let's talk about all of these tech stories. There's a lot going on with Bloomberg Tech co-host Caroline Hyde. She joins me here on set. So Caroline, first off, the Apple story is interesting to me because even Apple has to deal with supply constraints, right? Plus, maybe this is kind of signaling Trump optionality in terms of building stuff in America.
Kind of win-win for the mastermind of supply chain, who is Tim Cook, who's going to be exiting to a chairmanship role where diplomacy comes first in many ways in that way. So, of course, this signals to the Trump administration that holds some shares and exposure in Intel that, yes, we are thinking about our supply chain, bringing it back to America, and Intel could be a beneficiary, but so too could Samsung. And look, these are two companies that Apple has always relied upon for various parts of its hardware. They're going back and maybe integrating a little bit more with these players. It'll be interesting is also TSMC, which is the main supplier for its chip hardware. It's building in Arizona.
For everyone's chip hardware.
Yeah, exactly. It is the key supply bottleneck. It makes 90% of all chips in the world, and they're largely coming from Taiwan. That is a key supply chain headache if you're too dependent on one particular nation that is at the heart of a geopolitical firestorm in a long-term perspective. So, yes, bring it back to the US. Maybe you do it TSMC here in the United States because they're really where you're dependent on the most cutting-edge chip manufacturing, but they're looking at Intel, they're looking at Samsung, and they're looking at basically ways to diversify, and that's a brave and clever thing to be doing.
We also have stories on Google raising another $10 billion in debt, right? This is Euro bonds, but that adds to $32 billion they'd already raised. Meta may be raising $13 billion to build a data center in Texas, which is pretty hot. Like, I think I would choose Alaska, but whatever.
They got a lot of space.
It seems like not only has this become a credit story for these hyperscalers, but it's also become a race to build the best model, to a race to get access to the most data center compute capacity.
And is it that at the end of the day, we are all but compute constrained. Now, many would argue that the mythos unveil of Anthropic, in many ways, is yes, because it's so powerful, but also because they're compute constrained. So why not just limit it to 30 key partners who are going to use that model to begin with? If we've got Meta still willingly investing that amount of capital expenditure, looking to up it to $145 billion, looking at clever ways to make this off balance sheet so that they can team with other credit areas of growth. Yes, you've also got Alphabet that's just able to sell bonds, particularly in euro, sterling. We've seen it do in the US. There is still insatiable demand for the credit story. It's not book building to the amount that we used to see, perhaps in the US when we first started the kickoff at the beginning of the year, but still there's so much demand to help finance it. Look, the credit side of the story, Alphabet's still awash with cash.
Yeah, but it's interesting to see these, they used to be asset light. Hyperscalers turn into asset heavy, like fixed income reliant, industrial utility businesses. Anyway, Carolyn Hyde, looking forward to your program with Ed Ludlow at 11 a.m. She hosts Bloomberg Tech. Let's turn now, though, to Bloomberg Pharma. Pfizer reporting sales that beat estimates with strong demand for its core drugs, helping offset weaker COVID sales. COVID sales? Is COVID sales still a thing? Here with more context is Bloomberg Health reporter Madison Muller. Is COVID sales still a thing? Are we still vaxxing?
It is. We are still vaxxing, not as much as analysts had anticipated with Pfizer's COVID vaccine sales and its sales for its Paxlovid pill falling below analyst estimates. I mean, it's something that for Pfizer was once so incredibly important, and so it still is part of the earnings story. I mean, coming up every quarter, analysts, Wall Street, still watching what's happening with COVID, even though largely the expectation is that demand for those products is so far below what it once was. But Pfizer is still looking to rebuild in the wake of the pandemic. So looking to oncology, looking to obesity drugs, potentially in the near future to try to figure out its next big thing.
And still, I mean, the stock is languishing. It's an absolute dog. Compared to Eli Lilly, right? I look at the past 5 years, just because that's the default on the Bloomberg terminal. Over 5 years, Pfizer shares are down 34%. Eli Lilly, meanwhile, is up 402%. It has quintupled. Why can't Pfizer keep up with its sort of cross-country rival?
Yeah, it's really amazing to see sort of the reshuffling of the pharma leaderboard. I mean, 10 years ago, Lilly was in this position. They really didn't have much going. They were sort of a sleepy pharmaceutical company that no one really cared about, and then came obesity drugs. I mean, the same sort of thing plays out in pharma just because of the life cycle, the patent life cycle with these drugs, where even if you have a really, really big blockbuster product, there's no guarantee that that is going to continue your growth for the next decade. I mean, these drugs run out of their patents, and then if you don't have anything to follow them up, you're in a position like we see Pfizer in now, we saw Lilly in 10 years ago, where Pfizer didn't really have anything immediate to follow up in the wake of the pandemic, and that left them sort of struggling and trying to figure out what was next. And they've made big bets on cancer, on obesity, but those things take a couple of years to play out. I mean, right now we're sort of seeing these studies read out, but they don't really have immediate products that are coming in to sort of fill the COVID hole.
All right, Madison, thanks very much. Madison Miller covers pharma for us on the BN side. Now, let's get to energy, because Duke beat on both profit and revenue, with the company reaffirming its full-year outlook. Joining me now is the Chief Financial Officer of Duke Energy, Brian Savoy. Brian, thanks very much for your time. So I'm looking at EPS. 193 was the print, 187 was what we were expecting. So a decent beat, and you keep the full year forecast unchanged. What gives you the confidence to do that in Q1, and why not raise?
No, it's a great question, and thanks for talking to Duke this morning. It's such an exciting day for us. I'm incredibly proud of Duke's performance in Q1, beating both in the top and the bottom line, executing on our strategic objectives. We're advancing generation across the system with a focus of speed to power on how we power a modern economy. And the point about the guidance for the year, it's early in the year. We want to see how the year plays out. Q3 is our largest quarter, so as the heat comes, so does the energy flow, and we want to definitely see Q3 before we would adjust guidance at this point.
Electric utilities adjusted income came in a little bit below consensus, despite the headline beat. So is that mix, weather, fuel, financing costs, or is there something more structural going on in the regulated business?
No, the regulated business had a couple of special charges related to merging the utilities and a settlement. So excluding that, which we clearly did, they're hitting on all cylinders. We're seeing growth from the critical infrastructure investments for our customers, and that the adjusted earnings clearly reflects that.
You're sitting, Brian, at the heart of this AI data center power boom, really, at the center of this cyclone. How much of that demand that you're seeing is actually signed, committed load versus inquiries? Because it strikes me that a lot of customers may want to just lock in as much as they can for fear of constraints in the future.
It's such an important question because, you know, this time last year, we were staring at a pipeline that was tens of gigawatts, and we still have a deep pipeline, but we don't talk about the pipeline. We talk about late-stage conversations that turn into firm contracts with customers. And we signed 7.6 gigawatts over the past year with customers under firm contracts with, say, 15-year commitments that there are minimum billing demands that ensure that those customers will pay their full share of hooking them onto the system and not have any spillover to existing customers. It's such an important distinction from just customers that might be shopping. You need to find the ones that are real, and we've got a focus of speed to power, and we're finding ways to get that done.
We are looking at you know, the biggest companies in the world continuing to try and lock in compute power. There's a story about Meta today looking to raise $13 billion for a data center in Texas. Alphabet raising even more debt to fund AI infrastructure. Is what the grid can do really the biggest constraint now on AI?
You know, Matt, what we've learned is the customers want to get on the system and grow. So our speed to power focus has been able to bring customers on. We ask them for interruptibility of 50 hours a year. And this provides that flex point that we don't have to build that next peaking resource before we add them to the system. We will continue to build generation and add megawatts over time, but allows the customer to get on the system a year and a half to 2 years faster than if we had to build generation one for one. And this provision we introduced last year, and it's been now standard in all of our contracts. And what it's doing, you know, the gigawatt data center doesn't start at a gigawatt. It starts at 150, 200 megawatts, grows about that much each year, and we're growing with it as we add generation to the system.
I see, you know, the bullish side of the AI story and the power story where they connect is obviously increased productivity for the economy, but also tax revenue for local economies, really important in building up this power. You know, the bearish argument is grid stress, higher prices, water usage. How do you see that weighing out? Because you're caught as well in kind of the political center as well.
Absolutely. And, you know, we've been building critical infrastructure in the communities we serve for over a century. And we are working with our customers, now these large data center customers, on how they can work and build with the community, not in the community. And when you're working with the community, you address those issues head on, and you find out what the community is concerned about, and you address those problems along the way. And it's paying huge dividends, as we've seen dirt turning at over 5 gigawatts of data centers that we've announced are in construction today. And that is a really good sign that they're moving through those challenges and opportunities with the communities and ensuring the community is not getting left behind.
All right, Brian, great to get some time with you. Really appreciate it. Hope we can get you back on the show soon. Brian Savoy there, Chief Financial Officer of Duke Energy, such an important player in the growth of, well, of this economy, of this country. A check on markets right now. We are seeing S&P futures up about 0.5%, NASDAQ futures gaining 0.75%. So even though we gave back a little bit yesterday at the close, I think the S&P was down about 0.4%. We're putting that all back out there and then some. So we could see new records again today if this fragile ceasefire continues to hold. That seems to be the underlying stress here. The 10-year yield right now at 4.42, so even though we see price up, yield down, it is still higher than it was when we were talking at this point yesterday. And Brent crude at $111.40. It's off 2 2/3%, but it is exactly where it was yesterday at this time. So crude holding high, even with a little bit of a drop today. Let's get a look at some of the single stock stories on our radar this morning. PayPal earnings beat estimates, but announced plans for job and cost cuts as the new CEO pushes a turnaround strategy. Shopify earnings exceeded the high bar for its revenue growth rate, but that metric is poised to slow in the second quarter. Those shares are down in the pre-market. And a stock that's important to me personally as I ride some of these bikes, Harley-Davidson cut motorcycle prices to help clear out lingering inventory, boosting sales but sending profit tumbling. Still, the shares are up 1 1/3% in the pre-market. We're going to talk a little bit later on about not just Harley-Davidson, but also Ferrari with Bloomberg Autos reporter Gabby Coppola. Coming up next, GameStop stock takes a breather after dropping 10% yesterday amid its bid for eBay. A lot of that in stock. One big short investor says because of that, he's out. He exited his position. We'll talk about Cassandra next. This is Bloomberg Open Interest.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
About 80% of projects will find it difficult to secure financing. And this is really all because of the level of readiness or preparation. As you know, for investment to occur, you need well-prepared, technically prepared projects, but they must also demonstrate economic and financial impact. So one of the major challenges is the stock or availability of bankable projects in countries. Almost all countries have got good plans and ideas, but when you look at the readiness of those projects, that's a major obstacle. And that is why the African Development Bank, through the African Water Facility, invests heavily in upstream preparation of projects to enable countries to have a large pool of investable projects. The second element that is an obstacle is the institutional and regulatory environment in most countries, which make it difficult for investment to happen.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Let's get now to high interest. Look what's making headlines around the world. A fragile U.S.-Iran ceasefire is holding after the most serious flare-up in weeks. Clashes erupted in the Strait of Hormuz after the U.S. launched a mission to escort ships through, prompting Iran to strike commercial vessels and fire missiles towards the UAE. That doesn't sound like a ceasefire. At a press conference last hour, Secretary of Defense Pete Hegseth said the operation will keep ships moving. That's Operation Freedom, and blames Tehran for the disruption.
What we're demonstrating with Project Freedom is they don't control the strait. I mean, we know Iran is embarrassed by the fact that our blockade is holding, And we can run ships through, and we're going to help the world run ships through. And if they hold it at issue, the whole world knows who's doing it. It's not us. We're willing to open it up. It's Iran.
Sorry, that's Project Freedom. Apollo just raised $6.5 billion for its latest hybrid fund, beating expectations as investors seek safer and more flexible bets in uncertain markets. The strategy blends debt and equity, letting companies grow without giving up control. Backed by pensions and sovereign funds, Apollo says this hybrid model could outpace traditional private equity and could even replace public stocks in some portfolios. Weird. Famed investor Michael Burry has exited his entire GameStop stake after the company's roughly $56 billion bid for eBay. Burry says the potential debt load breaks his instant Berkshire thesis and argues the deal adds risk, not stability. Bloomberg's Bailey Lipschultz has been covering GameStop since the meme craze, really, and he's read all of the books about Michael Milken, so he knows about taking on way too much debt to buy bigger companies. He joins me here on set. I love that this happens right as the Milken conference kicks off.
It's the perfect timing, you know. I actually wish we were on site in LA so we could ask the pros, the guys who did this, you know, back in the dirty days, we'll call it, a couple decades.
Well, don't worry, we've sent like 17 people out there to ask those questions. But while you and I are here, we can talk about Michael Burry because, look, this is a deal that would mean GameStop, which has less than $10 billion in cash, would take on $20 billion in debt, though that debt is not guaranteed, right? It's just like we think we can raise it.
It's a high confident letter. I was actually talking to a banker about it yesterday, and he was just kind of like, that's a large check for TD Cowen to write. And when you just think about this, the guy was saying, having worked on a number of these deals, a high confidence letter just means if these kind of bars are met, then yes, we could be comfortable with this. It does not mean like, throwback to Elon Musk, funding secured, this is actually $20 billion being wired over to Ryan Cohen so he can turn around and pay eBay shareholders.
So, by the way, they also want to pay for $26 billion of this $56 billion overall price tag in shares. Yeah. What happens when GameStop shares get decimated like we saw yesterday? I mean, shout out to Ryan Cohen. This chart is, the man has done amazing things with a company that sells video games out of brick and mortar locations. But this may be a big reach.
Well, the tough part is when you just do the math and say it's a $10 billion market cap, you can't, how much can you tap in an ATM at the market offering, or how much can you raise from convertible debt to try to bridge that gap? It's not like we're talking about $1 or $2 billion where you bring in a strategic investor or you're able to really kind of power sell at an ATM. You're solving for something that is essentially a gap that's 1.5 times your entire market value. So that's kind of the big question, and obviously a viral interview of Ryan Cohen.
So it will be, I mean, he said in January, I think in a Wall Street Journal interview, this is going to either be like a stroke of genius or incredibly foolish. If he makes it happen, that would be incredible. But what does eBay say about it? Like, he kind of needs them to play along to some extent as well, right?
In looking through the analyst reaction, it seemed like a hard pitch for eBay investors to want to sign up for this, because you can argue if eBay should be run more efficiently and has kind of synergies that they could find with better management or a kind of a management team that wants to focus on costs, but it's hard to kind of do the bending over backwards mathematical gymnastics to come to a point where, for an eBay investor, at least from the Wall Street perspective, it makes sense to sign up for this deal, again, because you're getting a potentially heavy diluted stock in GameStop and then some cash, and the synergies are going to work out, at least according to Ryan Cohen.
All right, Bailey, look forward to your continued coverage. Bailey Lipschultz covers not only meme stocks for us, but also IPOs, SPACs. There you go.
A little bit of everything.
Coming up at the Open, Goldman Sachs Chief U.S. Equity Strategist Ben Snyder joins me at the desk to talk about all these callbacks to the Predator's Ball, to the dot-com bubble, as we continue to hit new highs day after day. This is Bloomberg Open Interest.
Tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
All right, markets are up after a brief down day yesterday. Let's get a look at some of the big movers on our radar this morning. Coinbase is cutting its workforce by about 14%, or 700 jobs. It cites a need to manage costs in volatile markets and advances in AI. So add that to your list of companies using AI as an excuse for old-fashioned layoffs. Pinterest earnings topped estimates and signaled strong growth in its advertising business as its user base jumps. So Pinterest shares up a mere 20% in the pre-market today. Alphabet, that is the owner of Google, selling billions of dollars in, well, of euros, I should say, of bonds and loonies, because it's selling into the EU and Canadian markets as it prepares to spend up to $190 billion on AI this year, becoming an asset-heavy, debt-reliant behemoth. A check on futures ahead of the opening bell after a little bit of a sell-off yesterday in the S&P 500. You can see we're back up today about 0.5%. The NASDAQ futures are up with a stronger gain. The 10-year yield coming down 1.5 basis points, but still at 4.42, and Brent crude off 2.5%, but still at $111.40 a barrel. When we come back, we'll have the opening bell from the New York Stock Exchange and the NASDAQ, as well as Ben Snyder from Goldman Sachs. This is Bloomberg.
world's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation.
As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlet Fu, who's taking a closer look at drone companies. With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space. Excellent reporting.
I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
We are moments away from the start of trading after a brief sell-off yesterday. It looks like we're back to hitting new highs. This is Bloomberg Open Interest. I'm Matt Miller. You can see futures are up 0.5% on the S&P. NASDAQ futures up 0.75%. We have an exciting bell ringer today at the New York Stock Exchange. We've got Chesapeake Utilities ringing the bell, and this is Beth Cooper. They're ringing the bell to celebrate her 36 years at the company. She's been the CFO for half of that, for 18 years. I didn't get a chance to look back further than 1994, but if she held stock and reinvested her dividends in Chesapeake since then, her investment has gained 5,000%. So Beth has done well over a long career of service at Chesapeake. Down at the NASDAQ market site, you got 1-800-Flowers ringing the bell, and they're excited. Wait, 1-800-Flowers.com. Not that you have to use the telephone. You can do it online. They're excited because it's Mother's Day on Sunday, and I'm going to guess that's one of the absolute biggest days of revenue for 1-800-Flowers. In terms of the stocks to watch, we got the big ones up here. Apple right now up about 0.1%, so not doing a lot, but it is said to be considering tapping Intel and Samsung to produce the main processor for its devices in the U.S. That's due to supply chain disruptions, the build-out of data centers. Everybody wants chips, higher demand for Macs. They're supply constrained, and of course, they want someone else besides TSMC to be able to make their chips, and they want to please the president, Donald Trump. Meanwhile, Palantir raised its full-year forecast and beat expectations on revenue, but the shares are down. You can see 3.25% on disappointing commercial sales growth. Plus, Palantir already has a massive valuation. I think at one point it was trading at 100 times sales and still could be hanging right around there. Goldman Sachs chief U.S. equity strategist Ben Snyder says continued earnings growth should support further gains in equities, but warns that narrowing market breadth and elevated investor positioning could be a callback to the dot-com era. Ben joins me now at the desk, and Ben, it's been kind of a day of callbacks for me. We're in that era, not just to the dot-com bubble, but also I love the GameStop story. Reminds me of the Predators Ball, right, as Mike Milken holds his conference out west. What do you think about this narrow breadth? Like, can we broaden out from here? It's not too late.
No, if you look at the S&P 500, as you noted, we're at an all-time high. But the median stock in the S&P is still about 13% below its own respective high. That's one of the widest gaps we've seen in about 25 years, to your point, since the dot-com bubble. So it does raise some signs, perhaps yellow flags looking at the market. The good news is we understand why some of that has happened. And if the war continues to improve, if we see energy prices recede a little bit, I think the base case should be a broadening both of earnings and of stock performance across the market.
How much does the war really matter? I keep trying to understand this because when I look at earnings expectations, they continue to ratchet higher, right? And I know that's for the average, but you would think that oil prices, that inflation would eat into some of those profits, and it doesn't seem like analysts across the industry are lowering them at all.
You're right that the index level earnings have been very strong, and they've mostly been driven by AI, although not exclusively. For example, the median S&P 500 stock is tracking earnings growth of about 12% this quarter, which is very strong. But if you look under the surface
of the median
market,
as opposed to the mean, so it's very important.
Correct,
right?
stock
That's
number 250
or
251.
Yeah.
Right? But if you dig in by sector, actually, the median stock in most sectors has seen margin estimates cut for the next quarter. And so I do think there are some clear signs in the market that, yes, higher energy costs are having an impact. It's just that they're being outweighed by all of the tailwinds.
So does that mean there's still room to run if the average, is it the mean average or the median average stock below its 13% high? Because if the median is still expected to continue growing earnings, but it's not at its high yet, I would want to buy that, right?
I think that's exactly right. And to your point, there are a lot of comparisons between today and what we saw in the market 25 years ago. But one of the key differences, in my view, is the importance of earnings in driving the current market. And what that means is, even though the equity market is at an all-time high, the PE multiple today is still about 10% below where it was a couple months ago, just because of that earnings tailwind.
Yeah, I was telling you that when I started in this job 26 years ago in Frankfurt, all of the CEOs I talked to were talking about churning revenue and didn't care about profit growth. Here, of course, we have the biggest companies in the S&P making an absolute ton of cash, for the most part. They're all positive free cash flow. What about the companies that aren't? Goldman Sachs has an index of unprofitable companies, but a lot of them are like neo-cloud companies, which obviously you still want to own in this AI boom, right?
I think that's right. I'd say generally when we look across the market, we see a pretty rational earnings-driven story. Maybe all of those earnings aren't happening today, but that's typically the case with equities. If you think about an equity, if you're paying roughly 20 times PE, implicitly you're buying a very long stream of future earnings. And actually, we just did an analysis last week. If you look at the S&P 500 through the lens of a discounted cash flow model, about 75% of the value is 10 years and out. So the fact that a company isn't making earnings today is not necessarily so concerning.
What does positioning look like? Because I had seen a lot of data at the beginning of this year about, for example, households in the U.S. Their exposure to equities was higher than it's ever been. European or foreign investors' exposure to U.S. equities was incredibly high as well. How does it look to you in terms of institutional and retail ownership of stocks?
I would describe positioning as one of the yellow flags I see in the market today. So for example, we have an indicator we call our sentiment indicator. It combines 9 different measures of positioning across hedge funds, mutual funds, retail investors, foreign investors, various parties. Today, that's about 1.7 standard deviations above average. That's high. Now, a couple of years ago, it was 3 standard deviations above average, so we've certainly seen higher. But I think it signals one should expect slightly below average returns over the next few weeks.
Because where's the marginal dollar going to come in?
Exactly right. Now, we are seeing, even though buyback growth has slowed, we're still seeing very strong dollars of buybacks. We're seeing very strong inflows through mutual funds and ETFs, about $150 billion year to date. So there's still plenty of demand. But if we're thinking about the high frequency marginal dollar, I think probably over the next few weeks, we're likely to see less than we saw over the last few weeks.
What's your take on AI being a job killer or a job creator? That's important, obviously, for the economy and the consumer. And I know that the jobs market, there's some worries about it, but if you just step back and look at 4.3%, maybe 4.4% unemployment, that's still pretty good, especially in a situation where wage growth is positive.
Okay, it's very hard to be confident about how AI will change the labor market going forward. Our base case is it will create new jobs, but it will create some disruption and probably put upward pressure on the unemployment rate. From my perspective, though, as an equity investor, I'm looking at the data I have available, and my favorite indicator for the labor market is every Thursday morning jobless claims. Last week, we continued to see very low aggregate layoffs.
189,000 or
Exactly.
something? Yeah.
And so that suggests to me, we can debate what will happen with the labor market in the future, But at the moment, the backdrop looks very healthy.
You had a great Odd Lots podcast. Joe Weisenthal and Tracy Alloway do this podcast. It's incredibly popular, and you were on, I think, with Jan Hatzius, right? How closely do you two work together? He's the chief economist for Goldman Sachs, and you're the chief market strategist.
Work very closely together, I'm happy to say. He's a fantastic economist. If I think about the S&P 500 from a macro perspective, as we were discussing, the most important driver is earnings. Now, different times, there can be different drivers of those earnings, but usually GDP is going to be the most important factor there. And for that, I can't find a better source than Jan Hatzius.
And how does he describe the consumer right now? Tomorrow, I think, will be an interesting day because we get from the New York Fed a report on the K-shaped consumer buying gasoline, or how that affects gasoline purchases. How does the consumer look to you and Jan right now?
Consumer data have been surprisingly resilient recently. I think some of that is the boost from tax refunds that have come through over the last couple of months. But his expectation is we will see some deceleration going forward through the year, both because of some of that labor market pressure we were discussing, but primarily because higher prices at the pump are an effective tax hike.
The consumer has historically been the backbone of the U.S. economy. I think 70% of the U.S. economy was ascribed to the consumer spending. But now we see massive AI capex. Just 4 companies with $650 billion in capex plans this year. Does that AI story overtake the consumer for the U.S. stock market?
It's hard to ignore the impulse from business investment. Yeah. It's not just an AI story, right? In part because of the fiscal package, we are seeing increased signs of business investment more broadly. But yes, actually, I'd say from the 5 largest hyperscalers, we're now up to $750 billion of capex. It seems like every day that number is climbing, and that is clearly a huge impulse for activity.
All right, Ben, great talking to you as usual. Thank you so much for coming into the office. Goldman Sachs Chief U.S. Equity Strategist, Ben Snyder. Now, let's get a check of what's going on in the stock market right now. We are 10 minutes into the session and looking at gains of 0.6%. This is the move screen. I think it's the most dynamic way to look at any index on the Bloomberg terminal, and you can see the breadth. This is what Ben and I were talking about at the top of that interview. Right now, it's to the upside, right? 270 stocks up, 225 down. Yesterday, if you recall, that was flipped. We had less than 2 stocks gaining for every 3 that were rising. Take a look at the movers here. You've got the AI story right here on top. Micron is gaining. Intel is gaining. Amazon, Google, Apple, Broadcom, NVIDIA. So all these chip makers and hyperscalers are up right now. I think a lot of that could have to do with the Apple story, that it wants to potentially invest more in Intel. On the downside, you've got Palantir. We talked to you about that commercial sales story. It still has an incredible valuation, don't worry, but right now it's off 3.5%. Eaton is off. Microsoft down. Visa, and then Meta, even as Meta looks to raise another $13 billion is said to raise another $13 billion for a data center in Old El Paso. Take a look at the sectors right now. Almost every group is rising. IT, the biggest gainers you'd expect after looking at that move screen on the S&P. Consumer discretion, communication services. These are the hyperscalers, materials, industrials, utilities. On the downside, you've got financials, staples, and energy as, I guess, real estate, really little changed here. Coming up, JP Morgan's global head of M&A joins from the Milken Conference to discuss if 2026 can top $5 trillion in deals. Very important to my co-host, Annie Berger, who is out there because she has a show every Wednesday at noon that focuses on just that. This is Bloomberg Open Interest.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. It doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start in the third floor or the lobby. You actually have to start in the basement.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch
Bloomberg 10. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg. Is Bloomberg. Take a look at the gains that we're seeing on the S&P 500 up to 72.45. If you round up, so 0.6%, adding 300 points to the NASDAQ 100 up to 27,950, so nearest damage to 28,000. And Brent crude coming down. It's off 3%. It's still at 111.20, which is exactly where it was yesterday. It's time now for our top calls. Some of the analyst action in focus this morning. First up, Bank of America is cutting lows, saying that the stock doesn't have much upside because earnings growth looks limited and there's no clear boost while the housing market stays slow. They have a target of 260 and a neutral. Next up, Piper Sandler is cutting Roblox after its latest results, saying the near-term story is murky as age verification rules get in the way of growth. The firm says it'll take a few quarters to prove momentum is back. You can see the stock down 3%. They got a $50 target on a $46 stock. Finally, Wall Street is weighing in on KKR's strong quarter. Evercore ISI says it had a high-quality beat with fee-related earnings driven by steady management fees. That's the business. Piper Sandler highlights its performance revenues, especially carried interest from public and private investments. You can see KKR stock over the last 2 days down 2.33%. Although it looks like, was that mostly yesterday? Yeah, that was mostly yesterday. Let's head to the Milken Conference in Beverly Hills, where Danny Berger is sitting down with JP Morgan's global head of M&A. Very important for you, Danny, because M&A is your game.
That's right, and I do have that show every Wednesday, as you mentioned. I'm so pleased to say that I'm here with Anu Iyengar of JP Morgan. Anu, thank you so much for sitting down early morning here at the Beverly Hills Hilton.
Yeah, best time to be on.
It is the best time, and it's during our show, which I love. Listen, this has been a wild ride for you. You must be one of the busiest women on Wall Street. 2025 is a huge year. It gets off to a rocking start. M&A, deal activity in Q1, one of the busiest first quarters by many accounts. Given all the disruptions we face, is there any element of you that has been surprised how elevated deal activity has been?
Okay, I think now I've gotten over the surprise. I think it's a bit more because it's now been several quarters of it, right? As you mentioned, last year was the year of the mega deal. And who would have thought that? Because we had several weeks of a complete standstill right after the tariffs were announced, because people were like, I don't know how to model this company. And then we went from there to say, you know what, look at the risks around us, whether that's supply chain risk, technology risk, AI risk, having people, because, you know, demographic change that is happening in the world, and the tremendous amount of scale premium that the market is giving. This is astounding. If you look at 2019 to 2025, the size of a company to be in the S&P 500 or S&P 600 has tripled. And the scale premium, a larger company, smaller company, same industry, trades at a higher multiple, sometimes 4 turns higher multiple than the smaller company. So everybody is like, you know, let's go big, right? So let's do 10 plus billion deals, which is what we call mega deals.
Sure.
And last year we had 71 of them. This year, just in the first 4 months, we've had 30.
And it is wild. And we're expecting these mega IPOs to come to market.
Yeah.
You know, I just wonder, when you're looking at the pricing of these deals, if they are accounting for the huge tail risks that we're experiencing right now when it comes to AI threats, or maybe the dream of AI doesn't get realized. Are valuations in check with reality?
So look, I think there's valuations in multiple different contexts, right? There's valuation of where is a company trading in the public markets. And despite the fact that you see record levels for the indices, right? If you go through that, there is still about 20% or so of various indices, the S&P 500 or any one of them that you look at, where they are trading at a deep discount to their 52-week high or their fundamental intrinsic value. So it's not that, you know, the rising tide lift all boats. It depends on which sector you are, which industry you are, what your size is. Then there's the private market valuation, because again, you've seen a trend over the last, you know, couple of decades. Number of public companies declining in the United States, number of private companies increasing, whether that's founder-based companies, family-owned businesses, or private equity-owned businesses, right? So, and now you no longer have the need that I have to be public in order to have access to capital.
Right.
So the private market valuations have actually been pretty good, and sometimes lend themselves to better diligence and understanding to say, how should I value this company? And then there's the M&A valuation, where the acquirer is saying, what can I do with this? So it may seem like somebody is, you know, buying something. I would have thought they would have bought it for $1 billion and they paid 1.5. But if it is worth $3 billion to me, because I'm going to buy that technology and deploy it across my full platform.
Right.
So what is it worth to me?
So the technology aspect kind of changes just the worth to it. So I have to ask for your business itself. You and your team were part of the reason that JP Morgan had such great earnings. I think your revenue increased something for like 38% year over year. How is this quarter looking so far? Do you think you can repeat those stellar numbers?
That's always the question on Wall Street. Like, what did you do for me lately?
One quarter's never good enough on it.
So look, April has been, I'd say, just a little bit more challenging because there's been a little bit of ceasefire, so just a little bit of geopolitical uncertainty. Not that we didn't have it in the first quarter, right? We're still in the middle of several geopolitical conflict. But when you see that it's about to get solved, you may say, you know what, let me just wait for a few weeks. So there's been a bit of stop and start that has happened in April, which again, larger companies, larger deals are able to navigate better, is what we always tell boards and CEOs is, don't think about what does this mean for, you know, today's stock price the day after you announce it. Think about it as what is this going to do for your company for the next 5, 10, 20 years going forward. And if the deal makes sense, you do that despite the market volatility. And that has been a little bit of the approach. But if you think that in a week things are going to be materially different, you can understand the psyche of the start and stop.
Right. So there's basically being can kicking at the moment for the smaller companies.
Little bit of that. And at the smaller end of the market, sub 2 billion, right? The number of deals has actually declined quite a bit. Because again, when people are thinking, is this needle moving? As the size of the companies becomes bigger, for it to be needle moving, I got to buy something bigger too. And you know this, the amount of work that goes into doing any deal is just as hard whether I buy something for 500 million or 10 billion, right? So sometimes people say, let's make it count. Let's do something that's needle moving. And the other has been for these smaller companies, it's also the impact of any one of these changes is pretty big, right? The very reason why people are seeking scale, because when you're larger, you have more levers to pull, you have more places from where to move things from here to there, and more flexibility in navigating risk.
Right.
The smaller companies find that harder.
Right.
And so that level, there is a lot of pent-up demand.
Right.
Just like, all these private equity companies, which also own businesses, which also need liquidity.
Yeah.
And so the other place where we've seen a lot of activities in the secondary market, right? Now you have GP-led secondaries and continuation funds and private IPOs and evergreen funds. So that's been another pocket of
this desire for liquidity. Well, I see they've sent in the dogs, Anu. So I think we're going to have to end it there. Thank you.
Let the dogs out?
Someone, Milken did, apparently. Anu, thank you so much for joining. It's been such a pleasure. Matt, that is, of course, JP Morgan's head of M&A on UA.
Absolutely awesome. Awesome stuff. Danny, thanks very much. Anu, thanks very much to you as well. Catch Bloomberg Deals. It's tomorrow and every Wednesday at 12 p.m. New York time. This is Open Interest.
The world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
To the minute geopolitical news whenever and wherever it's happening. I'm Anna Marie Hordern in Caracas, Venezuela, and this is Bloomberg.
Coming up the next hour, we have the CEO of EQT, Per Franz, on AI investment monetization. I want to just say that as we look at Intel stock, because that's all about the AI story. Apple said to consider using Intel and Samsung to build chips and get away a little bit on its reliance from its reliance on TMC. Intel shares up 10%. Just 15 minutes into the trading day, 25 minutes into the trading day, Micron gaining almost that as well. And the stocks index up another 3%. It has gained 23 out of the last 24 sessions. What a run. This is Bloomberg Open Interest.
Court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Iran has threatened the U.S. The two sides have exchanged fire at sea, but the Pentagon says the ceasefire is holding.
The Joint Chiefs Chairman says since the fragile truce began last month, Iran has fired at U.S. forces more than 10 times. But General Dan Kane says those strikes have not been significant enough to break the ceasefire.
All below the threshold of restarting major combat operations at this point.
In addition to the ongoing blockade of ships heading to or from Iranian ports, the U.S. military is now undertaking what officials call Project Freedom, an effort to ensure safe passage of commercial ships through the Strait of Hormuz. Stephen Portnoy, ABC News, Washington.
Defense Secretary Pete Hegseth says that Project Liberty is a defensive operation.
All of these ships from all around the world want to get out of the Iranian trap that they have been stuck inside.
But shipping and insurance companies have said the White House has not been clear enough about the plan or the conditions in the strait. The strait's closure has sent gas prices in the U.S. higher. They're up over $1.50 on average since the war began, and Gas Buddies petroleum analyst Patrick DeHaan tells ABC.
We could be seeing a national average rise to $4.55 to $4.75 by the time Memorial Day rolls around.
And that could become a political liability for Republicans. And today, primary races will determine who's set to be on the ballot come November. In some states like Ohio, Vice President J.D. Vance will be there to vote in his home state. He'll also be in Iowa on behalf of Republican Congressman Zach Nunn. The World Health Organization says it's working to evacuate 2 people infected in the suspected hantavirus outbreak on a Dutch cruise ship, which is anchored off Cape Verde in the North Atlantic. Maria Van Kerkhove of the WHO said
passengers are being asked to stay in their cabins and limit their risk while disinfection and other measures are being taken.
3 people have died. You're listening to ABC News. State of California suing State Farm Insurance, claiming it mishandled more than 11,000 claims stemming from last year's wildfires. Jesse Albert lost his home in Altadena and said while his neighbors are rebuilding, he's only gotten about a third of what he needs, not for a lack of effort.
Walking through everything that you have to do, not just to fight them, but to document and to provide them documentation is a full-time job.
State Farm denies any wrongdoing and tells ABC it disagrees with how the state agency has classified its actions. Some parents who had planned to send their kids to more than 300 sleepaway camps in Texas this summer are now scrambling to find alternatives because of new state licensing requirements.
After last summer's flash flooding that killed more than 130 people in central Texas, including 27 campers and counselors at Camp Mystic, Governor Greg Abbott led a push for stricter regulations.
Improved camp safety is now law in the great state of Texas, a law that will save lives.
But with only weeks to go before the summer season begins, only 9 of Texas' 300 camps have met new requirements for emergency plans, warning systems, and staff training. Jim Ryan, ABC News, Dallas.
Tony Award nominations are out. Arthur Miller's Death of a Salesman received several nominations, including a Best Leading Actor nomination for Nathan Lane. The awards honoring Broadway's Beth are June 7th. Brian Clark, ABC News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals and the Bloomberg Business app.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City. We are streaming live on YouTube. We're streaming live on Bloomberg.com as well, so check us out there. Scarlett Fu out today, but no worry. Alexis Christopher sitting in for at least the first hour. We're going to go the first hour.
I like that. Yeah, I'm here. Okay, I was with you for the previous 3 hours, so we've been together
exactly.
for a while.
Everywhere. So we got a lot coming up here. We've got some green on the screen here today. We have some ISM data. We'll get to that coming up in just a moment. Caroline Hyde, B-Tech co-anchor, give us the latest on some of the news coming out of the tech. Apple may be using Intel, Samsung to build device processors. So some news coming out of Apple. Kim Forrest, founder and CIO of Boca Capital Partners, will give us her market outlook here. Geetha Ranganathan, she's a Bloomberg Intelligence media analyst. Paramount Skydance had some numbers here, so we'll get the latest from Paramount Skydance and kind of the deal for Warner Brothers Discovery, waiting for that to close. Mandeep Singh, Global Tech Research Head at Bloomberg Intelligence, give us the latest on some of the tech space. Palantir reported some numbers as well. So we got a lot to talk about on the tech side there. But right now, let's kick this whole thing off with Charlie Pellet and a Bloomberg Business Flash.
Hi, thank you very much, Paul Sweeney. And here's what's going on. This Bloomberg Business Flash is brought to you by IBKR. For the past 3 years, Interactive Brokers individual clients averaged 24.3% annually, beating the S&P 500. Lower costs and access to 170-plus global markets matter. Visit ibkr.com/performance. Yes, looking at an up Tuesday here with the Dow, the S&P, NASDAQ. They're all advancing right now. We do have the S&P 500 index climbing by 51 points, 72.52 where we stand right now, up by about 0.7%. You run the GIP screen on that index, and right now we are looking at our best level of the day on the S&P, again up by 0.7%. The Dow up 218, up 0.5. NASDAQ up 0.9%. The NASDAQ 100 index up 1.2%. Could see record closes again today for both the S&P, NASDAQ, and the NASDAQ 100 index. All of this with a VIX below 18, a 10-year 4.41%, a 2-year 3.92%, and the 30-year just under 5%, 4.99%. Gold up 1.2%, 45.78 the ounce. Crude now lower. WTI down 4.4%, 101.72 a barrel. Brent just above 110 now, lower by 3.3%. As for the market backdrop, Amanda Agati is Chief Investment Officer at PNC. She was a guest this morning on Bloomberg Daybreak.
I do think if there's one thing that investors focus on, and it's hard to, dial back all the noise, but I think if there's one thing investors focus on, it's really the path for earnings growth. And it's amazing to see that we're looking at, 19, 20% earnings growth on a year-over-year basis for the S&P 500. Do we hit that level? I don't know if we can get to that kind of a return level, but we could get to double digits.
Amanda Gotti of PNC. And speaking of earnings, after the close of trading today, we will be hearing from Advanced Micro Devices, up now by 1.7%. Oil lower, and oil stocks mixed right now. ExxonMobil, little changed, up under 0.1%. Chevron down 0.4. ConocoPhillips down 0.7%. Alexis and Paul, that is a Bloomberg Business Flash.
All right, Charlie Pello, thank you so much. We appreciate that. Alexis Christopher sitting in for Scarlet Fu today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. Had some economic data here today. ISM Services Index, that's a closely watched one, came in at 53.6. The consensus was 53.7. Last period was 54, so kind of right in line there. Let's break it down here. We can do that with Stephen Miller, chairman of the ISM. He's down there in Aledo, Texas, down in the oil patch. If you watch Landman like I do, you know exactly where that is in Texas. Steve, thanks so much for joining us here. Talk to us about the services sector of this economy, which is, again, 70% of the U.S. economy is services. What did you see here?
Good morning. It looks strong again. So we've had 3 months in a row where at least nine of the 10 sub-indexes are in expansion territory. The one disappointment this month was seeing employment still under 50%, although it did go up by 2.8%. So it was a positive sign, but the 9 other sub-indexes are all in positive territory.
And Stephen, there was a slowdown in bookings growth. What does that tell you? What's the big takeaway there?
Yeah, so for the new orders last month, we saw it was one of the largest increases that we had seen in the history of the reporting of the services PMI. This month, it looked like it was a little bit of a pullback, although it's only slightly below, less than half a point below our 12-month average for the new orders. While our order backlog remains strong. So to me, it looks like it's just a recovery from last month where people were trying to buy ahead of petroleum-related cost impacts into logistics and transportation, and they backed off, still in a growth mode this month, but less than it was in March.
Steve, how does the energy situation where we have higher energy costs here, and it's been, a couple of months, and, oil still at higher levels, gasoline prices, diesel prices still at higher levels. How does that factor into your data typically?
Yeah, the prices the prices paid index, which is still above 70 for the second month in a row, is showing some of that pressure flow through. What we've heard from commentary from those that have responded to the survey is we saw both petroleum prices and unleaded gasoline, fuel, oil-related products, commentary was that those are all up in price. And then about equal commentary of we've not yet seen petroleum-related products prices increase. So I think we're still in for a couple of months of that high prices index in the 70s until we see that full flow through of the higher petroleum prices. Hopefully we'll see some recovery in that here in the next couple of months with guided shipping through the Hormuz Strait.
Steve, thanks so much for joining us. Really appreciate getting a few minutes of your time. Steve Miller, he's the chairman for ISM. That is the Institute for Supply Management. We appreciate getting a few minutes of his time. Market Drivers today is brought to you by EisnerAmper. EisnerAmper provides assurance, tax, outsourcing, and advisory services to businesses that need more than a generalist. Whatever the challenge, we have a team for it. EisnerAmper.com. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney alongside Alexis Christophers, and we're joined by Bloomberg's Christina Aquino. Christina, what are you looking at today?
All right, Paul, let's take a look at Coinbase to start today. So ticker COIN, that share is down about 2% at the moment here. We did get news from Coinbase saying that it will cut around 14% of its workforce. That means that it will affect around 700 employees, and the changes will come expected to be in the second quarter. So that the company is also expected to incur as much as $60 million in restructuring expenses, because of course laying off people does tend to cost a little bit of money there. And so CEO Brian Armstrong saying that the plan is to concentrate the remaining staff around AI skills and reduce layers of management. What a novel idea, hey? Bloomberg Intelligence weighing in on this action, saying that it does signal volatile conditions in the near term, and it probably means that Coinbase will have to reduce its tech and sales cost guidance in its May 7th earnings release. So keep an eye out for that.
All right, want to move over to your next stock, which is Meta. And I do know this. I don't know why the stock is moving today, but I do know Mark Zuckerberg was at the Met Gala last night, his first one ever.
What is your verdict on the fashion?
But he did not go through the red carpet. He kind of came in like the back entrance.
Like through the kitchen, you know, of the Met. No, I don't know. But yeah, they avoided the red carpet, he and his wife. What's going on with Meta?
Well, the stock at the moment, just down a little bit today. So ticker META, down about 0.7%. We did get news that Meta is tapping Morgan Stanley and JP Morgan for a financing package for a data center in El Paso, Texas, that could total potentially roughly around $13 billion. And the plan supposedly is to finance it in a form of a little bit of debt, a little bit of equity, which is typically how these deals tend to go, right? It's a combination. So this comes after Meta completed a financing package worth almost $30 billion last year in rural Louisiana. So guess what? The company raised the funding through an entity known as Beignet Investor. Guess what this entity for El Paso, Texas is going to be called?
What?
Sopapilla.
Sopapilla.
I like it.
That's a southwestern food thing?
Yeah, like a pastry.
Okay.
Yeah, yeah. So now I'm kind of hungry.
I'll tell you what I'm learning now. These data centers, they're expensive. It's not like building a warehouse in the middle of Texas. These things are like $13 billion for a data center.
I didn't need the energy to keep it going.
Yeah.
Right.
Okay. Very good. All right. So you need the money, and they're going to the bond market. They're raising debt in Europe. They're raising debt in Canada. They're everywhere, which is good. They can raise it wherever they want, these tech companies. All right, one more.
All right, let's take a look at Fiserv as well. Payments company down about 8% at the moment. Those shares, ticker FISV. We did get their earnings today. Not a good look for the company. They reported first quarter adjusted revenue below analyst expectations, $4.68 billion versus an estimated $4.73 billion. Organic revenue was also below estimates, but they are sticking to their full year forecast with growth at around 1% to 3%. Now, Bloomberg Intelligence weighing in here as well, saying that the key risks continue to be margin compression and weakness in the banking sector. So let's see if that plays out, how well that plays out for their full year guidance for the rest of the year.
All right. Appreciate that. Ms. Aquino, with the new haircut, which looks awesome, by the way. So
this is my summer bob.
Love the look.
That's how you do it. Charlie Pellet, I don't think Charlie Pellet has a summer bob.
Yeah, I'm not a fashion guy. I think viewers, I think anybody, essentially, and you know what, Paul? I suspect the same about same about you.
Yep.
You have most likely, probably on weekends, chinos, button-down collar shirts. You've been wearing the same stuff likely since the 70s. Am I off base?
You're
Me too,
absolutely
and
right.
I'm proud of that, and I'm happy about that too.
It works just fine.
And it does. I'm very, very happy. Another story, perhaps for another time, just to show you how consistent I've been. I wound up on the cover of Land's End magazine, the Land's End catalog back in the 80s, which tells you something about my consistency in what I wear. So there you go.
You know what?
But predictable.
His Met Gala invite is in the mail for next year.
Didn't happen.
It was in the spam filter. You missed it there. Christina Aquino, thanks so much. We appreciate that. We looking at these markets here, Alexis, we still got, we got green on the screen here. This is a market, as Tom Keene was just mentioning this morning, continues to grind higher.
Yeah.
And I think this time, probably most of the time, but certainly this time, it's on the backs of some really strong earnings.
Well, that's what I was going to say. Most of this is driven by really stellar earnings, despite the backdrop of geopolitical tensions and the ongoing war and soaring oil prices, which, by the way, I don't mean to be a bummer, but the national average for a gallon of regular right now, $4.48.
Yep.
And people in California, $6.13.
Over $6. Yeah, with all those taxes. Yeah. So that's why we got the number 4 offspring who goes to college in California. We got him the hybrid, because the gasoline prices are so high. So he made that pitch to me. It worked. I usually don't buy his pitches, but this one worked, and he got the hybrid.
It's saving you money, a little bit of money anyway.
That's why it's working. So we'll we'll take that as we can. Gold higher here, still around $4,500 per ounce. We'll keep an eye on that. So we've got, again, green on the screen coming up. We're going to check in with Caroline Hyde, BTech co-anchor. We got some news coming out of Apple and kind of where they're going to get some of their chips and some of their hardware. Plus, Kim Forrest, she's the founder and CIO of Boca Capital Partners. Get her thoughts on these markets so far. Is the earnings growth that we're seeing out of corporate America, is that enough to continue to push stocks higher? It looks like we've got a Fed that's on the sideline. If you look at the work function for the remainder of the year, no rate cuts, no hikes either. That's all coming up. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks pushing higher. The Dow, the S&P, NASDAQ, all in the green right now. Perhaps just might see more records today for the S&P, NASDAQ 100 index. 44-point gain right now. Relative calm returning to markets. The S&P at 72.45. That is a gain of just about 0.6%. Stocks rising. Oil is falling as signs that a U.S.-Iran ceasefire is still in place. That is reducing fears about a full-scale war. The Dow up 228 now, up 0.5%. S&P, to be sure, off session highs, but still up by about 0.6%. We have got NASDAQ up 0.8%, with the VIX up below 18 now. The 10-year 4.42%. We do have the 2-year yielding 3.93%, and the 30-year right at 5.00%. Spot gold at $45.73 the ounce, up 1.1%. West Texas Intermediate crude down 3.7%, 102.48 a barrel. Barrel of Brent just above 111 now, lower by 2.7%. Keeping an eye on Apple shares, Apple has held exploratory discussions about using Intel and Samsung to produce the main processors for its devices in the U.S. It's a move that would offer a secondary option beyond longtime partner Taiwan Semiconductor Manufacturing. Apple shares up now by 1.4%, recapping S&P up 52, gain there of 0.7%. I'm Charlie Pellet, Alexis and Paul. That is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. Appreciate that. As always, we've got Alexis Christopher sitting in for Scarlett Fu. I'm Paul Sweeney live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. That Apple news really, that Charlie was just reporting, really got my attention. Apple's held exploratory discussions with Intel and Samsung about producing main processors for its devices in the U.S. That's a secondary option beyond Taiwan Semiconductor Manufacturing. That's pretty interesting. That's a pretty big change. I'm looking at Intel. Stock's up another 13% today. 52-week high. I'm going to say an all-time high, and I'm old enough to remember when the last time it hit an all-time high. My boy Frank Yeary, who's the chairman of board Intel, one of my Solomon Brothers running buddies, he just announced he's stepping down from the chairmanship. So a good day for my boy Frank. So good for him, going out on a high note there. Caroline Hyde joins us here, B-Tech co-anchor, along with some dude named Ed Ludlow. This Apple news, it seems kind of interesting, Caroline, because, I mean, Taiwan Semiconductor is such a huge supplier for all of the technology space. What's Apple doing here?
It's almost going back to its partners of old. Yeah. Remember, Apple didn't always design its own chips. It used to rely upon Intel and Samsung it still depends upon a lot for other parts of the iPhone. Remember the screens, for example. But this is about the dominance of Taiwan. TSMC obviously has most of its manufacturing out of Taiwan. About 90% of all chips in the world are made in Taiwan. That is a huge potential choke point, bottleneck concern, particularly when Taiwan is in the eye of the storm, not only weather storms, but also in terms of geopolitics and what if China was to start making any sort of aggressive moves. This just means that for Tim Cook, the supply chain god over at Apple, who's now moving to the chairman role, he's always trying to think ahead of how he can be less dependent. So remember, TSMC is manufacturing in the US more. They're likely to be committing ever more billions into Arizona. That is something President Trump wants. But Samsung, too, is investing in the United States. In Texas, we understand that people have been from Apple to go and look around those fabs over in Texas. And then what about Intel, a company that the U.S. administration has skin in the game in, and this would also be a political move in many ways.
So this is Apple's way of sort of insulating itself best it can. And one of the last major things I guess Tim Cook will do during his tenure as CEO before he passes the reins. What about supply shortages? We know there's a lot of demand for the Mac. How are they doing with that? And also, would this deal with an Intel or a Samsung for these processors help with that?
Well, I think that was what surprised many, was the admission that maybe the memory chip issue wasn't so much Apple's problem this time. It was more the sheer desire to buy Macs, trying to buy basically Apple products to run your own OpenClaw, run your own agents overnight, and suddenly they see Mac Minis fly off the shelves. They just cannot get the equipment fast enough. And so, yes, that has been a bit of a blocker for Tim Cook. Basically, they've got a lot of demand, and it's the supply that's the issue in terms of their previous quarter. How quickly this can get off the ground, that's a question, Alexis. And so whether or not we'll see Tim Cook make any moves while he's CEO to fix that is still an open book, because look, they're still building fabrication points for Intel. This is a long-term play coming from Lip-Bu Tan, but we know that the CEO of Intel has in many ways been the issue of, look, I will build it if they come. So if Apple is coming, they will start to build out that Ohio presence, for example, be able to become the fabrication partner of choice. Samsung already is building out in Texas. How quickly they can start rolling off. But you're right, the supply chain issue has been what chips are getting into their Mac and their hardware products more broadly.
Apple is also preparing a new Creative Pass feature for its next major iPhone software upgrade, allowing users to build and customize their own digital tickets and gift cards within the Wallet app. That seems pretty
Fun.
Cool little.
It also seems pretty confusing. What does that mean for me?
I put a lot of stuff in my wallet. I mean, that digital wallet. I'm putting more and more stuff in there, right?
Yeah.
Yeah, and that's with even certain events that you go to, certain gift cards you might get, not actually having the ability to put it on your Apple Wallet. So this is instead, say you get a one-off event down at Jones Beach, you're going in New Jersey, I know you're spending your summer by the shore there.
Caroline knows you.
Yes.
I love working alongside Paul, and I get to know the New Jersey love. But say that particular event doesn't have the feasibility of a relationship with iOS, you can take a QR code that they send you and just load it into your wallet. So there it is. So you can have all things in one place. They're trying to become more of a hub in that respect. So this is a nice little upgrade that we're going to see to the software operating system coming soon.
I look forward to that because I know I'm one of those people I have to search through my inbox to go, where did those tickets go?
Yep.
Where's that QR code? If you just put them in the Apple Wallet and forget about it. That's smart.
One-stop shop.
Is this coming out in the next iOS update? Or?
That's what's anticipated by
All right, here's the latest thing I put into my wallet, and I'm not sure I like it. Like the key fob for my new car.
Okay.
Don't need a key fob. You just download, put it in the app, and my phone is now my key.
Yeah.
And the BMW key is actually now in your wallet. So as soon as you just walk up to the car unlocks.
Well,
and then when you walk
it's a little
away
scary. Don't leave your phone anywhere.
Exactly.
That's the scary part.
So I don't know how that's all going to work. Caroline Hyde, she is the boss of all this B-Tech stuff. Yes, exactly. Caroline Hyde, B-Tech co-host, giving us the latest on what's happening in the world of technology. Looking at these markets, guess what? We're moving higher here. What are the pros doing here? How are you resetting for a market that's hitting new all-time highs seemingly on a daily basis? But hey, as we said earlier, Alexis, these are driven by some really strong earnings, I think the market's seeing.
And the AI trade is very much alive and well.
Yep, very good. Kim Forrest, founder and CIO of Boca Capital Partners, joins us here. Kim, what do you make of this market here? You feeling comfortable with these moves we're seeing higher?
Kind of, sort of, but not really. You know, we're supposed to manage risk here. And, you know, if reward gets too big, guess what? That's risk, right? Like, it's good to be winning, but let's take a little off the table every once in a while. And I think a day like today might point us in that direction. And as you said, like, how about Intel? I think at the beginning of the year on people's, like, things that are going to happen in the year bingo card, this was completely off the table. That wasn't going to happen, right? Like $100 Intel, no one had that. So, you know, if you have Intel, it might be a good time to take a look at it.
Kim, are you feeling like these markets are getting just a little bit frothy, given all the possible headwinds that we are seeing? You know, nevertheless, we've got this war going on. We've got geopolitical tensions in many parts of the world. Is the market just a bit ahead of itself here?
The market is always ahead of itself. That's what it's supposed to do, is kind of give us an indication of where things are going in the future. That's what people are betting on. And I hate to use that word betting. I really like to think of myself as owning stocks, owning a collection of companies, not trading stocks. So let me make that perfectly clear. That being said, there's a lot of market participants, and they are saying, hey, we think these companies are going to win by buying them at the prices they are at now. I think the build out in AI is going to go on, but I don't know that it's going to play out the way everybody thinks, that we're going to have these huge data centers, that LLMs are going to replace human beings en masse, and we're all just going to, you know, like somehow become the Matrix and sit in a chair and not do anything. Oh, that's grim, isn't it? Sorry. But I do think AI is going to be something that adds productivity to our lives, both at home and at work. It's going to take an amazing amount of semiconductors, but it's going to be this odd lot collection that changes over time. You know, if you had said 2 years ago, NVIDIA is going to be like treading water and Intel will shoot up, again, who would believe that? We don't know what the future brings, but we know we have a pretty good idea. AI, data centers, and productivity are all key themes.
Kim, I know you've got a lot of history looking at the software space here, and again, that's been one of the areas that's really had some pressure on it as people are concerned about AI and the competitive threat it poses for many sectors of the AI stack. How do you think about that theme?
Sure. Well, I think you should always have looked through the lens of, is this software product making somebody more productive or more entertained if you want to go into the commercial or the consumer realm? Personally, I don't get a thrill about sitting in front of a screen after hours, playing games and stuff like that. So let's shove that off to the side and only talk about enterprise-focused software. I think there's some companies out there that are solving a problem at a price that's too high. And what I mean by that is maybe AI will be able to take over some of these software packages. But I think by and large, people have thrown out the baby with the bathwater here. There are companies that either have stores of data or really do add value, and their software companies are trading lower. So you have to sift through what all the companies in your portfolio do and decide, are they valuable enough at the price they're charging now, or maybe a little less, to their customers that they'll continue using them? And I think there's a lot of yeses out there and some nos as well.
And of course, it takes patience on the part of the investor, right, Kim? Because we just don't know if this massive spending on AI is really going to pay out the way these companies are hoping. Why is Wall Street picking and choosing who to rally around when it comes to AI spending? Because you hear about some companies saying, oh, we're going to spend, X amount on AI, and then the stock sells off while others, skyrocket.
Sure. Well, maybe they don't have a track record of deploying new technology well. I know that's shocking. We kind of think that all of the companies in America are above average, and, some really aren't. There are some non-tech companies that are phenomenally good about picking technology, deploying it, and making their employees more productive. And I think, that is always in style. And there are others that just chase after, the next new thing, deploy lots of money, and it doesn't pay off for them. So again, I'm a fundamental analyst. I eat this stuff up, looking at companies, seeing what their track record is, who their executives are, what their track record is, and can they deliver? That's the big question. And can they deliver better productivity with AI? Some yes, some no.
All right, Kim, thank you so much. We always appreciate getting a few minutes of your time. Kim Forrest, she's a founder and Chief Investment Officer of Boca Capital Partners out there in one of my favorite towns, Pittsburgh, Pennsylvania. Concord Town, I think one of the best cities out there. S&P up 50 points, Dow up 270, NASDAQ up 250, that's 1%. WTI crude oil, it's lower by $4, $102 per barrel. This is
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ solidly in the green. Could see a record close today on the S&P, NASDAQ, and the NASDAQ 100 index. But right now, we are off session highs. Relative calm returning to global markets. Stocks rising. Oil is falling as signs that a U.S.-Iran ceasefire is still in place. Reduce fears about a full-scale war. So here's where we stand right now. Mid-morning, we have got the S&P at 7250, up 49, up by about 0.7%. Dow Industrials up 243, up 0.5. NASDAQ up 225 for the NASDAQ Composite Index, a gain right now of 0.9%. The NASDAQ 100 Index up 1.1%. The SOX surging by 3.3%, with the VIX below 18 right now. The 10-year 4.41%, the 2-year 3.93%, and the 30-year just below 5%, 4.99%. Gold up $60 the ounce, up 1.3%, 45.82 on the precious metal. West Texas Intermediate crude and Brent both lower, just above 102 for a barrel of WTI, down 4%. Barrel of Brent 110.97, down now by 3%. Kim Forrest is Chief Investment Officer at Boca Capital Partners, and moments ago right here on Bloomberg Intelligence, she told us she is focused on the artificial intelligence build-out.
I think the build out in AI is going to go on, but I don't know that it's going to play out the way everybody thinks, that we're going to have these huge data centers, that LLMs are going to replace human beings en masse, and we're all just going to, like somehow become the Matrix and sit in a chair and not do anything.
Kim Forrest of Boca Capital Partners interviewed right here on Bloomberg Intelligence. Job cuts at a number of companies in various industries. This morning, crypto exchange Coinbase Global cutting roughly 14% of its workforce. Coinbase down now by 2.9%. Sources tell Bloomberg PayPal Holdings plans to cut around 20% of its workforce in the next couple of years. PayPal down 10.2%. Also, word of job cuts at BioNTech. BioNTech shares right now trading lower by 3.1%. Recapping stocks higher, S&P up 0.7. I'm Charlie Pellet. Paul and Alexis, that is a Bloomberg Business Flash.
All right, Charlie, and we appreciate that. Charlie Pellet with the news there. We've got Alexis Christopher sitting in for Scarlett Fu. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio, streaming live on YouTube as well. Paramount Skydance reported first quarter sales and earnings that beat analyst expectations as the company moves closer to acquiring Warner Brothers Discovery. Investors underwhelmed, I would say. Stocks off 6.5% today, off 22% year to date. So there's a lot of moving pieces at Paramount Skydance. Let's break it down with Geetha Ranganathan. She is the media analyst for Bloomberg Intelligence. She's down there in Princeton. Hey, Geetha, first of all, let's just kind of go to the earnings here. How's the Paramount Skydance managing under new management?
They actually did a really good job, Paul. So, just from the results that they reported yesterday for the first quarter, it was really strong. Both revenue as well as adjusted EBITDA came in well above consensus estimates. And, the really encouraging thing and what investors look at quarter in and quarter out is how well they are progressing on the streaming front. And they had pretty good subscriber growth. A lot of this has been driven by their new UFC deal. But more importantly, they actually reported profits. Remember, this is a service that has been has been racking up loss after loss, quarter after quarter. But for the first time, there was an inflection. They reported about $250 million in adjusted EBITDA, and they are actually going to sustain momentum when it comes to that profitability. So across the board, actually pretty good numbers. But then, as you said, there's just a lot of different moving pieces and a lot of investor anxiety about those moving pieces.
And I want to pick at some of those moving pieces right now, Geetha, because revenue from Paramount's film studios grew 11%. There was a strong theatrical performance from the horror movie Scream 7, so I guess lots of fans out there. But sales in Paramount's TV unit fell 6%. Was that driven by just lost business, or is there a fall off in advertising, or maybe a little bit of both?
Yeah, there was definitely, advertising. So remember, Paramount derives about 33% of its revenue from advertising. So huge, very, very critical part of the business. And yes, across the ecosystem, Alexis, we are seeing a weakness in TV linear advertising. And of course, no exception there at Paramount as well. They're obviously going to have a little bit more weakness for the second quarter. That's what they guided. They did not have the March Madness Final Four, which they had the previous year. So, we're seeing tough comps and just general core ad weakness.
So, Geetha, what are the companies saying here? I'm thinking about the big companies that own broadcast and cable networks. What are they? That's a declining business. It's in a secular decline. It kind of feels like newspapers 30 years ago, radio 20 years ago. What do they plan to do that structurally wise?
So structurally, Paul, what all of them are doing really is moving to digital. So, it's the big shift from linear TV to what they're calling connected TV. That shift couldn't happen any faster. They're all trying their best. It's a $55 to $60 billion linear market, but there really still remains this huge gap between eyeballs and monetization, because we've seen all of the eyeballs move from linear TV to streaming. We haven't seen an equally fast or an equally rapid shift of that monetization from linear to streaming. And that's really what all of these companies are trying to capitalize on. Netflix, of course, made its big move into advertising, but then all of the linear companies already have advertising relationships, whether that's a Disney Plus or a Paramount, but again, it's about how fast they can get there, but they're all trying.
We know that Paramount, clinched the $110 billion deal for Netflix. It hopes to close on that deal in the third quarter. But Paramount has asked the FCC, Geetha, to sign off on a funding structure that includes more than a third of the company's equity coming from Middle East government entities. Are they going to get that FCC approval? And I'm wondering if the war in Iran is, putting any of that in jeopardy.
I think they will get the FCC approval. I think so far all the indications that we've gotten from on the regulatory front seem to indicate that the administration is definitely going to give them the go-ahead. I think if at all they have any problems, it'll probably be in California. The California AG has on numerous occasions stated that this is not a done deal, that he thinks that this is actually going to be bad for Hollywood. So I think there's definitely a little bit of regulatory nervousness when it comes to the California AG. But I think on the FCC front they should be fine. I think the reason why we are seeing so much of weakness in the stock today is really worries around post-deal execution. This is a tall order. This is a company pro forma that's going to have about $80 billion in debt. That's about 7 times EBITDA. So highly leveraged company. You have only about $12 billion in EBITDA. Their goal is to get to above $20 billion because they need to get to a 3 times leverage ratio, but that's going to be possible only if they achieve about $6 billion in synergies and really bump up that EBITDA. So there's really a lot for them to do, Paul and Alexis. And I think, so execution, regulatory, and then there's the issue of dilution from a share count perspective, because right now they have about 1.1 billion shares with Paramount. When they get the WBD deal, that's going to go to about 5 billion. So we are expecting massive share dilution there. And so that's another big reason.
30 seconds left, Geetha. When you put all these companies together, there's Paramount, Skydance, Warner Brothers, Discovery, is that going to be a streaming service of scale that can compete against Netflix and maybe even Disney?
It can, Paul. And I think that's what investors, the bulls are definitely betting on that. I mean, this is a service that's going to have over about 220, 230 million subscribers. Definitely puts in within striking distance of both Netflix and Disney. And I think what we're really kind of betting on with this new management team is how they leverage technology. I mean, this is David Ellison we're talking about. He's a tech kid. Can they leverage AI to get all of those efficiencies?
Geetha, great stuff as always. Geetha Ranganathan, she is the media analyst at Bloomberg Intelligence, one of the leading voices out there on this stuff. So read her research if you're interested in the media space out there on a global basis. BI goes is the function. Geetha was mentioning that this company pro forma, the leverage will be about 7.5 times debt to EBITDA. When I lent Paramount money back in the early 90s, 4 times leverage max.
Right. Your times have changed, Paul. And
no,
the tolerance has changed now?
No, this is going to be an over-levered company, and this can be a problem, I think. And,
regulator, I wanted to ask Geetha, we'll have to bring her back at some point. Regulators abroad still have to sign off on this thing. Are they going to ask them to divest of certain things to make this happen or somehow lower that debt load?
They'll typically follow U.S. regulators, but as Geetha said, the states might step in here. And again, the states usually follow the federal. But California, you're going to be looking at a lot of potentially lost jobs.
We know Hollywood's not in love with this deal.
That's going to be a concern here. So stay on top of that. But the deal is supposed to close in the third quarter. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Alexis Christopher sitting in for Scarlett Fu today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube. I tried to make it a Mandeep-free day. No luck. He's here. Mandeep Singh, Global Tech Research Head for Bloomberg Intelligence, joins us here in studio. Mandeep, has a gajillion things to talk to you about. Palantir Technologies, talk to us about that company and how it fits into just kind of the tech stack, the AI play, because they raised their numbers again. They reported some good numbers. So talk to us about Palantir.
85% top line growth for a software company, and given all the pressure that software sector is under, so that just goes to show that this company is definitely doing a lot of right things in terms of appealing to the government. They're benefiting from that. Enterprise usage is very strong, and look, overall, when your stock is trading at 50 times EV to sales, there is always that risk that somebody may say, oh, sequentially, the growth decelerated slightly, which is why you see that kind of stock reaction. But I think all in all, this still has a long runway. They are exposed to government spend, which is why the concentration risk is really high. I mean, more than 50% of their business is still from the U.S. government. And so from that perspective, I would say, things could change. If, let's say, the war ends and suddenly we are not spending as much next year, then the growth could taper off. And again, it's a function of valuation.
Right.
So they're growing nicely into their valuation, but the sustainability of growth could be questioned if they're exposed to that degree.
Yeah, they are sensitive to that government spending. When we dig into the numbers here, I guess one area that you could nitpick is U.S. commercial sales. For the first quarter came in at 595 million, but that fell short of expectations.
Well, so it's more the backlog growth than the actual growth in the quarter. They still had, triple-digit growth. So
it's still enviable growth.
Yeah. So not much to nitpick on there, but look, you could say the LLM companies like OpenAI, Anthropic, they could be potentially competitors of Palantir down the line because a lot of the software that is being built by these companies is bespoke, customized for a specific use case. And that's another risk. Like Anthropic is growing faster than Palantir. Even though Palantir has got 85% growth, Anthropic's growth is, north of 300%, 400%. So from that perspective, you could say there could be a competition from LLM companies down the line.
So what is the call on just software in general these days? Because we had a sell-off in software, particularly software as a system. The theory being that AI will disrupt a lot of software applications. Where are we? How has that evolved in the marketplace?
I mean, the general thesis is, the software that was, legacy, which didn't really change over the years. Now you have an option to build, bespoke software using the LLMs. And that's where you could do a lot of customized things that you are not able to do in the past, or you had to rely on IT services companies to do that sort of thing. You can do it much faster. Your developers are a lot more productive. So that's the big theme. The software growth rates haven't really gone down that much. It's just that everyone is focused on the terminal value of software, given the change that's going on. And look, some of it is hypothetical. Nobody knows what will happen, 10 years from now in terms of what the growth rates may look like. So that's the narrative right now. It remains to be seen if, these LLMs are going to disrupt every category of software. And we could argue, the system of record companies will have a very strong mode that is hard to disrupt.
But a company like Salesforce.com, which is, I don't know anything about this SaaS business, and I'm proud of that fact. But I know Salesforce is kind of my proxy. That stock, which is a great company, great stock, great product. Everybody you talk to uses Salesforce in their daily workflow, love it. Stock's down 30% this year. To me, that just says the market has re-rated down, cut the multiple down for these stocks. And okay, maybe now we start from here, maybe. I don't know.
But they did that to Google too. Yeah. Remember when ChatGPT launched?
Yep.
Google got re-rated and everyone was bad.
I still don't know why that's not a Google killer.
But look at where Google is now in the past 12 months. So market isn't right all the time. That's what creates dislocations. Yep. But look, there is an influence in terms of software overall growth rates because of LLMs. And that seems to have definitely been impacted by the rise of LLMs. And not every software company will grow at the same rate as it was growing before.
Before we let you go, 30 seconds, AMD after the bell, the bar is high. The stock is up 250% in just the past year. What are we expecting?
Well, so what Intel told us is CPUs are having their moment in terms of shortages, and so that is a nice tailwind for a company like AMD, but it's already reflected in the stock. Right. So from that perspective, I think it better be a very big beat and raise, otherwise they go for disappointment.
I believe that. We could talk to Mandeep every single day.
Love it.
There's so much stuff to talk about in the tech space. Things are moving. I'm looking at these service as software stocks. I mean, ServiceNow, they're all down like 30, 40% this year. It's crazy. Mandeep Singh, Global Tech Research Head for Bloomberg Intelligence, joining us here. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour at Bloomberg Intelligence starts in just a moment with the markets higher here. The S&P's up 50 points. That's 0.75%. The NASDAQ up 220 points. That's 0.9%. WTI crude oil off about 4.5%, right around $102 per barrel.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals and the Bloomberg Business app.
All right, Alexis Christophers in for Scarlett Fu. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in New York City. We're just going to go above 80 today. Boom. Our spring was yesterday, and now we've got
right. The sad thing is we're going to jump right into summer. Actually, we're not, because I looked at the long-range forecast, and it's not going to last.
Again. Okay. All right, we're on top of it here. We're going to enjoy our warm weather here in the city. Coming up, we're going to check in with Paul Goldberg. He's Bloomberg Intelligence Senior Echo Analyst. Coinbase cutting 14% of workforce, citing volatile markets and AI. There's a little theme here. Dick Shigera, Bloomberg Intelligence FinTech Analyst. PayPal plans to cut jobs. I'm sensing a theme here right around the AI, I'm afraid. Chuck Lieberman, co-founder and chief investment officer at Advisors Capital Management, get his thoughts on these markets here. Eric Balchunas, senior ETF analyst for BI. Yes, no prediction market ETFs are coming soon. Why not? What could go wrong? So we got a lot coming up there. Let's kick it off with the Charlie Pellet.
Hi, thank you very much. And here's what's going on. We have got the Dow, the S&P, NASDAQ, all advancing right now, very close to session highs on the S&P 500 index, up 53 right now, 72.54, up by about 0.7%. Could see a record close today on the S&P, NASDAQ 100 index, also potential records there, both pushing higher. The Dow advancing as well, up 0.7, S&P to be sure, up 0.7, NASDAQ up 0.9%, the NASDAQ 100 index doing a little bit better, up now by 1.2%. All of this with the VIX just above 17 right now. The 10-year, 4.41%. The 2-year, 3.93%. Spot gold is up $57 the ounce to $45.78. That is a gain of 1.3%. West Texas Intermediate crude now down 4.5%, 101.62 a barrel. Brent, the global benchmark, 110.76. It is tumbling by 3.2%. So stocks are rising, oil falling as signs that the U.S.-Iran ceasefire is still in place. That is reducing fears about a full-scale war. Also on everybody's minds, the Federal Reserve and the outlook for the coming year. Michael Darda is chief economist at Roth Capital Partners, and he was a guest this morning on Bloomberg Surveillance.
Well, we can look at financial markets, and the financial markets are not looking for any big changes in the policy rate over the next 12 months. In fact, all of the previously expected rate reductions have been priced out now, and markets actually are pricing in a very small probability that the next move is a hike instead of a cut over the next year.
Michael Darda of Roth Capital Partners. We're keeping an eye on Pinterest after earnings. Shares of Pinterest, it reported last night after the close of trading. And right now we do have Pinterest shares. They are advancing today. We got Pinterest up by just about 10%. So again, recapping here, stocks higher, S&P up 54, up by 0.8%. I'm Charlie Pellet. Paul and Alexis, that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. We've got Alexis Christophers sitting in for Scarlett Fu today. Scarlett will be back tomorrow. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. As Charlie's just reporting, we've got green on the screen here. Let's take a look at some of the stocks on the move today. We can do that with Christina Aquino, Managing Editor for Markets Live, Bloomberg News. Christine, what are you looking at?
All right, Paul, let's take a look at Alphabet today. Ticker GOOG. Those shares are up just over 1% at the moment. And of course, they're keeping up the theme of big tech company looking for some financing. So they're tapping both the euro bond market as well as the Canadian dollar debt market. I mean, double offering here today.
Yep.
And so they're raising 9 billion euros in euro bonds. And now they're also seeking about 3 to 5 billion in Canadian dollars. Of course, to fund what else? Their AI investment goals, because they are, in fact, going to have to be spending $190 billion this year to invest in data centers, which is critical to their AI investment plan. And so they're going to need some cash for that, apparently. But
52-week high for the stock today, all-time high for the stock today.
For Alphabet?
Yep.
Wow.
No,
and
it's
get
for
this,
Google.
Amazon, Alphabet, Meta. I know, right? We're always and forever going to call it Google.
Yep.
So Amazon, so the 5 big hyperscalers, Amazon, Alphabet, Meta, Microsoft, Oracle, issuing a record $121 billion in corporate bonds.
they're getting busy. Yeah, because they're going to need some cash to finance all these projects. But you know what? There is a lot of demand for these products, particularly in Europe, because there's not a big tech sector there. So Bloomberg Intelligence actually saying that the appetite for these assets well outweighs any sort of concerns around funding and all that. And so they're optimistic that the issue is going to get a tighter range as it goes through.
Okay, also PayPal, right? I mean, they're sort of a mixed bag for
Exactly.
PayPal.
Yeah, a mixed bag for PayPal. But of course, the focus is what it plans to do with its workforce. So ticker PYPL, those shares are down more than 8%, pairing some of those earlier losses that we've seen. But again, the headline grabber here is, in fact, what they're planning to do. They're planning to cut 20% of their workforce in the next 2 to 3 years. That's equivalent to about 4,500 jobs. And they're looking to save about $1.5 billion over that time. And again, it's part of a restructuring under CEO Enrique Lores, and Bloomberg Intelligence weighing in on this. Their valuations have been depressed. Capital returns are notable, but the path to sustained reacceleration really hinges a lot on this restructuring plan.
Eaton Corporation.
Eaton, yeah.
Industrial company.
Exactly, power equipment company. So those shares on the back foot today as well. Ticker ETN, they're down about 4.5%. We did get the results today, a little underwhelming. The second quarter outlook missed estimates. They did raise the low end of their range for 2026 guidance, but analysts still calling the results a mixed bag. And Barclays analyst Julian Mitchell saying that they were a little bit of a victim of high expectations going to the results. And so it is generally tough for, the stock to work when some of their segments really are not beating expectations. So that's going to be key for earnings moving forward.
Yeah, I was just looking back to PayPal for a moment. Worst performer in the S&P 500, leading the decliners there. Rough day for PayPal.
All right, Christine, thank you so much. Appreciate that. Christine Aquino, managing editor for Markets Live. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, and anywhere you listen. Coinbase cutting 14% of its workforce, citing volatile markets and AI. Let's break it down with Paul Goldberg, Bloomberg Intelligence Senior Equity Analyst. Paul, talk to us about what's going on with our friends at Coinbase.
Morning, Paul. I think there is a change of heart. Obviously, when they reported earnings in February and guided for the first quarter, they were guiding for the expenses to be roughly flat, which kind of raised the eyebrows a little bit because the activity levels were trending down, and there was some concern. But going back to December when they announced the build out of everything exchange, there are a lot of investments that they have been making. So they basically wanted to maintain those investments going forward, but clearly 3 months later, we do get some change of heart here.
So we're talking about 14% of Coinbase's workforce being cut. I guess that amounts to about 700 jobs. Is AI behind this cut?
I would think that AI is probably part of the equation, but not necessarily the driver. They did, in Brian Armstrong's post on X, they did mention the volatility as being the biggest issue. So even we've seen the Bitcoin price dropping from 125,000 to 65,000, and it's probably, 81,000 today. So it's coming back in the second quarter, but there is a lot of uncertainty. So they're trying to adjust to that mainly. They're also, as part of the transition, they're cutting out some management levels, so they're trying to optimize the business, and maybe AI is the helper there, where the managers can actually be individual contributors as well.
So, Paul, I think a lot of people know Coinbase as simply a platform to buy and sell cryptocurrencies. So is this stock primarily, entirely, partially driven by the price of Bitcoin?
If you look at the stock chart, part of that reaction is kind of similar to what the Bitcoin is doing. But if you look at the businesses that are in the subscription and services businesses, the staking, the payments, and all those other things that they're building, there's really a lot of other things happening across the entire ecosystem, including the tokenization and getting even into more traditional markets like equities.
And certainly Coinbase is not alone, right? I mean, you've got a number of companies in this space announcing job cuts recently. Block, Gemini Space Station comes to mind, I think Crypto.com. What are the reasons why that these companies are offering for why they are tightening their belts?
I think so. I don't think it's necessarily a long-term problem. I think it's more of a cyclical problem. And because the cycles are so short in those businesses, the technology develops so fast, they really have to adapt and adjust almost on an annual basis or every few years when things change very dramatically. So they do have to refresh their workforce.
So, Paul, what's the next step for Coinbase here? What's kind of the bull case for this stock here?
I think the bull case is the ecosystem on the blockchain and tokenization, the base layer programming that they're building that can allow their users to build on that blockchain, the tokenization of different kinds of assets. So we're just having a lot of things in terms of payments, market structure, and things like that shifting very dramatically onto usage of blockchain. So I think that's where the opportunity is for them.
All right, good stuff. Stock off a little bit here today, off a couple of percent. Paul Goldberg, Senior Equity Analyst for Bloomberg Intelligence, giving the latest on Coinbase. We also got some earnings out of PayPal. And the earnings, I'm looking at just at the earnings. PayPal reported first quarter adjusted earnings about $1.34, beating the average analyst estimate of $1.27. And the company reiterated its full year guidance, PayPal did. But they're also cutting costs here and cutting some jobs here. So let's break down what's happening at PayPal. Diksha Gira, Senior FinTech and Payments Analyst, joins us. She's at Bloomberg Intelligence. She's based out there in San Francisco. Diksha, what'd you learn from PayPal with their earnings results?
Yeah, hi. As you can see, Paul, revenue was up about 7%. It was a decent beat, about 6% EPS beat. Adjusted EPS was ahead of consensus. Volume was up 11%. Venmo volume accelerated to 14. So operationally, it wasn't really a bad quarter, but the stocks are still down. So how I'd frame it is that this is a decent show me result, but the bigger issue here is around credibility. And I think the market basically wants to see can new leadership really demonstrate some stabilization and execution. So not a blowout quarter, especially given the tough environment, but it was better than what we feared.
Was Wall Street happy, though, with guidance for the current quarter? Because I'm sort of reading some mixed things here on the Bloomberg terminal, and also saw them guide toward a decline in earnings per share in the second quarter.
Yeah, you're right? See, this is what we had flagged in our React as well. I think there is a lot to prove yet. So this was a great quarter, but one data point does not make a trend. We are still yet to see whether branded checkout growth can increase sustainably, ideally grow above low single digits. The second thing is whether transaction margin dollars return to growth after the second quarter dip. So guidance to that is also signaling weakness, it doesn't really inspire confidence in that sense. And thirdly, I think the market also wants to see whether the new CEO can convert this whole $1.5 cost program into product velocity rather than just like some EPS support.
What's the bear case here for PayPal? FinTech is it's an exciting growth segment, but boy, it just feels like competition is everywhere.
You're right, Paul. I think, see, the bear case investors have heard several turnaround stories before with PayPal, and there is that fatigue setting in. The second quarter guidance does not suggest that the reset is still ongoing. So the bear case is evident, stocks are moving. What I'd argue is that, is there a bull case here? And especially like just looking at the valuation and the capital situation with PayPal, like they have targeted $6 billion plus of free cash flow this year, and they plan to buy back as much of stock. So that is definitely very interesting for value investors. It's a very cheap, highly profitable company, but I think there is still nervousness around can new management turn it around?
And it really was considered a pioneer, wasn't it, in the payment space? And would you say that it just was too late to sort of change with the times and other companies in that space started to eat its lunch?
I think definitely there are a lot of new players that are coming in, Stripe being one of them, Adyen coming in with the more non-branded kind of offering. So there are lapses, particularly the challenges around the branded business for PayPal. But I wouldn't say the battle is lost, right? Just the scale and the size of this company and the two-sided network, these are very enviable attributes, and I think there's still room for that. One thing I would kind of allude to is the whole job cut situation as well. We've been getting a lot of questions around that.
I'm glad you brought that up because it's an unspecified number of job cuts, right? Or did they say how many they're looking to let go?
So I saw a news line saying 20% job cuts.
Wow.
And PayPal's like 24,000 plus employees at the end of last year, and that could mean around 4,500 jobs being culled. And the job cuts technically are a double-edged signal, right? On one hand, they show that management is serious about taking costs and complexity out of the business. But on the other hand, when a company is cutting this deeply, investors tend to ask whether this is just margin repair or whether it actually fixes the growth problem. Basically, PayPal does not need to be smaller just for the sake of being smaller, right? It needs to be faster, more focused, and more competitive at checkout. So that's the question, will they be able to deliver on that?
Diksha, thanks so much for joining us. Really appreciate it. Diksha Gera, Senior FinTech and Payments Analyst for Bloomberg Intelligence, giving us the latest on PayPal. Again, you're right. It's Alexis, it was arguably one of the first fintech companies out there. But again, it's such a technological race there that
it is.
You have to always worry about the person who's in their garage in Palo Alto coming up with better technology.
Exactly. And it did have that sort of cool factor that I feel like it's lost a little bit of that mojo over the years.
Because I use Zelle, Venmo. That's what
right. I'm with you on that.
Yeah. So Apple Pay also a lot. So
more and more for me.
Yeah. And I'm kind of shocked when I go on a website or doing any kind of commerce, and Apple Pay is not an option, where I got to pull out my credit card, enter that in. I'm like, dudes, get with it.
Like the olden days?
Yes, exactly. I mean, I'm not like some, tech aficionado, but at least I can use the Apple Pay. So anyway, so we'll see where PayPal fits into all of that. President Trump out with a bunch of social media posts, repeats praise for the stock market records during his administration, reiterates the world is in trouble or would have been in trouble if Iran has a nuclear weapon. He says can't let Iran have a nuclear weapon. Praises the World Cup for ticket sales. So we got a lot going on out there. So President Trump out there on...
Apparently also direct flights from the U.S. to Venezuela are back, according to the president and his social media posts.
Okay. So I'm sure there are a lot of people that that would try to take advantage of that. Like people like Charlie Pellet who like to go to these crazy...
Just travels the world.
...vacations and go to places you would never think of. That's where people like Charlie Pellet go, those adventurous travelers. I'm not one of them. Just sitting on a beach, put me in front of a craps table, and I'm in good shape. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. We've got the U.S. equity markets, specifically the S&P 500 index, holding close to session highs. This Bloomberg Business Flash is brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k, tax and penalty free, go to goldencrestmetals.com. That's goldencrestmetals.com/guide. Relative calm back in global markets on this Tuesday. Stocks higher, oil lower, as signs that a U.S.-Iran ceasefire is still in place reduces fears about a full-scale war. The S&P right now trading at 72.56, on track for a record close, up 56. That is a gain of 0.8%. Dow Industrials up 287 on the Dow. Gain right now is 0.6%, while NASDAQ higher by 1%. The NASDAQ 100 index is advancing by 1.3%. 10-year at 4.41%, the 2-year 3.93%, and the 30-year 4.99%. Gold up $57 the ounce to $45.79, up 1.3%. A retreat for crude WTI just below. Right now it is down 4%, just above 102.21 a barrel. Barrel of Brent just below 111 right now. Brent crude down by 3%. Apple shares trading higher by 1.1%. Apple is said to have had exploratory discussions about using Intel and Samsung electronics to produce the main processors for its devices. It's a move that would offer a secondary option beyond longtime partner Taiwan Semiconductor Manufacturing. Again, I mentioned Apple up by 1.1%. Intel, though, ripping higher now by 13.7%. Recapping, S&P up 0.8%. Alexis and Paul, that is a Bloomberg Business Flash.
All right, Charlie Pella, thank you so much. We appreciate that. Alexis Christophers sitting in for Scarlett Fu. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in New York, and we are streaming live on YouTube as well. Markets moving higher, as Charlie was just reporting. Oil coming down. It's been one of the drivers for these markets over the last 8 weeks, given the war in Iran. The market's obviously sensitive to global energy prices and what that means for earnings growth, what that means for economic growth, and for inflation. Chuck Lieberman, he knows all about those things, co-founder and chief investment officer at Advisors Capital Management, joining us here. Chuck, we had that sell-off in a lot of risk assets, including the U.S. equity markets when the U.S. began the war with Iran. But boy, the stock market's bounced back pretty dramatically here. What do you make of the last 8 or 9 weeks of trading here?
Yeah, it's really pretty simple, actually. Anytime there's bad news, there's a military conflict of any sort, the market sells off, and that's perfectly understandable. But the underlying trends are very, very positive. The economy is doing well. Corporate profits are doing, not well, but maybe spectacularly. The outlook is very positive. So any sizable sell-off is essentially a buying opportunity.
I want to talk about and call out, Chuck, small caps. They're actually outperforming some parts of the market here. And I was looking at some analysis from Bloomberg Intelligence. 100% of active small growth funds beat the average active large growth fund over the past year. The rate there, 99%. I have to think that's more than just stock picking luck, Chuck. What's behind that, do you think?
Well, academic research in this area suggests that small firms outperform medium-sized firms, and medium-sized firms outperform large firms. Large firms, by definition, are large, and therefore it's tougher to grow. The base is bigger. Percentage growth is harder to achieve, and so it's tougher for large firms to grow quickly. They're safer. You have less volatility. Those are big positives, but the growth rate is lower. Smaller firms are more volatile. They're more exposed to incoming information, fluctuations in the economy, you name it. But on balance, over the longer term, they should outperform. And so there's a bias for small and mid cap if you're looking for performance.
Chuck, the earnings this quarter have been very good. They've been very good for a number of quarters here. Are they good enough to propel this market higher, do you think?
Yeah, they do. So when I look at PE multiples for the market, obviously for the overall market, they're high, but they're high because the Mag 7 or the Big 10 have very, very high PE multiples, and yet despite their size and despite what I said earlier, they continue to grow at a pretty amazing rate. And so there's a case to be made for many of those companies. They're large, they're very, very profitable. Some people view them as a place to hide in a storm. There's a lot to going for them. But at the same time, the rest of the market is relatively a lot cheaper. Excluding the Big 10, the highest PE multiples in the market, the rest of the market's trading under 20 times. And at that level, there's real value. There are plenty of companies around trading at multiples of 12 or below, or even 10 or below. Good, solid companies, good growth, not 30% a year, but nevertheless, good, solid companies, good growth tied into the economy. And it's a great place to be to diversify a portfolio.
Well, Chuck, share with us, please, what are some of those companies, if you can't talk individual names and sectors?
Well, I can easily talk both sectors and even companies. So in the case of sectors, take the banking sector. The entire banking sector is still cheap. The market suffers from PTSD. So we saw what happened to the banking sector after Silicon Valley blew up. They mismanaged the bank. They failed banking 101. They bought long bonds at very, very low yields, blew up. They're gone. But the rest of the bank suffered as a result, and the values are still there. So you look at a company like Citi or Wells Fargo. These are companies trading at modest PEs, modest price to book, good solid growth. Big article in Barron's this weekend, excellent article about Citi. Lots of growth still ahead of it, and it's the cheapest of the big banks. Very attractive holding. I own it in my income with growth portfolio. It's done spectacularly well, and I haven't sold a share. So that's one example. Another example would be insurance. Insurance PEs are very low. Companies are doing fine. Examples would be Radian or Magic. Those companies insure mortgages. Mortgage default rates are very, very low. Housing is fine. It's healthy. There's a lot of upside in housing. We have a shortage in this country. Right. So there'll be a lot of construction. And that leads to another area that's attractive, everything tied into construction. Yep. So there are a lot of areas if you look.
Very good. Chuck, and the market agrees with you. The market's higher again today. Chuck Lieberman, co-founder and chief investment officer at Advisors Capital Management, joining us there. A few months ago, Alexis, I took my first Waymo ride in Santa Clara, California.
And you lived to talk about it.
I did, and my youngest offspring convinced me to do it, and it worked. We went to In-N-Out Burger, so we had a good day. So we all survived. But apparently this, it's a theme. This U.S. robo-taxi industry is a theme that is continuing to grow in, I think, attention from the marketplace. Certainly for our next guest, Xian-Hu Wang, BNEF analyst covering autonomous vehicles for the BNEF, joins us here in our Bloomberg Interactive Broker studio. Xian, talk to us about the robo-taxi business. Where are we today, and where do you think we're going to be in, kind of 3 to 5 years?
Well, we're still early in commercialization, but most folks will agree that this is no longer experimental tech. So it's real, it's coming, but the growth is going to be more gradual than the hype would suggest. Nonetheless, Waymo, as you mentioned, is the clear leader today. It's the only company running fully driverless, paid, and 24/7 service across multiple cities. Everyone else is still in some form of pilot mode. By that, I mean small fleets, limited service areas, in some cases, free rides, and in most cases, still with safety drivers on board. So that doesn't really qualify as a driverless vehicle if you think about it. So where the industry is going to be in 3 to 5 years, if you look at it in terms of the fleet size, we believe by the end of this year, we're going to hit about 18,000 of these robo-taxis here in the US. And over the next couple of years, it's going to be something in that range as well, in the tens of thousands, until we get probably to the early 2030s and beyond. That's when you scale to something around hundreds of thousands.
Wow.
So
it's hard to imagine. I mean, Carol Massar, Bloomberg's Carol Massar was in LA or is in LA right now for the Milken conference.
I saw that.
And she was in her Waymo yesterday.
Well, she's so cutting edge.
But I just cannot imagine doing this in a place like New York City where the streets are just so crowded as it is. Is this going to be a barrier of entry? I mean, think about all the people who have not adopted an EV yet because they just can't make the jump. Making the jump to a driverless car, what I would argue is even larger than making the jump to an EV.
I see, yeah, for sure. But there's also that novelty factor, and this is more appealing, I guess, to the younger demographics. People want to try something new, especially given the case that robo-taxis are, being described by many companies today as the best example of physical AI that interacts with the real world, in addition to humanoid robots. So there's that appeal. But based on what I've looked at, if you look at the number of trips completed by these Waymo robot taxis today, they're still tiny.
Right.
So Uber and Lyft combined complete about 10 million trips per day here in the US. And Waymo handles just roughly 71,000 trips per day. So that's a share of about less than 1%.
Right.
So it's still small and it's, it's still growing. Now to your question on New York. So Waymo began testing, I think, in September of last year, but they've ended their testing because their permits weren't renewed in March recently.
Okay.
So it's mostly on the regulatory front.
I mean, they let them lapse or they couldn't get them?
Yeah, so apparently the DMV and the city DOT did not approve the permit.
Okay.
This is all political in some way because there's huge pushback from the taxi unions and all that. Obviously, you can imagine the fear of labor displacement coming from robo-taxis and the like.
Now sometimes my Uber is a yellow cab.
Yes, exactly.
Because they're all they've melded.
Yeah, they have. 30 seconds left. Sion, Tesla, where do they fit in here?
Well, they're clearly the outlier as they're the only company right now doing everything completely in-house.
Okay.
From vehicle manufacturing to the self-driving tech development to running their own ride-hailing app and their charging network. But again, I'd like to look at all of these companies based on two key metrics, number of cities and their fleet size. So for Tesla, today, I think they are only operational in 3 Texas cities with a fleet size of 60 vehicles, as opposed to Waymo, which has about over 3,000 vehicles, and they are live right now in 11 cities.
All right.
So
we'll stay on
still
top
too
of it.
early to call the rest, I guess.
I did it. I'm on the cutting edge of technology.
You're
Sion
so cool.
Huang, thank you so much for joining us here. He's from BNEF. He's the analyst covering autonomous vehicles. And we'll see. I don't. At 4:40 every morning, I get in a car with some dude I've never met before.
And you trust him.
I don't know. I mean, I guess how's it any different from
You make a
some
good
computer?
point.
And I kind of get here. S&P up 52 points. The Dow up 245. The Nasdaq up 230 points. That's 0.9%. We'll have more coming up. This is Bloomberg. Good morning.
breaking news from Bloomberg.
Hi, President Donald Trump in Washington. He is signing a proclamation. He's also taking questions from the White House press bowl. Let's take a listen.
Not to. And then they were warned again by a young Annapolis captain of the ship with a great look, central casting. These people are central casting, I'll tell you. And he said, don't do it. Then he said, evacuate your engine room with this unbelievable loudspeaker that goes over water. He said, you have 10 seconds. And then from 4 miles with one bullet, it went right into the engine. And Gary, the ship stopped very quickly. They hit the engine with one shot. It wasn't a missile. They don't want to waste a missile on it. It's too easy. And we had another one at 2000, one of the biggest ships in the world. They were warned, and he said, go back now, go back right now. You will be shot at within 10 seconds. Yes, yes, I am going back to Iran. I am going back. And that was the end of that, right? He went. It took him 10 miles to the ship was so big, but they respect us. They didn't used to respect us, but they respect us more than we've ever been respected. Our country now is the hottest country anywhere in the world. We had a country that was dead when we had that group of people that ran this country with their open borders, letting anybody come in from the Congo, from countries all over the world. They came in from prisons and mental institutions. We had a country that would have been a dead. If they won the election, this country would have been a dead country. Now we have the hottest country anywhere in the world. Go ahead.
Thank you, Mr. President. You said recently that if Iranians were armed, they could take over their regime. Do you plan to arm them soon?
Well, I don't want to say that, but yeah, I mean, people say, why aren't they protesting? They want to protest, but they don't have any guns. So you could have 200,000 people protesting and have 5 or 6 sick people with guns. And when they start shooting them right between the eyes, and you see a guy fall and another one fall, and you have no guns, very few people would be able to stand there and do it. I mean, I understand it. I tell them not to. Don't forget, they killed 42,000 people last month. 42,000 unarmed protesters. They had no guns. So they had a 250,000 people crowd, and they had snipers. They had like 4 or 5 snipers in buildings up high. And you're standing there, and all of a sudden the guy on your left goes down, and somebody. That's what happened with a women protest. They had 200,000 women protesting a year ago, and everyone thought that was the end of Iran. And then all of a sudden, a woman dropped dead with a bullet right there, always right there. Then another woman dropped, and then the word started to spread, and then there was panic, and then they ran, and so I don't want that to happen. We don't need that, we don't need it. But the only reason that they want to protest so badly, but they don't have weapons. Yeah.
Thank you, Mr. President. Next week, you have a very important meeting with President Xi in Beijing. Secretary Bessent has said that a top priority on the agenda will be Iran. What do you hope to achieve with President Xi as it relates to Iran?
Well, I have a very good relationship with President Xi. He's I find him to be a tremendous guy. And we get along well, and you see how we do. We're doing a lot of business with China and making a lot of money. We're making a lot of money. It's different than it used to be. But I'll be talking about that'll be one subject. But he's been very nice about this. In all fairness, he gets like 60% of his oil from Hormuz, and I think he's been very respectful. We haven't been challenged by China. They don't challenge us, and he wouldn't do that. I don't think he'd do that because of me. But I think he's been very respectful, and we've offered, if he wants to send the ships to the United States. I think one of the big things that's happened is I made a statement: send your ships to Texas. It's not that much further. Send your ships to Louisiana. Send your ships to Alaska. Alaska is actually very close to a lot of the Asian countries. People don't realize it. Japan is back and forth. It's like. It doesn't seem it, but it's a very short route, 2 days shorter than almost any other route. We're making tremendous big deals with South Korea and with Japan. But I said, send your ships. All of a sudden, I don't know if you saw the graph today. This is Space Force, which I created. Space Force has, they just sent out some photos of the ships that are lined up all the way down the ocean like it's a highway. It looks like the Long Island Expressway for ships. and they're all heading to Texas, Louisiana. We've made up this list, and that's why when I decided that I have to do this for the good of the world, not just the United States, in a way, we would have been in less trouble than a lot of other places. Certainly the Middle East would have been blown up. There wouldn't be a Middle East anymore. They would have taken over the Middle East. Now they're trying to survive, and they won't be successful unless they make a deal. Oh, if they don't make a deal, they won't be successful. They'll go very quickly and methodically. Believe me, it'll be very easy. But we have so many alternatives. It's amazing. And nobody knew this, because as an example, Japan got 90% of their oil, most of their energy, but most of their oil from the Hormuz Strait. South Korea got 43% of it. By the way, their ship was shot at. They were not in the cavalcade of ships. They decided to go it alone, and their ship got the hell knocked out of it yesterday. But they didn't shoot the ships that were guarded by us. I'll tell you that. We knocked down a lot of missiles. So what happens is that we have a situation where we have total control. As you know, the blockade's been amazing. It's like a piece of steel. Nobody's going to challenge the blockade. And I think it's working out very well. We're going to see. I can say this. Iran wants to make a deal. What I don't like about Iran is they'll talk to me with such great respect, and then they'll go on television. They'll say, we did not speak to the president. We did not. We did not speak to the president. So they play games. But let me just tell you, they want to make a deal. And who wouldn't? When your military is totally gone, we could do anything we want to them. Who wouldn't? Please.
On the filibuster, Mr. President, you posted a lot about wanting to eliminate the filibuster. It hasn't happened. Are you disappointed in leading?
Yeah, no, I'm disappointed. I like John a lot, but he has a couple of Republicans that are foolish people. A couple of them I like. A couple of them I can't stand, actually, if you want to know the truth. Although I am, according to CNN, 100% approval within the Republican Party. That's better than your record, Gary. I'm at 100% approval. Did you see the CNN poll? Nobody talks about it. CNN, I think the people that did that poll probably got fired. But within the Republican Party in MAGA, which is basically 100% of the party, I think, but 100%. No, I think that you're going to see some very interesting things. The filibuster, if you had it, we should have the Save America Act. We should have voter identification, voter ID. We should have proof of citizenship. We should have mail-in voting for the military and people that need it, but not for everybody. Because anytime you have mail-in voting, they're going to cheat. And they cheat like dogs. And they have to cheat. In all fairness to the Democrats, when you have men and women sports, when you have open borders, when you have transgender mutilization, don't listen to this, kids, of your children, transgender mutilization of your children for everyone. When you have policies like that, you have to cheat. It's the only way they can win. And we shouldn't allow them to cheat. And we should terminate the filibuster, because if they get the chance, they'll do it in the first hour back.
Mr. President, thank you. When Iran is seeing 50% inflation, they've moved money from their sovereign
Their economy is crashing.
Would you allow their financial system then to fail?
Well, I guess so, because we're making it fail, right?
Is that what it takes?
I hope it fails.
Is that what it takes?
You know why? Because I want to win. It takes getting pounded on by the military, I think, for more. But in addition to that, it is failing. We have sanctions on them, tremendous sanctions. Scott Bessent's done a great job. We have sanctions that nobody's ever seen before. No, they're failing. Their currency is worthless. Their inflation is probably 150%. The real number is 150%. They aren't paying their soldiers. They can't pay their soldiers. The money is worthless. No, they should do the smart thing, They should do the smart thing, and because we don't want to go in and kill people. We really don't. I don't want to. It's too tough. Great people. I know the people. I have so many Iranian friends from New York and from other places over the years. They're great people. I don't want to kill those people.
Gas prices in the United States are...
Is it possible that you can talk about that?
Well, wait, go ahead, finish it.
Yeah, gas prices in the United States are $1.48 cents a gallon. You said they would come back down. Will Project
They'll drop lower than they were before.
Will Project Freedom, escorting those ships, make that happen?
Well, it will, because So people don't realize some of these tankers hold 2 million barrels. One of them holds 4, I think it's the largest one in the world. That sucker is big. I've never seen anything like it, a ship. It's bigger than aircraft carriers. And yeah, it has a big impact. It's so much. You know, there are like 400 ships in there, 400. That in itself. Now, the best is when it ends and just neutralizes. But what's happening is people are learning to buy oil from the United States. I mean, they're making the trip, and they have safer. Probably it's a better product too, by the way. But they're learning to buy. They're changing their habits. So when I did this, I thought the market would go down 25%, and I thought that was a great deal if it did. If it went down 25%, I was satisfied. I said, because we cannot let these people have a nuclear weapon. They'll use it. We can't. I also thought oil would go up to 200, 250, maybe 300, and I knew it would be short term, but I thought it would go. I looked today, it's like at 102, and that's a very small price to pay for getting rid of a nuclear weapon from people that are really mentally deranged. Yeah.
President, just on politics.
The world is like, by the way, other presidents should have done this. 47 years they've been toying with these stupid people. In many cases, stupid people. This should have been done by Obama. He went the other way. He was giving them cash. He sent plane loads of Boeing 757, took the seats out, and put green cash, $1.7 billion in the plane. Every bank in Virginia, D.C., and Maryland was stripped of their cash. They took out all the cash from the banks. They put it into a plane, a Boeing 757 packed with cash, and they flew it to Iran, and they let these guys just, I don't know what the hell they did with it, but they took it and then gave them billions and billions of dollars and bribed them basically to be friends. And after giving them tens of billions of dollars, they screwed Obama, okay? That's not the way we play. No, we do it the old-fashioned way. And they should wave, they're very proud. Maybe you won't see a white flag, but essentially that's already what they are. They should wave the flag, the white flag of surrender. In hockey, they say, uncle, right? When are they gonna cry uncle? But, and they have another expression. If this were a fight, they would stop it. But you know, we have to go out and we have to do it, and it's very sad to see. Even shooting those boats, they've got 3-4 guys. They got a little machine gun in front. They're shooting at one of our ships that's meant for it. It bounces, they don't even know they're being shot at. And then they take it out.
All right, that was President Donald Trump. He's speaking at the White House at a signing proclamation and taking some questions from the White House press corps on a wide variety of topics. Let's get back to these markets here. We're right smack in the middle of earnings period for sure. And one of the companies that we're going to be hearing about, Super Microcomputer. After the close today, Woo Jin Ho joins us here, Senior Technology Analyst at Bloomberg Intelligence. Woo, remind our listeners, our viewers, what Super Microcomputer does, and then what are you going to be listening for from this quarter?
Sure. Hey, Paul, thanks for having me on. So Supermicro is a leading AI server company. They've benefited from the AI server boom from some of the neocloud providers. CoreWeave and Nebius are some of the names that they supply to, as well as Oracle. A couple of things that I'm looking for, quite frankly, orders. Right, they had a lot of scandal this past quarter relative to one of their co-founders being indicted for smuggling GPUs.
Okay.
I do think that the quarter is intact, but there have been some speculation that even though the company hasn't been implicated, that some orders might have been delayed or canceled.
How is AI playing into the landscape for Supermicro?
Well, they're one of, if we think about, let's talk about the quarterly expectations, right? Their revenues are poised to go from about 5 to 6 billion last quarter into 12.5 billion this coming quarter. Wow. And they're on track to deliver about $40 billion for the year, right? So we're talking about really, really strong growth. In the U.S., they're neck and neck with Dell in terms of being a AI server provider.
So, talk to us about the actual products that they're selling and who are they selling it to? Who are their customers?
Yeah, so the actual products it's a PC on steroids with a bunch of GPUs, right? That's how I describe it. But it takes a certain amount of engineering and an amount of scale to provide the type of AI clusters that someone like they have sold to Meta in the past, and they may be selling to Google, from what I understand. But also it's the CoreWeaves, the Oracles, the Nebius, these new AI cloud providers that they're selling to.
What about I want to talk about Wedbush. Yeah, I wanted to bring this up. Wedbush actually came out with some interesting analysis, and they said while the company itself was not implicated in this smuggling scandal involving the co-founder, that vendors, and it might not cause vendors to switch companies, they might try and gain concessions from the company. What might that look like, and would that be a problem?
Yeah, there are only few concessions that they can give, and what I think Wedbush is referring to is pricing concessions. Right?
That makes sense.
So gross margin in the sense to maintain share. I wouldn't be surprised if Supermicro does give up on price. However, we're talking about a company that has operating margins of 5%. You're not going to get much more unless they want to go to operating losses. And quite frankly, given the state of their balance sheet, there isn't much more that Supermicro can give.
Year to date, Hewlett Packard's up 23%, Dell's up 70%, Supermicro down 5%. Is that underperformance all associated with the issues about this senior management scandal?
It's the headline risk with the company, and also if you compared to Dell and Hewlett Packard, they're a lot more diversified than Supermicro. Supermicro is a two-trick pony: storage and AI servers. I would say about 80% of their sales is AI servers. Dell and Hewlett Packard, they don't rely on AI servers as much.
But is this going to be a situation where it needs to be a blowout earnings report where good just won't be good enough for Supermicro?
Oh, I expect them to blow out this quarter as well as guide well, right? It's all about giving a message that gives confidence to investors and shareholders that the scandal is behind them. And quite frankly, I think the CEO has to go.
So, all right, give us the...
Might they announce that today, that the CEO is...
There is a possibility if Charles Liang decides to step down, the stock will be up.
Really?
Yeah.
So who would step in there? I mean,
we don't know yet.
Okay.
But
was he the person that was involved?
No, it wasn't.
Okay.
It wasn't. But there are quite a few governance issues with the company. I'm not happy with the structure of the board, and given that it is one of the co-founders who was involved in the scandal, there are quite corporate governance issues from a CFO side. And keep in mind, if we recall, they've had accounting issues as well.
All right, very good. Would you know? Thank you so much. Appreciate that. Would you know? Senior technology analyst, Bloomberg Intelligence, previewing Supermicro's reporting after the close here.
It's going to be a busy after the bell.
Yeah. Exactly. Red headline: crossing the Bloomberg terminal. SEC unveils proposal to allow for semi-annual reporting. That's pretty big for those of us that grew up on quarterly.
That would really change the cadence of what we do here, but certainly what Wall Street does in general.
It would, and a lot of companies have been asking for this because they're saying you just make us, the quarterly reporting requires us to think so short term,
right?
And we'd rather think, maybe longer term, invest for the longer term, and that kind of thing. And that's kind of where that story goes.
It might make sense. We'll see
and
where
that's
that
what
goes.
In Europe they have semi-annual reporting.
That's
people
right.
get used to that there. All right, for our listeners in the U.S., a reminder. You can listen to us via satellite radio on SiriusXM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on SiriusXM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Your top stories and global business headlines are coming up in just a moment. Alexis, thank you so much for sitting in for Scarlett.
Always
we appreciate
a pleasure.
That. That's always helpful. And we're going to have, looking at the markets here, 53 points higher on the S&P. That's 0.7%. NASDAQ doing a little bit better, up 0.9%.
Record territory again.
And the Russell up 1.5%. How about that? More Bloomberg Radio coming up. This is Bloomberg.
From ABC News, I'm Chuck Sievertson. Despite attacks between the U.S. military and Iran recently, says Defense Secretary Pete Hegseth at today's Pentagon briefing.
No, the ceasefire is not over. Ultimately, this is a separate and distinct project, and we expected there would be some churn at the beginning, which happened. And we said we would defend aggressively, and we absolutely have. Iran knows that.
Pentagon officials say Project Freedom has had the U.S. military escort 2 American commercial ships through the Strait of Hormuz. No word if insurance companies will greenlight more international shipping in what has been part of the war zone. Gasoline prices will keep going up until the Strait opens, says Patrick DeHaan, head of petroleum analysis at Gas Buddy.
If the Strait remains closed, into the month of June, I think by July 4, we'll be at all-time record highs.
After several deaths from a rare virus on a cruise ship that left Argentina for the South Atlantic, this update from the World Health Organization's Maria Vanderkove in Geneva.
At this stage, there are no additional symptomatic people on board. That said, the situation is being closely monitored, and as a precaution, passengers have been asked to remain in their cabins while disinfection and other public health measures are carried out.
You might pay for part of that Trump White House ballroom, says ABC's Stephen Portnoy in Washington.
The president has insisted the $400 million ballroom would be funded privately, but Senate Republicans now propose to put $1 billion in taxpayer dollars toward the project for its security enhancements. In court filings, the administration has said those upgrades would include bomb shelters, a hospital, top-secret military installations, missile-resistant steel columns, drone-proof ceilings, and blast-proof glass. Republicans now aim to add the money to a measure that would provide 3 years of funding for ICE and the Border Patrol using a procedure that Senate Democrats can't block with a filibuster.
ABC's Stephen Portnoy, Wall Street, an up day so far, and you're listening to ABC News. President Trump says he has an obligation to intervene in Cuba, suggesting he would go into the country after the Iran war ends. Cuba has suffered from an energy crisis ever since the U.S. forced Venezuela to cut off oil shipments to the country. ABC's Matt Rivers recently traveled to Havana.
Clearly, what we're hearing from the administration, from President Trump, from Secretary of State Marco Rubio, is that they want regime change. They're not being coy about this. They want to change the government, and for now, they are doing this strictly economic pressure campaign, but they explicitly have not taken military action off the table.
A gallon of gasoline in Cuba is $40. State of California suing State Farm Insurance, claiming the company mishandled over 11,000 claims from last year's devastating wildfires by conducting inadequate claim investigations, underpaying claims, and denying damages. Jesse Albert lost his Altadena home in the fires. After spending hours on the phone with State Farm, he says he has only been allotted about a third of what he needs to rebuild.
While they didn't cause the fire, right, the injury from their actions, the delays, the having to relive everything, it's huge.
In a statement to ABC News, State Farm says they strongly disagree with the agency's characterization. Doris Fisher, co-founder of The Gap, has died. She co-founded the clothing chain in 1969 with her late husband. Fisher was 94. Chuck Sievertson, ABC News.
This is Balance of Power with Joe Matthew and Carol Masser, live from the Milken Global Conference.
We are live in Beverly Hills, the fastest show in politics here on Bloomberg. I'm Joe Matthew alongside Carol Masser at the Milken Global Conference, day 2, with Parallel storylines once again here, Carol. A market that just keeps on roaring, and even more uncertainty when it comes to geopolitics.
Joe, you say day two. What a different mood it is in the market. You've got stocks up, oil back. Looks like that truce is holding for the moment. 24 hours ago, we were talking about nervousness once again back in the market. So we're going to tackle some of that with our guests throughout the next couple of hours. But we've got a great guest standing by, former Treasury Secretary Steven Mnuchin. He's going to be with us. We had that headline about maybe semi-annual reporting.
That's right. SEC out with that new proposal. We'll talk to the former secretary about that and a lot of other storylines coming out of Milken here. He is the face of Milken on this second day and will be with us straight ahead here on Bloomberg.
I also hear he likes movies a little bit.
Yeah, absolutely. We're going to get down to Michael and Batman versus Superman if we have time.
All right, let's get to the markets. As we mentioned, a rally underway, some calm back in the financial markets. Let's toss it over to Charlie Pellet.
All right, thank you very much. Indeed, right now, we are looking at a record on the S&P up 57, 72.57. That is a gain of roughly 0.8%. Dow Industrials up 273 on the Dow, up 0.6%. NASDAQ right now up by 1%. We've got oil retreating. Barrel of WTI 102.15, down now by 4%. Brent crude down by 3.4%. All of this with a 10-year at 4.40%. The VIX just above 17. Back we go to the Milken Global Conference in Beverly Hills. Once again, your hosts, Joe Matthew and Carol Masser.
And we take it from you, Charlie Pellet. Thank you so much. You're up to date on the markets. We want to welcome everybody who is watching, too, on Bloomberg Television. Carol Masser, Joe Matthew, live here at the Milken Institute Global Conference in Beverly Hills.
With a very special guest that we want to welcome here to our set at Milken. It's the former Treasury Secretary, Steven Mnuchin. Thanks for being with us, sir.
Great to be here with you.
We've got a lot we'd love to talk to you about, but we've got breaking news that just went right on the terminal right before we began the broadcast, and that is a proposal by the SEC to go to semi-annual reporting, or at least allow it. And you can look at two different sides of this coin. Do you think this is good for the markets? Is it good for investors?
Well, I support the proposal. I think there's too many companies that are too focused on quarterly earnings and whether they miss or beat expectations, analysts' expectations. So I think the idea of giving companies the option of whether they want to do quarterly or semi-annual is a good thing. I mean, I can imagine there are a number of companies, particularly companies that are growing, that are still going to be interested in showing quarterly earnings and showing their progress through the year. But I think giving companies the option is a very good idea.
Does it do anything to kind of the global perspective from investors about how the U.S. market is kind of the gold standard, so transparent because of those quarterly reports and so much more, and some of the rules and regulations that really govern our companies here?
Well, there's no question. The U.S. is the gold standard for companies to be listed. It's the most liquid market in the world. It's the largest and the largest economy. And I think giving companies the options, I think, will continue to have transparency.
Do you think most of them will still stick to quarterly reporting?
My guess is some will switch and some won't. I mean, as I said, if you're a growth company, you have every reason to want to show the growth every quarter. If you're a company that's in turnaround and things are improving, you're going to want to show it. On the other hand, there are plenty of companies where, you know, they're focused on a long-term transition, and I think giving them an option is a good thing.
You could pretty quickly see two classes of companies when it comes to reporting season.
Kind of mess up our world a little bit, but that's okay.
Your after-hours sessions are going to feel really different, Carol. So I'd love to hear from you on this market as a whole and the psychology that's confounding a lot of us. As we mentioned already, it's rally time, Mr. Secretary. Oil prices are lower again today after the defense secretary suggested that this effort in the Strait would not go on forever. That's all you need, and we're back to buying on Wall Street. Is this getting a little toppy, or can you rationalize what you're seeing?
I think there's two things that are going on in the market. One is that you have very large CapEx spending and very large growth around AI, around data centers, around the cloud. And that, to me, we are still in the early innings of this transition. There's no question that AI is going to impact almost every business that we touch. And that's something that's going to be a very positive way, but there's also going to be job issues and job implications on that. The second thing we have going on is the U.S. is the destination of where people want to invest. You know, Europe's economy is underperforming. People are concerned about what's going on in Europe. So the flow of funds into the U.S. dollar, in particular into U.S. equities, is still very strong. As I like to say, if you can take a 10-year horizon, there's no better place than buying S&P 500 500s. You know, if you're day trading, that's a little bit of a different issue, trying to predict the short-term markets.
Steve, how do we figure out whether or not the spend in terms of data centers is just too much, that there isn't some overspend ultimately? You know, we were talking on a real estate panel with folks who are all investing in data centers, talking maybe like, do we need to have an exit strategy? You know, we talk about data centers in space. Like, this thing could evolve. Chips get more efficient. So is it something that could be down the road, but not to worry about now, or do we need to think about the overspend?
Well, I'd say in the short term, you know, the demand for compute is very strong, and you're seeing this across a number of companies. I'd say there's two different things. You have OpenAI and Anthropic on the one hand, who are going to consume a lot of cash as they build out these businesses. And then you have Microsoft, Amazon, Google, Meta, that all are cash machines and are building out both AI and are building out the cloud. I think the good news is if there's overspending in the next few years, they'll cut back. So I don't think you're going to see the same trajectory. I think the other issue is going to be we're going to run out of power for data centers. So I think it's people want to spend the money now, get the data centers operating, and if they have to scale back over time. I mean, some of these data centers, particularly the training centers that have 15-year leases, my guess is 15 years from now, they're dark. The cloud data centers will have tremendous growth and will be around for the next 50 years.
Do you have exposure to the area?
We spent a lot of time on the area. We're long-term investors in what we believe are stabilized data centers.
Okay.
Do you worry that, just to add on to that, and I think this might be where you're going a little bit, Carol, that efficiencies, whatever is going to be developing in the next couple of years, will render these massive data centers useless? They could be the size of a phone booth at some point, or just a completely different, to Carol's point, in space. Is this something that has a shorter timeline, knowing that technology will evolve?
You know, if you look back at data centers from 20 years ago in Virginia, we're still using them.
Well, that's true.
So, again, I separate training data centers. You're going to need to train these models. Then you're going to, it's very different, kind of the cloud native issues. But just going back to the market, you know, the market is discounting kind of the geopolitical risk, in my opinion. So, you know, we don't really see the market is expecting we're going to have a good outcome. I completely support President Trump and what he's doing in Iran. I always said Iran getting a nuclear weapon is the biggest risk in our lifetime, and there's no question from my experience in the government, they intended to do that. You know, how we play out from here is a little bit more complicated, and as you said, we've seen a lot of volatility in the oil markets, and the stock market is really not discounting this going on for a long time.
So that sounds like we're missing something here. If
I wouldn't say we're missing. What I'd say is hopefully we will have a good outcome. Iran will come to the negotiating table. I think the economic and the blockade, the sanctions work.
Even if the Strait reopened tomorrow, though, we've heard that it could be months before energy flows are back to where they were. Does the market have a reality check coming on that?
I think it will take a while. Having said that, there are such positive things going on in the economy that I think to the extent the Strait can open up relatively soon, the economy will absorb those energy costs.
I want to ask you, you obviously were in the first administration. You have a better, really probably great understanding of President Trump. And as we say, the markets can go from day to day based on the headlines. It looks like it's a 180. How should we be reading what the president is doing? What do we need to understand? Because do you feel like this is a different Donald Trump's this second term versus the first term?
No, I don't. I think there's a lot of similarities in it. I think on this issue, and this is an issue he's been focused on since the first term, he's determined, and his legacy will be that he's going to prevent Iran from getting a nuclear weapon. And there's been other administrations that were, you know, understood the risk, but were concerned. I also give Israel a lot of credit because one of the concerns was all the ballistic missiles, and obviously the defense, the air defense systems in the region have been very powerful. But no, I think this is a president that would prefer not to go to war with them again, but will if he needs to.
But this could we be still talking about war at the end of the year?
I think we could. I mean, I think he's determined that he prevents this from happening, the nuclear situation. And I think that part of the issue is, and he said this, he took out a lot of the leadership. So part of this is making sure that leadership develops in Iran that can negotiate a deal that they'll stick with.
What's the other geopolitical? Because you say geopolitical. Is it just the Middle East? Or are you thinking about China? Are you thinking about other parts of the world?
No, I think I mean, there is this war in Ukraine. I don't want to forget what's going on in Ukraine.
Later,
That's still an important issue. I feel like we don't see it on the press every day. But obviously the big issue right now in terms of risks for the economy and risks for the world is the Middle East.
There's another cloud you could argue is hanging over this market that has nothing to do with the war in Iran, although maybe there's a connection at some point when we start talking about the cost of this operation. But that's the debt, now topping 100% of GDP, Mr. Secretary. How long can we sustain this? Hank Paulson mentioned to David Weston the need for a break glass solution. What should the Treasury be preparing at this time for this?
Well, I unfortunately think there's not a break the glass solution. I think there's no question that during COVID, we had to spend massive amounts of money. We shut down the economy. I mean, anybody who ran a business never ran it thinking you'd have zero revenues. I'm particularly proud of we saved the airline industry, so we have a very robust airline industry. Having said that, well, no, but we saved the industry overall, and I think it was the right thing to let Spirit go through what they are. Having said that, it kind of normalized trillion-dollar spending. And I think this is an issue that needs bipartisan support. Part of it is the mandatory spending. We have to deal with that part of the budget. And, you also...
Defense, too, though? If you look at what's being allocated for defense in this budget, it's a lot.
Look, there's no question, particularly in this day and age, we need to spend more money in defense. I think right now it's going to be hard to spend another $500 billion in defense without significantly cutting other things out of the budget. So I am concerned about deficits. I think this has to be dealt with. And I think the good thing is President Trump understands these issues. And if there's someone who can tackle the spending issues, I think he's the one to do it.
Does this mean, what's the make or break moment? Because I'll go back 10, 15 years, we were talking about concerns about the deficit or more, and then it kind of faded away. So what is the make or break moment? And I think about this in the context of Kevin Warsh coming in as the next Fed chair, in terms of servicing the debt and so on and so forth, pressure that might be on him, kind of roll it all together. Do you think that he should be cutting rates in this environment?
Well, I think we're close to the equilibrium rate. So before the situation in the Mideast, we did have inflation coming down close to the Fed's 2% target. And I think you could say the equilibrium rate is probably between 2.5% and 3%. So we're close to that level. Also, there's no question that the deficits push up our cost of funding so that there's a risk premium built in. And one of the things that Kevin is talking about, which I also support, is shrinking the Fed's portfolio. Well, if you shrink the Fed's portfolio, that's also another tool that you don't have to lower rates. Ultimately, the Fed does set short-term rates. If they're not doing quantitative easing, which they're not going to do now, they're not setting long-term rates. And I don't think we're going to have a make-or-break moment where one day we wake up and we can't finance the debt. I do think you'll see an increase in risk premiums. You see the 30-year bond kind of approaching, kind of 5%. Part of that is the volatility around inflation and what's going to happen with the war, but part of that is also just pushing up the cost of long-term financing for us.
What's Kevin Warsh in for when he wakes up in the morning and looks at Truth Social? Is this contentious relationship with the chair, if he's not cutting, going to continue?
I think Kevin will do terrific in his new job.
Okay.
Is that a yes or no?
I think he will be an independent Fed. That doesn't mean that he will or won't agree with the president. Now, look, part of it is where interest rates are depend on the economy. If we continue to have a very strong economy, we're not going to need to cut rates. If for whatever reason we go into a recession, we will have 1% rates. So, we had zero rates in COVID. There was a reason why they went down to zero.
Hey, we can't leave without talking about Lionsgate. think you guys have about a 13% position.
We do.
What's your plan with Lionsgate? What do you want to do?
It's a great business. I've recently got on the board.
Yeah.
Lionsgate is one of the few independent studios left. It has an incredible film library, and Michael's been a great success.
Yeah.
So,
do you want to own all
the story of Michael Jackson.
Do you want?
I can't comment on that.
Well, so let's wrap with one fun question about the movies. Michael is in an incredible debut. Looks like it's across the board when it comes to demographics. And we're in a world where consumer sentiment is pointing lower. There are worries about consumer spending, the price of gas, but they're lining up for that movie. What does that tell us about that business?
It shows you that when you have the right content, people still want to go to the movies. It's not just about sitting at home and watching it on TV. And, Michael Jackson was just an incredible performer, and his music was obviously pretty extraordinary.
On my playlist. Got to be starting something.
We all remember growing up with MTV and Thriller.
It's not just old folks going, though, you said.
Exactly.
Who's old? Who's old?
Not you.
20 seconds. Do you miss the administration, being inside?
It was an experience of a lifetime. I couldn't be happier that I did it. I'm proud of what we did. I'm enjoying being on the outside and rooting for them.
Well, we certainly enjoyed having you here. Thank you so much. Really appreciate it. Stephen Mnuchin, of course, former Treasury Secretary, and of course he is Liberty Strategic Capital founder and managing partner. All right, folks, we're going to toss it back, I think, to, are we going to Joe? No, not to Joe. Are we going to Charlie?
Right here, yeah. I think we're wrapping things up. Charlie Pellet's got a look at the markets for us. Now that we heard from the secretary, what do you have, Charlie?
All right, what I got is a stock market that's pushing higher, Joe and Carol, right now, with the Dow, the S&P, NASDAQ all advancing on track for a record close on the S&P 500 index. Right to the numbers here, with the S&P 500 index currently trading at 72.61, higher by 60 points, up by about 0.8%. We have got the Dow Industrials up 274 right now on the Dow. That is a gain of 0.6%. NASDAQ is up 258 points for the NASDAQ Composite Index. That is a gain of 1%. The VIX just above 17 right now with the 10-year 4.40%, the 2-year 3.92%, the 30-year 4.98%. Gold up $43 the ounce. The precious metal at $45.65, up now by about 1%. West Texas Intermediate crude oil coming down 102.14 a barrel on WTI, down by $4 a barrel, down 4%. Barrel of Brent still above 110.49 right now on Brent. The global benchmark down now by 3.5%. So bottom line here, we do have relative calm returning to global markets. Stocks higher, oil falling as signs that a U.S.-Iran ceasefire is still in place. That is reducing fears about a full-scale war that could hamper the economic outlook. As we have been reporting, and we've got more details, quarterly reports could become semi-annual. Those 10 Qs, companies could choose to report earnings semi-annually instead of quarterly under a proposal just released by the SEC, potentially reducing how much information publicly traded firms must share with investors. Speaking of those quarterly earnings, we got shares of Pinterest higher now by 9.3% after earnings. Palantir Technologies heading the other direction after earnings, down now by about 7.3%. And among the many names reporting after the close of trading today, we will be hearing from Advanced Micro Devices. And some of the other stories that we are following for you at this hour. Apple has held exploratory discussions about using Intel and Samsung Electronics to produce the main processors for its devices in the U.S. Now, this is a move that would offer a secondary option beyond longtime partner Taiwan Semiconductor Manufacturing. Apple shares, they're up now by 1.5%, but Intel continues to surge. Intel up now by another 12.7%. Job cuts at crypto exchange Coinbase Global, cutting roughly 14% of its workforce, citing a need to manage costs in volatile markets and technological advances in AI intelligence. Coinbase down now by 3.6%. Also announcing job cuts this morning, PayPal shares tumbling now by just about 8.7%. And you can add BioNTech to the list of companies cutting jobs. The shares are down 2.7%. It plans to halt operations at several manufacturing sites, affecting as many as 1,860 jobs due to dwindling demand for its COVID-19 vaccine. Recapping, S&P up 0.8%. We are at a record. Back we go to the Milken Conference in Beverly Hills. And once again, your hosts, Carol Massar and Joe Matthew.
All right, Charlie, thank you so much. Charlie Pellet on the markets. He'll be back in about 15 minutes' time with another check on stocks and bonds. We've got a nice little rally going here, Carol, thanks to lower oil prices, which is confounding to some who are watching the situation unfold in the Middle East. Just a couple of remarks from Pete Hegseth this morning in his briefing at the Pentagon was enough to give us, I guess, a new reason to be optimistic, suggesting that this operation in the Strait would not go on
I feel
forever.
like we've done a 180, a 360 kind of in the last 24 hours. And I'm looking at, the U.S. playing down that prospect of a return to active war with Iran. So it looks like the ceasefire, Joe, is in place. You've got a great guest to talk about all of this.
For sure. Amos Hochstein is with us here at Milken. We should remind everybody we're in Beverly Hills today, which is a bit different at the Milken Global Conference. And of course, former Middle East senior advisor to President Biden and a lifelong diplomat with a real sense of nuance when it comes to the energy markets. Amos, it's great to see you. Welcome back to Bloomberg.
Thank you. It's always good to be here.
Many questions about how we rationalize what we're seeing right now. The fact that oil is lower by simply, even though Iran is shooting at ships, but one statement from the government that the ceasefire remains in place and we're selling oil today, is that the move?
Well, two things. One, remember that we're saying that oil is lower.
Yes.
Oil's at 110.
Well, that's right. We're still in triple digits.
So one, we're at
Not
110.
where it was at the start of the year.
It was 60.
I know.
Okay, 60. So we're basically almost double where we were. And we're talking about, nobody thinks of 110 ever as a low oil price.
Well, that's fair.
That is a very
Just
high oil
directionally
price.
speaking, though.
But here's what's happening. The market really wants to rally. They don't like bad news.
The stock market.
The stock market.
Yeah. Totally.
The stock market. The physical market and the stock market are divergent at the moment. We may get convergence at some point. We probably will be. We don't know if the convergence will be when the stock market realizes where the real physical market actually is, or that the war actually ends, we have an opening, and then the physical market will go to where the stock market is. But they are not in the same place. $110 of Brent oil is only available on a Bloomberg terminal.
I know where you're going.
You can't buy that barrel. That barrel of Brent oil is selling for 150, 145, some days 155, even 170
Supply
on some
demand,
days.
right?
Because it's only paper.
Yeah.
It's people on Wall Street.
That's the real market.
The real market right now is that there is not enough oil. We're in a demand destruction in certain countries, but they're poor countries first. So stock market doesn't care. So we are in a place where every day that goes by now with fake headlines, and what happened today at the Pentagon is fake headlines. We're not really in a ceasefire because missiles are flying. That's usually the definition of a ceasefire, is missiles don't fly 2 days in a row. We don't have a ceasefire in Lebanon because we still have fighting in Lebanon, despite the fact that we say it's a ceasefire. And tankers are not moving, despite the fact that we have government officials say they are moving. They're not. So that means that there is no tankers on the water going to Asia, going to Europe. None. Zero. And so that is going to, that bite will deepen every day.
Okay, so I guess, I don't know, how do you then look at things longer term? Because I think what most folks are also thinking off of this war, that things are going to be changed forever in terms of people thinking about, we talked about this yesterday, about countries' access to strategic commodities, whether it's oil, whether it's, really ensuring that their supply chains are solid, that they can't be disrupted. And that means a lot of domestic production, that means probably higher costs around the world. It feels like it's a very different global economy going forward.
So I think that's...
Should we prepare for that?
I think we will prepare for that. And in fact, some of it is already happening.
Yeah.
So this is similar to two other events. One is the 1970s, which led us to build a strategic reserve, created the IEA, the International Energy Agency. Structures of the energy market were different moving forward after the 1970s. They were very different before, changed forever. COVID changed how we think about supply chains. We suddenly got shocked by the supply chains, which is why we started stockpiling. We started thinking about making sure that we didn't live on, one supplier, et cetera. And now what's going to happen is the Strait of Hormuz is under Iranian control forever, basically for the foreseeable future. Regardless of, nobody in the market should look at what the deal says eventually and believe it on straits. Iran will control the straits. Everybody in Washington will believe it. Nobody in the Gulf. No one in the Gulf will believe. They know the Iranians are not going to control this. What does that mean? It means you got to change, Carol, what you said. You got to build out infrastructure that does two things. One, bypasses the Strait of Hormuz. It's possible to do.
Yeah.
It's not even that expensive. A few $1 billion. but a few $1 billion in what we're talking about doesn't cost very much. The redundancy is important. Second, build out more storage facilities in destination countries. So we already have some storage in places like Singapore, but build them out in Tokyo, in Delhi, and China already has, not just of oil, but of jet fuel. Airports should probably hold a little bit more jet fuel capacity.
Just ask Lufthansa. Who's canceling flights for the summer.
Exactly. Not just them. I think everybody. If you're an American listening to this and you think you're going on vacation this summer, plan for a very, very expensive one.
Yeah.
Driving is going to be very expensive, and so will RVs. RVs will be even more expensive because diesel is through the roof, and jet fuel is.
Can I ask you why this is happening right now? If it was President Biden and you were advising him, you know, were you guys pushing to do something to this effect in Iran?
No.
They have been a threat for how many decades, right?
Look, we used to joke whenever people come and say, "Oh my God, we're."
But we've had people come on and say, "Listen, this was long overdue. It was time to do something. We knew this was a country that hated America."
Yes. By the way, they're not alone. If we're going to war against every country that hates America, then there's a list that we may have to go to war for a few more months, a few more years. North Korea is doing.
Not funny, actually.
North Korea is doing a lot on nuclear. They hate America. We're not going to war there. Iran is a place where first of all, we had a deal with Iran to not go to a nuclear weapon called the JCPOA in 2015. Right. President Trump got out of that in 2019. Probably should have stayed in, because the deal we're talking about now that we will get is going to be very similar to that. There'll be some cosmetic changes. It'll be very similar. We didn't have to do this war. I understood some of the rationale of the June war several months ago. They were cheating on the nuclear side. If they're not going to go back into a deal, a limited strike, and the Iranians didn't strike back, and the proxies didn't strike back. They didn't close the straits. It was limited in scope. It was limited in time. And so I understood that this war was a moment of opportunity. There were a lot of protests that were rising up, and President Trump said, help's on the way, and all of a sudden got painted into the corner, and then started coming up with reasons why we're in this war. Nobody really knows why we're in this war. No American really knows why we're in this war.
I don't even think,
But we hear the justifications
matter.
from the administration every day.
But they change.
You mentioned storage, though. I want to ask you about what's about to happen in Iran when it comes to their own oil storage, because there's nowhere to put the oil at this point. They're loading tankers almost. They're putting oil supposedly on trains to China. The president says the whole underground infrastructure is going to blow up, which I'm not sure is true. But if they have to start shutting wells, that's going to be a pretty major moment, and something that could happen in days or weeks. Do you?
Well, first of all, it was supposed to happen already several days ago.
So that's not.
So it didn't happen. Here's the thing. Why not? Because I've dealt with, there is real economies of oil where you look at the Baker Hughes manual of what do you do in this situation, and there's wartime and stress time. They're very different. I spent a lot of time in southern Iraq trying to help them refix and so on. And if you went down there, no manual told you to do it. They should have been shut in. Wow. There is a way. Iran is a very good engineering country. They have remarkable engineering talent. They've been in the oil business 100 years. They know what they're doing. When we did I was in charge of the sanctions 15 years ago, so 2012. And we took them down to like 900,000 barrels of exports. And instead of doing all of what President Trump suggests, things blowing up and just shutting everything down, there are ways for them to do wartime economizing. Right, so you shut down one field, do some maintenance on it, then you bring it back. You shut down the next one. You can do a rotation. You can set fields on fire, which is by design, which doesn't put any pressure on the pipes below ground.
Wow!
I don't expect to see any explosions. They are hurting economically. They are devastating economic pain in Iran.
And yet, here we are still at war with them. This is,
they can handle the pain.
I'm just saying.
They can handle the pain, and their view is, how long can you handle the pain? And I'll tell you this, we're going towards a cliff on oil and oil products by the end of this month.
Physical shortages.
We have physical shortage already, but it's just in countries we don't care about. Okay. So then they will, because they're poor. But then it'll go to middle income countries like Vietnam and Thailand. Then it goes to Japan and Korea. And then it comes here. And here's the thing, you want to fly out of the United States? You can say, we have oil, we have jet fuel. Okay, you can't take it with you.
Wow.
When you fly out, you got to be able to refill somewhere else.
It's already making its way through manufacturing supply
Well,
chains.
that's
like
right.
you are feeling it
And ask
throughout.
the airlines when,
Yep.
when it comes
And
to
if
jet
AI
fuel.
spends a lot of money, hundreds of billions of dollars, which is not dependent on
they need
consumers,
power.
but they're not dependent on consumers. What happens when consumers say, I can't spend this?
Yeah.
I have no money.
Almost, thank you.
Okay.
It's great to have you on Bloomberg. I hope Milken treats you
Full
well.
optimism,
Alongside
please.
Carol Massar, I'm Joe Matthew. This is Balance of Power, live from LA, only on Bloomberg.
It's 1240 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ all advancing. S&P at a record, trading close to session highs right now. 72.56 where we stand. A record on the S&P, up 56 right now. That is a gain of 0.8%. Dow Industrials up 266 on the Dow, a gain now of 0.5%. The NASDAQ Composite Index up 222 points. For NASDAQ, that is a gain of 0.9%. The VIX just above 17 with a 10-year 4.41%. Gold is up $35 the ounce to 45.57, up 0.8%. Crude, the big story, yes, relative calm in markets. We've got stocks rising, oil falling. West Texas Intermediate crude 102.06 a barrel, down by 4%. Brent crude 110.46 for Brent, a drop there of 3.5%. I'm Charlie Pellet. Back we go to the Milken Conference in Beverly Hills. Once again, your hosts, Carol Masser and Joe Matthew.
All right, Charlie Pellet live in New York. He'll be back at the top of the hour when we welcome our global television audience to the program live from L.A. and more specifically Beverly Hills at the Milken Global Conference, where we're spending a lot of time, Carol, talking not only about the economy, but geopolitics and the way they are impacting one another.
I got to think about our guests so far. You know, Treasury Secretary, former Treasury Secretary Steve Mnuchin. We talked geopolitics. We talked the White House. We talked a lot of things. Then we got a lot really deep into geopolitics, energy specifically. But a big thing of Milken, yes, it's business. Real estate has always been kind of a core conversation here at Milken, and we've got a great guest to do it. It comes amid a backdrop where the White House has been out with reports talking about a shortage of 10 million homes here in America. We know the supply-demand imbalance. So let's bring in our guest, Warren Waxberger. He's CEO of Eldridge Acre Partners. They're a real estate investment management firm. Welcome, welcome. Great to have you here with Joe.
Appreciate you guys having me on. Thank you.
So talk to us about your world right now, because there are these supply-demand imbalances. We talk about affordability. There's not enough homes. There's people staying in their homes too long. Rates being too high for people to want to pull the button and buy a home. How do you see it from your perspective, and where do you find the opportunities?
I think that's exactly right. I think it's totally a function of rates, and you look at it on the rates on the ability to buy homes, but also on the ability to create new supply. So if you look at kind of the measure that we look at mostly, which is the 10-year, that 10-year is so elevated right now that it makes it very uneconomical to build. And as a result, we think it actually presents a lot of opportunity to come into places where there may be stress in building.
So you've got a 10-year...
Stress. Or
stress.
Okay, well,
not
you've got
distress.
that 10-year to supply costs. I mean, we've been talking about this since COVID, just to be able to get lumber. Now you add the cost of energy, the price of diesel to drive all of that lumber to a construction site means what for new groundbreakings in the year?
So it's really interesting. In 2025, we actually didn't see too much impact from tariffs. What was incredible is that the impact of tariffs was mostly absorbed by the contractors. We're starting to see now in 2026 really
no longer
as a result of what happened with what's going on with oil. Diesel prices are obviously up tremendously relative to gas, and that's really being impacted. And so you have this window in 2025 where if you were like procuring new supply or new materials and so forth, the costs weren't as high. Now going into 2026, our research is really showing we're going to see elevated costs of supply mixed with those elevated rates is really creating this perfect storm where you see the supply cliff in new supply coming in, particularly in multi-housing.
So, Warren, help me understand, because everyone reminds me, you go back to the 70s and interest rates were a heck of a lot higher and mortgage rates were a heck of a lot higher. And yet people bought homes, like they figured it out. So what is it? What's the dynamic here? Where's the disconnect? Why can't people afford? I know the average house is like $340,000, $400,000. It's a lot of money across the country. But where's the disconnect?
I think the disconnect really does come out of supply, and I know I sound like a broken record with it, but when we think about what's going on right now, you're anywhere between 5 and 10 million housing units short in the U.S. Wow. Demand is continuing to go up, and we're just not seeing that new supply being created. And so from our perspective, it's a supply issue not only on housing, but also just on manufacturing, on the infrastructure we need within the U.S. And so we're focused really on the broader real assets platform. So both real estate and infrastructure in places where you have the supply-demand imbalance, and that creates that investment opportunity.
You talked to the HUD Secretary yesterday about the administration's pretty lofty goals when it comes to creating new affordable housing units in the next couple of years. Your research is pointing to a multifamily supply cliff, not even a maintaining of the current level that we're at. Is it possible for the administration to affect this market that seems to have its own direction?
I think you can do a lot with policy. One of the things that's obviously been an impediment to new supply is local zoning ordinances and so forth. Sure. You know, you got a lot of NIMBYs out there who say, I don't want this new multifamily building next to me. Yeah. And ultimately, we see it, for example, in Austin, right? Austin has a huge supply boom, and it's one of the markets where you're starting to see rental rates decrease.
Well, rents are going to be going up everywhere else.
Rents are going to be going up in places where supply is constrained, and it really is a micro location opportunity.
Talk to us about the shifts, because it's interesting you brought up Austin. I did a big real estate panel yesterday. Jeff Blau was on it of Related, a bunch of other big players. They talked about San Francisco being hot, even after everybody was writing it off after COVID. Same thing with New York, but you got to pick your properties very carefully. Austin, you know, overheated. Places in the South overheated. Where are the opportunities for you guys? And what kind of opportunities specifically are being presented?
So the opportunities for us on the real estate side are primarily in places where we can bring capital and expertise. And so what we're seeing is a lot of stalled developers who are in a situation where you had rate shock. They maybe bought the site 2 or 3 years ago, or sorry, even before that. They've gone through entitlements for the last 2 and 3 years, and now are sitting in a situation where it's unaffordable to build. They have their equity in there, and so we can come in with preferred equity, mezzanine debt to allow those projects to go forward, but have real convexity. So we've got downside protection with upside participation.
So do our investors who are listening and watching right now need to be looking more at real estate? You've got a stock market that's roaring, but if we've got such a supply crunch in real estate, why fool around with semiconductors when you can buy land and housing?
I like both. Yeah. I like anything real assets related. And so when you think about it, what's really interesting about real estate is real estate took its lumps, right? And so in 22, when we had rate shock,
it's already had its recession.
It's already had its recession. Right. And so we think real assets overall as an asset class is really poised for significant growth.
Warren, how much though still in terms of pricing still has to clear? And that's what I've also heard, that there's still a lot of markets where you still need to see some correction going on.
For sure. And I think that's the opportunity, right? In the 2010s, you were rewarded by just having balance sheet, right? You were riding an escalator up and you just had to stand there and you'd get returned.
Right.
Today, now you actually have to walk up the stairs. And so you actually have to do the work. And so that specialization and understanding the micro markets and bringing capital plus expertise is what really drives the alpha.
Is your concern, everyone's got something that keeps them up at night, interest rates, you mentioned this briefly, if that 10-year keeps climbing, maybe due in part to the geopolitical pressure on the market right now, rising energy prices, could we be in a world where mortgage rates start to become a problem again?
I mean, I think mortgage rates are a problem today.
Are they?
Yeah, I think it is unaffordable in the U.S., but I do think that in itself creates an opportunity from an investment perspective, because I think that is what allows you to find those opportunities. Because rates are up, people are having difficulty building, and in turn you are rewarded when you bring capital and expertise to the table.
We talk so much about, though, the AI and data center and infrastructure build out. I think you go back a couple of years here at Milken, a lot of it was about logistics, right? What Amazon and all these others needed to move around stuff. What's the data center opportunity, or is that just too heated and too much capital already in it, that's not an opportunistic play for you?
I do think that data centers themselves is a cost of capital shootout. Whoever has the lowest cost of capital is going to win there. But I do think the data center adjacent, so where you're talking about fiber or behind the meter power, ultimately it's about controlling the electrons. That's what's going to really drive the opportunity in the future. And so if you can control the fiber, you can control power, and you're in an opportunity to invest in that. We particularly like the credit side of that play. We think it's really interesting. There's a lot of credit being issued for data centers in particular, but where we find it really interesting is on the power side, on the fiber side. So we're seeing a lot of fiber opportunities, which you obviously need to be the backbone.
Can I ask just quickly about the other side of that coin?
Sure.
If we keep throwing up data centers around the country, there is a worry, and there's the NIMBY a part of this as well, but it also threatens to increase property values. Does this argue with your hopes for the housing market?
I think we've already seen the NIMBYism around data centers, and you're starting to see state and local regulations that are prohibiting data centers in particular markets and so forth. Ultimately, it's a power issue, and that's really where it comes down. And I think President Trump did a really good job in terms of pushing the narrative that these data center operators are going to have to pay for their own power in terms of it. I think that was really smart, and I think it was a really great step in terms of taking away some of the arguments that power costs are going to go up as a result of these.
Those big hyperscalers, their top and bottom line is, they've got to have the power to fuel those data centers. Warren, thank you so much. Really appreciate
the time. Thank you, guys.
Warren Waxberger, he's CEO of Eldridge Acre Partners. We're going to stay with real estate. I did have this amazing discussion.
I want to hear this.
With 5 folks in the real estate industry. They were from Ares, PIMCO, SVP 3650, and also Jeff Blau of Related. You might know him from developing on the west side of Manhattan, Hudson Yards, but he had a lot to say about data centers. Check it out.
We got into the space through our renewable business. We started a renewable business about 5 years ago. We built solar, as I mentioned, and mainly for governments and utilities. And then all of a sudden, the tech companies came calling and looking to buy power in very large quantities before kind of all this current craziness around data centers. And Google is now our biggest customer in the renewable space. But really what was interesting, I said, what are you guys doing with all this power? And we started to learn about data centers, 3+ years ago, which seems like ages ago in data center land.
Yeah.
And we started to understand, and we pulled talent that were power, grid, utility experts out of our renewable. We put them with our real execution team on the real estate side. We hired some veterans of the data center space. We formed this company, Related Digital, and now just 3 years later, we have about $35 billion of development underway in data centers. We're building for almost all the hyperscalers. A couple of us on this panel.
Russ and Julie.
Last week, we closed a big deal in Michigan that was in the press. That was a $16 billion deal, part of the Stargate program, where we're building a data center for Oracle and OpenAI. And we used a very new, kind of interesting financial structure to get that done. So the demand from the hyperscalers seems just unabated. I spend a lot of time because we all ask the same question: how long could this last? Is this real?
Yeah.
And I could just tell you from, in their offices, speaking to the tech companies, the demand is essentially unlimited right now. Now, I don't know how long right now lasts. None of us know that, but I could tell you it's at least 5 years, because the commitments that are being made now extend 5 years. So is it 10 years? I don't know, but right now, the biggest constraint to new data center development, I'd say there's two, is power availability and now community relations, right? Those are the two things that could slow this down.
Come on in, Russ, because talk about the financing side of it. It's certainly something we covered, but why don't you talk about the details?
Yeah, I mean, you throw out some big numbers, and those numbers are so big that, the bank market can't take it all down. It necessitated broader participation. And so I think what Jeff was mentioning is we structured it as a 144A securitization such that, we could trade it. It's more easily tradable. For someone like PIMCO, it gives us the flexibility to, provide liquidity if things were to slow down, or realize a total return in excess of a hold to maturity if we want to sell some. So we're always looking for that flexibility. There's probably 4 or 5 banks out there quoting 2 ways on it, and anytime that we can use liquidity to our advantage, we're going to. So I think it's a template we've actually used twice now, also in the Meta deal in August of last year. And I think it's going to be probably used a lot more frequently going forward.
All right, that was my panel yesterday here at Milk, and Russ Ganaway, co-head of Tactical Opportunities over at PIMCO, and you also heard from Jeff Blau over at Related. But it was fascinating. We talked a lot about data centers, but we did also talk about Office and just trying to understand the AI impact, how we work. We're still figuring it out off of COVID. But they talked about the real estate market, Joe, as being kind of a stock picking type of market. You can have a street in New York that's good and a street right next to it that's maybe not. And that's how kind of granular.
Stock by stock.
How granular. And I've never heard the real estate market kind of talked about in that way. I've talked about city, region, type, but it was fascinating to hear.
I'll tell you, there's an incredibly receptive crowd here at Milken. All of the panels that we've been honored to host here have been incredibly well attended, and people really are deeply focused on the conversation here to try to learn something that might help them make their investment decisions. So we're going to add to that conversation in our second hour. We'll welcome our global television audience and bring you a conversation with Neera Tanden, the force behind the American Center for American Progress, former Biden administration official. We'll get the view of a progressive in this land of billionaires.
I'm ready. Are you ready?
Absolutely. It's straight ahead.
Live from the Milken Global Conference, this is Balance of Power with Joe Matthew and Carol Masser.
All right, everybody. Carol Masser, Joe Matthew. We are live here in Beverly Hills. We're at the Milken Institute Global Conference, bringing together where money intersects with everything, whether it's politics, business. We've talked real estate today. We had former Treasury Secretary Steven Mnuchin just kind of going into the White House, talking about disclosure in terms of earnings, talking a little bit about Hollywood as well, right. Michael Jackson.
That's right, with Steven Mnuchin, the, of course, executive
love that you
producer.
can do that with him.
Well, look, it's going to be the diversity of voices this hour will really give you a sense of what it's like to be at Milken, the various panels, speeches, and interviews that we're being exposed to on a regular basis. We want to bring to you here on Bloomberg TV and radio, and we're going to do exactly that over the next hour, beginning with our next guest, the force behind the Center for American Progress and a former senior advisor in the Biden administration. Neera Tanden is with us here live at Milken, and it's great to see you. Welcome back to Bloomberg TV and radio.
Great to be with you.
We're surrounded by billionaires. We're surrounded by big business. Do progressives have a home at Milken?
I've come many years, so
Yeah.
I hope so.
Okay, so you're speaking the same language, because a lot of people think the Democratic Party has lost the billionaire class. How about you?
Well, I do think it's really crucial for the Democratic Party to have an agenda that's focused on economic growth. And I think that that's important for the billionaire class, the working class, the middle class. I think we have maybe different visions of how we grow the economy and make sure everyone is taking part in it. But that is definitely a cornerstone of our view. And say billionaires have done really well in this country, and we'd like to see more of them, and more people gaining wealth across the board.
So what's a productive policy that gets there and gets to that lower rung of the K-shaped economy?
Yeah, I think the big things we're seeing, and really the stress people are feeling, is in cost of living, and that's housing costs, healthcare costs, utility costs. Healthcare costs have gone up 25% in the last 5 years. Housing costs went up 30% over the last 5 years. So people, I think, are really struggling to make ends meet. So we believe that we should put forward ideas, have ideas out there that
But
would.
like what? Tell me how we make or break this, because we've been talking about expensive housing for a while. Healthcare costs, man, we've been talking about that for a long time. So what is a policy that we can put in place that actually changes this direction?
Excellent. So housing costs are such that for a first time buying your first home, the average age today is now 38 years old. It used to be 25, 29 years old. Rents have gone up, as I said, 30% over the last 5 years. So that's a huge struggle for people. So the way to do that is to build supply, expand supply, make it easier to build, deal with permitting reform, but also put incentives down for building. And when communities are building, we think we should provide some kind of tax relief to renters for a limited period of time so they feel a benefit from that increase. So those are ideas.
You know who gets tax breaks? Big developers.
That's
right. To build those big buildings.
Yes,
I have a lot in my neighborhood, and I'm like, why are my taxes going up, but you're getting that break?
Yes, but for I think we should expand support for housing, but we should also ensure that first-time homeowners, renters, they get access to support as well.
Yeah, you're a professional at messaging when it comes to the Democratic Party, right? You were helping to craft the message for the midterm elections, and I'm fascinated by how little it actually changes. It's getting prices down.
Yeah.
And maybe it's no new wars.
Yeah.
That's the same mantra that Donald Trump got elected on. That's the same mantra that Joe Biden got elected on before him. And we're going to, so it's a consistent set of issues. It's just a question of who you want to have solve it. Which approach will win? How do you message that in this cycle?
I honestly think this is what I find so surprising about the last year, right? Because we had a cost of living concern. And what's interesting about the American people is they're as concerned about cost of living, if not more so today, than 4 years ago when we were at 9% inflation. Inflation has come down. Sure. It's still, prices haven't come down relative to where they were before. But people really feel
it's just the rate of increase.
Yes, exactly. No, that is why people are angry.
Yeah.
That is why people are angry. But what I find surprising about policies, and I do think this gives an opening to a lot of Democrats, is the tariffs and the war are really increasing costs for people. The gas prices, obviously, with the war, which I just think no one really expected coming into this administration, that you'd see tariffs that are essentially a version of a national sales tax and disproportionately felt by working class people because they're buying more stuff.
Will Democrats then run on a no tariff platform? Is that what we're going to hear in this cycle?
We definitely need to pull back on the tariffs.
Yeah, okay, so no new tariffs. lower prices,
Yeah.
no new wars?
Yeah, and end
Healthcare,
the wars.
that's exactly-
End the wars. Lower healthcare costs, lower utility
How
costs.
do you win the trust of people to say Democrats can do that?
Well, I think that's really going to be up to candidates with
Yeah.
real ideas of how to do it. You can't just mouth words. You have to give people actual ideas of how to do it. And sometimes you have to fight some special interests on the way. And I think that gives candidates a lot of credibility as well.
How do you fight the business community? I mean, pockets are deep. Lobbyists are out there in full force. You know, it's companies that do have the deep pockets and making sure and helping lawmakers get back there in Washington. So the money in politics and who is really heard, I think, is really problematic today.
Yeah, I think that is a core concern for democracy. But I guess what I'd say I don't think we should be fighting business. That's not the way I think about it. I think about it from the perspective.
I love capitalism too, but I just want to make sure that I'm heard, Joe's heard, you're heard.
Well, I think
kind of the average Joe.
Yes,
You're not average.
100%. I think what really concerns my genuine view is what people, they don't hate that a billionaire exists. They hate that a billionaire has a billion times more political power. Working class people actually want to become wealthier. But what they're angry about is a system where the billionaires pervert our democracy. So I think we all have a stake in actually a functioning democracy.
On that, will a billionaire tax be something that the Democrats will endorse going forward?
I think there will be some Democrats that endorse that, but a lot of Democrats would say that doesn't actually make sense. A wealth tax may not make sense, but a tax I do think wealthier people should pay more. The big tax cuts that were deficit finance and the One Big Beautiful Bill Act that went to the highest income people. I think a lot of people wonder, why are we doing that when our deficit is
I was going to ask you how many times you've been asked about a billionaire tax since you've been at Milken. Does that come up every time you walk in the room?
I haven't. I genuinely think that there's problems with doing a wealth tax. The Supreme Court will overturn the wealth tax, but I do think we should all be thinking about how the tax structure can seem more fair to all Americans, and maybe billionaires having a higher tax rate than other people would be a part of that.
A couple years ago, being at Milken, and very wealthy individuals coming up to me and saying, "We get it. It's our time. We've got to pay more." They understand. Yeah. They don't think it's ridiculous. And yet, hear the battle, right?
Yeah. I think
it's not going to make them poor.
I know. I actually think I
love billionaires. I'm employed by a billionaire. I'm very happy about it.
I know a fair number of wealthy people who are willing to pay more taxes. I think that's just part of the social contract of the country, and we should. That's that's the right path.
Really interesting. We've got a debate tonight in California for the next governor. I'm just wondering who you're looking at here, because a lot of people talk about the Center for American Progress as a shadow administration or a Democratic administration in waiting. The people who you share office space with, if the Democrats win the White House, will probably be moving in. Who do you have your eyes on when it comes to the Newsoms, when it comes to the Coopers and others around the country who might actually make a stand, the Pete Buttigieg? Do you have a bench that you can, once we get through the midterms, have confidence in?
I'm very impressed with the broad bench of governors, new generation leaders around the country. I think there's a real hunger, not just amongst Democrats, but for something new that's more uniting in the country. And we have hosted a lot of people who are governors and members of Congress. We have a Path Forward series where we've had Pritzker and Governor Pritzker, Governor Shapiro. We'll have Governor Newsom in a few weeks, Governor Moore. I think
that's the short list, though. Huh? That's the short list.
Yeah.
All right.
Yes. Well, it is good to come to CAP if you want to be on that short list.
Yes. Funny how that works.
Well done. Well done. Nira, thank you. This was really fun.
Oh, so great to be with you. Have fun.
Great to have you.
Managing the conference.
We are. Nira Tandon, she's President and CEO of Center for American Progress, joining us right here. And, of course, former policy advisor to President Joe Biden. All right, let's get back to the markets. A lot going on here. Let's toss it back to Charlie Pellet back in New York.
Hi, thank you very much indeed. We are looking at records right now on the S&P 500 index. We have got crude oil moving lower, equities moving higher right now. The S&P is up 56, standing at 72.57. That is a gain of just about 0.8%. Dow Industrials up 254 now on the Dow. We're at 49,195, a gain of 0.5%. To be sure, potential record on the S&P. NASDAQ 100 index also pushing higher. NASDAQ right now up 0.9%. We do have the NASDAQ 100 index up now by 1.3%. All of this with the VIX just above 17, a 10-year at 4.41%, a 2-year 3.93%, and the 30-year 4.98%. Spot gold is up $33 the ounce to $45.55 now, higher by 0.7%. And a retreat for crude, certainly helping with equity sentiment. WTI down 3.9%, 102.26, still above $100 a barrel. Brent 110.52, a barrel of Brent down now by 3.4%. Bitcoin 81,222 on Bitcoin, up by about 1.6%. So bottom line here, relative calm returning to markets as oil falls and stocks do advance. The SEC is out with a proposal that would allow American companies to report earnings semi-annually instead of quarterly. Critics argue that less frequent reports could increase the risk of insider trading and allow companies to bury bad news. Earnings news, Pinterest surging after reporting first quarter sales that topped analyst estimates. Right now we do have Pinterest shares. They are rallying by 8.4%. Pinterest did give an outlook for revenue in the current period that was higher than anticipated. Again, recapping here, S&P up 54, up 0.8%. Back we go to the Milken Global Conference in Beverly Hills. And once again, your hosts, here they are, Carol Massar and Joe Matthew.
All right, Charlie Pellet, live in New York. We'll be back with more on the markets coming up a little bit later on this hour as we connect the dots between the conversations here at Milken in Beverly Hills with the action that we're seeing on Wall Street. And, of course, all the cross currents from the war in the Middle East, Carol, to lower oil prices, interest rates, all colliding here in a pretty fascinating set of conversations. And we've been talking a lot about the war in Iran.
We have.
Amos Hochstein spent time with us near a tandem. There's another war that's going on that in many cases has been overshadowed by what's happening.
And folks are bringing it up and reminding us that the war between Russia and Ukraine, we're now in our 5th year. Who'd have thought? We thought some might have said it might have been resolved earlier, but it continues. And I even saw some more actions, I think, about drone action over in Russia by Ukraine this morning. So it continues in a big way.
It certainly does. And there are a lot of questions about resources, whether, of course, we're going to be able to continue to provide the weapons to Ukraine that we have for many years, knowing the needs that are in place now in the Middle East when it comes to Iran, when it comes to Israel, and the massive amount of work we need to do in our defense industrial base. But the political side of this, the relationship between President Trump and Vladimir Putin and the looming summit between Presidents Trump and Xi will all play into the way this works. And it's where we start our conversation now with Vladimir Kara-Murza, who is the Vice President of Free Russia Foundation and a voice that we've been looking forward to hearing from here at Milken. Welcome to Bloomberg.
Thank you so
Your
much
first
for
visit to Milken and LA. So I hope this is going well for you. And I just wonder if you worry that Ukraine will be left in the back of the shelf the more focus we put on Iran.
Well, frankly, Ukraine has been put on a back shelf since Donald Trump came into the White House, because I think there's absolutely no doubt that the current president of the United States, however crazily that sounds, is actually on the side of Vladimir Putin. He's generally on the side of dictatorships against democracies, and that's clearly the case also in the war.
He says he's been harder on Putin than any president in history.
Yeah, well, I think, I'm a historian, and we historians usually go by the facts, not by what people say. I think it's absolutely clear that in the war that Russian dictator and usurper Vladimir Putin has unleashed against Ukraine, the sympathies of the current U.S. administration are clearly with Putin.
Help us understand this relationship between President Trump and President Putin. Some say, keep your friends close, keep your enemies closer. Is it possible that this is strategy on the part of President Trump to pretend that there is friendships, or how do you see this relationship, what it really means? Because there are times he has pushed back, certainly at the Russian president.
I'm not a psychologist, but in my view...
but you understand Russia. You've been in prison. You've had to deal with what is the reality of what goes on in Russia and what is
I think Donald Trump just likes Vladimir Putin, and this is the root of the problem. I mean, we hear all these conspiracy theories about some potential compromise or whatever that Russian security services may have on Mr. Trump. One day, once the Putin regime is gone and the archives are open in Russia, in a future democratic Russia, we may find this out. Obviously, I don't have any inside information on this, but I just think that the main problem is that Trump likes Putin. He likes autocrats. He likes so-called strongmen. That the word, by the way, is deeply misleading. There's nothing strong about imprisoning or killing your opponents, about falsifying elections, about muzzling the media. That's actually the behavior of somebody who is weak and insecure, which is what Vladimir Putin is. But Trump likes dictators. I mean, I think he would like to have no parliament, no elections, no media. Of course, the situation is very different in Russia and in America. When Vladimir Putin came to power, Russia only had 10 years of democracy behind it. And so it took him only a few years to destroy our democratic institutions, the separation of powers, free elections, independent media, and so on. You in the U.S. This year are marking the 250th anniversary of your democracy. So, of course, the situation and the context are very different. But if we're talking about personalities, I think they're just fundamentally alike, and this is the problem.
Our audience should know that you have personally felt the wrath of Vladimir Putin, and having been poisoned not once but twice, yet you're sitting here with us today. There's news this week that Vladimir Putin is receiving additional security, that they're beefing up security around the president because of the number of threats against him. Is that justified? And what are you hearing about the opposition in Russia?
First of all, if I could argue with the terminology, let's not call him president. He's not a president. He's a dictator and a usurper. Presidents don't stay in power for 26 years, which is how long he's been in power. And we haven't had a free election in Russia for more than 2 decades. This is not my opinion. This is the verdict of the Organization for Security and Cooperation in Europe, which is the gold standard for election observation. But yeah, I mean, it's clear that Putin is paranoid. He's spending most of the time in the bunkers. There are anti-missile systems around his, his residences. We hear about additional security, of course, in the coming days. There will be a Victory Day parade on Red Square, which is going to be massively scaled down because Putin is afraid, he's afraid of Ukrainian drones, he's afraid of a potential coup, he's afraid of attempts on his life, he's afraid of everything. I mean, this is what happens when you cling to power for more than 2 decades with no elections, with no independent media, with no normal political system. This is how all these dictators end up.
Is there an
paranoid
effort to
in
kill
their
him?
bunker? Well, first of all, frankly, I wish that Vladimir Putin spends as much time in prison as possible. I want to see him in the dock on trial for all the crimes, being held accountable for all the crimes he's committed against our own people in Russia. Let's not forget the 2 main opposition leaders in Russia, Boris Nemtsov and Alexei Navalny, have been murdered on Vladimir Putin's personal orders. There are thousands of political prisoners in our country, more than 2,000 known political prisoners, according to human rights groups. This is more than the whole of the Soviet Union, that's 15 countries put together, had in the mid-1980s. And of course, for the 5th year now, and really for the 13th year now, because the annexation of Crimea happened back in March of 2014. Vladimir Putin has been leading the largest military conflict in Europe since the end of the Second World War. I want him to be held accountable for this.
I want to understand something in how you see President Trump, because he can remove dictators. Look at what happened with Maduro in Venezuela. Look at what's happening in Iran. Like, there are times he does push back against dictators. So I just wonder, what is the special mix here between these 2 individuals? And do you start to also think about, nobody lives forever. Do you think about life, without Putin, and then what happens in Russia?
It's not just that we think about it, we have to think about it, we have to plan for it, and not just we, the Russian opposition. Yes, it is, and in fact our organization, the Free Russia Foundation, and other groups like Memorial and Yulia Navalny's Forum are actively working on a roadmap for a post-Putin transition in Russia. We're also doing this on the international level. I'm a member of the Platform for Dialogue with Russian Democratic Forces at the Parliamentary Assembly of the Council of Europe, which brings together lawmakers from 46 European countries. Look, Russian history teaches us that major political changes in our country happen like this, swiftly, suddenly, and totally unexpectedly. Both the Tsarist regime and the communist regime collapsed in 3 days, literally speaking. Nobody saw it coming. Whenever the Putin regime falls, it will be just as sudden and just as unexpected, and we have no right to be unprepared for that because Russia is too important.
Anytime soon?
Could be in 3 years and could be in 2 weeks. This is Russia, but the point is we have to be ready because Russia matters. Russia is too important. And for as long as there's a dictatorial regime in Russia, Russia will continue to remain a threat, not just to its own people, our own people, but also to everybody around. And the only way to have long-term peace and security in Europe is with a democratic Russia, a reliably democratic Russia that will respect the rights and freedoms of its own people and that will respect the borders of its neighbors. And we have to work towards that post-Putin democratic Russia together.
Thank you. It's a great pleasure to spend some time with you, and we appreciate your insights here on Bloomberg. Enjoy the rest of the Milken Conference. Alongside Carol Masser, I'm Joe Matthew in Beverly Hills, and we want to bring you into an interesting conversation, not about Russia, but geopolitics and the effort to harden resources, sovereign efforts to have additional resources when it comes to governments, the AI race, and infrastructure. Held a panel on the geopolitics of supply, and we heard from the Chief Strategy Officer at Cerberus, Nate Fick. Let's listen.
I came back to finance. I came to Cerberus most recently from the State Department after serving as ambassador for cyber and digital for the United States, where I led our technology diplomacy around the world. And in that job, everything that my colleagues here have said resonated very strongly. And so in thinking now about the investment opportunity, I do think we have to nest it in the question of what's going on. Summarizing the state of the world in 2026 in 30, 60, 90 seconds feels daunting. I think, though, every one of us on the stage is saying different versions of the same thing, which is sort of geopolitics is back. Like if you went to college 20 or 30 years ago, you read books like The End of History and The World is Flat, and maybe you feel a little bit lied to. It didn't end, the world's not flat, right? And in that geopolitical competition, these battlegrounds are emerging, and they are primarily technological or industrial. They are AI, they are navigation systems, they are telecom infrastructure. They're all these things we're talking about. All of those systems, to Amir's point, were optimized more or less since the end of World War II for cost and for economic efficiency. And then, put aside the war in Iran, put aside U.S.-China competition. Do you remember the ship getting stuck in the Suez?
Sure.
Like even events like that, relatively minor, things that you might have been inclined to laugh about over the breakfast table, actually reverberated through the global economy in some really fascinating ways. So those supply chains now are being rewired. And that's a long-term rewiring. And then the fourth thing I would point to is this isn't about one political administration. The Biden administration did the CHIPS Act and the IRA. The Trump administration is doing an array of things, and whoever comes next in the United States is going to have to confront this. It's also not just about the United States. You've got German auto manufacturers repurposing production lines for defense, Japanese defense spending. You can look around the world. To answer your question, it's macro secular and enduring. It's of critical importance to many economies around the world. And so in that is, the silver lining to the very dark cloud from a human perspective is a huge amount of opportunity, I think, in all the areas that everyone up here has discussed.
Miriam, as the CEO of a publicly traded company, do shareholders understand that? Do they appreciate the need for that investment? Because so many days we find ourselves after the closing bell, there's an announcement on CapEx and the stock's going down because there's great worry about overspending on this.
Yeah, great question. Thank you. I think the shareholders do understand the coming of national security, and a lot of spend is in the national, as Nate can tell you, and it's very much focused on how do we build resiliency, how do we bring national security together with the private markets, how do they come together to form public-private partnerships, right? And how can the government play a role in this? And I think they do see that opportunity. However, they also see the risk.
There you have a taste of our panel here at Milken on the geopolitics of supply, which of course is something that we talk about just about every day here, but interesting to hear from voices around the world. Those were business owners and executives operating in the Middle East, operating in Asia, and they each have a slightly different angle on this, although it's a common thread throughout this conference.
I feel like the supply chain grab is on, and some people in some countries are certainly better positioned than others.
Supply chain grab. We should have called the panel that. I like that.
All right, I'll work on it. Hey, we're going to do a little bit of a switch to something that's actually top of mind because we have PayPal out today planning job cuts. The new CEO is really pursuing kind of a massive turnaround strategy at this company. They're going to make Venmo a standalone unit. But we think about these payment companies, Joe, that I don't know about you, but I'm using mine all the time.
100%.
Kind of this concept of digital money. We want to see what Denise Leonhardt has to say. She's the chief of Zelle. I use Zelle a lot. She's here at Milken. You're very welcome. Tell us about this, because this is a consortium of banks that are involved in it, and it's kind of direct to bank transfer. Tell us about your world, what you're seeing in terms of activity on the platform, and what it kind of tells you about our economy.
Yeah, so we are owned by a consortium of 7 of the largest banks, but we actually have a network of 2,400 financial institutions. So that's everything from the largest bank in the United States to those small community banks and credit unions, and those are really important to us. And we have 160 million accounts on the platform. That includes consumers as well as small businesses. And in December, we actually had 100 million of those accounts were actually active. So during that holiday season, 100 million customers in the United States were actually using Zelle.
Which is pretty typical, or was that?
Yeah, it's actually pretty typical.
Okay.
And we continue to see this increase in terms of digital payments. So we had $1.2 trillion moved on the platform last year. So that's larger than the GDP of Switzerland, to put that into context. And we're continuing to grow at 20% year over year. So we just continue to see more and more people move away from cash, move away from check, and go to these digital payments.
You just had, I believe, your second consecutive $1 trillion year.
Exactly.
Where do you find growth from here? I know that you're working on potentially having an opportunity for people to pay their mortgages, to pay their rent, recurring payments like this that might make your life a little bit easier. Is that the next opportunity for Zelle?
It is. So when we talk about the value proposition of Zelle, it's exactly how you described it. It's moving from one account to another account and being able to do that quickly and safely and securely. So what we want to do is actually just open up more use cases for people to be able to use Zelle. Okay. So that includes small businesses. Yep. It includes, we have currently a pilot with bill pay with our friends at Truist. We also have a pilot for donor-advised funds in order to get into the charity space with Bank of America. So we're continuing to pilot these and hoping to expand them and expand our roadmap.
You just want more and more people on the platform.
More and more people, and also thinking about us more and more often.
Denise, where's the growth? You talk about bill pay, you talk about donor-advised, you talk about small business. Where's the growth?
Yeah, I think that there is growth in all of it, actually. So it's just that recurrence and using us continually to make all those different payments to people or to small businesses that you know and trust.
Can you tell us in terms of data? I mean, everybody's got lots of data, anything that's digital. So what can you tell us about the types of payments? And does it give you any indication about the health of this economy? It feels pretty good. We talk about the market going up, but we know the market isn't necessarily what is going on in the broader economy.
So on the platform itself, we continually see this increase of overall payments. So again, 20% year over year. But what we're also seeing is this boom in terms of small businesses. So 30% of our volume is small businesses, and that's actually our fastest growing segment. So part of the reason why small businesses love Zelle is because they get their money almost immediately, and then they can be able to pay their workers, or they can be able to go out and buy supplies instantaneously. So it's that quickness of payments that people love.
Is your sort of long-term vision or your dream a cashless society?
Well, when's the last time you went to an ATM?
I don't know about you. Hey, Joe, they got rid of the penny.
They did. They don't make them anymore. I keep finding them in my pockets, though.
But you remind my daughter, there is actually money under all of this.
I actually feel silly sometimes. I don't remember the last time I carried cash, but there are a lot of people that do. And I guess, is that the goal, where cash is useless?
I mean, the goal for us is to more and more digital payments. It's more safe, it's more secure, and it's also more convenient.
Does the structure stay just as, multiple bank ownership? Is it something that this is a company that could essentially go out on its own?
I think
Would that make sense?
It will stay in the current ownership structure. It's actually fun to be part of this ownership structure because you get the best payment minds in a room often. And really thinking about the innovation as the entire ecosystem moving forward.
Yeah, it's kind of fascinating to see that. Thanks so much for stopping by.
Thank you for having me.
Another snapshot of what goes on here at Milk. And Denise Lienhardt, she's chief of Zelle, joining Joe and me right here on set. Hey, folks, back to the markets we go, back to New York and back to Charlie Pellet.
Hi, thank you very much. And here's what's going on. We are trading at just about the best level of the day right now on the S&P 500 index. Relative calm returning to U.S. markets. Stocks higher, oil moving lower right now. We've got West Texas Intermediate crude oil. It is trading down by 4.3%. WTI trading at just above $101 a barrel right now. Barrel of Brent crude at 110. It is down by 3.8%. Stocks are rising. Oil is falling. Amid signs that a U.S.-Iran ceasefire is still in place that is reducing fears about a full-scale war. The S&P 500 index higher now by 60 points at 7260, up by about 0.8%. Dow Industrials up 307 on the Dow, gain there of 0.6%, while NASDAQ higher by 243 points for the NASDAQ Composite Index, up by 1%. The Russell 2000 Index of small-cap shares up now by 1.5%. And the SOX, so that is the Philadelphia Stock Exchange Semiconductor Index. It is surging now by another 4.8%. All of this with the VIX just above 17, the 10-year 4.41%. Recapping, S&P up 0.8%. And back we go to the Milken Conference in Beverly Hills. Once again, your hosts, Carol Masser and Joe Matthew.
All right, so appreciate it. Charlie Pellet there with an update on the trade on this. Yes, it's Tuesday. I get lost when I'm on the West Coast. The 3-hour time difference. Where am I?
I pledged to stay on East Coast time one day, and it's already gone.
That's my watch is East Coast. My phone is West Coast. All right. We are back here at Bloomberg Institute. The Milken Institute. Boy, did I just tell them that I just renamed it?
Well, we could maybe work on that for next year.
We could do it. Milken Institute Global Conference.
Yes.
Carol Mass and Joe Matthew here in Beverly Hills.
One thing we talk about a lot, and we've spent some time talking about the energy space over the course of this program. Almost Hochstein painted a pretty bleak picture. We also talked a lot about data centers, and these two stories come together in a way that has reinvigorated the conversation about nuclear. In a way that nobody could have really predicted. We talk about it with experts in the industry, the need for more power. We talk about it with lawmakers who are trying to find a policy path. And our next guest can speak to all of this. Maria Korsnick is the president, chief executive officer of the Nuclear Energy Institute, the trade group for the nuclear industry. It's wonderful to see you. I'm sure you've been awfully busy at Milken. This is a conversation a lot of people are trying to get close to, whether it's the small modular reactors that could end up landing around data centers, whether it's actually taking old decommissioned nuke plants out of the mothballs and putting it back online. When do we start actually building and seeing approvals when these projects are proposed?
Well, we're doing that already, right? So you have the TerraPower had their construction permit approved out in Wyoming. They're beginning construction. They're building actually in Canada, the GE Vernova first SMR for that. It's about 300 megawatts. And then down in Tennessee, the Kairos Power test reactor is under construction as well. So we have actually, transitioned from just some great ideas to actual construction.
Marie, when does nuclear that become something really significant in the United States, in a country where we know there's a lot of neighborhoods, a lot of areas that just don't want to have any kind of nuclear facility in their area?
Well, we're 20% of the electricity sector today, so I would say nuclear is already making a difference. And honestly, we're not hearing the pushback that you're mentioning for local communities anymore. One of the latest polls showed greater than a 60% favorability rating for nuclear and climbing. And I think part of that is what you mentioned. It's the data center conversation. Data centers are looking for really reliable energy. They'd like it to be clean. Nuclear is here to help. And so you're going to be seeing, first of all, extending the lives of plants we have. Started out 40, we got it to 60, have over about 25 plants approved for an 80-year life. Okay, so what you have is going to last longer. What you have can make more power. So 3/4 of the fleet are going to do power uprates. That's going to bring 5-ish to 6 gigawatts of new power to the grid.
Fascinating.
And that can be short term.
Are the near-term solutions small modular reactors, or should people get used to seeing large plants like we used to at just a different scale in the old days?
Yes, all of the above.
Okay.
All of the above.
If you're a data center, though, do you want an SMR on your property?
Yeah, it might. So there's a couple different things. If you're a data center, you need that power. Constant, right? They don't want to have that disruption.
As well.
Could be off the grid. But because of the high reliability that you want, you might want to have a couple of small packages rather than one large package. If you're a really big data center, you might want several large packages. So I think it depends on your solution, but it's literally all of the above. From the large gigawatt size to the medium size to the even really small, we call them micro reactors. So think less than a megawatt even. And so you're going to be able to look at nuclear as a solution set in ways that you just never thought before.
You mentioned the SMRs, though. Do we really have a viable design and it's happening?
Sure,
because I feel like we've been talking about it. So how long, though, before those are actually in use and production?
So one's in construction in Wyoming, one's in construction in Canada. You just heard X Energy within the last 2 weeks do their IPO, raised over $1 billion. That's an SMR.
But when are they up and running? What are you hearing?
So early 2030s, I think, for that design.
Okay.
But the GE design, I think, is talking about being online in 2030, and same for the TerraPower design.
Do you think, when you guys ask Americans if they're comfortable with it, I mean, is it because is it against the backdrop of higher electricity prices? Because I think Americans are feeling so squeezed. And is that where they say, okay, if that's what's going to make it less expensive for me, I'm in?
You know, it's a combination of things. Do you want energy security? Nuclear has that. Do you want it clean? Nuclear has that. Do you want it reliable? Nuclear has that. I mean, the value proposition broadly for nuclear, and it's not just here in the United States, it's around the globe.
What do you need from Washington? What do you need from policymakers to continue continue the growth?
It's still hard to go first. So one of the things that we're asking for from a legislation perspective is what's called the ARC Act, which is something that's going to help the government lean in on a little bit of those first-of-a-kind risks just to help those get ameliorated so you can move right in. The other thing is we got some energy credits, the tax credits, and they're wonderful. There are a couple of tweaks. Would like to opt out of normalization to let you get that tax credit faster, and some transferability. And both of those are in legislation that's on the Hill now.
All right, interesting stuff. We didn't talk about nuclear waste, which is always an issue, too.
Next time.
I'm going to leave it there. Maria, though, thank you so much, because I do feel like when we talk energy, you're right. Everybody's saying we need it all in order to power. Right. Maria Korsnick, Nuclear Energy Institute CEO, joining us right here at Milken.
Thanks, Maria. It's great to have you with us.
Appreciate it.
Thank We've got a lot more ahead coming up the rest of this hour as we continue on day 2 here at the Milken Global Conference in Beverly Hills. It's been a really interesting mix of policy, of executives, and in some cases, celebs walking around the hotel here.
I have to say, I love this conversation with Maria because I go back to about 2 or 3 years ago. We did something at NJIT out in New Jersey, and wanted to talk about power, and all they wanted to talk about was nuclear energy. And it really kind of caught us off guard because we felt like that had been pushed to the side in the U.S.
You'd be amazed at how many lawmakers tell us they want to talk about this when they come on the air now in Washington as well. And you've got an administration that has clearly embraced nuclear as the way forward. It's an administration that's embraced AI, and it's hard to separate the two.
We have an administration also embracing space. We're going to talk about that a little bit later on this hour. All of that to come as Joe Matthew and I continue from the Milken Institute Global Conference. We are in Beverly Hills, and this is Bloomberg.
You're listening to Balance of Power with Joe Matthew and Carol Masser, live from the Milken Global Conference on Bloomberg Radio and Television.
It is the center of the business and political universes all at once here in Beverly Hills. Thanks for being with us on what we'll call a special edition of Balance of Power here at the Milken Global Conference.
We'll take special,
indeed. Well, Carol Masser's with us. It's got to be. I'm Joe Matthew, as you just heard live at Milken, and it's been an interesting conversation today that we want to continue here by going to the top of the mountain with the face of American business.
I have to feel, exactly, and I feel like all the conversations we've had lead up to this, whether we talked about energy, higher costs, inflation, supply chains, geopolitics, politics in Washington. Suzanne Clark is with us. She's president and CEO of the U.S. Chamber of Commerce. A great voice when it comes to what's going on in the business community. What is top of mind? Because the laundry list of things that is coming at American businesses right now is a lot.
Well, thank you so much. Thank you for having me. I was saying a minute ago that we were just with the LA Chamber yesterday, and it's such an opportunity to get out and talk to local businesses, big and small, about what's happening in their community. And what we see is businesses really trying to deal with all of this uncertainty. What should they be doing about finding workers? What should they be doing about their supply chains? What will happen with the economy? What does AI mean? So all the things that you've been tackling all morning, business leaders are live trying to figure out themselves.
What conversations are you having when it comes to affordability? I know you were on a panel today with Neera Tanden, who was on the broadcast a little bit earlier. Both of you, I'm sure, coming from different perspectives. When you're trying to keep American business in mind, knowing price pressures from the gas pump to the grocery store are very real. You reached for the word uncertainty first. How do you speak with your members about this, the challenges they're facing and about to face?
Well, you know, let me say first that Neera and I had violent agreement about the need for permitting reform, right? That we really need to build things faster. All of it, right? It's housing, it's electricity, it's utility costs, it's, you know, so what could we do as a country to build things faster, more efficiently, and cheaper? So that comes up with affordability. The U.S. Chamber, we really believe a lot of the root of the affordability problem is a supply constraint, right? We don't have enough housing. We don't have enough access to health care. We have labor shortages in key sectors. We don't have a resilient supply chain. So the question is, if we want long-term economic growth, 3% growth that lifts up families and communities in the country and helps pay off debt, if we want all of that, we got to take some of these structural issues really seriously.
Like which one? If we could tackle one right now, in this given moment, what would it be that you think the American businesses could really get behind and say, this is a game changer?
I really think it would be permitting reform. Think about the fact that it takes 5 to 7 years to get a permit. In that time, you'll have a change of administrations, most likely. Right? So if you have one administration that prefers one type of energy, and you have a different administration that prefers a different type of energy, how do you decide where to invest and what to build? And yet at the same time, as you've reported, we need all of the above.
Suzanne, how do we get there, though? Because I think about, you know, the American business community, they have a great line often to the White House and to lawmakers. So how do they say, hey, folks, it's not just about 4 years, 4 years, 4 years. It's about a 10-year plan. China does it. It's a whole different country, and I know that. But how do we do that so that we really commit longer term to build some of these things that need that perspective?
It's such a good point, Carol, because we certainly do not want a government-planned economy, right? None of us are for that.
No,
but you're right that we do need government to set the conditions so that we can grow, so business can solve these problems at scale that society really needs answers to. And I think maybe we have to do two things a little differently. One is talk to more people at the local level, local businesses, local chambers, and get them to drive community support for politicians who are willing to do some hard things. And two, I think businesses are going to have to get more involved earlier in the process, in the primary process, and really thinking about candidates who don't want to just admire the problems and say expedient things, but are willing to do hard work and take hard votes.
You know, I think about you sitting in your headquarters right across from Lafayette Square, looking out the window at that White House. You've been there a lot longer than this administration, and to your point, you're going to be there for administrations in the future. But this Trump administration has embraced crypto in a way that we have not seen in a White House before. And of course, the timing has a lot to do with this suddenly kind of going mainstream. And there's a Clarity Act that Republicans and some Democrats are hoping to see passed this year. In fact, it could be sooner than later. Are we managing the rules of the road when it comes to crypto in a way that the chamber can support this approach?
I really like the question, and I really even more like the preamble, right? Yeah. Which is, we just had our 114th birthday.
How about that?
I know. I don't look a day over 112. I really feel...
You look amazing.
Thank you. I really feel the weight of the fact that, who was the guy in my office in the Depression or in World War II, or and how did they think about emerging technologies, emerging financial instruments? How did they think about the impact on working families and communities and American security and competitiveness? And how do we do the long-term right things while being empathetic to the real short-term pain? So I think your preamble was just so important. We actually do need institutions with historical memory and reach, and I think it's really important.
Sound like an institutionalist. But the chamber not taking a position on crypto?
Look, I think what we want to do is be supportive of new technologies at the same time that we don't lose sight of what really works in this country in the traditional capital markets and traditional financial services. We want to be
banks
careful.
Have been watching this so closely.
That's right.
And they've gone from pushing back completely, not interested, to embracing slowly, but I think moving carefully. But there is this concern. We talk about disruption and innovation, that how could something like the digital world or cryptocurrencies replace so much of what the banks do? So is there a lot of pushback that you guys are getting from the banks?
At what point is that innovation good, and at what point is that disruption dangerous, right? And it's what you're always balancing with a new technology. And so I applaud these industries and these companies that are educating Congress and getting to a point where we can do something that makes sense and makes sense for business.
It's, of course, not just crypto. When we think of emerging technologies, there's another industrial revolution happening right now.
Have you heard of it?
Take the words from Jensen Huang. That's what he calls it. How concerned is the chamber about, to your point, there are wonderful things that AI is bringing to us, but there could also be a negative disruption when it comes to the job market. Is that a worry of yours?
Do you want to hear something cool? Do you know the people having the fastest uptake of AI? Small business. It's the first technology in the United States that small business embraced first, which is really a leveling out, right? A great equalizer. Last year, the United States had 5.6 million new business starts. That's optimism for you. And some of that is that they can do more with AI, which is really fascinating. So the answer to your question is, of course, everyone can see there's a disruption coming. We don't have revolutions without some kind of disruption. So how do we help people through that? Because we're long-term optimistic about job growth, about health impact, about the innovation, about what it does for our country. We want to compete with our adversaries, right? So I think this is a really important topic, and we're going to have to do reskilling and education. But the short-term disruption, I think, is going to lead to a nice hockey stick.
We need a little bit of optimism. I feel like there's been a lot of serious stuff we've talked about today.
Let's take it. Yes. Thank you for the optimism.
Suzanne, what a pleasure. Thank you so much.
Thanks so much for having me.
Suzanne Clark, President and CEO of the U.S. Chamber of Commerce. All right, folks, back to New York headquarters of Bloomberg and a look at the markets. Here's Charlie Pellet.
I thank you very much. Do want to stick with the optimism theme, because right now we have got the bulls charging higher. The Dow, the S&P, NASDAQ, all advancing right now. S&P 500 index up 61. We are looking at a gain of just about 0.8%. Potential record close on the S&P at 72.62, where we stand right now. We've got the Dow Industrials up 308 on the Dow. That is a gain now of just about 0.6%, while NASDAQ higher by 250 points on the NASDAQ Composite Index. That is a gain right now of just about 1%. NASDAQ 100 Index also trading at a record, up right now by 1.4%. The SOX ripping higher by 4.8%. That is the Philadelphia Stock Exchange's Semiconductor Index. All of this against the backdrop of a VIX just above 17. 10-year at 4.41%, the 2-year 3.93%, and right now we have got the 30-year at 4.98%. Gold up $39 the ounce to $45.61, up by about 0.9%. Crude, major story today, relative calm returning to global markets, stocks higher and crude oil lower. 101.74 on WTI right now. WTI down 4.4%. Brent just below 110 right now. It is down by 4%. Bitcoin 81,345 on Bitcoin, up by just about 1.8%. We've got Apple saying it will let users choose from a range of outside AI services to power features across its software. Sources tell Bloomberg users will be able to select from multiple third-party AI models for tasks like generating and editing text and images. Right now, Apple is up by 2.1%. Recapping, S&P up 0.8%. Back we go to the Milken Global Conference in Beverly Hills, and your hosts, Carol Masser and Joe Matthew.
All right, Charlie Pellet, thank you so much.
Ready to go to space?
We're going to go to space. Charlie would have wanted to come with us here. I feel like, Charlie, you're gonna like this. We are going to go to space here to talk about another emerging technology, but it's also one that has been rather mainstream. And it's not just SpaceX. It's not just Jeff Bezos. There's a massive collection of companies that fulfill what we call the modern space industry. And one of them is Northwood Space, where Bridget Mendler is CEO and co-founder and joins us right now live from the Milken Global Conference. It's wonderful to see you and welcome. You actually control the ground infrastructure that helps to make satellites work. As I mentioned, it's not always the most obvious type of approach that your company has found something unique. When you're talking to business leaders here at Milken, what markets are opening for you? What does this mainstreaming of space mean for your company?
Yeah, well, thank you both very much for having me. It's fun to have the occasion to talk about space at a forum such as this.
Yeah.
And what we do is that networking infrastructure between Earth and space, so enabling all of the space missions that we are seeing commercialized, whether it's things like direct-to-cell applications, really expanding the telecom sector, or different national security priorities, or enthusiasm around compute and growing compute solutions from orbit, really bringing a lot of the industries that have typically been terrestrial into a more expansive architecture that goes beyond.
Bridget, got to ask you, because again, somebody like an Elon Musk and a lot of stuff that he is doing, whether it's Starlink, tell us how you differentiate what you guys are doing from a lot of the big players, so we understand exactly what this business is.
Yeah, and so what we're excited to solve with our company is the networking infrastructure for the industry writ large. We tend to draw comparisons to like an AWS platform, where you think about not everybody was able to have their own IT department and local data storage solutions, and so AWS opened up that solution for many more companies to grow and blossom. Think about the whole SaaS ecosystem that we've been able to see grow and expand as a result of that. And so for the space networking solution, the kind of nuts and bolts of that networking, it's not really a differentiated solution for a lot of space companies, but it consumes a lot of their time, a lot of operational overhead, complexity, and cost. And so for us, if we can do that at scale, provide it as a generalized solution for the industry, then that opens up a lot of different businesses to really grow their prospects.
I just have to acknowledge what everybody's thinking watching this right now. Yes, this is the same Disney Channel. You're a Disney Channel actress. You're an award-winning
Bridget, you have
singer-songwriter.
A bunch of fans around you. I'm just going to tell you.
You'll have
it's
a
a different generation from Joe and me.
So yes, this is the same Bridget. How do you go from that world to investing your life in a space company?
You
could be doing anything right now.
I think the space industry is full of people who are just extremely passionate, curious, and I feel really grateful to have discovered that community. And I also feel grateful that the world is kind of opening up its excitement around the mainstream aspects of this industry. Think about, Artemis this year. Think about SpaceX IPO.
Is there a halo effect from Artemis on all of your businesses?
I think what it points to is that these missions are becoming possible in a way that is more mainstream. And that's really the core of our business. The core of our business is how can we take all of these ambitious missions and get them further faster by providing the infrastructure that is kind of common and serves to be a strong foundation.
Actually, the Bloomberg team back home, they know my dad was involved in the initial space race, so we kind of grew up with this, and it's really fascinating to see it move so much into the private sector and kind of away from the government. Having said that, I'm curious about who's working with you, who are your customers, who's funding you, like what's the longer term plan here?
You've got a big round of funding.
Yes, we've raised around $140 million to date, and our customer base is very intentionally broad. We want to serve the whole space industry, and so that includes government customers that require ground connectivity for solutions ranging from launch to GPS satellites that power a ton of diverse applications terrestrially, to sensing applications. And then you have real commercial industry. So we're in communications with multiple public communications companies in space that are trying to resolve their networking infrastructure.
Where are you in terms of development and deployment? And just got about 30 seconds here.
It's a really big year for Northwood. We last year was about developing our very first site, our very first operational units. This year it's about scale. So we currently have sites in multiple continents, both in Australia and the United States. We're planning to be on 8 different countries this year and producing nearly 100 antenna units. So it's going to be a very busy year.
When are you going to space?
you know, that's what's
working on it,
next,
right?
That's
My
what
God,
this is all
exactly.
about.
One of our producers, James, I think wants to go to space too. I'm just going to tell you.
We'll put them together.
He's over there.
Producer James is actually with us at Milk, and I'm glad you pointed that out. Bridget, it's wonderful to meet you and great to see you. Thank you for all of your insights.
Thank you very much.
Northwood Space is the company. This is Balance of Power. She's Carol Masser, and I'm Joe Matthew. Great talk today.
Yes.
You're going off the panels. I'll meet you on Bloomberg TV and radio, 5 p.m. Eastern.
Want to go to space?
On the late edition of Balance of Power. Maybe we'll get to space. I don't think I want to go to space.
Not yet.
Charlie will have more on the markets coming straight ahead with us. Stay with us on Bloomberg.
Welcome to the second day of our special coverage from the 29th Annual Milken Institute Global Conference here in Beverly Hills, California.
Your name is Romaine Bostic.
It still is, Katie Greifeld.
I am Katie Greifeld. We have some big names joining us over the next 3 hours. They include Katie Koch of TCW, Manny Roman of PIMCO, as well as Rick Reeder of BlackRock. And that's really just a taste. We are packed with quality today.
Absolutely. And so let's get right into it. We're actually going to kick off the show today with Wall Street Royalty, the firm that Alan Schwartz built from scratch, flexing on two fronts. Its securities unit, it's been adding senior bankers across aerospace, software, consumer, expanding into Europe, all while a lot of his rivals are pulling back. The asset management division, they just closed one of the largest private credit raises of the cycle, and he's been building out his energy bench as the AI boom drives up demand for electricity. Alan Schwartz joins us now, the executive chairman of Guggenheim Partners. Great to see you, Alan.
Nice to see you, too.
I mean, you guys are no stranger to energy. You basically pioneered the 144A securitization. You have the Renua deal. You have to explain that to me with regards to the land lease financing here. But when you walk around this conference, it doesn't matter what business you're in. Everybody's talking about energy infrastructure in some way or another.
Yes. Well, look, we've had a few decades of relatively flat, demand for electricity, and all of a sudden we're electrifying the entire economy plus AI, and so the demand curve is moving like this, and we are far behind in the war to make sure that we have the electric power to allow us to compete, especially in AI, because if we don't have the power to compete in AI, as somebody said, it would be terrible to win the technology race and lose the power race for AI.
Wow. Is the capital there to do this?
The capital is there. Fortunately, if you go in the past when you had a new technology, for example, wind and solar, the government would create a credit. The credit would allow it to be deployed at a high price, but allow that price to come down through the development and the learning curve of pricing. The government can't do that now for some of the new power sources, but the large, data center users and, the hyperscalers have the capacity they can today pay the very high price that electricity will be, created at, and that will allow it to come down. So there's a very important point that we're getting pushback that the public's afraid that data centers are going to come and take away their power or drive up the cost of power. And the reality is we need them to be the ones leaning in to bring down the power curve for everybody else and the cost.
Well, that's exactly what I was wondering about. You think about the narrative that has emerged in the population about data centers, and there's a lot of not in my backyardism. And certainly, if you take a look at the map of where data centers are distributed, they're really concentrated in a few places in the country. And I wonder, obviously you see this as an opportunity for Guggenheim, but do you worry that, there could be some regulatory risk here, some political risk here at some point?
There is. The NIMBY movement is a concern, and it's actually backwards, is the point I'm trying to make. I mean, you look at Georgia, for example, which is the largest user, they're using the deployment of power to the data centers to bring down the cost to the average consumer. As I said, the government used to support it. Now they can pay the high price to get it created and come down the learning curve and make it available to the population. So it's the exact opposite of what people are concerned about. I mean, it has to be regulated properly for that to happen, but it's the exact opposite of what people are afraid about, and I think the message has to get out there.
Yeah, it's interesting. In some ways, it feels like it's parallel to the conversation that we have around institutional ownership in housing. Whether or not the facts back it up, there is that perception out there that that's driving up costs, and maybe that applies to energy as well. I do want to throw you a little bit of a curveball because we heard from BlackRock's Larry Fink earlier today on a panel saying that you think about the U.S. right now, we're short power, to your point, we're short compute, and we're short chips. And as a result, he believes that we're going to see an entirely new asset class in the form of basically buying futures of compute. And I wonder, when you think about...
Futures of what? I'm sorry.
Of compute.
Okay.
And, maybe you don't agree with that specifically, but do you think that, the forces that we're talking about are profound enough to be creating new asset classes here?
Yes, I think, whether or not we're going to have a specific futures market for compute or whatever it is, there is going to be a significant opportunity for a flow of capital into the things we need the most. We've gone through this period of, believing that we can get whatever we need from wherever in the country it's cheapest, and it will always show up on time and everything else. else. And now as we move into a multipolar world, there's an awakening that we have to be careful not to be dependent on one country to get everything we need to build our future. And so that reshoring opportunity is one where there's going to be a lot of opportunity for investment.
Speaking of opportunity for investment, obviously over the last few months, there was a lot of hand-wringing about the state of private credit. You guys just had a huge new debt fund, $8.4 billion or so, at a time where everybody's looking at this space and thinking, why would you be pouring money into it? The fact that you're able to raise that, the fact that that actually hits your hard cap, if I'm correct, seems to show that there's still a lot of demand out there for that. Why?
I think there's two things. Yeah. First of all, there's been a lot of demand. That is beginning to fade. Secondly, in our side on Guggenheim Investments, we did not raise a ton of private credit in the last, say, 6, 7, 8 years because we thought that the market was a little too ebullient. And so we've been going to other sectors where we can find opportunities. Now is the time to raise private credit capital to take advantage of what there might be opportunities if the private credit market cracks. And we are concerned that it will.
You are concerned?
Yes.
But to a point where it could be systemic? I mean, we should point out, I mean, you were, before Guggenheim, you were the last CEO at Bear Stearns. So, I mean, you had a front row seat to what was going on during that crisis.
Yes.
I mean, when people start talking about parallels between 06, 07, 08, 09, and today, is that fair?
It's fair. I don't think it's going to turn out to be anywhere near as significant. So it's fair in this sense. One, that whenever you have a sector that grows very rapidly that in the past has not grown so much, you have to worry about that. Is it going to have excesses? We've seen that in private credit. We had a tremendous increase in private credit after the financial crisis, which I read about, and a lower quality rating in that private credit market. So we've been paying a lot of attention to that, which is, I say, why we didn't raise as much, but also on the security side, paying a lot of attention. The recent, demands for getting their capital back has put some focus on it, and there are some tremors in that market. Now, systemically, I think it's different in this sense. One, I do think that a lot of the big players in private credit, the Apollos, KKRs, are very sophisticated investors. So I'm a little less concerned that there's going to be a rapid, or a big, huge amount of problem. Second, the last time in the financial crisis, it was the banking system that got paralyzed with all of these assets. The banking system is let's say, the arteries for the monetary authorities to put liquidity back in the system. So if the arteries are clogged, it becomes much more systemic. Now the banks who cut back on a lot of this are in very good shape. And so this private credit, I think, can be handled in a better way than the financial crisis was able to be handled.
Well, it's interesting. I mean, you mentioned the Apollos and the Ares of the world, and you're not really concerned about them as managers. But it was interesting. We heard recently from the head of spread products over at Citi warning basically about tourists in the private credit space, that you've had a lot of managers who spotted an opportunity there and came in a big way, and then maybe that's who you see come out. And I wonder if, you would list that as a concern of yours as well.
Yeah, I think so. And I'm not saying there won't be fractures in even the very good managers. They're going to have some issues. I just don't think they'll be, tremendous. The issue is we're seeing anytime you have an asset class that is illiquid and non-transparent, and now when you're getting redemption calls and you may get margin calls, the lack of any knowledge of what the market is or what that particular credit is, because it's not transparent, makes it a very difficult asset category to get, fixed, because there's no marketplace to go to. So it can spasm and create some, significant problems. I just come back to, we're seeing an increase in shadow defaults and things like that. So it's something we have to keep an eye on. And I'm not saying it's going to be really small, but I don't think it'll be systemic.
Well, Alan, I do want to switch gears a little bit, because we brought up 2008, and someone you saw in action in 2008 was Kevin Warsh. And
sure did.
Kevin Warsh, if all things go smoothly, should be the next Fed chair come this month. And, you think about the central bank makeup that he's inheriting here. 4 dissents at the most recent Fed meeting. You think about what a Fed chair has to do new. It's not just policy, it's also politics as well. So, you know, in your experience knowing him, how do you feel in terms of how he's going to be able to orchestrate all these differing opinions on the Fed right now?
Look, I have said this before. I don't think there's a better person to step into that role today than Kevin Warsh. He was the superstar, in my opinion, interacting with the government in the financial crisis. He's very analytical. He's a very analytical person. So people who think, oh, I'm going to come in with my desire and my demand are wrong, he's going to create analysis. Now, separating the near term, if he came in tomorrow, let's say, given what's going on in the energy markets, Iran, et cetera, he's very, very good at using the team to analyze what's happening in the markets. The near-term policies are going to be based on the data that they see out of that. But then longer term, I think that what he sees is something that I totally agree with, is that I think we've had a bigger productivity revolution than a lot of us realized was happening. And Kevin was seeing that. And that has impact on the way markets react to interest rates and the size of the Fed's balance sheet, et cetera. So I think he's got a vision of where we should be going long term, but he's not going to dictate it. He's going to bring the credibility of research to the team and the board to look at.
But when you say vision, I mean, if you take him at his word, this is potentially going to be a real philosophical change in the way that the Fed is led. Are markets prepared for that? Do they understand it?
I think that his point will be the markets will turn out to react differently than the models would say. Look what we've seen so far. What did we think was going to happen with the increase in tariffs, with the shortage of different things as we've talked about? But somehow corporate profits just keep going. Inflation hasn't taken off. The economy is going to, against all of these things that we think would flow through. So you have to rethink the models, and then you have to articulate it to the public.
We are getting a bit of a rethink in the philosophy behind monetary policy. Do you have any hope that we'll get a meaningful and, more importantly, a constructive rethink of fiscal policy?
I think that's very, very important. I think the challenge there is, as you say, the politics of getting a group of people in a room who are all there for the same reasons to come together on a change in policy is a little bit different than trying to get the Senate and the administration and Congress together. And we have a real issue with that. You know, one thing about it, it could become more important because I don't think people realize that post the financial crisis was the first recovery in U.S. financial history that we had an actual decline in consumer credit as a percentage of GDP. Every other recovery, there was more credit, more credit. So the government stepping in and borrowing more was actually in some ways a necessary thing. But it also created an environment where people would say, oh, as much as the government borrows doesn't matter. And on top of that, we had interest rate compression where they were able to refinance their high coupon debt with lower coupon debt. And so we went, I don't know, let's say 15, 16 years where interest expense was flat while debt doubled or tripled. So there's a complacency in the market that now consumers aren't going to keep delevering and interest rates are no longer able to refinance at lower rates, so that the pressure that could come from the market that would force some reconciliation could come. But I think without it, it's going to be very hard politically to find something that you can get a consensus around what to do.
Absolutely. Well, Alan, really great to have so much time with you this morning. That is Alan Schwartz. He is Executive Chairman over at Guggenheim Partners. Really fantastic way to kick off this program because we touched on a lot when it comes to, you know, the energy needs of this country, especially as AI becomes more ubiquitous, and a little bit of Fed policy there as well.
A little bit of Fed policy. It's a little bit of everything. And we've talked about kind of this sort of mashup of what we see Wall Street, Main Street, and now Washington, particularly with Washington now, really in the mix of it all.
Well, we also talked about private credit, and coming up, we're going to hear from one of the largest investment management firms in the country about what's ahead for both private and for public markets. TCW President and CEO Katie Koch, she joins us next. This is Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, succession starts now.
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
Katie Koch has sat at the helm of TCW, one of the country's largest investment management organizations, since 2023, and that was after a 20-year run at Goldman Sachs Asset Management. She's now navigating TCW's $200 billion plus in AUM through a changing market landscape, expanding into ETFs and private credit. I'm pleased to say she's sitting right to our right. Katie, it's great to see you.
It's so great to be here. Welcome to my hometown of Los Angeles.
It's a little chilly.
I know. This is actually bad weather for LA, so it is an amazing place to live, and we are so proud to have this conference here.
Well, I'm very excited to talk to you. This is my first Milken, but I was looking at some of the comments you made at last year's Milken, and what a moment, because you said that when it comes to direct lending, when it comes to private credit, that we are now going to start to see some of the accidents in this asset class. And sitting here a year later, it certainly feels like we've started to see that. But did it play out the way that you were thinking this time a year ago?
Yes, so we did say that we thought there would be accidents ahead last year. We have seen some of those. And now our outlook is we see tremendous opportunity, because as is usually the case, when other people are heading for the exits, that's why you want to get involved. And Katie, if I could, I'd love to give you a little bit of context on how we approach the asset class, and then maybe we can talk about what we saw last year, where we are now, and where the opportunity is, if that works for you and Romain. So just important to know about us. We've been doing this for 26 years, and that's important because 98% of managers in this asset class actually started post-global financial crisis. And so for those of us who've been doing it for 26 years, that means you've invested through multiple interest rate cycles, multiple economic cycles. You've had a lot of things go wrong, and so you've wanted to have the documents to get to the table and work out of those situations. It's a really important differentiation to have done it for a long period of time. The other thing I want to say about us is that we have a disciplined approach and highly differentiated outcomes. So as an example, we don't own any software.
Right.
And so people ask us, why is that? Did you predict you're gonna have to help me with this. It's SaaSpocalypse, which we did not, but because we keep our leverage at about 3 to 4 times, and the market went much higher, and because we have documents, and because we have very strong covenants, and because we stay disciplined on pricing, we just ended up not making loans to those companies, or you could say they didn't want our money because it was expensive with a lot of strings attached. Both of those things are true, but that's how we ended up with something very different. So I think we can be objective about what we see from here. And so maybe we talk a little bit about kind of what went wrong. Would that be helpful?
That would be. I'm very curious, to hear where you're seeing the opportunities, and also, that does imply a degree of confidence that maybe we've seen the bulk of these accidents so far.
Yeah, so I think it's also important to say, to keep this in perspective, private credit is effectively bank lending, which has been around since Mesopotamia. So if approached in the right way, it's going to work out just fine. This environment is going to, and all environments ultimately will reward disciplined lenders, and that's really what you need to look for. But there's no reason to panic here. We do think that just like it wasn't the golden age ever of private credit, now people are calling it radioactive. Like most things in life, that's not true. The truth is somewhere in between. And if you are with a disciplined lender with a lot of experience, you're going to be just fine in this asset class with great opportunities ahead. But I want to pick up on what you asked about in terms of what did we see and why were we worried last year. A lot of money came in quickly. And when a lot of money comes in and there's a lot of pressure to deploy it quickly, lending standards loosen. So it wasn't that we predicted some issue in a sector. We just said lending standards are loosening, and eventually that's going to show up with some challenges. And that's what's happened here. So now where are we? We are at a moment where manager selection is going to matter a lot. Yeah. The beta trade is over. It actually is very easy to lend money. The harder part is getting it back. And so people who have positioned themselves well to do that are going to perform. I think we're also going to have, I hope we've done some learning around sector concentration. This is leveraged finance. We make mistakes for sure, and things go wrong a lot, but you don't want to be concentrated into one sector.
Well, I mean, since Katie went back in time to last year, you also said last year, you talked about the asset-backed financing market. I think you said $1.5 to $2 trillion market, even though the addressable market could be what, like 20 trillion?
Much bigger addressable market.
Much bigger addressable market. So how much of that have you gone after in the past year?
We have built up a great asset-backed finance business where we do that in IG as well as more opportunistic. We have an interval fund in that space called TPay. We just reached our 1-year anniversary on it. And this is a good, so just taking a step back, you asked about opportunities generally. Asset-backed finance would be one. When you are late cycle, people, if you're worried about corporate credit, here's a way to get some yield, and you're taking a different type of credit, right? You're securitized against these cash flows, and you can invest across both the IG and the more opportunistic part of the market and produce a really interesting income stream. So this is a great complement to a fixed income portfolio. I just want to end by saying beyond that, in private credit generally, we also just see opportunity in new vintage direct lending, because if money is coming out, that means that you're going to be able to earn better spreads and you have a higher base rate. That's good. And then finally, we also see opportunities in rescue finance here. That's probably where we're deploying the most capital.
But on that point, and this is more of a risk question, and forgive me if this is a bit out of left field, but I am curious about your relationship, TCW's relationship with Nippon Life, and how that sort of relationship works in terms of discussing the amount of risk to take on at a time where there still is a lot of uncertainty as to how all this shakes out.
So we're very proud to have Nippon Life as a partner. They've been a long-term shareholder of TCW. So just for everyone's edification, TCW is a privately held company. This is one of the reasons why we produce such highly differentiated portfolios. Because we're privately held, we can think very long-term. And we have some tremendous partners. Nippon Life is one. They are the world's largest life insurance company. Very proud to have them as a partner. And they are one of our largest clients, too. And they are looking to, in their life insurance general account, like many life insurers across the world, they're looking for ways to diversify and pick up additional income. And so they are invested in our private credit products, both direct lending as well as asset-backed finance. And life insurers in general are really good matches for this asset class because of income needs and also because of the length of the liabilities.
And maybe this is out of left field too, but I've just been turning over.
I can't wait.
I've been turning over what you were saying about, you think about a lot of the folks who are now in this space, 98% of them, when it comes to direct lending, when it comes to private credit, they entered after the financial crisis. And I have to imagine, or it'd be really interesting to see what that number looks like when it comes to just the past 5 years. We were talking about tourists and private credit with Alan Schwartz in the previous segment. And I do wonder whether we're entering into an environment that could be conducive to more consolidation in the asset management industry, especially when you think about private credit and how many more managers there are there now?
The way that we think this is likely to work out, again, there's no reason to panic here. I do think that whenever an asset class experiences a moment of glory, which for us was, 20 plus years in the making, it does bring in new entrants. That's kind of the history of Wall Street, right? And so the way this is going to work out is that, yes, maybe there's some consolidation, some managers go away. I don't think that's going to be the majority of what's out there. There's going to be some folks that are going to produce, mediocre average returns. And so some of those clients may say, do I really want to be locked up, pay these fees for those returns? There could be some of that reaction. And then there's going to be some people that really differentiate themselves in terms of returns and risk-adjusted returns. And, obviously we aspire to be in that group of people. So you're going to get back to this conversation around manager selection mattering. I also just want to make a plug here for public fixed income markets, which got left out. Which is, it is the largest market. It's something that we're really excited about at TCW. You guys mentioned at the outset that we've built out our ETF franchise. So we have built out our active ETF franchise at TCW. And the three main areas we're focused on is income, so I can talk more about how we're positioned in the liquid bond market if that's of interest, power, and AI. So which one of those should we pick up on?
Well, it's going to break your heart here. But
okay, are we done?
We're out of time.
Okay.
We would love to keep going here.
We just have to have you back. Should
we do that in New York?
Yes, absolutely.
I'll be there this summer. I so appreciate the opportunity to be here, guys. Thank you so much.
And we really appreciate you having us, particularly in your hometown. Katie Koch there, the president and CEO over at TCW. I think she says she's coming back.
I feel hopeful about this.
Before your baby.
Yes, please.
All right, when we come back, we're going to talk the travel and leisure industry with a giant in that industry, Eric Resnick over at KSL Capital Partners. We're going to catch up with him when we come back after the break. Live from the Milken Conference here in Beverly Hills, California. This is Bloomberg.
A world where an analyst who previously covered 20 stocks could cover 200 because they are maybe managing a fleet of agents that looks at all these stocks and tracks them. So I actually think it's going to reshape how we do things in the long term.
One of the things we struggle with is it's very easy to get siloed as an analyst, and these are the sectors I look at, these are the tools I rely on, these are the models I've built, and for us, we are spending more and more time as a research team collaborating around ideas with multiple people looking at sectors or trying to solve key questions or things in the market. And so the ability to have standard tools that we're all using to track lots of different things, to inform how the models are trained, will be super helpful, I think, in people being able to pick up someone else's work and say, I totally get this because it's in the same vocabulary that I do it myself.
In case you missed it, on the opening trade.
Our revenue has now hit 30 billion in run rate, and we're seeing really significant demand customers like Spotify, Lovable, for example, that are really using and harnessing the power of the technology. 2 months ago, we had 500 customers that were spending over $1 million with us. That's doubled in size just in the last 2 months. So we're really seeing a lot of amazing growth.
Don't miss the opening trade, live every weekday.
You don't think the court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
Is integrated into every aspect of our lives, from finance to defense, AI to entertainment, and from the road to the stars. Bloomberg brings you the latest stories from the people and companies pushing the tech sector to new frontiers and the politics that shape global tech markets. I'm Tom Mackenzie in London. Watch Bloomberg Tech Europe. New episode Friday, only on Bloomberg Television.
All right, let's talk the business of travel and leisure. Eric Bresnick has spent his entire career at the intersection of mountains and money. He started at McKinsey, moved to Vail in the 90s, and helped run a KKR-backed hospitality platform before co-founding KSL Capital Partners back in 2005 with a singular thesis that travel and leisure is one of the most durable growth sectors in the global economy. Eric joins us here from our stage here at Milken. Great to have you.
Oh, great to be here with you, Romain and Katie.
We talk about the durability of that, even, of course, with all of the talk right now about macroeconomic concerns. That holds up?
It really does.
Yeah.
And if you think about, those who, are fortunate enough to be doing well in the economy, and obviously the K-shaped economy is a real thing, but what they really want to do, they want to spend time with those they care about, doing the things they care about, and the number one thing they care about is experiences, health, wellness, and travel fits squarely within that.
I want to talk about your crown jewel, which is Alterra, the ski, kind of a roll-up of all these ski resorts into one, Icon Pass. You just had a big CEO change, or got rid of your CEO. Talk to me a little bit about the health of that business, not so much just from the consumer perspective, but also just from a cost perspective.
Well, Jared Smith did a great job for us for the last 4 years, and we're looking forward now to hiring a new CEO over the next 6 months or so. We're in that process. That business is incredibly healthy. It was not a great ski year, just to be clear, in the Western United States.
Well, Mother Nature was not working on your side.
was not kind to you if you lived in the West, and if you lived in the East, it was a great ski year, and throughout the Northeast and the Mid-Atlantic. But we're actually still skiing at Camelback in the Poconos, believe it or not, today in May in Pennsylvania. It never happened before. But the cost pressures in that business are real. But fortunately, we've been able to have reasonable pricing ability to be able to pass those costs on and still be able to provide a great experience for our guests, and to be able to continue to build out those mountains.
But I'm curious with the business model. Obviously, a big part of that business model was the idea of selling the passes, getting that money sort of locked in up front. Of course, people get grumpy when they realize, okay, I can't get to the mountain because it didn't snow or there wasn't cold enough, and obviously you're not getting really refunds from that. So how do you square that? Because at some point you do get pushback from your consumers.
Well, I think the consumer recognizes they're getting the benefit of a trade, which is they get incredible variety and the opportunity to ski really anywhere in the world. We have over 70 destinations on the Icon Pass. I mean, some of the best resorts in the world and in all the critical ski markets. And the trade for that is that they get the best deal if they buy it up front. They buy it in the spring or they buy it in the fall before the season starts. And so the trade-off for them is, they're taking a little bit of that weather risk in exchange for the great value that they're getting up front. And I think overall, even in a year like this year, the average person who bought the Icon Pass is still going to be skiing about 8 days, which is still a great value for them. And certainly we hope that next year they're skiing 10 or 12 days and getting even more value out of the product, and I suspect they will.
Well, weather aside, I do want to talk a little bit more about geopolitics, because you can have a conversation around fuel, but then there's also just, the human concerns about traveling right now, especially when you take that global perspective. And I wonder if you're seeing any sort of ripple effects from that, any changes in behavior from this 2-month war.
You are. I mean, you generally, the WTTC generally says that when you have geopolitical upheaval, it takes about 2 months to recover. And in fact, that's exactly what we're seeing. At the trough, we saw bookings down 16% across all of our hotels and resorts that we have around the world. This past week, we were up 8%. So it's taking taken about 2 months. So we went from, we were +5 to start, down 16, now +8. That's week over week, meaning back to last year. And so we're still +2 for the year at this point. So we think that, yes, there's been shifts. International's down more than domestic. So the consumer's still traveling, but where they're traveling is shifting a bit. The American consumer that last summer was going abroad a lot, this summer I suspect you're going to see them stay a little closer to home. And so you'll see puts and takes, but overall, the overall demand picture actually is still quite healthy.
All right, Eric, we have to leave it there. Really appreciate you joining us today.
No, great to see you guys.
Eric Resnick, the CEO over at KSL Capital Partners. About a little after 11:30 here in Los Angeles. We do want to check in New York with where equities are. And Katie Greifeld, we are setting up for yet another record high. I mean, we talk about the concerns about what's happening in the Middle East and the macroeconomic picture here in the U.S. And yet for investors right now, this is still about corporate earnings, and they're still there.
Yeah, much different photo than what we were looking at this time yesterday. The S&P 500 higher by about 0.9%, and you can see that it's big tech reasserting itself, higher by about 1.5% when it comes to the NASDAQ 100. It probably helps if you take a look at the bottom of your screen that you do have Brent lower by about 4% today.
This is somewhat of a narrow rally, too. We should point out the Philadelphia Semiconductor Index up about 5% right now, so a lot of people piling back.
What about the transports?
In the chip stocks, and they're there. Thank you, Katie. You caught me off guard. Transports are up 2%. How about that? Yeah, look at that. I just keep that. I should just highlight that one in yellow for you here. But that's a quick look at the public markets. We do want to continue, though, given where we are here at the Milken stage, talking about what's going on in the broader markets as well, in the private markets, too. And that brings us to our next guest. Hepson Uzan is the America's CEO over at DWS, the Deutsche Bank-backed asset manager with more than 1 trillion euros under management. And the U.S., it's the firm's top growth priority. And Hepson is in one driving it, overseeing the expansion of X-Trackers. That's ETFs, Katie Greifeld.
Indeed.
Europe's third largest ETF platform, and they're actually moving into the U.S., plus a $100 billion euro alternatives business spanning infrastructure and real estate. Hepson, great to see you again.
Great to see you, Romain. Thank you for having me.
So you took over the Americas business, about 16 months ago. I don't know what playbook you came in with, but a lot's changed over the last 16 months, as you know. Has your vision changed?
No, I think in these markets, being disciplined and consistent is the key. We continue to give the deliberate message as we did after our first quarter earnings.
I know you're building out the Americas business, but I do want to talk about the products you have in Europe, because there has been a lot more interest in those products, given what's transpired over the last 16 months, from the whole tariff issues last year to now what's going on in the Middle East. Europe defense tech is hot. A lot of European defense sectors are hot right now, and you're rolling out new products in that space.
Well, when you look at our X-Trackers franchise, you see that a lot of people are actually getting out of the traditional asset classes. For example, when you looked at our World ex-US ETF in actually Europe, has tremendously grown closer to almost $8 billion. So those are the asset classes. So people are not getting out of ETFs. They are being more deliberate and demanding more from the product line.
Well, as you know well, I mean, the ETF industry is fiercely competitive. And I wonder, how you're positioning X-Trackers. When are you thinking about distribution, when you're thinking about potentially model portfolios and the like? Because you think about the U.S. again, that Eric Balchunas of Bloomberg Intelligence calls it the Terror Dome, and Europe as well is also very, very cutthroat.
All of the above. I think the product manufacturing is critical, but it's your reach, right? And it's your credibility. When you think about what's happening right now and what we are hearing at Milken is, I'm sure you heard about the private credit, but one of the things that's basically emerging is also, how about global markets? Is U.S. actually paused? I think it's not ending, but in global markets, I think the individuals are pausing on U.S. market, and that's a huge opportunity for DWS, because we sit at in the middle of Europe and U.S. We have Deutsche Bank heritage, deep U.S. franchise, and expertise.
How does that stack up against, when it comes to what we've been talking about, when it comes to energy prices? The idea that the U.S. has been pretty well insulated from this energy shock that we're seeing unfolding around the globe, but it's a different picture when you take a look at Europe. Of course, much more directly exposed to what we're seeing there. Certainly diversifying out of the U.S. has been a great trade over the past several years, but, how much runway does that truly have left if we see this conflict in the Middle East continue for the next several months?
I think one of the biggest lines that I heard here is that the has what's going on at Hormuz been priced in yet? Because as we know, energy prices impact the earnings, and that will be an impact to how the markets will be reacting. And I think for Europe, that is critical, and that's why we have the deep expertise to make sure that we will shift our strategy accordingly.
Is this a sort of a structural shift, though, too, in terms of what we're seeing? And are you seeing more U.S. investors really pursuing that geographic diversification outside of the U.S.?
Exactly. Yeah. I mean, when I hear about from institutional clients, it's not like how much more U.S. Is that what's next? And I think that's a structural shift that we haven't seen for more than 3 decades. I mean, Japanese rates are real. European rates are very competitive. Yeah. And I think investors are paying attention to that.
What about U.S. rates? I mean, the general consensus here is that we're going to see downward pressure on Fed rates, presuming that Kevin Warsh gets his way. I guess, A, how does that affect your business, if at all? But more importantly, how does it affect that reallocation of capital?
Well, look, I think ECB has much more room to navigate than the Fed has, and that definitely plays into our hand. And like I said, I think the impact of what's happening in Middle East has not really been priced in. And I think that's what's being talked about in the private markets right now. And I think in the private conversations that I'm having in Milken, people and smart investments are moving out of U.S. Again, it's not outflows from U.S., but how am I locating my inflows? I think that's the conversation we should have.
Interesting. Well, I mean, when you think about the whole world outside the U.S., that is obviously a very big umbrella. I mean, talk to us a little bit about what you're seeing for Europe, for example, versus emerging markets or Asian economies, or where are you seeing that interest when you do have those conversations about diversifying?
As you know, we opened our Abu Dhabi office over the last year, and we're having very constructive conversations with our Middle East investors, and that is real. And a lot of our investors, especially from APAC and Middle East, are very much interested in our private credit and infrastructure business focused in Europe. And that is definitely a shift that I'm seeing.
Well, compare and contrast, you know, all of the noise around private credit when it comes to U.S. markets versus, you know, the demand and the conversations that you're having around private credit when it comes to Europe. Are you seeing those same sorts of concerns come through?
Not exactly. I think that there's a pause. And when I think about actually the concerns that are being private markets, I don't see that as systemic. It's more about, I think, the credit markets maturing, right? I think what I'm more concerned about is the democratization of alternatives. Has that gone too fast without actually the investors being educated enough? I think that is what we are seeing right now. And if you look at the first quarter, the private credit, obviously, outflows impacted our, for example, high-yield ETFs as well. Not because there was actually a systemic problem, but it was the noise. So I think the alternatives investor education, especially in retail markets, is going to be critical. That's what we are being very, very deliberate about. And also I want to highlight about what's in everyone's mind, right? Right now, it is incredibly important as investors for us to be disciplined. That means income and liquidity. And the income needs to be actually coming from 4 asset classes, right? Short duration credit, municipals, real assets, and infrastructure-linked investments. Those are the 4 areas that we have deep expertise in DWS Americas. So that's what I'm really, really focused on.
All right, Hepson, that's a good place to leave it. Really great to get some time with you. That is DWS America's CEO, Hepson Yuzcan. Really interesting conversation. And it's interesting to hear, you know, and this is a common thread, all of this focus on income. Even still, when you have the S&P 500 at all-time highs, you have credit markets pretty much, you know, not, some would say complacent. Income.
It's called cash.
Yeah.
Cash is king.
People want it. I know. But, you know, you take a look at the S&P 500, the time that we've had, typically you think about income as being a little bit more defensive. So still that bid out there. But still ahead. We're going to talk about how Fortress is shielding its portfolio against AI crosswinds and market swings. Jack Newmark, he is the co-CEO of Fortress Investment Group. He joins us next. This is The Close on Bloomberg.
tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
In case you missed it on Balance of Power.
Obviously, the aim ultimately of this mission is to make advancement enough that this becomes something that is much more frequent, that we have a permanent base on the moon, that people are constantly shuttling back and forth. Would you describe this mission as having been a major step forward? How much faster will things be able to move from here?
Well, I hope a lot faster. Finally, we're flying again. The new NASA administrator had I thought, a great kind of light of fire speech under folks at NASA. We're going to start flying a lot more often, and he's absolutely right about that. Hopefully, NASA's date is next year. Our next flight will be with the landers in Earth orbit, and then the flight after that will be with a moon lander that will actually go to the moon and land on the moon. SpaceX and Blue Origin are the two contractors for those landers, but this is a great first step. There's going to be a lot more test flights and then finally landing on the moon, and I think we have some momentum. Like Austin Powers said, we have our mojo back.
Don't miss Balance of Power live every weekday.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation. As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlett Fu, who's taking a closer look at drone companies. With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every Wednesday at noon Eastern, only on Bloomberg Television.
All right, let's get right back to it. Marcelo Clara is one of the most connected operators in tech and private equity, the former CEO of SoftBank International. Before that, orchestrating that $26 billion Sprint T-Mobile merger. Today, he's a partner and co-chair over at Brightstar Capital, founder and CEO of the Clara Group, and vice chairman of Shein and the largest independent shareholder of T-Mobile. Marcelo, great to have you here.
Great to be here. Thank you for it.
I want to talk about AI, not so much as the AI build out, but how AI and that technology gets integrated, particularly into your portfolio companies, how fast that is going, and more importantly, what's the purpose?
So I think the time of the application of AI has arrived. I mean, if you look what has happened over the course of the last few years, everybody's been investing in what we call the AI factory. Data centers, semiconductors, power, LLMs, applications, all the exciting development of what I believe is the most powerful technology. But now the time has come of how do we apply that technology to our businesses. If you look at the numbers are huge, right? If you look at the latest McKinsey estimate, they say that the value of AI will reach up to $8 trillion in P&L impact per year. I mean, multiply that by multiples, and that's a gigantic jump in our GDP. And what's interesting is they expect that 70% of that will go to incumbents, to everyday businesses. So I think the time has come now for that technology to be able to be applied to businesses. And I think you're starting to see some amazing developments, I think, over the course of the last few months. And the future is going to be about the application of AI.
Well, I am curious about what you're investing in and how you look at it, and particularly in light of the news that Eric Epstein over Davis and Kempner is joined earlier this month here. What does that signal about where you want to take Brightstar?
I mean, obviously, we joined Brightstar because when you have a technology revolution like the one we're having right now, this will become an exponential opportunity for some, hopefully for us, an existential crisis for others that are not being able to adopt this technology. So what we're doing is we're building a great team. I think bringing Eric to the team is an incredible accomplishment for the management team of Brightstar. He's one of the leaders in the private equity space, and having him take a prominent role within our private equity is an important piece. It is only the beginning. We have a lineup of stars who believe in our strategy. Our strategy is very simple. We buy good businesses, we apply operational transformation like we've done at Spring, like we've done in many companies in our career, and then we do an AI intervention. We were able to see firsthand.
An AI intervention,
yes, and we've been able to see firsthand this. We've seen it in T-Mobile. T-Mobile is probably one of the leaders in terms of applying AI into their business.
Right.
We were the early starters for Sprint when we started using AI, when AI was not such a thing. And I was very lucky to be part of SoftBank in a time where we started talking about AI in 2014, 2015. We talked about the concept of singularity, which today has finally arrived. So I've been lucky to have seen what AI can do to businesses. So now the time has come to buy good businesses and make them great by applying AI both in not only in cost, in productivity, increasing revenue, and so many different areas where AI will be a game changer.
Well, let's talk about that a little bit more. You know, the playbook you have of AI intervention, I believe you called it. It sounds like basically infusing AI to boost productivity. What types of companies have you found are most ripe and stand to benefit from that?
Let's make sure that people understand the technology is ready and technology works. So the first business that we bought is in the UK. It is the UK's largest for-profit university. It's Arden University. It has 50,000 students. We did a partnership with some of the leading large language models companies, and what we're doing is we're redefining the entire journey of students. First thing we're doing is every single student that graduates now graduates with an expertise in AI. When I hire people at any of our companies, the first thing that we ask you is, how well do you know AI? How well do you know how to apply AI in your field? You know, when you hire now, when a psychologist comes through our curriculum, we teach our psychologists how to use AI in their field. And then as we hire people, if you listen to Jensen speak the other day, he says, bar none, the people are going to be hired, the people that know how to use AI. One of the hottest jobs today, we call it the master agent. He's the one that knows how to make agents and manage agents. So that's an important piece. Secondly, we're redefining the entire journey. We're recruiting people now utilizing AI agents. We're onboarding. The interviews are going to be done by an AI agent. And more importantly, as we teach students the future, now we're going to start using personalized learning. We've been teaching people the same way for the last 2,000 years, and that is one size fits all. With AI, it gives you the ability to teach you based on your skill set. So that is the first deployment of AI that we're doing. We're also doing it at the educator. I mean, 50% of the time an educator spends, they're spending non-value-added activities, marking, grading, and all that. AI can do a much better job than that. So that's the first business. We have a lineup of businesses that we're buying, that we plan to buy, and we look at businesses where technology is ready and we can apply AI to create